Watch them as well. And then Santander out with earnings, saying they had a strong start to the year, growth in customers and revenue, and backing their targets despite the global economic uncertainty, Tom.
Oil started the session a little weaker, at least started the morning a little weaker. That has changed. So Brent is up 1.3%. The open is right now, as we look at the equity markets and, of course, the linkages to the oil story. So up 0.4% on the FTSE 100, and we'll see to what extent the energy sector plays that role in terms of supporting the broader UK benchmark in the session today. Across the headline Stock 600, you're seeing very, very modest gains, just a couple of points right now. We're waiting for the DAX and the CAC current to open as well. Geopolitics, of course, remains in focus with the war in the Middle East, but also the meeting of the G7 foreign ministers in France. The CAC current up 0.1%. The DAX is currently a little negative, currently flatlining on the German index. The IBEX over in Spain up 0.3%. But again, there doesn't seem to be a significant amount of conviction. Yes, the sentiment has turned from the negativity of yesterday, but you're only gaining across the benchmark just shy of 0.1%. Given what could happen over the weekend, of course, when it comes to Iran, the decision-making of the Trump administration, maybe it's not a surprise that there isn't significant conviction across these markets, at least for now, Lizzie.
Well, it's very strange when I'm looking at the sectoral breakdown today. I'll start by saying that you've got half of sectors in positive territory, half in negative. Basic resources leading the gains, up 0.5%. But you'd flagged energy, Tom, because we have got Brent past $109 a barrel now, up more than 1%. And yet energy is the 17th out of 20 sectors. It's one of the worst performers this morning, down 0.3%, which is strange, right? And we look at that breakdown geographically across the continent. The FTSE is outperforming. It's up 0.5% compared to the Stock 600, as you say, up 0.1%. So I want to dive into some of the individual energy names, but Total, BP and Shell, indeed, all in the red this morning. Some of the individual stocks that I had said we should be watching: Pernod Ricard up 2.9%, Novartis, more M&A there, up 0.25%, and so interesting moves there following the broader risk on move, but with some individual idiosyncratic stories for those stocks to watch.
Let's bring you live pictures right now from just outside Paris, a couple of clicks outside Paris, where G7 foreign ministers are meeting right now. Marco Rubio, of course, landing in early morning, around 2 a.m., according to Oliver Crook, who's on the ground. You can see that live picture right now. G7 ministers, of course, meeting. There's Marco Rubio with the bright red tie, of course, alongside his counterparts from the UK, France, Germany, Canada, of course. There the camera is pushing in to Marco Rubio. And so that is the focus, of course, in terms of how those conversations evolve with the Secretary of State of the US, no doubt bringing a message that is going to try to convince those members to join US efforts to try to contain Iran. We know that the US is unhappy that NATO members and EU allies haven't done more, as they see it, to support the US in that conflict. But we know the Europeans as well have their focus on Ukraine, Lizzie.
Yes, indeed. Well, let's get further market analysis now. We have Fabiana Fedeli joining us from M&G Investments. She is, of course, Equities and Multi-Asset CIO. Fabiana, taking in the geopolitics and looking at how markets are performing into the weekend. I know you tend to advise looking through geopolitics, but is this war an exception?
It is different from the geopolitics that we've seen in the past, Lizzie. In the last 2 years, we've seen geopolitics that didn't really have an impact on either credit conditions or earnings, and those are the two transmission mechanisms on risk markets, whether it's credits or equities. Now there is a powerful transmission mechanism, and that's energy prices. So the longer this conflict lasts, and also the more the damage to the energy facility, obviously the more impactful that transmission mechanism is going to be.
And so when you look at the equity picture so far, has it been complacent or is it resilient?
So that is very interesting. I think this market has actually told us what we already knew from the past 2 years, which is that the playbook of the risk, the flight from risk to safety and the traditional safe havens are just not working anymore. I would say that equities have been calm given the situation. I would also say that that flight to the US dollar, yes, we've seen the US dollar, the typical safe haven, up, 2.4% versus currencies globally. That's not a lot if you consider what is happening in the world right now. And it's only up 3% and a little bit versus emerging market currencies. Emerging markets would have been the typical beta trade in a situation like this. So that playbook where yields are going down because of the flight to safety, it's simply not working anymore. And investors are looking more for diversification as their best way to keep their portfolios resilient.
How does that story evolve if we got one of two extreme different scenarios? One, there's an agreement between the two sides before April the 6th. Two, you see actually members of the US military on the ground in Iran. How would that change your thinking, those two potential outcomes?
Well, that is really the issue here, that we don't know what those outcomes are going to be, and it's so binary, right? At some point, this conflict is going to end, but we don't know when. We don't know with what level of damage. So it is very difficult right now taking a position on the market only based on oil prices. You need to go one step beyond that. You need to still think about the longer-term themes that you believe will continue to be valid after this end. And so think about this. Energy security is coming to the fore. It's really important. The G7 are getting together. That is going to be a big part of what they're going to talk about. Think about infrastructure. There's a lot of rebuild and also resiliency that has to be put into that infrastructure. And think about innovation. Companies are finding their markets being completely fragmented. And so innovation is going to help them to have more pricing power.
Where else are you finding balance sheet resilience in this environment?
You know, the interesting thing is if you look at the overall indices, the volatility has been quite limited given what is happening. But when you look at under those indices, you look at the stocks within different sectors, the dispersion in price behavior has been significant. Think about sectors such as technology, but also in consumer, in industrials. And you've seen also sectors that are not behaving as you would expect, such as, for example, the energy sector as of late. So there is a lot of balance sheet resiliency, but it's really, and again, we talked about this in the past, is stock by stock, security by security exercise.
I just want to come back to the dollar because Hugh Gimbo was on earlier, and he didn't say this on air, but it is in his notes, that investors will prefer to deploy capital in their home markets the longer this goes on, which would then weaken the dollar. So do you believe that? And ultimately, does that mean that the war becomes a sell America story?
Look, I'm not sure if it is a on-market bias, but we've seen, for example, from European investors that they're far more willing to invest in Europe and away from the U.S. than they were in the past. So they've come from very overweight positions in the U.S. to a much more diversified portfolio when it comes to risk assets. And I'm not really seeing that change.
I want to get your take on what's happening in the credit markets, because there is a link, obviously, in terms of what we're seeing on the geopolitical side, yields higher, repricing across the curve, and how that is reflecting across credit markets as well, at a time when we already have that AI software disruption. How concerned are you about what's happening in private credit? Is it a systemic risk? How close are you watching that?
So we're concerned. We're watching it very closely. It doesn't appear to be a systemic risk now, as of now. But clearly, some of the volatility you've seen on the credit side, also in public markets, is probably due as much to what is happening in the private credit market as much as to the war. And so we need to really make sure that when we invest, we know what we're investing in, because not every security out there is the same.
But are you worried about contagion to European banks? Because many guests will argue that we're less exposed here than in the US.
We're definitely less exposed, and there are other factors that are coming in. I mean, one of the things that we've been looking at as of late has been the impact of savings that for some banks have come from the implementation of artificial intelligence on their costs. I mean, there's so much more that is happening to banks also in Europe that can offset a limited contagion from the credit side. It's all a matter of relative impact.
What assumptions are you making about central bank reaction function? The assessment seemed to be very broadly from Fed speakers and the ECB yesterday were on hold. And the BOE voices that we heard from seemed to be suggesting that maybe the markets were overpricing the number of hikes.
But just a week after they were sounding oh so hawkish on both sides of the Atlantic.
So how do we think about the central bank reaction function? Are markets accurately pricing right now how central banks react to this?
I think they're actually pricing the fact that even central bankers don't know what's going to happen. Because it all depends on the oil price, energy price, gas prices. And we still don't know how far this is going to go in terms of the damage to the facilities, in terms of the duration of the war. But right now we're at a time of uncertainty, both on the side of central banks and obviously investors. And that's why we say do not take directional trades based only on where oil prices are going to go, because the conflict could end tomorrow or could last much longer.
Appreciate the honesty, Fabiana. Brent at 109.30, up 1.2%. Fabiana Fedeli, Equities, Multi-Asset and Sustainability CIO over at M&G Investments. Always a pleasure to have you with us.
Let's bring you some breaking lines right now. So red headed across the Bloomberg terminal, China starting retaliatory trade probes against the US. We've forgotten, of course, trade very much has been put to the sidelines, but shouldn't have been, arguably. The focus, of course, rightly so, on what's happening in the Middle East. But trade has been a theme, of course, over the last, well, since President Trump took office, and continues to be there. And this is a reminder that this story is not going away. So China starting a retaliatory trade probe against the US. This is in retaliation to the US 301, Section 301 probes, according to China. China saying it strongly opposes those 301 probes. It can take corresponding measures depending on the probe/investigation. So this is a reminder that China is looking to ensure it has the tools in place and a bit of leverage, arguably, as well, ahead of that meeting between President Xi and President Trump in May.
While we've got the MSCI Asia Pacific Index down 0.5%, in fact, we've got the Hang Seng Index up 0.4%, and the CSI 300 up 0.6%. But taking our focus back to Europe, let's just check in on the core six on this Friday morning, shall we? 8:11 a.m. here in London, and we have Nestle, the only member of our core six, eking out gains this morning, up 0.3%, but losses here for LVMH. Novo's losses pronounced here, down 2.5%, but in the red as well for Rheinmetall, ASML and Schneider Electric. But let's get a check on some of the other individual stocks on the move this morning with Louise Moon. Louise.
Starting off with Pernod Ricard, shares into the green. This is after talks that they might merge with US liquor giant Brown-Forman. Now, this is kind of echoing the moves that we saw in Brown-Forman in late trading in the US last night. Their shares also rose on the back of this potential deal, so showing that shareholders are welcoming this as they're both trying to strengthen their businesses against a weaker consumer, particularly for the alcohol space. So shares up almost 4% into the green on the back of that. AstraZeneca seeing similar moves, also up over 3%, almost 4%. That's after one of their drugs for a deadly lung disease, saying that this reduces flare-ups. Now, this again is them moving into new spaces, trying to kind of bolster themselves. And this drug in particular is projected to have huge revenues. So good news for AstraZeneca. Shares ticking up higher into the green as a result of that. Next, we're moving to Poland. Polska, the supermarket operator, shares plunging down into the red, over 15% lower. That's after their earnings, showing that costs are higher, guidance is seen as negative, a record low margin. So really dragging down their share price this morning as it opens. And then finally, moving to Rio Tinto here in London, the huge mining company Rio Tinto, only slightly into the green. That's after they've been raised to an outperform at Macquarie. And this would imply, Macquarie's new price would imply about 10% higher than their last closing price, but only slightly taking them higher into the green. So we'll be keeping an eye on that to see if that moves further upwards today.
Louise Moon, thank you very much indeed on Stocks on the Move this Friday. Coming up, a turbulent month, of course, for oil traders, to say the least, as the Iran war drags on. We're going to take a closer look at the outlook. Macquarie saying you could get to $200 a barrel, a record, if this conflict continues into June. We're going to get the latest from the Middle East. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romain Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
As I walked into the Bloomberg building this morning, futures were in the red. You've just told me futures are in the green. You're getting whipped around on truths, on tweets, on these kind of news flow, which, with the best will in the world, none of us can predict at all. So I think a lot of it is about trying to square the position and just being very, very humble around the things that we don't know at the moment.
You cannot invest for the tomorrow or the next day at the moment. As we look forward, we think there are tremendous opportunities caused by the volatility, the dispersion that's building both through geopolitics, through economic concerns as well.
The recent developments just showed that Europe is a bit more fragile and vulnerable, but overall, if we have de-escalation, that is positive for the risk on.
We're likely going to move to a lower intensity war that will mean that Iran will continue to disrupt the region with occasional drones, with disruption of the Strait of Hormuz. That means we're not going to go back to a time where the strait was fully open. So I think we have to assume the base case is ongoing disruption.
Keep your strategic vision and don't get dragged into the short-term movements, because as we've seen from yesterday to today, it's just massive swings. Stick to your guns, don't get dragged in.
All right, some of our guests this week weighing in on, of course, what was another volatile period in markets. Let's check in the markets right now. We've seen volatility again. We were leading up to this session with futures pointing higher by 0.2. Right now, European stocks across the benchmark are down 0.3%. As you can see, the FTSE 100 is holding its head just above the water, though, up 0.1%, helped by what's happening in the energy space. The DAX over in Germany is down 0.5%. That's where the biggest losses are coming through across the region right now. Over in France, the CAC 40 is down 13, almost 14 points. We're seeing a bond sell-off as well. It's not dramatic, but it is there. There had been some drama in JGBs, and you're seeing that reflected to some extent in the sovereign debt of the Eurozone and gilts in the UK. Yields are up 5 basis points across the curve, Lizzie.
Well, one stock that's managing to gain this morning is Pernod Ricard, up more than 3%. Pernod and Brown-Forman, the owner of Jack Daniel's whiskey, of course, have confirmed that they are in merger talks. In a statement, Pernod said that the partnership would be akin to a merger of equals, and Bloomberg understands that the transaction being discussed has a significant stock component. So let's get more detail now with Manuel Baigorri, Bloomberg's deals reporter. Hi, Manuel. So just talk us through what we know about this potential acquisition.
Yes, Lizzie, what a fascinating transaction here. We've been following both companies separately over the years. Pernod Ricard has been quite active on the acquisition front, buying different brands globally. Brown-Forman has been, talked about a potential takeover target for years as well. And now, finally, it sounds like they are opening to talks for a merger, a combination with Pernod Ricard. So fascinating, and definitely remains to be seen how it's going to play out. There is, as you said, an important stock component being discussed between the two families behind the companies, and it will be important actually for Brown-Forman's family to have a say and a significant share of the combined entity to potentially pick up of any upside down the road, given that the company and not just the company but the whole industry is going through a lot of setbacks and a very, very subdued demand, weak demand globally amid different shifts in consumption these days.
And Manuel, Pernod Ricard, as you would know, of course, one of the largest drinks companies in Europe. And looking at its portfolio, it includes Absolute Vodka, Havana Club Rum, Jameson Whiskey. I wouldn't necessarily recommend mixing all of those even on a Friday. With this acquisition, Manuel, how big does this company become?
Yeah, it will be very transformative, definitely, adding to all the rapport of brands, Tom, that you were mentioning. So for sure, yeah, just Jack Daniel's to mention one, but there is other very iconic brands across different categories behind Brown-Forman, and it will be a very transformative transaction, one of the biggest in this alcoholic beverages space for sure, that will obviously respond to the trends that we are seeing and the challenges that this industry has been facing for quite a while as different trends in consumption evolve. So this is poised to be one of the largest transactions globally this year, definitely within the sector. And interestingly, we've seen quite a number of big deals in consumer, broadly speaking, as well.
Okay, Bloomberg's deals reporter Manuel Baigorri. Manuel, thank you very much indeed for the details on that merger. Now to the oil space. Almost a month into that deepening conflict, of course, in the Middle East, oil traders continue to reel from weeks of massive market swings, beginning to pull back, creating a drain on liquidity that threatens to exacerbate future moves. More, let's bring in Anthony De Paula, Bloomberg's Middle East energy markets reporter in Dubai. Anthony, always appreciate your time and your insights. We're looking at oil prices higher again. Brent closing in on $110 a barrel. What underpins this, given that Trump has pushed this deadline back, this apparent deadline, until April the 6th?
Yeah, good morning, Tom and Lizzie. The deadline is pushed back, but the bottom line is we still don't have oil coming out of the Persian Gulf. So we are seeing that oil price tick back up. Again, this morning we were a little bit lower yesterday, opened higher today, and it's come back up as well because we're simply not getting the supplies that the market needs in the quantity that it needs. So we've seen some vessels coming out of the Gulf carrying Iranian oil. Some vessels that the Iranians have said that they've let go through. Some ships are paying a fee, like a toll, to get through the Strait of Hormuz. And we even heard President Trump talking earlier this week about a gift that the Iranians had given the U.S. apparently that was allowing some additional tankers to pass through. But when you think about the context of the global oil market, if you're relying on gifts from Iran to allow vessels to pass through the Strait of Hormuz, which had previously been an open channel for navigation, then you're already in a more negative situation than you were before, relying on one country to let through or not vessels onto the global market. So that's a problem. That's what the market is focused on. Plus, we've got this deadline delayed from earlier in the week. So let me tell you, those of us in Dubai were happy to see that deadline did not come to pass at the start of this week when Trump threatened to bomb power facilities, in Iran, and then the Iranians reciprocally threatened to bomb power and desalination here in the Gulf region. The UAE has been one of the countries that's been hit the most in terms of missiles and drones. So we're happy to see that not come to pass. That was delayed until the end of this week, now delayed again. So I think the market is kind of looking through that and looking at the placement of troops as well, the need to get the Hormuz open, Trump's comments about opening that also forcibly. So the market is potentially looking at some other action happening before we get to that deadline, and also take into account that the longer Hormuz stays closed, the more damage there is done to the oil market, Tom.
And so, Anthony, where Malaysia says that Iran has allowed some of its ships through the Strait of Hormuz, do we take that as a sign of de-escalation, or do we take it as a sign that Iran is tightening its grip on control of who goes through the strait?
Yeah, I think it's that. I think it's tightening the grip. It's obviously a conciliatory gesture, but it shows that Iran has a level of control in Hormuz that it didn't have, that it wasn't exercising before the war. So this is one bit of posturing by which Iran is trying to show that it's got a bit of an upper hand on that aspect, at least. Militarily, they are taking a beating, but they do have the global oil market by the throat by closing Hormuz. Potentially a de-escalatory move, but not enough really to help the market. And I think that the Gulf countries, we saw the UAE ambassador to the U.S. commenting in an op-ed yesterday. We saw the ADNOC CEO talking earlier this week, speaking to CERAWeek, as well as in some meetings in Washington, including with the vice president. They want Hormuz opened, and they want the situation in the Gulf really sorted out, not that the U.S. leaves the region and leaves it with an Iran that is able to exercise control over the Gulf or threaten energy facilities. The Gulf countries really want stability so that they can supply their oil and gas back into the market. That's where they make their money. They make their money by having a stable
Anthony,
environment.
we'll have to leave it there.
So
Anthony
really
DePaola out of Dubai. We appreciate the update. Thank you very much. Coming up next, we'll talk tech. This is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air, and they want clean water, and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Good morning, this is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg 10.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
This is the opening trade. We're 30 minutes into today's session, and we told you that things could whipsaw this morning. It is a Friday. We started with the European futures picture in the green, but now red across the screen into the open. 30 minutes in, we've got the Stoxx 600 down 0.5%, as we've seen oil climbing above $110 a barrel on Brent, and yields rising as well. Take a look as well at the US futures picture, because again, we had seen a positive picture in futures, and that's paired somewhat because of the Chinese Commerce Ministry saying that it's starting 2 probes into US trade. So the gains that we had seen, actually now futures pretty flat stateside, Tom.
I think the volume story tells a story as well. Currently down 30, close to 32% volumes versus that 20-day average. I think you're going to see investors staying on the sidelines to some extent leading up to the weekend, because goodness knows what could happen in terms of the Middle East. Yes, President Trump has kicked that deadline, that self-imposed deadline, to April the 6th. That just prolongs the uncertainty for many, at least. In terms of how it breaks down across the Stoxx 600 members, you have 122 stocks in positive territory this morning. The majority, of course, as you were saying, Lizzie, in negative territory. 465 stocks currently lower in the session so far. If we flip the board and have a look at terms of where the leaders are, there's some interesting idiosyncratic stories as well to flag. The laggards now the leaders. AstraZeneca, best performer in the Stoxx 600 so far this morning. Gains of close to 3%, as you can say, rising after news that its experimental drug for a deadly lung condition brought some statistically significant results. So Astra getting a lift on that. Pernod Ricard, we're talking about this potential merger that's in the cards, up 3.3%, exploring a potential acquisition of Brown-Forman, which is the owner of Jack Daniel's whiskey. That could significantly expand, of course, its portfolio, already significant for Pernod Ricard. SAP turning around after 3 consecutive days of losses. The software giant, of course, listed over in Germany, currently up 1.5%, is on the front foot, at least for now. In terms of the laggards, Siemens Energy, of course, a key piece of the data center story that's performed very well in the last 12 months or so on that build-out story. A different picture today, dropping 4%. Morgan Stanley analysts citing the exposure to the Middle East as a potential risk for Siemens Energy, and you can see that drop. And a significant drop for Dino Polska, down almost 15% after results showed record low margins and negative guidance. And Nokia on the telecoms equipment space dropping after it was cut to underperform this morning by Santander. That stock down almost 4%, 3.6% right now. Lizzie.
Here's what else you need to know this morning, Tom. US Secretary of State Marco Rubio is meeting with G7 foreign ministers in France today for talks on the Iran war and Ukraine. Before leaving Washington, Rubio said that other countries should support the US push to reopen the Strait of Hormuz, saying it's in the G7's interests. Elsewhere, 3 Australian plants that provide about 8% of the world's liquefied natural gas have had their output curbed by a cyclone. The disruption will affect mostly Asian buyers and comes amid an energy crunch stemming from that closure of the Strait of Hormuz and an Iranian attack on the world's largest liquefaction plant in Qatar. And Bloomberg understands that Anthropic is considering going public as soon as October. Sources say the maker of the popular Claude chatbot has held early discussions with Wall Street banks about taking leading roles on a potential listing. Anthropic has been boosted by a winning court, with a judge blocking a Trump administration ban on government use of its AI technology. Tom.
Let's stay on technology, because Meta's stock tumbled yesterday, almost 8%, after the Facebook parent company was found liable in a social media addiction trial. That on a day when a Bloomberg gauge of Mag 7 stocks had its worst day since October. We're going to get a take in terms of what's happening across social media companies, AI as well, the potential societal risks, and someone who has deep insights and experience. Let's bring in Dex Hunter-Torek now, CEO of the Center for Tomorrow. He's also a former speechwriter and advisor to Mark Zuckerberg, Elon Musk, and Google's Demis Hassabis, amongst others. Dex, good morning. Thank you for joining us.
Good to be here.
We think about Meta, we think about Alphabet and Google and being found liable in this case around media addiction. As a reminder that social media has had its problems before. This is before the advent of generative AI. Not before the advent of AI, but before the advent of generative AI. You've worked with the likes of Elon Musk. You've worked very closely in the pits with Mark Zuckerberg. You've worked very closely with Demis Hassabis. When we think about the potential societal risks, the impacts on jobs, the impacts of AI and the military, the impacts of AI on the environment, these guys have a plan, right, Dex?
No, they don't. I wish they did. Look, we're in a moment where I think most people would say, if you look at how social media and the last generation of technology was managed, did we do well? I think very few people would say yes, as today's news shows. With AI, you're looking at something that's vastly more challenging for all of those systems in our societies. It's going to be transformative for our economies. It is having very unpredictable effects already on the geopolitical order. You've got AI targeting systems being used in militaries in ways that are rapidly exceeding our capacity to manage conflicts as human decision makers, as our international systems have broken down. Climate change is something that's just accelerating, and as we turbocharge economies with AI, you're actually going to see even faster consumption of resources. So all these problems are just coming at leaders now from every direction, and I think people really are missing the interconnected thinking.
And to be absolutely clear, I mean, you've been in the room with Elon, with Mark Zuckerberg, with Elon Musk, with Demis Hassabis at SpaceX. When you put those concerns to these tech CEOs, who, whatever you think of them, are incredibly smart individuals, intellectually bright, intellectually on the edge, what do they say? How do they respond? Are they thinking about these issues, Dex?
Well, I mean, you know, people are pattern recognition machines just like AIs are. They look at things, you know, in the way they've unfolded, you know, throughout our history, and they cling, you know, to those patterns, you know, and hopefully they will guide us through the future. And people often think about the moment we're going through and say, it's just like the Industrial Revolution. People worried about jobs, people worried about the future. We ended up having, you know, lots of new jobs. We had very, very different societies where we solved a bunch of our problems. This is not like that. This is not the arrival of steam power. You've got a bunch of leaders who are fantastic at developing those technologies, at racing for new innovations. They don't understand how deeply frail our societies are. In many ways, it's not their job to fix those things, but now we really need a lot of other leaders, a lot of other voices to step up and solve those problems.
So is that the government's job, then? If you've got an AI-saturated economy, people losing their jobs, we were discussing this earlier in the programme, do we need a universal basic income?
This is the sort of thinking that might be part of the solutions we need. Currently, UBI proposals are mostly fanciful. They are mostly fringe, developed by, you know, thinkers who haven't really figured out how to actually, you know, afford these things, especially when the effects of AI will arrive for societies all over the world. You know, we're looking at a moment coming very, very quickly over the next decade where increasingly advanced AI is really going to have a huge displacing effect on a lot of traditional jobs. And we might get new jobs, but that means we need to transform all of our education systems, the way we are equipping young people with skills. at the moment we're looking at unemployment in the UK for young people, soaring to, one of the highest numbers it's been in a long time. That's just a taste of the path we might be on if we don't fundamentally rethink a bunch of those assumptions that give us future growth.
Well, because some proponents of UBI would say just tax big tech more. Surely that would just drive big tech away when you need that economic growth that they provide.
Well, this is the point, right? There's a very small number of companies now which are achieving an unprecedented concentration of economic and political power. And what you've seen over the last year, right, is some of those Silicon Valley firms being utterly intertwined with government, with the US administration. Nvidia's at, what, a $5 trillion valuation. That's bigger than the GDP of 170 nations plus. And the idea that you're going to restrain them, you're going to be able to tax them in that way in a decade to actually power UBI systems for the whole world's nations, I think that's fanciful unless you have really put thought into what does a fundamentally different economic model look like.
We touched on, and you touched on the fact that the here and now, when it comes to the military conflict in Iran, is the use of AI, both by the US and its Israeli partners. We have seen some pushback to government aspirations from Anthropic and from Dario Modi, a pretty monumental spat between the Department of Defense and Anthropic. Does that give you some comfort that corporate leaders at Anthropic are pushing back in terms of putting some limits around the use of this technology?
I'm going to say that I have the barest amount of comfort from that because Anthropic went into this thing eyes wide open. Like, did they discover, recently that the Trump administration has a fundamentally different revanchist, worldview and international agenda? No, they knew what they were doing when they signed those contracts. They then asked for very, very minor changes, in how those contracts, ultimately applied. And look, that's a very, very small sign of progress. But, ultimately, you have all the other firms pretty much, hundreds of billions of dollars being plowed into applying next-generation intelligence systems to the largest military rearmament in history. And in a world order, in the way that we are today, with ballistic missiles raining across the Middle East, militaries all over the region using AI systems right now to target enemy population centers, this looks unlikely to be heading for a constructive outcome.
Do you think the European political leaders understand the realities of warfare in an age of AI?
I think European leaders understand it, but have yet to come up with an agenda for actually how to fundamentally deal themselves back into the game and prepare for that world. This is the same moment of peril for all the middle powers. When Mark Carney was speaking at Davos and he talked about a fundamental rupture in the international order, that is something that has absolutely illuminated, thinking for leaders all over the world, not just in Europe. But how do we ensure that, in the next decade, as you arrive potentially at artificial general intelligence, commercial quantum, nuclear fusion, if the United States and China are managing the arrival of those technologies, how do we ensure that the middle powers have a seat at the table? Mark Carney said, if you don't have a seat at the table, you're on the menu. And this is the challenge for all leaders now, to figure out how we are not on the menu.
So, Dex, you've started the Centre for Tomorrow. You're out of tech after what, 2-decade career,
yeah.
right at the pinnacle, and you've started the Centre for Tomorrow. What are the objectives? What are you hoping to achieve?
I mean, fundamentally, I think now we need a dramatically different set of solutions to solve the societal problems arising from that next generation set of technologies. If we think about these problems as mostly technical with technical solutions, then we're going to fail, because I want to know, where are jobs coming from in a decade? How do we ensure that we stop climate change? How do we ensure that the race for these new technologies simply doesn't push us faster into a catastrophic conflict? And these are questions you're not going to find in simply managing the technology. They are fundamentally choices about what kind of world do we want to live in, what kind of lives do we want our children to have. And that's a much larger mainstream conversation we need to have now with publics, with serious decision makers across society. These are choices that cannot be left up to a handful of billionaires in Silicon Valley.
Dex, thank you very much indeed. Dex Hunter-Torok, founder and president of Centre for Tomorrow, on some of the risks involved around the rollout, the implementation, of course, the use of AI, and possibly some of the solutions as well to take the edge of some of the potential downside coming through as a result of that technology. Lizzie?
I just want to check back in on these markets, Tom, because we have seen some dramatic whipsawing this Friday morning since the start of trade. In Europe, we've turned negative, and stateside, where we had seen futures positive, now they're flat, and NASDAQ futures actually actually in the red. This partly on headlines indicating a further deterioration in US-China trade relations, that Section 301 investigation, two of them, the Chinese Ministry of Commerce starting 2 trade investigations against the US, responding to that Section 301 probe by the United States. So that's potentially what's weighing stateside, but more broadly, of course, we have got oil higher, Brent now nearly at $110 a barrel, yields higher across the curve, across the continent, and that weighing here in Europe. Coming up, US Secretary of State Marco Rubio arrives in France for G7 talks, with the Iran conflict and Ukraine war top of the agenda. We'll bring you the latest lines from those discussions next. That's next. This is Bloomberg.
Say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Russian intelligence is helping Iran target Americans and US allies. This according to the EU's Foreign Affairs Chief, Kaja Kallas. Speaking to Bloomberg at the G7 Foreign Ministers meeting ahead of the arrival of Marco Rubio, Ms. Kallas called on the US to help Ukraine by stopping Moscow from supporting Iran.
Clearly, these two crises, two wars are linked. If you hear about the intelligence that the Russians are providing to Iran so that they could attack Americans. So, the response of the Americans should also be not to help Russia. And there it is important that the oil price is capped and they don't have the funding to actually go on.
And do you think those reports about that intelligence sharing and potentially drone deliveries we're talking about potentially to Iran from the Russians, does that make the the sort of battle lines a lot clearer for the United States, and does that then put the United States on the European side of those lines?
Well, it's very clear for us where the lines are, and clearly, I mean, Russia is not on the side of Americans. That's very clear. So there should also be pressure on the Russians because they are providing drones, but also intelligence.
And also thinking about the war in Ukraine, the end game there, we're now approaching basically a financing cliff for the Ukrainians. The 90 billion euro loan still remains blocked. We have reporting now that some of the hardware from the United States is being diverted potentially away from Ukraine towards the Middle East. How do you see things progressing? Are we not just basically stuck in deadlock here for the Europeans? What is going to advance this story for Ukraine?
Yes, definitely the 90 billion loan that we agreed in December has to be delivered to Ukraine. They desperately need it, and it's also the question of European credibility. So the work is ongoing there. Hopefully still we have solutions and also working on the plan Bs on this. But what is important is that so the weapons that Ukraine needs to defend themselves, that they still have, because the war is very brutal.
And there's been some reporting that maybe actually the European money that's been paid to buy the weapons through the Pearl program could be rerouted. Is there a reaction from Europe from that if the European money is being used for weapons that are now being sent to the Middle East?
I'm not aware of that.
And then also thinking about Ukraine and the Hungarians and the role, we've had some reporting recently about the foreign minister effectively briefing the Kremlin from some of the meetings that are being held in Brussels. Do you believe that that is the case? Is that appropriate? I think I know your answer to that. And what can you do about it?
Yeah. Well, clearly it's not appropriate. I mean, secret discussions or closed discussions should remain closed discussions. And there is also the obligation of professional secrecy. So I've reached out also to the Foreign Minister of Hungary to have discussion about this. And I've also reached out to the Secretariat of European Council to see what are the gaps in our rules of procedure to cover these kind of cases.
EU representative for Foreign Affairs, Kaja Kallas, speaking to Bloomberg's Oliver Crook, of course, who is at the G7. Let's bring Ollie in at this point. At the talks, of course, in Vaux-des-Aulnay, just south of Paris. Ollie, US Secretary of State Marco Rubio now in France. You told us earlier he landed what, at 2 a.m. or something? What is the message? What does the US want from its allies, from its G7 partners, in terms of support for this conflict that they started against Iran?
Yeah, I mean, I think that is the question for many of the foreign ministers here, because we've heard a lot of sort of ideas articulated by the President of the United States saying that NATO is sort of a disappointment, that a number of G7 allies are a disappointment, but they haven't articulated necessarily very specifically in clear terms what they want from those allies. So Marco Rubio is now currently in this room just here behind me with a number of foreign ministers of the G7, including, we'll say also with an incredible note on this trip, which is the Saudi foreign minister, also of Brazil and India, all having discussions today. And I think for those allies, it is to get an idea, a clear idea, and a sort of articulated, concrete idea of what the allies can do to help the United States, but then also what their view is on the war in Ukraine. For the Europeans, that is, of course, front and center, as you were hearing there from Kaja Kallas, whom we spoke to yesterday, trying to link these two wars with the reports of the Russians delivering intelligence and potentially drones to the Iranians, and really saying that these really makes a clear delineation of where the battle lines are. So for Marco Rubio, it is going to be trying to enlist some of these Europeans, these G7 countries, to try to help in some way on the Straits of Hormuz. We should say that yesterday we heard from the Secretary General of NATO, Mark Rutte, saying that there is a coalition emerging of 30-plus countries, a coalition of the willing to try to aid some of the passage of naval vessels in the Straits of Hormuz. But the real question is, at what point are those nations willing to help, and in what capacity? The people I've spoken to here are not willing to join a sort of kinetic, active military operation. We've heard from Emmanuel Macron that these are more sort of the day after plannings, but those are some of the conversations that are happening right behind me as we speak.
Yeah, if those G7 ministers do not want to help when it comes to the US in Iran, then what happens to Ukraine?
Well, that's the big question. And I think that what's interesting is that the Europeans are trying to link the war in Iran to the war in Ukraine, but the Americans are trying to link it in the other direction. We heard from President Trump yesterday out on Truth Social saying NATO nations have done absolutely nothing to help with the lunatic nation now militarily decimated of Iran. The USA needs nothing from NATO, but never forget this very important moment in time. So for the Europeans who have said this is not our war, this is a time for the United States to say that Ukraine is not our war. And in fact, that is exactly what Marco Rubio, the U.S. Secretary of State, said last night as he was boarding the plane in Washington, D.C., saying that a couple of leaders in Europe who said that this was not Europe's war, well, Ukraine is not America's war, and yet we've contributed more to that fight than any other country in the world. So it'll be something to examine that the president will have to take into account down the road. So again, for the Europeans, it's trying to link Iran and Ukraine and the Russians, and for the Americans, the same sort of thing. The real question is, at what point will European nations, will the G7 be willing to be involved in trying to open up the Straits of Hormuz? From all the conversations I've had here today, that is a day after, and we're still very much in the day of.
Okay. Oliver Crook, our chief Europe correspondent in France for that meeting. Thank you very much for the context.
Okay, let's check back in on the markets, with European markets now off by 0.8%. US futures also negative right now, flatlining on the S&P E-minis. Nasdaq 100 after a brutal day yesterday, currently down 0.1%. I say brutal, it was down a little over 2% by the end of the close. That's the context. Let's bring in Adam Linton for more context now from our Bloomberg Markets Live team. Adam, we're seeing a sell-off in bonds, yields are up, sell-off in equities again. Futures have pointed higher. That is not the story that we're seeing in the session today, and US futures currently pointing lower. What is your assessment of how markets are trying to get to grips with this new deadline that President Trump has imposed and the potential risks over the weekend?
Yeah, definitely. So I think, we did see upside in stocks initially, when I walked in the office, but it definitely did look out of place with the price action we've seen in the bonds markets. We've kind of seen those brought a bit more into line now. But as you mentioned, there was that deadline extension, which at first glance is a positive for the market. But ultimately, whilst there may not be any near-term attacks on energy infrastructure, it doesn't do anything to get the Strait of Hormuz open. If anything, it potentially defers that. And then concerningly, we saw from Trump, that the Strait of Hormuz doesn't even matter to the US. We saw him reiterate that. And whilst this deadline does allow scope for talks, we've seen how far both sides are apart this week. Iran wants reparations, wants control of the Strait of Hormuz. And then at the same time, you've seen the US amassing troops in the Middle East, reports of more troops. And then you've also seen Israel this morning continue to attack Iran. So, there's still not really lots of positives to the markets to trade off despite that headline yesterday. And at the moment, we're just kind of following the trading patterns that we've seen throughout the conflict. People don't want to be taken on risk heading into the weekend. Neither the Stock 600 or the S&P 500 have closed higher on a Friday into the conflict. And throughout the conflicts, we've seen a lot of escalation over the weekends. So it makes sense for traders to be taking down risk ahead of that.
And Adam, I'm looking at the Spanish CPI numbers that came out at the top of the hour, actually lower than expectations for March, both year on year and month on month. Where does it leave the outlook for the ECB? We've had lots of ECB speak this week. We've talked about the comments from Lagarde to The Economist. Are markets pricing about right when it comes to their outlook, do you think?
I think there's still just so much uncertainty. So yes, this Spanish inflation release is of note, but it's early days. And then for Spain specifically, there's a huge caveat because they've got this absolutely massive support package of about 5 billion euros, which Bloomberg Economics estimates it could shape about 1 percentage points of inflation in 2026. If you compare that to France and Germany, which are expected to take much more targeted approaches, then Spain is ultimately a bit of an outlier. So we'll see what the full Eurozone-wide release says on Tuesday. But again, it is very much early days at this stage. And we saw from Lagarde earlier in the week, they want sufficient information before they take action. And we actually get another inflation report just hours before that April decision. So in terms of what we'll actually learn from how the data is shaping up and what the ECB reaction function will be, this next week probably won't provide too much more colour beyond what we already have.
Okay. Adam Linton from the Bloomberg Markets Live team, thank you very much for that update. Well, Tom, we're nearly at the weekend.
The weekend. Let's tell you what's on the agenda then for the weekend, as you maybe look for some time to kick back and relax. It's NCAA March Madness. That continues stateside. Also in the US, the Miami Open finals. That would be good to watch. F1 Japanese Grand Prix is also happening, of course, in Japan. Some excitement on the track. And when it comes to what's happening with Disney Adventure World, opening in Paris. Lizzie's booking her flights or train trip there already. Also worth noting, daylight saving times, 2026.
Is that another hour in bed or less?
Less, 1 hour less.
Just what we want.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
President Trump delays U.S. attacks on Iran's energy by 10 days, claiming the two countries are negotiating, while Brent crude is on course for a record monthly gain. China retaliates with trade probes against the U.S. ahead of President Trump's visit to Beijing in May. Plus, the U.S. Senate forges a path towards ending the partial government shutdown. Lawmakers under pressure to fund the Department of Homeland Security with record queues at airports across the country. Now, happy Friday, everyone. It has been certainly a very messy week on the markets. When you look at markets overall right now, look, risk sentiment, we started actually, on the tail end of Asia was a little bit better, but risk sentiment once again souring pretty fast in European trading. There's a couple of things we need to watch out for. Of course, is everything to do with central banks. But I think traders are feeling a little bit lost on where they go next, which is why there's this volatility that we've seen. For example, Europe's economy starting to feel the pain from Iran's war. We're seeing that in some of the figures and some of the data. That's what the economic toll, I guess, of the Iran war hitting home in Europe is one of the reasons why we've seen also this downturn for European stocks. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Now, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. President Trump has once again extended the deadline for Iran to make a deal or face more attacks on its energy sites. Now, the Wall Street Journal reports that Tehran had not sought a pause in strikes. The president spoke to Fox News earlier.
I gave them a 10-day period. They asked for 7. You're going to say, oh, Trump's a terrible negotiator. They asked for 7, and I said, I'm going to give you 10 because they gave me ships. We talked about the 8 ships, the president that I talked about the other day. But they asked for 7, and I gave them 10. You got 10 days, and they were very thankful about that.
Well, let's bring in Laura Davison, Bloomberg's Deputy Washington Bureau Chief. Laura, the extension allows more time for talks, but do we even know who's talking to who?
We don't. This is still continuing to be a very nebulous process. There are mediators involved, both in Pakistan and in Egypt, who have been sort of talking with both sides, but it's unclear that there's any direct talks happening with Iran and with the U.S. Trump now has given 3 different deadlines: a 2-day deadline, a 5-day deadline, and now a 10-day deadline to extend these talks, which indicate that he is not super keen on following through on the initial threat that started all of this, which is striking energy infrastructure sites within Iran. Those would have long-lasting problems for the region that would extend long beyond this conflict. So that appears to be a bridge too far. But whether there is a peace deal or at least a ceasefire deal imminent does not at all seem clear. And Trump's continuance to extend those deadlines suggests that that the U.S. is not confident that something's going to come together imminently.
So, Laura, the delayed timeline also gives the president extra time to amass extra forces in the region.
Yes, this is, the U.S. has announced several successive waves of additional troops. Earlier in the week, there were about 5,000 Marines that were deployed, another 2,000 special troopers from the 82nd Airborne Division. The Wall Street Journal is now also reporting that the White House is considering an additional 10,000 ground troops. So in all told, that would be about 17,000 additional forces in the region. It'll take some weeks for all of those folks to get there, and particularly if the U.S. decides to move forward with that last batch of 10,000. But this, suggests that the military options are not foreclosed at all if the U.S. is going to all of these lengths to bring new people in. This, of course, Trump has been talking about some sort of peace plan, a deal, but the military seems to be preparing for more expansive ground strikes.
Laura, turning to what's happening at home, the Senate has cleared a path towards ending this partial government shutdown, which has caused, and we were looking at the images, really lengthy airport delays.
Yes, this is a deal that passed in the middle of the night in the Senate. It will then have to go to the House and to President Trump for his signature. This would essentially open up the airport security and make sure that those folks get paid, which have led to historically long delays at airports. People waiting 4, 5, 6 hours to pass through airport security. It could still take some days, if not weeks, for this deal to get passed, but it would mean that the U.S. government would be operating largely with a budget intact. I'll note this deal does not fund ICE and Border Patrol. The Republicans and Democrats decided to separate that out and fund that at a later date. However, most of those agencies are still continuing to operate at a certain level because they have extra funds that are outside of what Congress needs to appropriate.
Laura, thanks so much. Laura Davison there, Bloomberg's Deputy Washington Bureau Chief. Now let's discuss the Iran war and the impact it's having on global markets. With us now, Henrietta Packman, Fixed Income's Chief Operating Officer at Allspring Global Investments, and Phoenix Callan, Global Head of Emerging Market Research at SocGen CIB. So thank you both for joining us. I think that the general theme is how do you navigate all of this volatility? Phoenix, maybe let's start with you. Yesterday we had a good panel on emerging markets. It's a bit of a nightmare, actually, especially in the emerging market FX space. I think it was only this week that we spoke to the Philippine president, who said, look, there's not worth spending too much money in propping up the peso because actually what we're seeing will drive investors to the dollar, so it's futile. Is that across the board?
It's not across the board, but there are certainly many vulnerable economies, especially out of Asia, who are so sensitive to high oil prices and to shortages as well. They have very limited days cover in terms of the reserves that they have to kind of supply their industries. So they are in a severe stress, and we think that will be focused on a number of names in the region versus other parts of EM.
But you agree with his general assessment that actually it's not worth propping up right now, and what other countries would you worry about?
Yeah, so outside of the Philippines, we would worry about Thailand as well, India as well, South Korea and Japan. Those are also huge importers of oil, especially from the Straits, and they do have more reserves, but they are going to meet those kind of limits relatively soon. Lots of countries have less than 30 days of reserves left.
Henrietta, and again, how do you, in fixed income space, it's kind of the same. It's like there's just a lot of volatility out there. So how do you navigate that?
Correct. We're seeing incredible volatility day to day. And I think one of the striking things is just the velocity of the market moves as soon as we hear elements of news and how fast it changes. That being said, if you look over a sort of slightly longer period, there are some trends that are starting to appear. Obviously, we're sort of seeing higher rates. We are seeing sort of spreads ratchet up in a normalized fashion, but we are seeing those widenings.
Where do you see the best value? in fixed income?
So if you look at what we've been doing, we actually started the year reasonably under-risked because of where spread levels were, and that set us in good stead. So we have been squaring off our portfolios, focusing on diversification, focusing on income, and also nibbling at certain areas of the market where we've seen spread widening.
I mean, to both of you, and maybe we start with Phoenix, how do you actually, attach probabilities to outcome? Because we don't know if there's a ceasefire. We don't know how long is the ceasefire. We don't know about negotiations. So is it scenario planning without attaching real probabilities that guide you to what to do next?
Yeah, so it's a lot of scenario planning. Our commodities research team has put out lots of notes, very detailed notes on this. And their baseline scenario, which had been previously, a de-escalation by the end of this month, as we move into April, they will have to shift that base case into not just kind of the mild alternative scenario, but the most bearish alternative scenario, where we are expecting for that paradigm shift in energy markets to occur. Brent prices go not from like the 100 type levels per barrel to 150 per barrel in April. So that's what we're expecting as kind of the next phase, and the market is going to drastically react to that, because that's a whole new paradigm, and that's a world we haven't actually been in.
Yeah, and this again, are you expecting a repricing, which the market hasn't quite latched on? I don't know whether there's an optimism in the market, actually, that's quite, difficult to get rid of.
I mean, it's a question of time, right? And we said that at the beginning, if it's a short event, then it's okay. But the longer it lasts, the more difficult it becomes. We're now pretty much a month in. We're starting to sort of hit some of the longer scenarios at this stage.
We also have, Phoenix, this headline in the last 20 minutes or so, China starting retaliatory trade probes against the U.S. I mean, the timing of this, giving President Trump is actually, going over to meet President Xi. What does that indicate?
Well, I mean, the timing in terms of like the May 14-15 kind of summit seems to signal that Trump wants some kind of ceasefire, de-escalation, some kind of deal reached before he has to meet with Xi and negotiate all of these trade and tariff things. So I think the market is latching on to that, as thinking, okay, there is kind of something on the horizon to alleviate some of these pressures. But at the same time, we are seeing such massive amounts of U.S. troops gathering in the region, and that opens up the possibility for much further escalation.
Phoenix, I get asked actually almost on a, maybe not daily, but twice weekly basis, whether this is all a play against China, so that the Trump administration went to Venezuela to make China mad, whether they're doing Iran because they buy their oil and that would put them in trouble. I don't know how if there's any truth in that, but also how you see these two countries getting along in 2026 overall.
Well, yeah, and this year and for the years to come, there's been this huge theme around reindustrialization in the U.S., which means then that it's so much about the commodities play, securing resources, whether that's in LATAM, whether that's in the Gulf. The U.S. is going after it and wanting to get those commodities, those resources necessary for the revival of manufacturing. So I think this is a long-term theme.
Henrietta, what are treasuries today? Again, we were talking about a move away from U.S. assets. I don't know what this new war, but also geopolitics mean going forward.
It is an interesting discussion, and we have seen some diversification away from the U.S. That being said, it is a huge pool of assets, so it's actually quite hard even for international investors to sort of move away fully from the U.S. So I think it's what investors are doing with incremental allocation that they have. They may think twice before allocating to the U.S. And if you look at what's happening on the Treasury side, you've got a number of dynamics at play. Obviously, you've got what's happening in the Middle East at the moment, and that it's inflationary potential. So we're seeing some of that. We are sort of seeing issues on the budget side as well, right? So that is also playing on the Treasury piece. So a lot of dynamics coming into play.
I mean, which central bank has it hardest? I mean, no one has it easy, okay? So that's our basis. Yes. That's our starting point. But is it the Bank of England?
I think it probably is the Bank of England, to be honest. Why? Because the UK is such an open economy and is a little more subject, because of its size, to be pushed around by the markets.
And we've seen this huge move in gilts more than others. I mean, when does this really become problematic?
I think it probably already is problematic if you look at where levels are now. The economic growth picture in the UK was starting potentially to improve. It really didn't need the crisis that we have now. I think it is definitely not helpful.
I mean, I imagine both of you spend quite a lot of time thinking about inflation, right? Even if there is a ceasefire tomorrow, what happens to inflation? Because it takes a longer time to readjust some of the oil flows. We don't exactly know how much damage also there is in some of these infrastructures.
It's going to be quite different across the economies. For places like Egypt and Turkey, they are going to see huge inflation spikes in the short term because of how sensitive they are to commodity prices, to oil prices, and how that sensitivity actually has accelerated over the past 10 years because of their various devaluations. So some countries are much more vulnerable and will see much higher prices. CE region relatively contained in terms of a short upward pressure on CPI, but broadly going to stay within the forecast range.
So obviously the energy side is the one that's sort of hitting the news the most. One thing we're also keeping an eye out on, and that's also the sort of question of time coming in, is the whole agricultural picture and fertilizers and what that means for the growing season. I think that is something that is sort of maybe a little more under the radar at this point in time, but I do think that the longer this stays, the more it becomes an issue.
And this is an issue across the board, or again, are there countries that are more vulnerable, or how do you look at it from a credit perspective?
So obviously there's some countries that are going to be more vulnerable. I think it also depends, when the sort of growing seasons and the planting seasons happen. So you sort of have to sort of follow that across the globe. But it is something that is likely to start hitting in the next few weeks.
To both of you, there is a lot of people are overwhelmed by the pace of news. Is there a data point that you look at to give you a good indication of what we should be watching out for? Is it comments from the president of the Philippines or things like that really help you inform where the market is going that is different from previous crises?
Yeah, it's anecdotes about what's actually happening on the demand side and whether we have some kind of demand collapse in response to the supply shock. So I think those indications about what's actually happening with airlines canceling flights, governments announcing that Wednesday is going to be national holidays going forward, kind of thing, to curb energy consumption. Yeah, those things are quite important to see how countries are actually reacting.
Yeah, you, Henrietta?
So I think one of our focuses is really on the sort of portfolio construction and how we create portfolios that are going to be resilient and able to deal with volatility. I think that's one of our big focuses at the moment. So making sure that we got income, so that we have that income protection, being thoughtful about what we're doing from a duration perspective, and as I mentioned, really sort of thinking about the diversification piece as well.
I mean, we're focusing so much on the war, and inflation. Does the partial government shutdown in the U.S. and the possible alleviation of that change anything?
It's helpful, right? But I think what we're also being careful about is thinking about other themes, right, that we need to have in mind in our portfolios. I'm thinking AI, and these are sort of longer-term effects. You can't forget about those, despite all the noise in the news.
And private credit. Thank you
and
both.
Private credit.
And thank you both for joining us. Henrietta Packman, Fixed Income Chief Operating Officer at Allspring Global Investments, and Phoenix Callan, Global Head of Emerging Market Research at SocGen CIB. Coming up, U.S. Secretary of State Marco Rubio joins his G7 colleagues to discuss reopening the Strait of Hormuz. We'll talk about that next, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francie Lacqua here in London. Now, U.S. Secretary of State Marco Rubio is in talks with G7 foreign ministers in France. Rubio says it's in the G7 nations' interests to reopen the Strait of Hormuz. Well, let's go back to Oliver Crook, Bloomberg's chief Europe correspondent, who's in Vaux de Cernay. Hi, Ollie.
Yeah, that's right, Francine. Before G7 foreign ministers who are gathered here, we should say the Saudi foreign minister is also here. The issue of Iran is front and center, and sitting behind me in that room, you have Marco Rubio discussing with the other allies. Standing right next to me is the voice of French foreign policy, is Pascal Confavreux, who is the spokesman for the French foreign ministry, the host of this meeting. Thanks so much for joining us.
Thank you.
In these conversations that we're having now with the Marco Rubio, what information do you need to get from the U.S. Secretary of State?
You know, the G7 that was invented 50 years ago, stone's throw away from here, has 2 goals, is to create a cohesion between the leaders and to have results. We want here a G7 of results on cross-cutting threats and also the big crisis internationally, namely Iran and Middle East, and second, of course, Ukraine. So that's exactly what they're going to discuss during the whole day behind these doors.
And Emmanuel Macron has been fairly deft in sort of hedging himself on the war in Iran, originally saying that the French will have no involvement, but being very quick to say that there should be a role of the French and others, coalitions, to open up the Straits of Hormuz at the appropriate time. We now understand there's discussions of more than 30 countries. Can you talk to us about how far those discussions have progressed and what this coalition of the willing is willing to do?
So it's the coalition of the willing is more for Ukraine, but you're right. It's also another kind of coalition of the willing. There are consultations taking place at the level of the chief of staff of the armed forces yesterday, including European members, regional members, and also extra-regional members states such as India or South Korea. These consultations are extremely important to see how such a mission could happen, being in mind that it would take place after the end of the bombing first, and not to be only in a defensive situation. So we are going on this first step. There is a second step, which are the discussions at the United Nations now.
And you say after the bombing, but of course wars don't necessarily end completely cleanly. What conditions would have to be in place for the French to join in on such a mission?
We are preparing such a mission with all the willing partners, but we have made very clear that this war is not our war, and we don't want to be entangled into it.
And you talk about cross-cutting threats. There's going to be an effort in that room right now as we speak to link the war in Iran to the war in Ukraine, saying that the battle lines are clearly drawn and that Russia is on the other side of that line from the United States. Is that a successful message, you think, to the Americans?
We think that there was an important cooperation between Iran and Russia. Iran has been also condemned and sanctioned at the European Union level for helping the Russian aggression of Ukraine during these last weeks and months. The Minister Jean-Noël Barrot has been part and parcel of this effort, and we have all reasons to think that this cooperation continues to exist between Russia and Iran at present, and that it can indeed hit assets that Iranians are targeting at present.
And I'd like to discuss the path forward for Ukraine, because we're reaching a sort of critical moment for Ukraine. There's a sort of fiscal cliff for the Ukrainians in terms of funding. That 90 billion euros has been blocked at the European level. There's now reporting that American hardware, military assets are being rerouted to the Middle East. How do you see the situation in Ukraine progressing?
So first, it's not what's happening in the Middle East that will make us forget what's happening in Ukraine. Second, if you look at the situation on the field, the Ukrainians are doing actually well. We all thought that they would be ended up in 4 weeks. It's now 4 years that their bravery is taking place day after day. And third, we stand shoulder to shoulder with them. The European Union has is now by far the first provider of help, both economically or militarily. You said it. We have a 90 billion plans that is not adopted yet, but that will be, and we are totally sure of that, adopted in the days and weeks to come. And we will find solutions for the very short-term short-term needs that you are talking about.
And I also want to get your reaction to some reporting we've seen from the European foreign ministers' meetings, where we're hearing that the Hungarians have been briefing directly to the Kremlin after those meetings, and there hasn't been really any sort of formal objection to that fact. Do you believe that that is the case? And if so, what should the Europeans be doing? What should France do about that?
Well, we take that very seriously. I don't want to make political comments about it. What we want to say once again is that there have been 19 packages of sanctions. And these packages of sanctions adopted by the European Union, they have been adopted at unanimously. So you show how united also we stand, and united during the long run, because it's been 4 years that we've been into it now.
And I also want to get your perspective on how advanced the talks about nuclear deployment of the French nuclear umbrella. Obviously, there was a very big speech by Emmanuel Macron a couple of weeks ago in front of that very impressive submarine, talking about potentially deploying French nuclear assets to other European nations. How advanced are those conversations?
There has been a very good welcome by our colleagues of the member states of the European Union on that speech. It's called Advanced Deterrence. That was proposed by our president. And so these talks are now ongoing with 7 and 8 countries, and they are going in the right direction.
And you elicit the sort of birth of the G7 format was a stone's throw away from here in Rambouillet, as I recall, about 50 years ago. But since then, now you have the Trump sort of foreign policy that's sort of blowing up that multilateral sort of trade structure. Where do you see the sort of format of the G7 evolving? In France, as the president of that for the next period of time, what do you hope to achieve during that period of time?
More necessary than ever to talk, to have these direct talks, even if we don't always have the same ideas. And so these moments like these, they can bring concrete results, one of which was announced yesterday, is the collective effort to fund the restoration of the dome of Chernobyl. You know that it has been hit by a Russian drone in 2025. It's a small hole actually, but it cost $500 million to restore. Yeah. So there is a common effort here to restore it, and it shows how dangerous this Russian aggression of Ukraine is.
Well, Pascal Favreau, thank you so much for your time. There is the spokesman for the French Foreign Ministry, who of course are playing as host to this G7 meeting here outside of Paris.
Ollie, thanks so much. Bloomberg's Chief Europe Correspondent Oliver Crook there, speaking to Pascal Favreau, France's Foreign Ministry spokesperson. Now, this is a picture for markets across the board. We did have a little bit of a downturn when it comes to European stocks. Stocks in general extending their route after China launched these trade probes into the U.S., adding to nervous sentiment driven by fears of a protracted war in the Middle East. I'm looking at global bonds. They're also extending their slump. Treasuries falling alongside them. The dollar actually a little changed. Gold gaining. Traders, again, fearing this broadening impact on energy supplies and oil prices, stoking fears of inflation spiraling that could force some central banks to tighten monetary policy. You can see S&P futures practically flat, as are NASDAQ and Dow Jones futures. Coming up, Iran drafting legislation to unilaterally impose fees on vessels seeking safe passage through the Strait of Hormuz. We have President Trump's reaction to that controversial draft bill. That's next, and this is Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump delays U.S. attacks on Iran's energy by 10 days, claiming the two countries are negotiating. Brent crude is on course for a record monthly gain. China retaliates with trade probes against the U.S. ahead of President Trump's visit to Beijing in May. Plus, the U.S. Senate forges a path towards ending the partial government shutdown. Lawmakers under pressure to fund the Department of Homeland Security with record queues at airports across the country. So the Iranian parliament is working on a draft bill to impose a fee on vessels seeking safe passage through the Strait of Hormuz. That's according to the semi-official Fars news agency. Now, the narrow waterway has been all but closed since U.S. and Israeli strikes on Iran began almost a month ago. President Trump was asked about the issue by Bloomberg's Anne-Marie Hordern.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to, but they're doing it a little bit. I don't know. Look, their capability is a lot less than it was 2 weeks ago. And with every week and every day, frankly, it gets less and less. All I can tell you is they're begging to make a deal. So let's see what happens.
Well, let's get more on the situation in the Middle East. I'm joined now by Jasmine Al-Gamal, Averos Strategies founder and former Pentagon advisor, and Paul Wallace, Bloomberg's managing editor for Middle East and Africa. So thank you both for joining us. Paul, what do we know? Who's negotiating with who? Because it's unclear, actually, and it changes quite often.
It's still pretty unclear, but the best we can say is that Iran and the U.S. are exchanging messages via Pakistan. Pakistan is essentially the main mediator at the moment, and the latest thing is Trump extending his deadline to, blow up Iranian power plants if Tehran doesn't take an off-ramp and accept a deal. He's extended that until April the 6th, so for another 10 days. Iran remains still very consistent in its message that it doesn't seek negotiations, and it's got some pretty sort of tough demands pretty much to even begin those negotiations. They include getting some kind of recognition that it controls the Strait of Hormuz. It wants reparations, and it also wants Israel and the U.S. to say they won't attack the country again once this conflict is over. Those are demands which I don't think the U.S. and Israel are likely to accept. So we're at an impasse at the moment.
Jasmine, I mean, do you think this is, again, because both sides are trying to, save face at home, or is it really that they just start from very different starting points, that the two, this is a fight for survival, and so they just want very different things?
That's right. I mean, what you're seeing right now is basically each side trying to set the stage for future negotiations. Yeah. They're trying to amass as much leverage as they have so that when they inevitably sit down at the negotiating table, they're not operating from a position of weakness. Mm-hmm. So you see the U.S. trying to impose a lot of costs on Iran and vice versa. I think it's important to parse through the different objectives that Israel and the U.S. have because they're not exactly aligned on what they want. Israeli objectives are much more long-term. They want the eventual complete capitulation of the regime. They want an entirely new structure in Iran. And as Prime Minister Netanyahu said, I think just yesterday, they eventually want the Strait of Hormuz to be completely bypassed, and they want new routes going through the Arabian Gulf and Israel. That's the way he described it. The U.S. doesn't think that long-term and doesn't necessarily want those same things. So when we look at just the U.S. and Iran, I think the biggest mistake, I'll just say lastly quickly, is that Trump keeps changing his deadlines. And I think Iran sees that as a sign of weakness on the American side. And in order to compensate for that, Trump may have to do something like military action over the weekend to restore the balance.
Yeah, what do we know the U.S. and Trump administration now want? I mean, I don't know whether the price of oil going up by so much was a shock. And so they just need to find a solution quick.
Yeah, they do. I think Trump, he needs Hormuz, the Strait of Hormuz to be reopened. It's as simple as that. You know, Brent today is trading at about $110 a barrel. We have analysts at banks like Macquarie saying, you know, if this strait is not reopened by June, then we're going to $200 a barrel, which would presumably cause chaos with the global economy. We're already seeing big signs that Western economies are being hit hard through PMIs from this month, March, and all that. So Trump needs Hormuz reopened. And just a note on Iran and its stance, you know, that it's still taking a pretty hard line even on negotiations. Attacks continued this morning. It's fired missiles at Israel. It's fired missiles and drones at Saudi Arabia, Bahrain, Kuwait, and Doha in Qatar got its first missile alert today for days. So, you know, the war continues as normal for now.
Yeah. Jasmine, I mean, you were saying that something could happen this weekend. I mean, is this boots on the ground? Like, how would President Trump restore this balance?
Well, I think we have to prepare for all options, right? I mean, there are options all the way going from just continuing to threaten to forcefully open the Strait of Hormuz. Interestingly, you've seen the UAE over the last few days steadily release statements and op-eds and making it clear that the UAE is now firmly in the camp of using force against Iran and trying to neutralize the regime's capabilities. But there are also possibilities for boots on the ground. There are senators that have just listened to classified briefings in the U.S. that came out and said, I am not authorizing boots on the ground, and you should be really worried about this. So I think what's important, we don't necessarily know which way Trump will go, but I think we have to be prepared for a scenario where he does put boots on the ground, even if it's not the most likely scenario.
Do we have a better understanding now of how many weapons and drones Iran has access to, or how fast they can build them? Because this took everyone by surprise.
We do know that they're capable of replenishing at least their drones and some of their ballistic missile program, although it's a timeline, it's competing timelines. How fast can the U.S. and Israel degrade versus how fast Iran can resupply? But it's also important to note that Iran hasn't fully activated all of its options yet. As I think we mentioned before when I was here last time, the Houthis are still fairly quiet. You know, they could come out at any minute. And Iran has not played all its cards yet. Iran playing its cards has less of a cost for them domestically. Obviously, it's not a democracy. They don't answer to their people, than the U.S. playing more and more cards. So I think also time is not on the U.S.'s side if escalation is where we're headed here.
Paul, I don't know what to make of the fact that Iran is drafting this law to introduce tolls for the Hormuz transit. I mean, if you're physically in control of the strait, I mean, do you really need to draft a law?
I think it's hard to tell exactly what Iran means by that, but I think in whatever the case, it's a show of confidence on the part of Iran. I mean, it would be a strategic disaster for the U.S. and the West and the Gulf Arab states if Iran ended up with any kind of control at all over passage of commercial vessels through the Strait once this conflict is over. I mean, that would be a nightmare scenario for all sorts of reasons. But Iran, at the moment, probably feels that this is a negotiating tactic to put the U.S. under more pressure. It's hard to tell whether it literally thinks it will be able to treat the Strait of Hormuz like Egypt does with the Suez Canal, for example, after this war is over. But I think it just shows how confident Iran is, at the very least, that for now it can keep the strait closed.
What's the probability, Jasmine, of a diplomatic solution?
Well, it obviously would be the best way. The best scenario here, best case, is for Trump to just declare victory, negotiate some kind of solution between the U.S. and Iran to keep the straits open, and just call it a day and take down the temperature. The problem is that if he does that, Iran comes out of this declaring complete victory, and the Gulf states remain vulnerable because Iran maintains the capacity to harm them or even just to intimidate them moving forward. That's what makes me think that we're not done just yet before we head into negotiations. I think Trump needs to restore that balance of power between the U.S. and Iran, protect his Gulf allies moving forward into the future, gain some strategic I can't think of the right word, sorry, but make sure that Iran doesn't have the ability to intimidate them moving forward. He has to get that guarantee somehow, and then they can go to negotiation. So that's what makes me think we're not over the hump just yet.
Yeah, and Jasmine, it kind of goes to, to a lot of our reporters are trying to figure out how this new Ayatollah will be different to the previous one and whether he's more of a hardliner.
Exactly. I mean, given his comments in the past and things, there is an argument to be said that yes, Mojtaba Khamenei is more conservative, more hardline than his father Ali Khamenei, who was assassinated on the first day of this war. It's hard to tell his thinking at the moment. He hasn't been seen in public at all since the war began, and even since he became supreme leader. The U.S. says he's injured, perhaps badly. So it's hard to tell. The Speaker of Parliament seems to be calling a lot of the shots at the moment. But I think, going back to what Jasmine said a bit earlier, time is on Iran's side. That's a crucial point. They see this as an existential fight. They are literally fighting for the survival of the Islamic Republic as they see it. And in that case, time doesn't really matter. They can keep going for as long as it takes to survive.
Jasmine, who do they have left in terms of allies? So Russia, we understand maybe there's some intelligence sharing, but unclear to, how much more Russia can do given their own situation. North Korea, I mean, could they get involved in this?
I don't think you're going to see countries really getting involved. I think right now every major actor realizes that the temperature needs to be taken down. This is now affecting the entire global economy, every city, every household in the U.S., to China, to Europe. This is in no one's interest to continue except for Iran saving its regime. And so I think what you're going to see, the question is not how many allies Iran still has, but whether countries in the region, international allies of the U.S., can get the U.S. to start taking down the temperature and moving towards negotiations. Iran is going to be isolated no matter what, diplomatically, but that doesn't really matter in the situation that we're in right now. It's about who can convince the U.S. president that this is not in anyone's interest. He's going to have to end this war in a way that is not necessarily in favor of the U.S., but he's going to have to do it. Who can convince him of that remains the million-dollar question.
Well, price of gasoline of $5, that'll convince the president, right? I mean, we're almost there. If you look at, we had a Macquarie, saying like, look, the price of oil could go to $200, but I think gasoline is above $4. This is problematic for him.
It's very problematic when you're heading into midterms in November, and with the economy such a big part of how Americans will vote. And, you know, I know California has its own issues with taxes and things, but we're above or very close to $7 a gallon there. So, you know, this is not what Trump wants. He is you know, throughout his time in office during term 1 and even the second term, he has gone on and on about gasoline prices. He said that they were too high under Biden, and he's taken pride in the fact that at least until this war, he kept them much lower, or they were much lower under his presidency than they were under Biden. That's now, you know, that's completely reversed. It's a big issue for him.
Okay, thank you both for joining us. We have a wonderful blog that I know your team are working on, and in the blog just minutes ago saying that actually Iran has also turned back 3 container vessels in Hormuz. Thank you so much for joining us, Jasmine Al-Gamal, Averroes Strategies founder and former Pentagon advisor, and Paul Wallace, Bloomberg's managing editor for the Middle East and Africa. Now, Ukraine risks running out of money to pay for its defense against Russia within 2 months. That follows Hungary's veto of a 90 billion euro loan and spat over the IMF's latest aid package. The EU foreign policy chief Kaja Kallas urged the U.S. to support Kyiv by capping oil prices, which are boosting Russia's war chest.
Clearly, these two crises, two wars are linked. If you hear about the intelligence that the Russians are providing to Iran so that they could attack Americans. So, you know, the response of the Americans should also be not to help Russia. And there it is important that the oil price is capped and they don't have the funding to actually go up.
And do you think those reports about that intelligence sharing and potentially drone deliveries we're talking about potentially to Iran from the Russians, does that make the sort of battle lines a lot clearer for the United States, and does that then put the United States on the European side of those lines?
Well, it's very clear for us where the lines are, and clearly, I mean, Russia is not on the side of Americans. That's very clear. So there should also be pressure on the Russians because they are providing drones, but also intelligence.
Kaja Kallas there, the European Union policy chief. Now, NATO's European allies and Canada both raised defense spending by 20% for a second straight year in 2025. The NATO estimate reveals a total increase of $574 billion after yielding to the U.S. president's demands and responding to escalating threats from Russia. Well, Secretary General Mark Rutte says it reflects a shifting balance within the alliance.
For too long, European allies and Canada were over-reliant on U.S. military might. We did not take enough responsibility for our own security. But there has been a real shift in mindset, a collective recognition of our changed security environment.
And President Volodymyr Zelensky says Ukraine and Saudi Arabia has signed a defense cooperation agreement focused on technology sharing and investment. During a surprise visit to the Gulf, Zelensky offered Ukraine's specialized anti-drone expertise to combat Iran's drones. Now, in exchange, he's asking for support in securing supplies of critical U.S.-made missiles. Now, traditional allies are seeing the U.S. under Donald Trump as a less reliable partner. They're looking to hedge their bets by way of China. Here's a preview of this week's Bloomberg Originals documentary.
There's a phrase which China's President Xi Jinping likes to use. The world is undergoing changes which have not been seen in 100 years.
Now these changes have appeared to arrive, but they're delivered unexpectedly by Donald Trump.
Epic fury. I said I like that name.
Amid the noise of war, the stance of another major power is speaking volumes.
中方敦促各方立即停止军事行动。
The US is demonstrating itself to be a force for instability in the world. And that gives President Xi and China a chance to present themselves as the adults in the room.
China is happy to see the United States getting bogged down in the Middle East. China has long viewed the existing order as being too dominated by the U.S., so Trump's challenges to that order actually presents Xi Jinping a very good opportunity, and the question is whether Xi is ready to seize it.
In many ways, he already has.
Trump's first trade war made China realize that dependence on the U.S. is a very dangerous thing. China's exports to the U.S. fell about 20% last year, but in the end, China had a record trade surplus hitting $1.2 trillion.
China deliberately tried to diversify away from the U.S. as a consumer base.
So, do Trump's actions strengthen China or expose it to more risk it cannot control?
And you can watch the full piece online, including the Video Hub, Bloomberg Video Hub, and YouTube. Now, coming up, we'll talk to Amy Gower, metals and mining commodity strategist at Morgan Stanley, as gold slumps almost 17% since the Iran war began. That's coming up next, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The general report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg.
Gold has fallen almost 17% since the Iran war began nearly a month ago, moving in tandem with stocks. Now, spiking energy prices have raised the risk of inflation, raising bets that central banks will leave rates on hold or even hike them. Now, adding to the downward pressure, Turkey's central bank has offloaded more than $8 billion worth of bullion. Well, Amy Gower, metals and mining commodity strategist at Morgan Stanley, joins me. Amy, thank you so much for being with us. I mean, there's a number of factors, right, that could lead to explain the gold trade in recent years. Central banks diversifying reserves away from the dollar, investors seeking alternatives to bonds. But then in the last couple of weeks, it's really tricky also to understand what gold represents.
Mm-hmm. Yeah, look, I think we've had a shock clearly here with the conflict beginning, and I think it's not unusual to see gold initially pull back when we do get these shocks. We saw that in COVID, we saw that at the beginning of Russia-Ukraine, we saw this in Liberation Day, and this is where gold's liquidity works against it. It is your most liquid asset. It is what you sell to free up cash, whether that's to pay margin calls or reallocate elsewhere. It does also look like we've had a bit of technical selling. We've definitely found support at key moving averages, for example. We bounced off the 200-day, so that suggests that there's perhaps some technicals behind this. But I guess the difference for this shock versus maybe, say, Liberation Day is that what it means for inflation and central bank actions around interest rates. And I think, look, here we have seen the pricing on the Fed change from expecting rate cuts to rate hikes. We know gold is sensitive to that. We've had the dollar creeping higher as well. And if we remember last year, we did have arguably safe haven demand for gold, but with a weakening dollar, and that's highly unusual. So we're getting kind of the reversal of that as well.
So it doesn't fundamentally change your view on what gold could become?
I think, look, gold should still be that real asset. We should still be thinking about, I think that shift in investor demand for real assets that took place last year as particularly with concerns around fiat currency debasement. I think that narrative is still there, but I guess at the moment we do have to deal with some of the changes. And one thing I would say is, if you say your two big buckets of gold holders or gold buyers have been central banks and exchange traded funds, look, we can come on to Turkey and the sale, but the exchange traded funds they can flip from selling to buying and back again. In 2024 they bought zero. In 2025 they nearly bought as much as the central banks, and so they are quite sensitive to what the Fed is doing. And I'd say if the narrative does start to become that we are at risk of a hike or maybe a longer pause, you might see that liquidation coming through.
I mean, could you see more central bank selling of gold?
Yeah, look, it's always tricky to say. I mean, Turkey, obviously, it's a large amount, 60 tons of gold. Yeah. Central banks collectively bought about 860 last year. I think already we were seeing a slowing pace of buying, so then it doesn't take much selling to start to weigh down. There were some discussions, I think, in Poland around as well, a more active management of their gold reserves. I mean, Poland was the largest buyer last year, so if they started to sell, that would obviously have an impact as well. I don't think anyone else has said it as of this point, but definitely I would expect a slower pace of aggregate buying.
And Amy, I mean, I guess apart from, we focus so much on oil and gold as an asset, is there anything else in that space that you worry or that hasn't behaved the way that we thought it would in the mining world?
Yeah, so look, I would say base metals are having a sort of a push and pull factor as well, and maybe aluminium is the one that stands out here. So aluminium is the one where everyone's first attention was drawn to what could be disrupted by the Middle East. So the region is about 9% of aluminium production. A lot of that leaves as exports, and at the moment, obviously, that anything stuck behind the Strait of Hormuz is not really making its way out. The region is also very dependent on imports of alumina and bauxite. So again, are we running close to critical levels on those raw materials? So aluminium initially had a lot of support both to the price and also the regional premiums. That's now come off a little bit because we're starting to worry about growth. And so I think that's where the base metals have this push and pull. At the moment, it feels like aluminium is still outperforming the rest of the complex, which I think makes sense. But we'll have to see where these growth worries go.
I mean, I get it, because we're starting to think about possible demand destruction, right? If everything goes, what data points do you look at first to have a sense of, is it some of the data coming from China or elsewhere, to understand where some of these base metals go?
Yeah, look, I think China's the place where we typically get the most data. I would say actually on copper, that's been looking fairly encouraging with this pullback. So we've seen copper inventories in China pulling back faster than normal. We've seen physical premiums in China jumping. So it does actually suggest maybe that they've been buying the dip a bit here. I guess elsewhere is maybe where we'd see more of a slowdown. But what I would say is this is not 2022, which is where we had a very big demand shock. But part of that was exacerbated by the supply chain was very well stocked. We'd had the COVID supply chain shock. Everyone had started to hold a little bit more, that just in time to just in case. And then as interest rates went up, the cost of financing that went up and everyone destocked. I would not say we're there. I think if anything, this could actually prompt that restocking cycle when things have settled, because suddenly everyone's realized how vulnerable their supply chains can be.
I mean, how fast could that happen? Is it impossible to say at the moment?
I think it's difficult to say, and again, it's going to depend on interest rates because we have to think about the cost of financing. But I think, particularly as we go into 2027, I would expect, you're going to have to start hearing about stockpiling, and even at the government level, not just at the country level, company level.
Company level. Amy, so interesting. Thank you so much for joining us. Amy Gower, the metals and mining commodity strategist at Morgan Stanley. Now, again, if you look at everything that we've lived through this week, it stocks, we've had a great roundup from Amy on everything that metals have been doing today. Stocks seem to be extending their rout after China also launched these probes into the U.S., adding to a nervous sentiment driven by fears of a protracted war in the Middle East. Global bonds extending slump, or their slump. Treasuries actually falling alongside them, and the dollar little changed, with gold gaining. If you look at traders, if you look at S&P futures, Dow Jones and NASDAQ, they're pulling lower a little bit more than they were just 15 minutes ago, down 0.2%. And it's really this fear of this inflationary spiral that could force central banks to tighten monetary policy that we're on the lookout for. Up next, it's Bloomberg Surveillance, and this is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view. As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend. This is Bloomberg Television.
We're at a world now where there's heightened uncertainty.
If we have a peace deal, then we could have a relief rally in markets.
The market has been volatile during this period, but not a tremendous amount of downside yet.
The market is pricing in that there's going to be a resolution.
We are going into an area of really uncharted waters at this point.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, extending the uncertainty. President Trump says he's extending talks with Iran for 10 more days as the energy market is considering a closed strait until at least April 6th. It's leaving oil at triple digits, leaving bond yields at the highs of the year. The uncertainty persists.
So what have we learned this week? It has been a tumultuous week, and one potential takeaway could be that the Truth Social diplomacy plan is losing its punch when it comes to propping up markets. Yesterday, we got this Truth Social post that you were talking about from President Trump talking about postponing that deadline. We saw the worst one-day sell-off before that posting in the S&P since the war started. Now, we're still seeing equities lower. We're still seeing bond yields higher. We're still seeing oil prices higher. That is the takeaway for me.
This is the problem. We've replaced near-term escalation risk with an extension of the uncertainty. Persistence is the problem this morning. If the strait closure persists, triple-digit crude persists. If that's the case, you don't need oil to keep going on higher. You just need oil to stay at these levels to cause sufficient problems, which is why if you check out the bond market this morning, 2s, 10s, 30s, 2-year yields back to where they were Monday morning before that post on diplomatic talks. 10-year bond yields higher than they were on Monday morning.
And when you take a look at Japanese 2-year yields, they're at the highest levels going back to 1996. It's not just a U.S. bond market move. It is a global bond market move as they reckon with the potential of rate hikes coming from central banks around the world in response to oil prices remaining where they are. We keep talking about asymmetric risks. The longer this goes on, the more of a sea change people see with respect to inflation, downside risk to growth.
And we're tracking the troop movement. This from the Wall Street Journal. Check out this report. The Pentagon looking at sending up to 10,000 additional ground troops to the Middle East to give President Trump more military options. That's hanging over this market as well.
Absolutely, because if those 10,000 troops are sent to the region on top of the Marines and on top of the already deployed soldiers from the 82nd Airborne Division, that would signal to this market that that this potentially will be a longer, more protracted war, which is why potentially you can see crude stay higher for much longer. We should note, this right now is just a report, but it does show that the president is keeping his options open.
It just eats away at confidence. It eats away at the Fed's easing bias. It eats away at potential economic growth.
Why send troops there if you aren't going to use them? If you have this hardening line from both sides, and this is already going on for a longer period of time, and ships are not getting through the Strait of Hormuz, people are pricing in a slightly new regime, which is what you're seeing coming through the bond market, which potentially could be the real signal that people need to pay attention.
I think what's going on the Strait, obviously, is of critical importance to this White House. The president talked about it a lot yesterday when I was in the cabinet meeting. But then this morning, you see Iran says that the IRGC turned back 3 container vessels through Hormuz. So you think potentially they're allowing more individuals to come in, more vessels to come in if you pay the Tehran toll. But right now, this morning, they're turning back some vessels. And this is a massive problem for this White House.
Equity futures this morning down by about 0.1% on the S&P 500. Coming up this hour, Russ Kostrick of BlackRock as the president extends talks. Kevin Burke of Clearview Energy Partners with crude still pushing higher. And Joe Davis of Vanguard with policymakers warning of rising inflation. We begin this hour with our top story. President Trump extending talks with Iran for 10 more days. Leading our coverage out of the region, Bloomberg's Jumana Basenji joins us now from Dubai. Jumana, it's another 10 days of uncertainty.
Yeah, well, you know, on first blush, this actually came as a relief to the nations in the region. The strikes on infrastructure, on key civilian infrastructure, both against Iran, but also potentially in retaliation against the Gulf states, pushed back by 10 days. So that was the, I would say, short-term reaction. But beyond that, there's still a lot of skepticism about the state of these talks, whether they're actually happening, whether the Iranians do want to engage. And the Iranians, at least rhetorically, are not signaling that any discussions are taking place. And in fact, the Iranian Foreign Minister Abbas Araghchi gave an interview to local TV yesterday, and he said that they're not engaged in any talks to end the war. They don't have plans to engage in those talks. But the U.S. had sent messages to them via Pakistan, which is in line with the reporting over the last couple of days. But there is no sign whatsoever that this in-person summit that people had been talking about is set to take place. So that is the diplomacy angle. But at the same time, in light of what you were just discussing, I think we really are going into a critical weekend in terms of the mobilization of troops that the U.S. is amassing in this part of the world. And we've been reporting over the course of the last couple of days that there are 2 Marine expeditionary units making their way. Our expectation is that the first unit will arrive in a couple of days. The next unit should arrive in mid-April, just to give you an idea of the time frame here. Wall Street Journal reporting overnight that the Pentagon are also considering sending 10,000 troops alongside infantry and key vessels as well. And so the takeaway from all of this is the U.S. is preparing for perhaps another stage of escalation. And you've got to assume that once all of this new military assets, these new military assets are deployed, they are going to be in striking distance of Iran or Karg Island, which is the key export island, or there's going to be some form of an attempt to forcefully reopen the Strait of Hormuz. There are little islands situated nearby as well. So the overarching question as we go into the weekend perhaps is less about whether diplomacy is going to yield anything, but actually what the U.S.'s plans are on the ground, if there is a plan.
Jumana Basenji out of Dubai. Jumana, appreciate your time. Stay close. No doubt we'll get some news throughout this morning. The base case at the start of this war, it won't matter to markets if it's days and not weeks. Remember that? And then it was weeks and not months. And now here we are at the 1-month marker and a new self-imposed deadline of April 6th. So we'll be talking about this into April based on this guidance.
Prediction markets are saying that through the end of April, this could potentially be the reality. And the issue is, and people are watching this, you don't just open the Strait of Hormuz. You don't just say, okay, green light, go ahead. This is the issue, the lag time. And so as people try to price that in, it seems like another number of asset classes are really starting to respond.
It's the reality of production in the region. The longer some of the production is shut in, the harder it is to ramp up production coming out the other side.
And that's why Macquarie this morning is out with a note saying if this is protracted, it lasts a lot longer. You're looking at $200 a barrel when it comes to oil. We actually know and had reporting from our colleagues in Washington that the Treasury Department was modeling out what the impact would be for that number, $200. So that is another key threshold everyone is watching.
Let's get to the view on Wall Street this morning. Russ Kostrick of BlackRock writing the following: while our base case is no recession, the energy shock suggests a moderation in near-term growth expectations. Russ joins us now for more. Russ, welcome to the program. You and a team have been de-risking. Where and what in?
Good morning, Jonathan. We've been de-risking across the board. We've really been getting closer to benchmark in our equity positions, closer to benchmark in duration. We've been bringing down some of the factor risk in the portfolio. And there are a couple of reasons for that. The obvious one is we don't know how long this is going to go to continue. I think you used exactly the right word a few moments ago, persistence. And the longer this persists, the greater the risk to inflation, the economy. But the other reason for de-risking is that there really aren't any hedges in this context. In 22, the dollar actually was an effective hedge against the sell-off in equities. Last decade, treasuries were providing some downside when there were concerns about growth. In other circumstances, gold has been working. Nothing is working right now. So really the only thing you can do within a portfolio, other than making some adjustments at the stock level, is to bring the risk down.
I often say, in moments like this, the bonds don't work, they make things worse. Yields right now up again by 4 basis points for us, 10s at 4.45, 2s at 4%. Lisa and I yesterday spent a lot of time on a week 2-year auction, a week 5-year auction, followed by a week 7-year auction as well, Russ. What is happening there? What's behind those moves?
So this, to me, is actually maybe even a bit more interesting than what's going on in equity markets. It's very easy to understand. You have an oil shock, higher inflation, hit to growth, and what's happening with stocks. The bond market, I think, is more nuanced. Obviously, the bond market is reacting to what will be an increase in headline inflation. That said, as you point out, I think most people realize, higher energy, not just oil, but natural gas, higher food prices, higher fertilizer prices, all of which leads to an increase in headline inflation. But the problem is, one, that doesn't necessarily flow into core. And two, it is also a drag on growth. And it's happening at a time when the labor market is already a bit soft. So the notion that you just want to keep selling bonds into this, to me, that's less obvious. And I do think at some point, if the concerns about growth continue to build, if we do have $100 or higher oil for a prolonged period of time, there is a question about at what point you want to start bringing bonds back into your portfolio as a hedge against weaker growth, which is going to be another risk we're going to contend with.
Part of the reason why it's been so hard, Russ, to get a handle on when that point is, when people should step in and buy duration, is it's unclear exactly what's behind the sell-off. Is it technical? Is it a question of central banks that are selling what they can to raise money for possible fiscal stimulus? Is it a potential concern for a fiscal response to any kind of slowdown in the future? What's your take on this?
So I think it's a great question. To my mind, one of the things that's clearly going on is a pricing out of what would have been a number of rate cuts from the Fed and pricing in a greater possibility of hikes, particularly from the ECB. So is the front end of the curve is adjusting. You're seeing that movement throughout all of the yield curve. But again, if we're going to be in an environment where $100 oil persists, and I think, you all raised a good point a few moments ago, it's not as if oil is going to go back to 65 the second the shooting stops. There's been damage to infrastructure. There are questions about how long it takes to open the Straits of Hormuz. There is likely to be a war premium or a risk premium embedded in oil for many, many months. So if you're going to have that period of prolonged higher energy and all the knock-on effects, you've got to start to bring down your growth expectations, most of which were high coming into the year. And at some point, that probably does suggest bringing your duration up further.
Which is something that I know others, including JP Morgan, has been thinking of doing. Given all of this and given what we know in terms of the prolonged conflict, do you think that right now we're facing a market that is overly complacent when it comes to the growth shock that's coming down the pike?
I don't think it's overly complacent because I do think you've already seen a fairly significant adjustment. I also believe that, at least in the U.S., I think the situation in Europe is certainly more serious given their exposure to higher energy prices. I think the U.S. can probably survive 80 or 90 oil, still have a year when growth is positive. Of course, the difference is going to be that we're not going to get, or we're less likely to get, the type of above-trend growth that investors were expecting just a few months ago. And if you look at what the equity market has been doing, is actually responding to that. The rotation that dominated back in late 25, early 26 was all about the broadening out. You bought cyclicals, you bought value, you bought international stocks, you bought small caps. To my mind, those trades were predicated on above trend growth. As you start to price that growth out, you're seeing a reversal of many of those trends. Investors have been looking for more defensive parts of the market. And interestingly enough, they've also been looking at tech, at least on a relative basis, is holding up better in a world in which economic growth is not as much of a tailwind.
Hey, Russ, always got to catch up. Russ Kostrick there of BlackRock. Certain piece of tech, maybe, but the NASDAQ 100 down almost 10% from the highs of the last year or so, and some individual names have been hammered. Microsoft down some 30% from the highs of last year. Meta hammered yesterday, down 15% so far in March.
That was fascinating. It's frankly breaking below a lot of the technical trends, leading some people to say this has legs. Is it because of disruption coming from new technology, whether it's overseas or domestically, or is it the lawsuits with Meta coming under pressure for some of its social media controls? Tech is maybe the haven, but it depends where you look in tech, and that is an increasingly complicated story.
It's not just the war you've got to track, it's the situation with technology, AI disruption, etc., and this in private markets. Is this a flex from Oaktree? This headline we've just seen, they'll meet 8.5% of private credit fund redemptions in full.
100% it's a flex, because that's the headline they want everyone to see. Apollo, Blue Owl, all of you people, you guys can cap things at 5% and say, oh, I'm so responsible. I'm going to meet it in full and have no problem with it. So sure, this is definitely going to be a time where they're all kind of trolling each other. And this is how I read this headline.
More on that story a little bit later this hour. Equity futures here down 1/10% on the S&P with an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Good morning, John. President Donald Trump pushing back his deadline for a deal with Iran, saying he will pause attacks on the country's energy sites for 10 days. Trump also saying talks with Tehran are going, quote, very well. Iran saying it's waiting on a response from the U.S. after rejecting its peace plan and offering its own conditions to end the war. A legal victory for Anthropic, the maker of the chatbot Claude, winning a court order blocking a Trump administration ban on government use of its AI technology. Anthropic arguing the ban could cost it billions in lost revenue. And the Senate passing a bill to end the Department of Homeland Security shutdown. The bill still needs to pass the House and be signed by President Donald Trump. Ahead of the bill passing, Trump saying he would sign an order to pay TSA officers. That's your Bloomberg brief. John.
Hey, Yahira, thank you. More from Yahira later this hour. Up next on the program, pushing allies to step up.
Very little of our energy comes through the Straits of Hormuz. It's the world that has a great interest in that. And so they should step up and deal with it. They should be doing something about it.
Up next, we'll catch up with Bloomberg's Colonel Wayne Sanders. He joins us next, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Biggest one-day loss since the war started in yesterday's session this morning. No pickup, no bounce. Even as the president extends talks, he extends uncertainty for this market. The Nasdaq is down by 0.2%, and this move continues. Weak 2-year auction, weak 5-year, soft 7-year. Bond yields up again, 2 basis points, north of 4% on 2s, on 10s, 4.46. Yields right now are higher now than where they were on Monday morning before the president declared there were talks.
We're now pricing in a 50% chance of a rate hike from the Federal Reserve by October, a 75% chance for an ECB rate hike, at least one, through the end of the year. And right now, it's a real question mark. If this goes on for a longer period of time, Christine Lagarde coming out and saying, we cannot be humble about our goal, which is getting inflation down to 2%. So even if it is a marginal move higher, we have to take action, seeming to confirm the hawkish bias.
It's pretty simple. The longer the talks go on, the longer the strait is closed. That's the view of the market right now, which means crude stays at these levels. Brent around triple digits, 110, almost 110 this morning. WTI 96.
Or the talks are basically just a distraction because the President of the United States is making sure that the right personnel is in place so that he can open the Strait of Hormuz. But I think one thing to really understand is that even if the U.S. military was able to open up the Strait of Hormuz, maybe also with a coalition, the FT is reporting the UAE would be willing to join this sort of coalition, it is not going to be normal flow of traffic in terms of volume that we are used to. So regardless, it is going to be weeks and months that this is going to be impacting the energy market.
Persistence is the problem. Under surveillance this morning, pushing allies to step up.
Very little of our energy comes through the Straits of Hormuz. It's the world that has a great interest in that, and so they should step up and deal with it. It can be open tomorrow if Iran stops threatening global shipping, which is an outrage and a violation of international law for all these countries that care about international law. They should be doing something about it. There was a couple of the leaders in Europe who said that this was not Europe's war. The United States is constantly being asked to help in a war, and we have more than any other country.
So here's the latest this morning. Secretary of State Marco Rubio at the G7 foreign ministers meeting in France, with the U.S. seeking support for opening the Strait of Hormuz. Bloomberg's Ollie Crook joins us now for more. Ollie, what's the update on the talks?
Yeah, for the G7 finance, or I should say foreign ministers gathered here. You have Marco Rubio just in that room there behind me having discussions with the foreign ministers of other G7 nations, but also very interestingly and very relevantly, the Saudi foreign minister who is here as well. For them, you know, it's going to be a fact-finding mission to get from Marco Rubio not only what the U.S. war aims are in Iran, of course that has been the big question for everybody, but also further to that, what are the specific things that are being asked of European allies? We've of course heard from Donald Trump yesterday saying that NATO had been effectively useless to them in the Straits of Hormuz and that he won't forget it. The question will be specifically what kinds of things the Europeans, the G7, can present. What we understand now is under discussion at a high level is a coalition of more than 30 countries. We had the NATO Secretary General Mark Rutte speaking yesterday about that would be involved in some way, this coalition of the willing to open up the Straits of Hormuz. Now, there's several questions attached to that. The first is willing to do what and willing to do it when. I've spoken to a number of officials here, including the Canadian foreign minister, a spokesman for the French here, who had originally floated this idea of being actively involved in opening up the Straits of Hormuz, and I couldn't really pin anyone down in terms of the timing. They say really after the majority of the war is done, but as you know, the war doesn't necessarily end cleanly. I think there's also an effort here by the Europeans to link the war in Iran with the war in Ukraine, saying that the Russians sending drones and intelligence are actively targeting U.S. troops and U.S. lives. That is a line they want to draw, but as you say there, John, the line that Marco Rubio wants to draw is that everybody's saying the war in Iran is not our war. The Americans say Ukraine is not our war, but we're still helping.
Ollie, it's good to catch up. Stay close. We'll catch up with you later if we see any headlines. Ollie Crook there on the ground in France. Joining us now to extend the conversation, Colonel Wayne Sanders, Senior Defense Analyst at Bloomberg Intelligence. Colonel, welcome to the program. Can we talk about the potential for a ground operation? Could you describe what that might look like and what the objectives would be?
Absolutely. When you think about ground operations, especially with the limited number of troops that are on its way, it is something that would probably be limited in scope. It's probably, you know, we look at the 2 Marine Expeditionary Units that are on the way. The first one's coming from the USS Tripoli, should be there over the weekend, and then the USS Boxer in the beginning of April. But any type of insertion, right, is going to require air superiority, which we already have. So you would actually see an uptick in overflights that would allow for those type of security operations to make sure secure passage to go there. Whether or not they're being airlifted in or whether or not they're actually going into the strait. We think about like Karg Island being one of the areas where you could potentially see boots on the ground because it is limited in terms of its its mainland Iran status, if you will, to be able to go there. But when you look at this, one thing I do want to bring up is the difference in troop numbers that are going out there now versus previous escalations, because people are talking about the ground strike portion of it. The U.S. troop count when in Desert Storm was 697,000. The amount of people at OIF, at Operation Iraqi Freedom in 2003 in Iraq, that was about 160,000. So we're only talking right now at about 10,000. Even if you bring in another 10,000, you're talking about 20,000 total. So a lot less. So it would be very, very surgical in terms of what they're trying to accomplish.
If it's surgical, does that mean that this wouldn't be a garrison of troops set up at one of these islands?
Well, that's about all you would be able to do with that, right? Is because you would have to be able to set up enough security, bring in logistics, refueling, everything that's required, air defense assets that you would have to set up to be able to provide security for those infantry and Marine Expeditionary Unit forces to be able to hold that. The straits are pretty long, so even when you're looking at where the choke points are and being able to do that, you still have to figure out how are you going to make sure that you can get rid of some of the asymmetric threats that can show up with shoulder-fired missiles. Because at this point in time, as you've seen, it doesn't matter. It doesn't have to be a full closing. Iran at this point in time has just had to threaten those attacks, and it has stopped most of the flow.
Does the president's new deadline of April 6th match up with the ability to get all of these troops in place?
I think it does a little bit. His original deadline of this weekend, right, was tied to the Marine Expeditionary Units coming in. There are additional capabilities that are coming in, and one of the other things we've seen President Trump do is he doesn't like to choreograph his moves. Most of the success has come from ones that hasn't been choreographed. Operation Midnight Hammer, nobody knew it was coming. And then even when the strikes originally happened on February 28th, same kind of thing here is that extension allows him to have additional options, even if he was going to do something with just one Marine Expeditionary Unit as they come in, or the 82nd Airborne, the elements of them that are coming in as well. It gives him freedom of operations at that point in time. There are more options available now as opposed to having to answer to a deadline that was set for this weekend.
Colonel, appreciate your time. Fantastic framing. Colonel Wayne Sanders there of Bloomberg Intelligence. We've talked repeatedly through this week about two-way risk. The two-way risk persists.
Even though there was a dialing down of the temperature, and this is the key point, a question of even if you don't necessarily have this bimodal outcome over the weekend, there still is a feeling that we don't have a sense of resolution. Why would anyone take big risk at this moment, especially with the lingering after effects?
You've got to remember who turned up the temperature to begin with. The original threat came from the US side to bomb energy plants in Iran, and that moved from an immediate threat to a 5-day period of talks, and that's now moved to a 10-day period of talks, taking us to April 6th. So you can turn the volume down all you like. This market's been focused on one thing, obsessively. The volume of traffic going through the Strait of Hormuz, what it means for production in the Middle East, the damage done there too. And if this persists, this story doesn't change, it gets worse.
And frankly, that is exactly why this is so different than what we saw during Liberation Day, because you could turn the temperature back down and it wasn't the Strait of Hormuz and it wasn't a physical goods. The fact that now UAE and Saudi Arabia are coming out and saying, you better not leave, and then leave this quagmire with us to deal with, gives you a sense of how this could develop.
I'm struck this morning. 2 Chinese vessels tried to go through and they had to make a U-turn.
If you're hoping for a change for the better, you're not seeing one right now. Coming up on the program, we'll catch up with Kevin Burke of Clearview Energy Partners, with oil rising as traders brace for a longer war. Live from New York City this morning. Good morning. You're watching Bloomberg TV.
phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
So we had a self-imposed deadline and the president has delayed 10 more days of talks. The price action might not be what you expected. This is seen as 10 more days of uncertainty, 10 more days at least of the Strait of Hormuz being effectively closed. Equity futures on the S&P down by 1/10% following the biggest one-day slide we've seen so far throughout this month, throughout this war. In the bond market, 2-year, 10-year, 30-year yields making new highs for the year. The 2-year, north of 4%, 10s at 4.46 and up 4 basis points. On the front end of the curve, up by 2. And this is following some pretty soft auctions through the week so far.
Yeah, and Russ Kostridge said it perfectly, which is you can't hedge anywhere, and it hasn't been a hedge in the 2-year yield. It hasn't been a hedge in the 5-year yield. And in the 7-year yield, when we got the auction yesterday, the similar kind of messiness, albeit even less, actually, ironically, than the 2 and the 5-year. The 60-40 portfolio, worst monthly performance right now, going back to 2022.
You don't need crude to go up a lot from here. Crude just holding on to these levels causes its own problems. And we're holding on to these levels, 110 on Brent, 96 on WTI. That's a problem. Once again, the P word. It persists.
It persists, and it is a problem because this is a global market. I was struck yesterday by the Treasury Secretary saying the global oil market is well supplied. Well, if it's so well supplied, then why are we taking all these extreme measures? Why are developed countries having to go into their stockpiles and release? And why is the president threatening all these troops to open up the Strait of Hormuz? Because it is priced globally, and right now, yes, the United States is dealing with this, but if this persists, a lot of issues are going to be prolonged. And it's not just crude. Fertilizer. You have to make these orders in the next 5 to 6 days, and we are reliant 20% on imports of key fertilizer ingredients.
There's a lot of options on the table heading into April 6th as we count you down to the opening bell. 3 hours away. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We start there with oil, with the U.S. energy producer Battalion up 14% in the pre-market as it tracks another rise in oil prices. And I thought Deutsche Bank put it best this morning, saying that while President Trump's 10-day delay for strikes may ease immediate risk, there's still no clear path to a resolution with Iran. So that is keeping supply concerns front and center and benefiting these domestic oil stocks. And it's not just oil, gold moving higher as well, and that is benefiting mining stocks like Hycroft up 2% in the pre-market. And what's notable here is that during this conflict, we have seen oil and gold moving in opposite directions, but today we are seeing them move in lockstep, both rising. And we end on AstraZeneca, those shares up 3.8% in the pre-market after late-stage data showed its drug to treat a deadly lung disease helped alleviate symptoms. And analysts say that this one drug could bring in nearly $1 billion in annual sales for the company. So shares up on that news. John?
Yahara, thank you. Appreciate the update. More from Yahara in just a moment. On our radar this morning, President Trump extending his deadline for striking Iranian energy sites for 10 days. In a social media post, the president writing talks are, quote, going very well. Tehran insists it's not negotiating with Washington. The White House considering sending 10,000 more soldiers to the Middle East. A senior U.S. defense official reportedly saying the forces would be in addition to thousands of Marines and paratroopers already deployed redeployed to the region. And finally, the Senate passing legislation early this morning to fund most of DHS. The deal approving funding for the TSA, but not for ICE. The budget impasse jamming airports and disrupting travel around the country. The measure heading to the House for a vote as soon as today.
And really the issue for me is, does this actually matter, given the fact that President Trump has already ordered that they get paid out of a discretionary fund? Has in some ways Congress absconded its function once again to the president, who is superseding them as they wait to vote on this measure? I just wonder how much pushback they get, because suddenly there is more time that they potentially could continue negotiating this, given that perhaps TSA agents are already going to be paid.
Two things stood out for me. One, if the president had this authority and found these funds, why didn't he do it weeks ago, before we lost all these people at TSA, before TSA workers were not getting paid? How difficult is that, to continuously miss paychecks? I'll tell you this, lawmakers aren't missing paychecks. And two...
And they're cutting lines.
Yes, and they're... Yes, exactly. And GOP leaders have, for weeks, resisting Democratic calls to say, let's just do a deal, let's pay TSA, and let's come back to the table and discuss what's going on for ICE and CBP. They said no, they said no, they said no. And guess what? Last night at 3 a.m. when we're all waking up, they're voting for it.
I don't know why politicians in Washington don't realize the following. They play this game where they want to make it about Republicans versus Democrats. If you're in that line, you just hate Washington. You just despise Congress. And you see this in poll after poll. There's one great poll about the handling of the economy. Are you happy with the handling of the economy by the president right now? And you'll see in that poll, no, people aren't happy. Then you'll ask them, do you think that the Democrats would handle it even better? And they'll say no in the very same poll. The consequence of this mess is not one wins versus the other. People just turn against Congress and the politicians representing them.
Everybody loses, essentially, is the way that this works. People lose politically, and people lose when they try to travel anywhere. One individual who went down to Washington, D.C. to discuss with them this, who actually is in the industry, asked them, why don't you just pass this bill, get TSA agents paid, we'll resolve this issue, you guys can scrabble, fight over everything else. What they said was, nothing gets done if we remove this point of leverage. It's very honest, but my goodness, it does not read well in this society.
Not good at all, is it? Not good at all. Let's focus on crude, pushing higher once again with no off-ramp in sight for the war in Iran. Kevin Book of Clearview Energy Partners writing the blockage of crude through the Strait of Hormuz could be more than offset by SPR releases in the Americas, but inventory levels in Europe could drop if current conditions persist. Kevin joins us now for more. Kevin, welcome to the program. This situation does persist, so let's assume, and it is an assumption, things can change, it's a self-imposed deadline, but if this continues through to, say, April 6th, what would that mean for this energy market?
John, good to see you. Look, we've got 10 more days for inventories to decline. The cold mathematics of inventory depletion are much like the cold mathematics of viral replication. If you go back to COVID, the problem was building around the world, markets, and really America missed it, and it's going to catch us.
Well, how much drawdown could the United States continue to do without going back and refilling the SPR?
There's room for the SPR to come down further, but not much room. And part of that's got to do with legislation and the ability to draw further under emergency conditions versus non-emergency conditions. Part of that's got to do with the practicality of the SPR. Having it available for big crises means you want to keep some in reserve. If this isn't over in 10 days, maybe you want it around longer.
Kevin, if the U.S. administration knew that this was a possibility, and it always was, the president, I remember a year ago talking to him about this. He prefers a diplomatic route, but he was steadfast. Iran will never get a nuclear weapon. He's willing to deal with them the hard way. Why were they not refilling the Strategic Petroleum Reserve?
As you know very well on this network, the Secretary of Energy asked for $20 billion, or at least mooted the proposition last year. And in what was probably the most catastrophic mispricing of risk in recent congressional history, they gave him $171 million. So without money, you can't refill the reserve.
When it comes to the OECD stocks, how does that actually impact the price of oil?
There's a very strong inverse correlation between OECD petroleum inventories and the front-month Brent crude price. And it's one of the relationships you can count on for a reason. When there's less oil in stocks, if it can't come out of inventories and it can't come out of the ground, it can't come out of the strait, where's it going to come from? Prices go up.
Is this an oil problem, Kevin, or are we overplaying the oil aspect of this and underplaying the natural gas aspect?
I think the natural gas aspect is pretty significant at the margins. It's easy to overlook it in sort of the total energy picture. And frankly, the two are related in a very significant sense. 4% of the world's energy consumption in terms of oil and gas bottled up in the Strait right now means that there's substitution fuel pursuits happening all over the world. In the last crisis, 4 years ago, we went from missing gas westbound into Europe, drawing liquids demand from petroleum for generation in Asia. Now those liquids aren't available either.
We do see, though, that the United States has been ramping up the production of liquefied natural gas and had previously been exporting a growing proportion to Europe in particular to offset the decline coming from Russia. How much do you see that continuing versus maybe a little bit of restraint on that front as natural gas prices in the U.S. also climb?
Well, they haven't climbed very much, and I think that's one of the significant takeaways of the LNG story here in the United States. There's still a great deal of missing connectivity that would provide for those prices to rise. There has to be some way to expand volumes in response to the deficit in global markets for there to be that kind of price response. And even then, we have a very flat supply curve. I think that when you look at importing governments, they're all going to be asking one question after this, and that question is, how can we make sure this never happens again? One answer is to diversify sources and routes. To the extent that routes are the solution, the United States can provide an answer.
That's certainly going to take time. Kevin, I want to finish on this, just a piece of scenario analysis, if you will. If there is a ground operation to take Karg Island to try and reopen the Strait of Hormuz, how do you suspect the futures curve would price that? Would it begin to price in a resolution to this war? Would it drag prices lower or push prices up?
I think we have to ask what the Iranian riposte would be to that, John. And I think the answer might be that they'll look westward at those cargoes going to the Red Sea, and maybe we see an activation of the Houthis in the next leg up in risk. So I'm not sure that's the answer we'll see in the market.
I think I understand where you think prices will go. Kevin, thank you, sir. Kevin Book there at Clearview Energy Partners, because if the Houthis get involved, we got another problem.
Yeah, and yesterday I thought that it was fascinating, the interview that AMH did, the indication that right now Saudi Arabia is paying off the Houthis not to interfere with the Red Sea passageway. Gives you a sense of, the rule by mob that seems to be going on over there.
But that could change, because obviously their biggest beneficiary is the Iranians. And at some point, the Iranians could say, we need to escalate this. We want to put the pressure up even higher. We want to move crude prices closer to a very painful threshold for this White House. And he could tell them to get involved. And all you need is one drone, one speedboat at the Bab el-Mandeb Strait, and this east-west pipeline that Saudi Arabia has been using to move 3, 4, 5 million barrels a day. Now that crude all gets stuck.
Brent crude right now. Brent 110, WTI 96. Let's get you an update on news worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Secretary of State Marco Rubio meeting with his G7 counterparts in France. Rubio may have a hard time gaining support from U.S. allies a day after President Trump complained about NATO countries not stepping up to help with the war in Iran. Nicolas Maduro appearing in a Manhattan federal court yesterday. You can see the court sketches there. The U.S. is pushing ahead with a broad drug trafficking and narco-terrorism conspiracy case against the ousted Venezuelan leader. And Oak Tree Capital Management is meeting all redemption requests for one of its private credit funds. According to a regulatory filing, the company is allowing investors to take out 8.5% of net assets from its strategic credit fund, which is equivalent to around $400 million. That's your Bloomberg Brief. John?
Yahira, thank you. The ultimate flex. Brahma was talking about it earlier. Everything just feels like a marketing campaign right now. They're all throwing shade at each other in private markets.
This is an opportunity for people to potentially gain market share and to show who the bad apples are and that they're the good ones. To me, this is saying you have to cap it. We don't. We're good.
The Oak Tree flex early on this morning. Equity futures right now, the S&P negative by 1/3 of 1%. Up next, the inflation warnings piling up.
Moreover, the conflict in the Middle East raises additional risks.
I still see underlying inflation as gradually moving down.
The inflation risk is greater right now as a result of the Iran war.
We'll get to that divide in just a moment with Joe Davis of Vanguard.
Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck. I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on. Stay tuned. You won't want to miss it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Uncertainty extended. Equity futures down by 1/3 on the S&P, following the biggest one-day slide on the S&P 500 so far this month since the war started. The S&P at the lowest level we've seen since early September. On the Nasdaq, we're down another 0.5%. The Nasdaq 100 very, very close to correction territory, down almost 10%. From the high of the last 12 months. In the bond market, new highs for this year: 2s, 10s, 30s, 10s, 446 up 5 basis points, 2 up by 3 basis points to 4.01%. This is the pain trade for me, Bremer. This is the pain trade for me. We've flipped from easing to tightening over at all these central banks, the Fed, the ECB, the Bank of England. And in this market, when you speak to anyone in fixed income, they talk about the value created in the yield curve and the opportunity to step in. There's so much doubt about this persisting, which makes it so much more painful.
If it continues to go up. And what you did see last week, in this past week, long-term bonds have seen their second largest ever withdrawal, their biggest withdrawal going back to March 2020. This is according to EPFR and Bank of America data. And Michael Hartnett over at Bank of America said, expect policy panic to avoid recession. Guess what? He's looking for that yield curve steepener as a result of the fiscal response to avoid any kind of serious economic downturn. This is the potential pain trade that you're talking about.
Check out crude, Brent, and WTI. There's 3 scenarios here, and we usually only talk about 2 of them, and these are the 2. The two-way risk that crude crashes from here on the back of a resolution, or things escalate and crude spikes to 150. What about the problems caused by just staying around these levels? And that's the conversation I think we have to have this morning as we talk down another 10 days of talks between the US and Iran, and Brent crude around 110.
Well, it's going to be very complicated, and not really as much for the United States as is the rest of the world. You're already seeing some countries like the Philippines saying this is a state of emergency. Asia is still the front lines of this crisis when it comes to the energy shock, telling people work from home, take carpools, and then it's really going to start to hit Europe. And that's going to be a big problem, and I'm sure Secretary Rubio is hearing about it right now in France at the G7.
Brent crude 110.50, WTI north of 96. Under surveillance this morning, inflation warnings piling up.
Moreover, the conflict in the Middle East raises additional risks. Higher oil prices tend to pass through pretty quickly to gasoline prices, and higher gasoline prices can be particularly painful.
I still see underlying inflation as gradually moving down towards target over the next 12 months.
I would argue that the inflation risk is greater right now as a result of the Iran war.
So here's the latest this morning. Federal Reserve officials raising concerns about the impact of the Iran war on inflation. Treasury yields setting new highs for the year as investors shift expectations from rate cuts to possible hikes. Joe Davis of Vanguard writing, the key indicators I'm watching are twofold. One is clearly just the labour market. The second has always been a wild card, the price of oil. Joe joins us now for more. Joe, welcome to the programme. Two time horizons. Let's start with the first. Quite short term. I want to start with the March data and the April data. What are you expecting to see in the March and April data?
Well, we're going to continue to see inflation that's somewhat stubborn. I mean, if you look back over 2 years, obviously some progress, but our theme going into the year before the events just in the Middle East was that the Federal Reserve was going to be a little bit challenged to deliver in the cuts expected because a little bit of this stubbornness in inflation. And so, again, that's before oil has moved. So we're going to see mixed signals, and some of it is dated given what we're seeing in the oil markets.
Joe, in line with that, how do you expect central bank communication to adapt, to evolve between now and the April meeting?
Well, I think we're starting to see it. You're going to have to talk tough on inflation. This is, central banks, generally speaking, have some scar tissue going back several years. And so I think the tougher you talk, the less you actually have to do. And I think that's where we're at. I think you're going to have to address the fact that although the oil spike will push up inflation, push down growth, you have to focus on the former, not the latter, just from a risk management perspective. I don't see the Federal Reserve hiking anytime soon, just because of the cross currents it'll do in labor market. But nevertheless, this notion of easing significantly because of the downdraft in the economy, you got to be careful with that timing, even if that would ever happen, because we need to see a lot of events unfold before we go down that path.
And Joe, this is the reason why when John says, what if oil prices just stay around here? Potentially that could be one of the more toxic scenarios for central banks, because they may have to respond more to ongoing inflationary pressure with growth continuing to hang in there, at least reduced, but at least positive. How do you see the Fed responding to oil prices staying here versus spiking higher or going back down?
I think that's the most interesting dynamic, what your conversation is this morning, because obviously if it collapses, we have obviously a risk on, and this is more of a return to other factors that we were watching. Obviously 150 price of oil per barrel starts to bring in the recession risk much more prominently, but it's a persistent around $100. You have to redo the calculus. I think that now that is a Federal Reserve that is very much on hold and is not going to get the disinflationary effect that you were banking on. And so I think that's the more interesting scenario. And I think that should be, more seriously considered than perhaps even the other two for the time being.
What do you think the bond market right now is pricing in, given the fact that we've had a repricing across the curve? Yes, there has been a curve flattening. Short-end yields have risen more than long-end yields, but long-end yields continuing to sell off with some auctions that represent real weakness. Is this people who are gaming out growth, rate hikes that persist, stagflationary types of situations?
It is doing both. I mean, we got a little fiscal in the background at the long end of the curve, but it is really oil. Does it dominate on the growth side or on the inflation side? And again, I think there's a really healthy debate. I mean, we're talking about it this morning, 3 scenarios, not one. And so you're going to get really some volatility on the yield curve. I think the intermediate part of the curve probably looks the most attractive and potentially safest if you talk to our fixed income team. So again, I think it's premature to talk about a Fed easing because the oil hit takes down growth, just given what we've been. And the fact is inflation is not super high, but it's above target. And you have to reflect that in your timing, even if you're bearish in oil going much higher.
In the meantime, how isolated is the U.S. economy from the rest of the world? A lot of economists have come on and said that Europe faces a real problem, Asia faces a real problem. The U.S. is somewhat insulated because growth has been at a higher pace. You have the tech impulse. Is that sustainable?
It is. Again, it all depends upon where oil goes. What we would need to see to have really a downdraft in growth are really two things. It's not just the price of oil, which we all feel at the gas pump, but it's also the fact that we would need to see financial conditions really weaken. So the equity market here is actually the wild card. The equity market would have to start pricing in downdraft in earnings significantly so that it would pull back some of the business investment and high-end consumer spending. It would have to shake confidence of CEOs and on the consumer side to really, because those are the really two strong foundations for the U.S. economy, hence your point. So again, you would have to see that foundation really become rocky before we're starting to talk about Fed easing here.
Hey, Joe, it's good to see you. Thoughtful stuff and lots to think about. Joe Davis there of Vanguard on this economy and energy prices. Central bankers know what to do in extreme situation. When you hit extremes, central bankers will know what to do. If you gap lower on crude and you crash back down to 50, 60, opens the door to cuts. If you spike higher to 150, pushing 200, they'll start worrying about growth. Mike Gapon of Morgan Stanley will break this down for us a little bit later. If you persist at these levels, they're stuck and they don't know what to do. We see this time and time again with the central banker. If you throw a recession at them, it's obvious what that central bank is going to do. You throw the middle ground at them, things get complicated.
Morgan Stanley, I'm glad you brought them up. They're the ones that say this $100 to $110 a barrel. That kind of range leaves rate hikes back on the table and potentially certainly no move from the Federal Reserve based on the ongoing inflationary pressure without that hit to growth. That, to me, is the most interesting situation, as Joe Davis said, and frankly, is one that this market is trying to grapple with.
Can we see a Federal Reserve that has to quickly hike rates to then get a growth shock and then unwind them, all while they have a leadership change at the top? I'm still confused about who will be running the Federal Reserve come May 16th.
You're not alone. Is it going to be Kevin Walsh? Is Chairman Powell going to be around for the rest of the year? Based on how things are trending right now, I'm not sure Chairman Powell wants to be around for the rest of the year, based on where things are headed.
Yeah, he would like to have this wrapped up. I think there is a sense of confusion about why there wasn't just an easy out taken so that we could resolve the subpoena, the investigation, and get on with it. Nonetheless, clearly the lack of clarity around the Fed reaction function adding to the volatility that we're seeing in bond markets and some of the messy auctions that we saw this week.
Yields up this morning by 2 basis points on 2s north of 4%, on 10s north of 440, with crude right now 110 on Brent, on WTI at 97. Coming up next, we'll catch up with Bob Michael of JP Morgan Asset Management, Tobin Marcus of Wolfe Research, the ECB Governing Council member Pierre Wunsch, and Sonal Desai of Franklin Templeton Fixed Income. The second hour of Bloomberg Surveillance is just around the corner as the uncertainty persists for global markets as the president extends talks for another 10 days between the US and Iran.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
We'll really start to see that energy price shock feeding through in the March data.
It could create some real challenges for the economy.
The central banks are in a tough spot.
They need to continue to focus, very closely on the data as it evolves.
I am concerned about the fiscal outlook.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action and scores look like this. Negative 0.4 on the S&P following the biggest one-day sell-off so far this month on the S&P 500. We sit here now at the lowest level since early September. Coming into Friday morning, the losses continue, down by 0.6 on the NASDAQ and in the bond market, unlocking high yields on 2s, 10s, 30s. New highs for the year, 446 right now on 10s. And in the commodity market, crude drifting higher. It persists, and it's persistence that we need to talk about. Brent crude at 111, WTI at 97. The president saying this: please let this statement serve to represent that I am pausing the period of energy plant disruption by 10 days to Monday. This market is not celebrating the removal of near-term escalation risk. This market is wrestling with the extension of uncertainty to Monday, April 6th, 2026.
This isn't a market that can embrace a taco trade, the so-called Trump always chickens out and he can reverse course, partly because he can't. This is a now multi-party conflict that's dealing with physical assets being shipped. It is the Strait of Hormuz, this key waterway, and a question of who's going to ultimately control this. And frankly, his discussion is coming, given the reporting that we have right now, with tens of thousands of troops lining up to potentially make their way. This raises a question of what it's going to take to de-escalate and whether the persistence has already gone on long enough to create some real damage.
That's a key point. 2 Marine Expeditionary Units are already en route. And then on top of that, we have the 82nd Airborne Division that has already been deployed. And then on top of that, the Wall Street Journal this morning talking about the fact that the DOD is weighing whether or not to send 10,000 additional ground troops. So while the market is digesting the fact that this might be prolonged and the president's kicking the can in terms of these talks, at the same time, there's reporting that there is serious concern and discussions about the decision being finally made that this is actually going to escalate in a serious manner with more personnel on the ground.
Kicking the can does not provide relief anymore. Kicking the can for a market looking for a resolution is not going to provide comfort. When you kick the can, you're guaranteeing the strait will remain closed. You're almost guaranteeing the crude will hover around triple digits. And that's the additional scenario we're talking about throughout the program so far. We've been going back and forth on this. We've been talking about the two-way risk. It's resolved. Talks are a success. Or escalation. Things get a whole lot worse and you start hitting energy plants across the country. They retaliate across the Gulf. There's a middle ground. This just continues, lingers. The strait remains closed. You hold on to triple digits in crude, and that causes its own problems.
It's not exactly a growth shock to the same degree that, say, $150 a barrel would be for the United States. It's not an all clear as going back to $65 would be. As Russ Kostrick of BlackRock said, and I think it was a really good point, nothing is working in this backdrop. There is no haven trade. It is not gold. It is not bonds. It is not stocks. It is not even, as we saw yesterday, some of the tech stocks. So what does an investor do with what looks increasingly like a stagflationary type of backdrop?
And Tehran did not take that Truth Social post as a moment to maybe have a reach out through the Pakistanis and say, yeah, you know what, we will come to the table. This has been challenging for us. Our entire top-level brass of individuals governing this regime have been taken out and targeted. Nope. What do you have today? You have missiles over Riyadh. You have the Strait effectively once again closed. IRG starting back 3 container vessels in Hormuz this morning. They even made an abrupt U-turn. Chinese vessels made an abrupt U-turn, wasn't able to get through safely. At this point, Tanker Tracker says that at this rate, only 2 tankers a day on average go through the Strait of Hormuz. Far cry from the more than 100 a day we saw before this war.
Yeah, and these headlines from the Israeli defense minister from moments ago aren't going to help things. They're pledging to escalate and expand the attacks on Iran, saying the escalation would be in response to Iran targeting civilians. That's the escalation we're looking for. And as you've reminded us repeatedly, this is not just a war between Iran and the United States. There's other actors involved here as well.
It's Israel. It's the UAE, which came out with an op-ed in the Wall Street Journal saying, hey, this is getting really annoying to us. We want to offer some deterrence. You're getting Saudi Arabia involved too. This is a much more complicated backdrop.
Futures near session lows on the equity market on the S&P 500, negative here by 0.5%. Coming up on the program, we'll catch up with Bob Michael of JP Morgan Asset Management. With crude holding on to triple digits, the ECB Governing Council member Pierre Wunsch joins us on the potential for rate hikes, and Sonal Desire Franklin Templeton with the bond market on very shaky ground. We begin this hour with the bond market struggling as crude hovers near 110. Bob Michael of JP Morgan Asset Management writing central banks are all in a terrible position. Overall, the bond market continues to struggle to manage this inflation shock, and it's testing reaction functions. Bob joins us now for more. Bob, good morning.
Yeah, happy to be here.
Good to see you, buddy. And first of all, congratulations, Mr. $1 trillion man.
Yeah, thank you.
$1 trillion in AUM, and I know what a team effort.
Fixed income business is doing well.
That has been. Fixed income itself is not doing well.
Not today.
So let's talk about that. What's behind the shakiness and the fragility in fixed income?
Well, I think there are a couple things. I think, first of all, you're right. The bond market is pricing in the worst of all scenarios, which is the administration is desperately looking for an off-ramp, and there is none available. They're not going to cede sovereignty and control of the Strait of Hormuz to Iran. So if Iran doesn't give them a palatable off-ramp, then escalation is the only path forward. I think the second thing that the bond market is dealing with is we came out of the FOMC meeting a week and a half ago with the FOMC more concerned about the labor market than inflation. They had rate cuts still priced in for this year and next year. They were willing to look through it, and now you're hearing more hawkish tones coming out of the FOMC, particularly from Waller, who's right. It's not just about energy. You have to think about fertilizers, the planting season in the U.S. and across the world, and could that ultimately pass through to finished goods and prices?
We've caught up with your team a few times over the past few weeks, Kay, Priya, Kelsey. They've all said something similar, that we're unlocking value here in bonds, that yields are higher, that this should introduce demand. But we haven't seen that at auctions this week, and I think people have found that surprising. 2-year, 5-year, 7-year auctions, soft. Why do you think that is? Who's not turning up to these auctions that would typically turn up and buy these bonds?
Because things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. Just stand out of the way. Keep positions that you're comfortable with riding through this. Let the market wash itself out. That's always been the best thing to do. And if it's at levels that you want to add to positions, then sure, go ahead and lengthen duration, add to a bit of credit. Right now, we're still not expecting recession. You have to go well north of $120 a barrel for a recession. So in the meantime, just let the markets go to wherever they're going.
Is it a trade, though, or is it a technical issue? With a question about some of the central banks, whether in Japan, whether in the Middle East, that are needing to raise money right now to support fiscal efforts, that need to do things like sell gold, as we've seen. Is that part of what's behind some of these auctions that have gotten somewhat messy?
I think it's a technical washing out of positions right now, that everyone got crowded into a few trades. The central banks would eventually be cutting rates. All you have to do is actually look at gold. This is the absolute ideal environment for gold. It's the safe haven, it's the risk off, and it's the inflation hedge. All of those things should have pushed gold up from, call it 5,000 to 6,000 if it were fairly priced. It was an overcrowded trade. There's exiting from overcrowded trades. You talked about the lack of a safe haven. There is one. It's Treasury bills.
Treasury bills, but not long duration. And this is, I find, very interesting, given the fact that a lot of people are saying that this is a Fed that's going to be more hawkish. The implication should be, if you have belief in the Federal Reserve, that should lower inflation over time. That should reduce growth over time. That should reduce your appetite for longer-term bonds. Why is it not working that way this time?
Well, it is working because if you look at forward curves, the 1 year forward, or the 5 year forward, actually, those yields have come down a little bit. So as more hawkish rhetoric has come out of the Federal Reserve, long-term inflation expectations are a bit more anchored than they were a week or so ago.
Inflation expectations, but not the bond yields. That's what I'm talking about. Is this sort of the fiscal response?
There is the painful path from here to there. The hawkish expectations lead to higher rates, which then dampen aggregate final demand a bit more, and that ultimately cools off.
Bob, you're talking about the recessionary level of oil around $120 a barrel. That's where the physical market is, well above that. At some point, Brent will potentially, if this is protracted, catch up. The futures market will catch up to that physical market, and that might be sooner than people expect. What happens then?
Well, the data we're going to see over the next couple weeks is going to give us a lot of information, particularly next week when we look at the labor market data, because it won't fully have the conflict priced into it. It will still be somewhat clean. And if it's softer, it's telling you that actually the labor market wasn't on firm footing heading into all of this. If you're a business and you're already struggling with trying to understand what tariffs you're going to pay, what the impact of AI is to your labor force, and you've paused hiring, now you have higher input costs and you're concerned about demand destruction. Are you really going to go ahead and do some hiring? Our expectation is it's already starting to bite in the real economy.
This all sounds super gloomy. Should we finish with some optimism?
Sure.
Torsten Slok of Apollo just published. Check this out. Markets are overreacting to what will likely be a 4 to 6 week period of volatility, which will ultimately result in 50 years of stability in oil markets, supply chains, and geopolitics. Torsten, just moments ago.
Yeah, the headline of this is sentiment destruction, not demand destruction. Always watch what they do, not what they say, given the fact that people are feeling so nervous and so they have to go out and shop to make themselves feel better and travel a lot more. He talked about how this shock is not enough to eliminate the tailwinds to the U.S. economy, and that is the reason why so many people have said, actually, the U.S. turns out to be more of a haven right now in all of its assets because of that tailwind, because of its ability to still grow.
The tailwinds being AI spending, the industrial renaissance, and the one big, beautiful bill. Bob, can you envision a better world 12 months out? Looking back 12 months out, and just seeing this as a 4 to 6 week period of volatility?
I can see us getting beyond this at some point. We keep going back to 20% of oil passes through the Strait of Hormuz. Why didn't oil go from $60 to $72 a barrel? So Torsten's right. There's some emotion in this. Whether it's troops on the ground or there's some sort of peace accord, we'll eventually get to the other side of this. I don't know that I want to look out a year, but I'll look out into the midterm elections. I think no holds will be barred into the midterm elections. And what is that, 8 months away?
What do you mean by that, Bob?
Well,
I think is going to happen?
Yeah, sure. I think when you look at the administration, they have to do whatever is possible to ensure that unemployment stays low. They've got to go back to affordability issues, particularly housing. You've got a new Fed chair sitting. You do have the tailwinds of the One Big Beautiful Bill Act. You do have all the CapEx because AI is real. Businesses know that. So you don't want to get too gloomy in here. That's why I said you just want to stay out of the way of this. see where it washes out. I think it's more technical than anything right now. Our bias is to add when we reach firmer footing.
It certainly feels painful right now with the 10-year at 446 and up another 5 basis points on the session. Bob, good to see you. And congrats once again. Thanks for being here. Bob Michael there of JP Morgan Asset Management on a very shaky bond market through the week so far.
Yeah, and he's talking about how it's a technical washout and that longer-term bonds are the haven. He talked about T-bills, not necessarily longer out the yield curve, not now anyway. Michael Hartman, I keep going back to this, expecting policy panic to support the economy heading into those midterms. I just wonder how much that's part of the reason why people don't want to go long bonds right now, if there's policy panic that comes in to flood the market.
If Bob's coming on the program and advocating for T-bills, you know it's a stressful moment, right? Certainly a stressful moment.
You know, you're also getting good yield, so I can understand it. And you are seeing some inflows into that area.
Let's get you an update on news elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump pushing back his deadline for a deal with Iran, saying he will pause attacks on the country's energy sites for 10 days. Trump also saying talks with Tehran are going, quote, very well. Iran says it's waiting on a response from the U.S. after rejecting its peace plan and offering its own conditions to end the war. Israel not planning to wind down its military strategy against Iran. Defense Minister Israel Katz saying moments ago attacks will escalate and expand to additional targets in areas important to the regime. Katz saying he and Prime Minister Benjamin Netanyahu had warned Iran against attacking civilians, but the firing has continued. And here's another jab. JP Morgan is planning a new private credit fund that will allow investors to redeem 7.5% per quarter. According to the prospectus, the fund will invest at least 80% in credit, including a substantial portion in private credit as well as publicly traded loans. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, making time for a deal.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to. All I can tell you is they're begging to make a deal.
We'll talk about that next with Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The German report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The self-imposed deadline has been extended Diplomatic efforts continue between the US and Iran, we're told. That continues, and this continues too. Equity futures on the S&P 500 pulling back by 0.5%, on the Nasdaq down by 0.6%, adding to some big losses yesterday, the biggest one-day loss we've seen so far this month. The S&P 500 closing yesterday at the lowest we've seen since early September. In the bond market, that risk aversion, unlocking higher yields, not lower yields. The source of the disruption in the bond market, around 4% on twos, 446 on tens, pushed higher by this move in crude. The move persists, triple digits. Brent crude, 111, WTI, 97.
And you've heard a slew of central bankers come out and say they are worried about inflation. They have to be vigilant, and they have to get inflation back down to 2%, given that it has been more than 5 years since we've hit that target. We're repricing a Fed response function. We're repricing the ECB.
It's a lot of uncertainty hanging over this market through to at least, potentially, April 6th. Under surveillance this morning, making time for a deal.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to, but they're doing it a little bit. I don't, look, their capability is a lot less than it was 2 weeks ago. And with every week and every day, frankly, it gets less and less. All I can tell you is they're begging to make a deal. So let's see what happens.
The President of the United States extending talks with Iran for 10 more days. The President saying talks with Tehran are going very well. Jonathan Tamari of Bloomberg Government joins us now for more. Jonathan, welcome to the program. We're tracking two things. One, the talks, the status of them, and two, troop movement. Jonathan, what do we know about both this morning?
Yeah, the state of the talks, it depends on what you're listening to publicly, privately. Publicly, you know, Iran says that there's not progress. The president says there is, that they're desperate to make a deal. Obviously, both sides are posturing there. And yes, there are reports that there are additional troops now moving into the region. And there's a lot of concern within Congress, I would say, about what that means, given that Congress has had really no say on this fight so far. And the addition of ground troops would be a significant red line, I think, for a lot of members of Congress, including some Republicans.
Do you think they're in a position to stop it?
Not right now. And in fact, they're about to be away for 2 weeks. And there's a concern among some lawmakers that while they're away on a scheduled recess, the president could escalate things, and Congress would really be in no position physically to take action.
The calendar is not friendly to risk assets right now. Bloomberg's Jonathan Tamari there with the latest on the situation following two tracks, the status of talks and the status of troop movements.
Yeah, and people are watching those troop movements very closely. We talked earlier about that Wall Street Journal report. Congress, you think that they're going to actually step in here? They haven't even been able to make a move on TSA. I mean, that was superseded also by President
They're not
Trump.
there, even when they are there.
They're correct. Thank
Right?
you. Even the vote last night, it was basically empty last night in the chamber when they voted at 3 a.m.
Yes, and it was just basically, yay, let's get the show on the road and let's make sure TSA is funded. That exchange I had yesterday with the president, he said that their capabilities have been decimated, but it hasn't changed the facts on the ground for the Strait of Hormuz. Every single day, according to tanker trackers, we're just at 2 vessels getting through on average since this war started, and tomorrow will mark 1 month. Before the war, it was more than 100, which is why the physical market is so much higher than what we're seeing in the paper market.
We've seen the damage done to some of the energy assets in the region. It's going to take time to repair them. And we know that when you shut in production, the longer you shut in production, the longer it takes to ramp it up at the other side. So we know this is going to go on for another 10 days, and the market is responding to that lingering uncertainty. Tobin Marcus of Wolf Research writing this: we don't think either side has reached the limits of its pain tolerance. The president thinks the US is winning, and the Iranian regime thinks they're winning too. Tobin joins us now for more. Tobin, where does that leave us?
I think it leaves us in largely the same dynamic that we've been in, where the president faces, options to escalate, to try to de-escalate, which he's doing now, or just to stay the course. I think all of those have downsides from the U.S. perspective. And I think anything other than, a surprising diplomatic breakthrough that we don't expect is going to perpetuate and intensify stress on markets.
Tubin, the Wall Street Journal also has that Iran, this requested 10-day pause on strikes, was not coming from Iran. Iran never requested this the way the president presented it to the world. What do you make of that? Is the president negotiating with himself? Is he just buying time as he has this troop buildup?
Yeah, I mean, what we were saying prior to the announcement of this extension earlier yesterday was, if we do see an extension, which seems like a very real possibility as we were approaching the end of that 5-day period, which the president himself speculated about the possibility of an extension during the cabinet meeting yesterday, that if that were to happen, it would reflect basically that the U.S. wasn't ready to choose between, to decide whether or not to undertake one of these decisive escalation options, rather than representing real, progress behind the scenes. And so I think characterizing it as having been demanded by the Iranians, even when the reporting contradicts that, largely lines up with that theory. So, maybe it's a very specific smokescreen for planned escalation, and he's waiting for more assets to get into the region. There's been lots of commentary about the first Marine Expeditionary Unit scheduled to arrive today, but there's more on the way. There's airborne troops on the way. So we could still be positioning for a definitive escalation plan, or he could just be buying time. If he's not ready to pull the trigger on either strikes on electrical infrastructure or one of these mooted ground operations, then, you can always kick the can down the road.
You have a new tongue-in-cheek alternative to taco, and you say it's a kebab. Kinetic escalation before abruptly backing off. What kind of kinetic escalation could we see?
I think the kinetic escalation that we had in mind when we came up with that kebab idea was what we've already seen, right? That we undertook this war. It's been, very high intensity so far. And then at some point, chickening out, I don't think is a great characterization of anything that's gone on here, but that at some point you could see the president try to just de-escalate. Notably, as people talk about, taco and the strike price of the Trump put and so forth, the one thing we haven't actually seen him do is make any actual move to de-escalate. We've seen him, open talks. We've seen him talk about talks, but those are all an idea that he might de-escalate if we see big concessions from the Iranians that there's been no indication that they're willing to make. What he hasn't done is actually reduce the intensity of U.S. strikes, actually, undertake a unilateral ceasefire and see if the Iranians respond in kind. And so I think, going back to the comments earlier about whether or not the two sides are at the limit of their pain tolerance, if we actually start to see the president in more of a panic about the market and economic and political backlash, which I don't think he's in right now, that option is still available of actually trying to de-escalate, short of, telling the Iranians essentially that we're ready to accept their unconditional surrender, which has been the U.S. message so far. And I don't think that surrender is in the offing.
Tobin, if this continues for weeks and possibly even months, how big is the blue wave going to be come November?
So I think the kind of elasticity of political outcomes to how this goes is relatively low. The House, I think, is basically, a foregone conclusion to flip Democratic, and we've thought that for quite some time. The Senate, betting markets are now starting to believe in the blue Senate. I personally don't really. I think it's a real long shot for them in these 4 red states that they would need to win 2 of: Alaska, Iowa, Ohio, and Texas. Those are all big reaches. And so I think we're in a universe where, even as the political situation deteriorates, as the war continues, as gas prices go up and so forth, there's not that many more seats you can lose in the House based on the way the maps are drawn, and similarly in the Senate. So if I'm President Trump, and I suspect that there are people around him telling him this, if the House is lost, the Senate's not that losable. That does give him room to have the courage of his convictions. If he thinks that this is a generational problem that he can, either substantively or as a way to kind of enshrine himself in the pantheon of American presidents by dealing with this, I do think that has some appeal looking past the midterms.
Tobin, it's good to see you. Thanks for catching up with us. Tobin Marcus there of Wolf Research. On the sentiment shock, you, Mitch, consumer sentiment coming a little bit later on this morning. Look out for that number. Might not be pretty. Up next, ECB Governing Council member Pierre Wunsch on Europe's path forward.
know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Equities declining here near session lows. We're down by 0.4% on the S&P and the Nasdaq, negative 0.6. The losses yesterday, notable. The biggest one-day loss we've seen since this war started. But one thing that hasn't been talked about enough, it's not just about the Middle East. There's something else happening here. It's also about tech and tech names. Microsoft having a really difficult go of it, down by 30% from the highs of last year. Meta down 15% this month, hammered yesterday. The Nasdaq 100 basically in correction territory.
It's down about 10% from its recent highs, but the idea that it hasn't seen a new high going back to 2025 gives you a sense of just how far we've fallen. They've lost their leadership. What does it mean at a time when we talk to a lot of investment managers saying that big tech is the haven, that we are not seeing that actually play out at a time of stress?
We've thrown so much of this market, tech problems, the Middle East, private credit, and bond yields just squeeze higher, making everything worse. Tighter financial conditions, yields up by 4 basis points, 4.45 on 10s, 2s around 4%. The president removing near-term escalation risk, but introducing longer-term uncertainty with 10 days of talks.
Especially because oil prices still are around that $100 a barrel, presenting a quagmire for central bankers. Do they hike rates? Do they keep rates where they are for a prolonged period of time, even as you do get some demand destruction? And you talk about how you do have financial conditions tightening. They're not tightening very quickly, but around the margins, just steadily increasing with mortgage rates hitting their highest levels so far this year.
Going into spring salad season, which isn't welcome news for a lot of you working in the housing market, I'm sure, and if you're looking to sell your home or buy a home, of course. In the commodity market right now, Brent crude, Brent 110, WTI 96. It's the persistence of this story that is going to cause problems. That the Strait of Hormuz remains closed.
Absolutely, and there's a note from Macquarie today that if this goes on till June, which at this moment, potentially you could see the Strait not being operational in the normal way. This can go on till June. You're looking at $200 a barrel. Caught my attention this morning, Qatar Energy. Force majeure for liftings through May. This is liquefied natural gas that the world is really relying on, especially Europe and Asia.
Stocks are softer this morning. We're negative 0.4% with some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. AstraZeneca this morning up 3.6%, releasing the results for a treatment of a deadly lung disease. That result showed that it was able to target improvement for the deadly lung disease. Bloomberg Intelligence saying that this would be a $5 billion addressable market for AstraZeneca. So shares, again, rising in the pre-market. You mentioned the tech, you mentioned the big cap, but it's also software, which continues to get hammered. The blame was originally put on that Google announcement of compressing the need for memory, but the pain has really continued. SanDisk and Western Digital and Micron all down at least 2.3%. SanDisk is down 15% in this week alone. It's also up 1,000% over the past year. So some of those gains coming off. Now, finally, wrapping things up with some deal news. Brown-Forman, those shares moving unchanged at the moment. This is the maker of Jack Daniels. They announced it as a merger of equals, which tends never to actually be the truth. But with them and Pernod Ricard, they're both heavily family-owned businesses. According to people familiar, this deal would involve a lot of stock. so those owners can keep control. So Brown-Forman, one to keep an eye on, but unchanged at the moment, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, President Trump announcing an executive order bypassing Congress to pay TSA agents during the partial government shutdown. This morning, the Senate approving a bill funding most of DHS. A House vote is expected later on today. Elsewhere, the president extending his deadline for striking Iranian energy sites for 10 days. Trump writing in a post on Truth Social, talks are going, quote, very well, even though Tehran insists it's not negotiating with Washington. And finally, the Secretary of State Marco Rubio calling on NATO allies to step up and do more to help secure the Strait of Hormuz.
There was a couple of the leaders in Europe who said that this was not Europe's war. Well, Ukraine is not America's war, and yet we've contributed more to that fight than any other country in the world. Very little of our energy comes through the Straits of Hormuz. It's the world that has a great interest in that, and so they should step up and deal with it. They should be doing something about it.
The Secretary, Marco Rubio, meeting with G7 foreign ministers in France today.
A polarizing message right now, and you hear, for example, UK Prime Minister Keir Starmer saying he's only going to harden his stance against joining this in any capacity or even opening up certain regions to U.S. troops as a result of pushback. Mark Rutte, the head of NATO, facing huge pushback among some of the other nations after going on CBS's Face the Nation over the weekend and saying Trump is doing this to make the whole world safe, saying what the president is doing here, which is taking out, degrading Iran's capability to be, again, an exporter of chaos, sheer chaos to the region, to the world, saying this is a fight that NATO should join.
I think two things can be true at once. Rutte's right. The Iranian regime is the biggest state sponsor of terror, and it doesn't help anyone in this world if they were to get a nuclear weapon. At the same time, I think the Europeans might be even emboldened by what J.D. Vance said last year. I can't get over this. J.D. Vance gave an interview, the vice president, and said the Europeans, maybe if they were a little bit more independent, if they weren't just a vassal of United States foreign policy, maybe they would have stuck up instead of going into the Iraq war with the United States, which J.D. Vance called a strategic disaster, the American-led invasion of Iraq. So you can have some capitals in Europe not really getting on board with wanting to a more protracted environment and maybe getting engulfed in this sort of conflict. And that was his message just a year ago.
We've seen that pushback this month alone. Let's talk about Europe. Global central banks facing the threat of higher inflation as energy prices soar. The ECB navigating mixed signals with some policymakers ready to act fast, others urging caution. Joining us now to discuss is an ECB Governing Council member and the National Bank of Belgium Governor, Pierre Wunsch. Governor, welcome to the programme, sir. Let's just start with the nature of this shock. From your perspective, is this the kind of shock that a central bank should look through?
Well, that's, of course, the big question, and we know the textbook case is for looking through for if you're confronted with a supply shock. Now, in the meantime, we have the episode of 22, and in 22 we were a little bit late in reacting. We had team transitory. We're not alone. I was maybe one of the first governors to be concerned about the fact that inflation might go up further than what we had in our models. So now we are there. We have, again, a supply shock, and we have to decide how to react to it. We should not overreact. I think so far we were able, I think, to communicate the fact that we would react if need be, but that we were not going to rush to do anything that would be looking like overreaction. But anyway, I mean, we have to. 22 is different. We have the textbook, and we need to find a middle way between what we have in the textbook, which is we don't react, and the experience we had in 22. But in 22, of course, there were a lot of bottlenecks in the system, very tight labor markets. You had a lot of fiscal support coming out of the COVID crisis, and that's not the situation we're in today. The labor market is a bit weaker in Europe. So we will have to find a good balance between the textbook situation and, again, what we experienced 22.
Governor, does that give you more time? Does that give you more time? And is April too soon to know what kind of shock this is to understand if you should look through it or react to it?
Well, if the conflict is mainly over by April, then I guess we will be closer to what we have in our baseline. We had just made some projections during the last meeting of the Governing Council. I think the base case that we produced was still relatively benign. Inflation was moving to a peak of 3%, but not on a yearly basis, and then going down quite quickly to 2%. On the basis of that, It's not clear that the reaction would be warranted. Of course, we were doing the projection on the basis of 2 hikes that were priced by the market. But I would say, if we are still close to the baseline, that it's not clear we have to react. If we move to what we call the adverse or the severe scenario, then we have higher inflation and certainly more persistent in the case of the severe. And then my guess would be that we would have to do something. But even then, I think we need to make a distinction between reacting so that real rates remain stable or reacting and increasing real rates. So if you believe that core inflation is going to go up for a period over a year, you may want to react, and the first hike might just be adjusting to this higher core inflation. And then there is a stage if the shock is bigger and you have significant second-round effects, which is, of course, a big part of the uncertainty, where you might have to tighten as such. And I would still make this difference. Hiking as such, if core inflation is going up, might not be tightening. And I'm not talking about spot real rates, but say over a period of 1 or 2 years, depending on what our view of the world is.
Governor, it sounds like you're more patient potentially than some other members on the ECB. I'm thinking, for example, of a recent interview that ECB President Christine Lagarde did with The Economist yesterday, saying that the ECB would have to respond in a forceful or persistent way if inflation looked set to sit well above its 2% target for an exited period. Most people would agree. But she said even a more modest overshoot could call for a measured rate move. Do you agree with that? That if inflation does not look like it is poised to go down to 2%, say, by the end of this year, that it makes sense to signal to markets that you're serious about containing inflation by making a hike?
Well, if I gave the impression that was not aligned with Christine Lagarde, I'm sorry for that, because we are completely aligned, or I'm aligned to her. With her view, but I was just discussing the case where by the meeting of April, the conflict would be over. And then, honestly, it's still something that is probably relatively benign, and we might have to react or not. But that's not, a difficult situation probably to deal with. My concern is, of course, and the concern of many people and of the market, is that it would not be over by April, or maybe not even over by June. What I would like to have is a better mapping of the scenarios that we're making to actually the conflict lasting until April or until June, that we have a better mapping of our scenarios and basically the meetings of the Governing Council. But it's moving fast. So one meeting is April, another meeting is June. If the conflict is not over by June, then we are, most probably way above our baseline. And that would probably warrant some kind of reaction.
Governor, do you think that the ECB is hamstrung by the fact that it is a single mandate Fed dealing with an inflationary shock that the Fed looks like it's currently prepared to look through, given that there is a serious growth hit on the other side that is potentially going to transpire?
Well, in a way, it makes it easier, because if you have only one objective, you only look at one target. But we always insist that we have an objective over a medium-term horizon. So we do integrate the impact of the shock on growth, and to the extent that the impact of the shock on growth would be to some extent deflationary. I don't think that's the base case, but of course we would have to take that into account. But it's taking into account the impact of the shock on the real economy, and then the repercussion in terms of whether we're going to be faced with second round effects or not. If the economy weakens fast, then the second round effects might be limited, which might warrant less of a move. And the big uncertainty is, of course, the labor market and the economy is less tight than it was in 22, coming out of the COVID crisis with all these bottlenecks in the system. But economic agents were surprised by the pickup in inflation. We had known a period of low inflation for a very long time. So people reacted, as much as we did in a way, slowly to the inflation developments. The big thing now we have to monitor is whether economic agents, firms, and then workers will adapt more quickly this time to the shock. If this is the case, it might lead to second round effects that will be, quote unquote, higher ceteris paribus compared to the level of the shock. If, because of weaknesses in the economy and the labor market, firms and then workers don't react fast and basically take the hit, then the case for reacting is less strong.
Governor, just a final question. Listening to you to recap, what I hear is patience. The prospect of two different scenarios with different responses. What I see in markets, though, is tighter financial conditions, a market doing the work for you already. Higher yields on government bonds, pricing in the prospect of rate hikes from the central bank over the next year or so. When you look at that, do you consider that an unwarranted tightening of financial conditions, given the patience that you've pledged this morning already?
Well, I'm patient today, but in April, if we're still there, I might not be patient. So I don't want to convey the message that we are not ready to act. But I'm comfortable with what I see in the market. But given the uncertainty is huge. So, making any judgment today on what we can do in April or June, given the uncertainty, the market signals or reaction will be different next week and the week after next. We have to monitor that. We have to at least, we should not overreact. We are not going to control the first round effect of this shock. So we should not even try to control the first round effects. So in this sense, we have time to react adequately, depending on what is our perception of what the second round's effects will be. But, April is not out of the question. If by April we have solid evidence that the shock will be lasting and will lead to a big hike in inflation that is likely to have some degree of persistence, then we might have to do something. But, we still have some time before the April meeting, and I don't want to take any bet in one or the other direction.
We are all flying blind, sir. We appreciate your time. Governor, thank you. The Belgian Central Bank Governor there, Pierre Wunsch, on the situation in European debt markets and in European rates.
Stephen Englander over at Societe Generale, Standard Chartered, came up with this line in a recent paper. FOMC Powell likely to aggressively do nothing. And it seems like right now, ECB officials want to aggressively not take a position because they don't want to give a signal that could potentially be committal at a time of so much uncertainty.
They want to commit to anchoring inflation expectations, but they don't really want to be hiking interest rates here. That's the delicate dance for communication into the next round of meetings.
Given the lack of growth in terms of the backdrop and the potential hit to inflation longer term, it's a difficult time for them, and you can hear that.
Now let's give you an update on news worldwide with some top stories. Your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. The Senate's passing a bill to end the Department of Homeland Security shutdown. The bill still needs to pass the House and be signed by President Donald Trump. Before the bill was passed in the Senate, the president had said he would sign an order to pay TSA officers. A legal victory for Anthropic, the maker of the chatbot Claude, winning a court order blocking a Trump administration ban on government use of its AI technology. Anthropic argues the ban could cost it billions in lost revenue. And Apple giving rare bonuses to iPhone hardware designers. Sources telling us here at Bloomberg the company gave bonuses worth several $100,000 to many members of its iPhone design team. The company is hoping to stem a wave of departures to startups like OpenAI. That's your Bloomberg brief. John.
Yahira, thank you. More from Yahira in the next hour. Up next on the program, keeping the pressure on the Fed.
We have a great new person coming in to take over the Fed. Kevin may not ever have an office, but they don't sue the guy whose interest rates are too high. We call him Jerome Too Late Powell.
We'll spend some time on that in just a moment. Sonal Desai of Franklin Templeton joins us next.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg 10.
Is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
So we're recovering just a touch. We're off the lows. We're negative by a third of 1% on the S&P. We're down 0.5 on the Nasdaq. On the Russell, we're down 0.4. In the bond market, shaky. Yields bleeding a little bit higher at the long end of the curve, tens around the highs of the year. Under surveillance this morning, keeping the pressure on the Fed.
We have a great new person coming in to take over the Fed. And Kevin may not ever have an office, but they don't sue the guy whose interest rates are too high. We call him Jerome Too Late Powell. Janine Pirro, working with Pam and others, has the courage to sue to find out what happened to maybe $4 billion at a building that may never be occupied by Kevin. We're gonna have to find him some space in the White House. We'll put him in the basement of the ballroom.
So here's the latest this morning. The president continuing his push for lower interest rates as the confirmation of Fed Chair nominee Kevin Warsh remains on pause. Sonal Desire Franklin Templeton writing, even before the current shock, I was not expecting any more cuts, but it is too early to forecast rate hikes. Sonal joins us now for more. Sonal, welcome to the program. I know so many people in fixed income itching to get long duration because yields have backed up, but they're nervous. What are you advocating for?
So, you know, we came in, thanks for having me on, Jonathan, but we came into this year actually a little bit short, and we are moving slowly towards neutral, but I am not tempted to go long yet. This is essentially, when we talk about the two, it's either bimodal distribution or more accurately, there are two tail risks, and we certainly can't predict which of those tail risks comes to fruition if either one of them, i.e. a very protracted conflict or a very short conflict. You can't actually position your portfolio to either one of those two tail risks.
Sonal, forgive me, I keep harping on this one topic. Why are long end bond yields rising right now? And I look at inflation expectations in the break-even rates market. Long-term inflation is not ticking up. If anything, it's going down. This is a real rate move at a time when people are looking out to the potential of a decline in growth. Can you explain what's going on currently in the long end of the yield curve?
To me, actually, what the market is doing is really rational. It is anticipating that, yes, there may well be a decline in growth, and the response to that decline in growth is going to be massive fiscal easing. You know, your prior guest from the ECB, he only spoke about monetary policy. He didn't mention what the probable fiscal response would be if this were to be a protracted conflict. There isn't a government in the developed world which will probably not react by trying to accommodate some of that weakening through a greater fiscal push. So I think that bond markets are actually behaving pretty rationally right now.
Do we think that we're pushing up against the limits of using a fiscal lever to offset weakness based on the pushback that we're seeing right now from the bond market?
So it depends. Well, that's a useful statement. I don't think we're getting to a limit, okay, because here's the thing. There is an enormous amount of liquidity floating around globally. There is the ability to finance more bonds. However, at this point, clearly the market is not accepting that the yield is an adequate compensation for the prospect of higher inflation and higher bond supply. But you do find a market clearing point. So how much can fiscal do? Even automatic stabilizers by themselves will lead to widening fiscal deficits. So, you know, the fact that unemployment goes up, so unemployment benefits go up. And so you will have a widening in the event of a significant slowdown. And I think there's a big difference between what's happening in Europe, as I think you've mentioned yourself, versus what's happening in the US. But in the US, for a whole host of other reasons, we're looking at fiscal profligacy as we've never seen before. For the last 5 years, we've seen it, and I see no indications that this is going to go away anytime soon.
So now, what you just said there on fiscal, I think is really important for multiple reasons. Here's one. Do you think it increases the odds that we'll see second-order effects if governments step in and try and support consumers in this moment?
Oh, in terms of inflation?
Yeah.
Yeah, because actually it was the opposite way around. If you think back to the famous transitory period of 2021, what was really going on in 2021? We did have very easy monetary policy, but the reality is we had an enormous fiscal splurge in the first quarter of 2021 as a new administration came in. It was absolutely enormous. And so back at that time, to me, it appeared absolutely self-evident that you were going to get demand push inflation, which the Fed kept saying was a supply side impact. And eventually, of course, we got the results we got. If you do get that fiscal accommodation of a shock of this nature, you will get second-round effects. Ultimately, let's take an extreme scenario. Let's suppose that we really are hitting and taking out not just 20%, but oil facilities, say, in other parts of the Gulf, which is responsible for 30% of global oil supply. Supposing you actually do something much more terrible, which leads to a several-year contraction, you can't accommodate it because ultimately you need demand destruction, which translates into slower growth. And if they try to not do that, that's a problem.
Sanal, appreciate your time. Thank you. Sanal Desai there, Franklin Templeton. Of course, this shock is hitting just as tax refunds are hitting as well.
That's the tailwind that Torsten Slok is talking about that will leave us in a bullish place at the end of the year.
Up next, Mona Mahajan of Edward Jones, Kali Hohu of Jefferies, Michael Gapert of Morgan Stanley, Ajay Rajadaksha of Barclays. The third hour of Bloomberg Surveillance just around the corner.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
We're at a world now where there's heightened uncertainty.
If we have a peace deal, then we could have a relief rally in markets.
The market has been volatile during this period, but not a tremendous amount of downside yet.
The market is pricing in that there's going to be a resolution.
We are going into an area of really uncharted waters at this point.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your price action looks like this. Off session lows, but no bounce. The absence of a bounce here notable. Equity futures down by 1/3 on the S&P, and the Nasdaq down by 0.5. Negative follow-through following the biggest one-day loss of March so far. In the bond market, yields 2s, 10s, 30s higher on 10s, up 5 basis points. A new high for the year. 446 is where things stand. Off the back of this, crude. The problems persist. Triple digits, 111 on Brent. 97 on WTI. With this statement from the President of the United States, talks won't wrap up in the next 24 hours. You'll have another 10 days. New self-imposed deadline, April 6th. The market take, the problem persists.
Ultimately, as you've said many times, we don't have clarity. I would take this a step further. There is a real signal right now that's coming from the markets, which is that the power of truth social diplomacy is losing its clout. We are looking at a market that doesn't see any easy resolution to this, and it isn't one man's decision to ratchet the temperature down and solve things. That, I think, is the takeaway from this week.
These aren't paper problems that you can solve with verbal intervention. They are physical problems. Jeff Curry of Carlyle talked about it multiple times on this program. You cannot print the barrels. You cannot print the molecules. You cannot reopen the Strait of Hormuz through talks alone. If they continue, by definition, it is closed. That's the situation, and as that problem persists, the problems keep building.
I think you need to look at action in the region and not words. And what we've seen just this morning, action in the region, you're seeing missiles across Riyadh. You're seeing the IRGC not let vessels through the Strait of Hormuz. You're seeing Chinese vessels. China buys the lion's share of Iranian crude that was before the United States decided to unsanction some of it that's on the water. They had vessels going through and made an abrupt U-turn. The facts on the ground and the reporting that the president is even weighing potentially sending 10,000 more troops show that this is going to be longer and this might be protracted. And that is why the markets are starting to wake up, that you cannot, as you say, taco your way out of this.
We have replaced the threat of near-term escalation risk and introduced the persistence of long-term uncertainty, at least for the next 10 days or so. And we're tracking two things. One, not just the movement of talks and the diplomatic effort, but two, troop movement. This from the Wall Street Journal. The Pentagon looking to send up to 10,000 additional ground troops to the Middle East to give President Trump more military options, more uncertainty.
Let's go back to the conversation that we had with Colonel Sanders from Bloomberg Intelligence earlier this morning, where he said, this seems like a significant troop buildup, but when you compare it to the Gulf, you saw more than 600,000 troops deployed to that effort. That said, it indicates a potential ratcheting up, and it comes alongside the fact that the UAE and Saudi Arabia both are being vocal about, hey, you better not pull out now and leave this as the status quo, because you're giving Iran a lot of power over one of the main waterways of the world.
That's why this doesn't look to be a garrison. This doesn't look to be permanent troops on the ground. Strategic. Can they go in there, these individuals, highly trained to do things like this, to capture islands, to open up waterways? But can they go in there and fix this in a short amount of time? And the Iranian parliament is talking about, even if this becomes open in the future, there's now going to be a toll. They've effectively said, we have demonstrated we can control this strait, and we are not going to give up that leverage.
Brent crude this morning, right now, very close to 111. Coming up this hour, we'll catch up with Mona Mahajan of Edward Jones. With diplomatic uncertainty hanging over markets, Michael Gapin of Morgan Stanley still calling for 2 rate cuts this year, and Ajay Rajadaksha of Barclays on the widening cracks in the U.S. economy. We begin this hour with stocks adding to losses as traders brace for a protracted war. Mona Mahajan of Edward Jones writing, while market volatility may persist, this may also provide opportunity. We prefer U.S. large cap and mid-cap equities, emerging market equities, and cyclical sectors, including industrials. Mona joins us now for more. Mona, welcome. We face what we've called all week substantial two-way risk, and that two-way risk will hang over this market now until at least April 6th, guided by the president's self-imposed new deadline. Mona, what are you advocating for between now and then?
Yeah, John, look, this has become a show-me story, and it's not only about updates on negotiations with Iran, it's really about what's happening in the Strait of Hormuz and what's happening with oil prices. And markets are almost indirectly correlated with the move in oil. We see higher oil prices this morning. We see lower futures, despite the 10-day pause or extension in the negotiation itself. So, generally, we are waiting to see what the duration of this conflict and especially of the elevated oil prices will look like. If you look at WTI futures markets, markets are still pricing in oil returning to mid-70 levels by year end. So if this conflict does remain contained, we think the spillover effects can remain contained as well. Now, there's a probability around that. That's a base case scenario, but there are tail risks on either side.
So, Mona, that's the story. Let's talk about the price of the story a little bit more. Equities on the S&P 500 down almost 6% so far this month. So far this month on a 10-year maturity, yields higher by some 50 basis points. Is the risk-reward right now more attractive in stocks or in bonds?
We still see a compelling stock or equity story ahead. Look, this is still an environment where we think the economy is going to be positive this year. Economic growth, we still think, can hover in that 2% range. And importantly, the earnings story, we think, is still intact. And keep in mind, parts of earnings, think about the energy sector, will see some benefits from a rise in oil prices, although parts will not. Margin compression is a very real story there. But what's important in the U.S. is we have this underlying secular theme of AI technology and CapEx spending. And that, to us, will continue to be a driver. We think earnings growth can be high single digits, low double digits still for 2026, and that provides some underpinning to the stock market.
The tailwind comes from big tech, and yet we've seen big tech of late not outperform. It has lost its leadership through most of this year, and we've seen this sort of cyclical rotation into some consumer-facing names. Can that kind of trend persist, given a backdrop of higher oil prices and stickier Fed policy rates?
Yeah, it's interesting. Certainly through the Iranian crisis, we did see a bit of a pause in that broadening cyclical story. And in fact, a return to maybe a little bit of what are considered defensive parts of the market. And technology and AI was part of that, partly because they had already seen a meaningful correction sell-off prior to the crisis, and maybe folks were looking for entry points again. But keep in mind, these are companies with tremendous balance sheets still, and can be considered relative safe havens in this environment of uncertainty. So we do think that the tech AI story is still part of a diversified basket for investors, and it does come to the forefront in times of uncertainty like this. And certainly, as we think of an environment where the US dollar is rising, there are winners and losers there as well. But overall, we think the diversification is going to be an important part of the 2026 story, unlike the last 3 years where it was very, very much about concentrated portfolios.
John was asking Mona this idea of what you like better, bonds or stocks here. You said stocks. At what point does the rise in bond yields pressure the stock story based on the fact that it's really come from real rates, and usually that does crimp potential for multiples?
Yeah, you know, look, we are looking at, we called for a 4.5% range on the 10-year Treasury. As we get perhaps above that, or if we do get above that, we would start to look at duration more meaningfully. You know, keep in mind, when we think about a Federal Reserve and what they might do going forward, we still don't see the potential for rate hikes on the horizon. We do think that this is a supply-driven shock. If oil was rising because demand was overheating, then yes, rate hikes could make sense. But very much this is, you know, supply shock, and a rate hike in this environment probably won't help that problem at all. So we think the Fed is on hold here, but we do think over time, and they indicated this still in the meeting last week, they are looking at 1 to 2 additional cuts in this cycle as well, which of course is broadly supportive. So we are looking at still, if bonds get above that 4.5% range, we'd consider that more interesting here.
Mona, though, if this is a protracted conflict, do you think the Fed would be able to cut interest rates?
You know, we certainly think in the scenario that this is, you know, the tail risk emerges and this is protracted, deep, prolonged, then we do start to think about a market that doesn't look as strong, that earnings growth does fall more meaningfully because consumers are pressured and corporate margins are pressured, especially those corporations that have energy needs. And in that environment, the Fed is likely to cut, but cut for the wrong reasons, which, you know, we don't want them cutting because they see an imminent downturn or recession in the economy. If we do see rate cuts, we'd like to see them because they want to neutralize the Fed funds rate a bit more, and they're too restrictive at this point. So, you know, in this scenario, historically, when we look at the Fed and what it means for markets, when the Fed is cutting because the economy is faltering, markets actually don't react as well. When the Fed is cutting because they're neutralizing, markets actually prefer that environment. We're hoping for the latter.
Mona, good to see you. It's good to catch up. Mona Mahajan there of Edward Jones. This is the communication dilemma for a central banker right now, whether they're in Europe or the United States. What they want to communicate and what they actually want to do, two different things. They know they have to pledge to anchor inflation expectations. And because of that, they can't invalidate market pricing, which is pricing interest rate hikes, particularly in a place like Europe. But they definitely do not want to be hiking into an energy shock right now or anytime soon. There is a real reluctance, and I think you can sense that from what you hear from some of these officials at the moment.
You mean the ECB banker who said absolutely nothing?
Without
I mean,
a doubt.
ultimately, you're going forward.
Brutal,
I mean, well, no,
yes.
I mean, but they're aggressively saying nothing, and that's on purpose. That's a policy decision, given the fact that ultimately, to your point, if you've got tightening financial conditions, that will crimp growth and potentially curtail the potential for inflation, both in real terms as well as in expectations.
We talked about it briefly earlier, and I'm looking forward to this conversation with Mike Gapin over at Morgan Stanley because they've broken out 3 scenarios, not 2. And we've been talking about it around this table. Essentially, the market's focused on 2, the prospect of much higher crude prices or the prospect of much lower crude prices. But there's a middle ground. And the middle ground's more problematic for this Federal Reserve. And I think for any central banker, central bankers seem more comfortable at extremes because they know what to do and they can do it with confidence. If you get a major recession, you throw the kitchen sink at it. And I've always said I don't think that's particularly brave or impressive because you know exactly what you need to do. It's moments like these that are really difficult to understand, to know what to do. And Mike Gapin's work on that, we're going to touch on it later, is pretty interesting.
Especially because they did give a 3-pronged scenario, and they said that the one that presents itself to central bankers as giving the most reason to hike is the one that we're in right now.
The 110.
The 110 rate. That is actually this uncomfortable situation that could prompt a Fed or an ECB to raise interest rates.
That conversation just around the corner. Look out for that. Let's get you an update on news worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump pushing back his deadline for a deal with Iran, saying he will pause attacks on the country's energy sites for 10 days. Trump also saying talks with Tehran are going, quote, very well, but Iran says it's waiting on a response from the U.S. after rejecting its peace plan and offering its own conditions to end the war. Israel saying it will step up strikes against Iran despite President Trump's delay. Defense Minister Israel Katz saying the attacks will escalate and expand to additional targets in areas important to the regime. Katz warning the Islamic Republic will pay a, quote, heavy price. And China has launched investigations into U.S. trade practices. It follows similar moves taken by the U.S. against China that the Trump administration launched after his tariff agenda was upended by a Supreme Court ruling. It comes days after the White House announced President Trump will travel to China in mid-May. That's your Bloomberg Brief. John?
Yeah, Hira, thank you. Appreciate the update. Up next on the program, the Morning Calls Plus, Kylie Coho of Jefferies with the war in Iran weighing on consumer sentiment. We'll break it down, what it means for the consumer and what it means for consumer-facing companies. From New York City this morning, good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
$150 price of oil per barrel starts to bring in the recession risk much more prominently. But the equity market here is actually the wild card. The equity market would have to start pricing in downdraft in earnings. It would have to shake confidence of CEOs and on the consumer side, and you would have to see that foundation really become rocky before we're starting to talk about Fed easing here.
Down almost 6% for the month so far on the equity market on the S&P 500. That was Joe Davis of Vanguard. Yesterday, the biggest one-day loss we've seen since this war started. Some negative follow-through here on the S&P, on the Nasdaq, on the Russell. We're softer by 0.5% on the S&P, on the Nasdaq down by 0.6. In the bond market, we keep going back to it. We've had some sloppy auctions this week. 2-year, 5-year, and 7-year, 3 for 3. Yields up this morning by 4 basis points, 4.46. And of course, Lisa, what's notable about this is yields are basically back to where they were on Monday morning before the president said there were talks with Iran.
There have been no developments that have removed the uncertainty around Fed policy and around ECB policy, and you still see a complete volatility in bond market pricing. I mean, even in the MOVE index, the implied volatility going forward, creeping ever higher. How do you get ahead of this? I mean, the idea that Bob Michael was saying this is technical, how is anyone going to step in and say, I have any conviction to buy?
Technical, fundamental, I tell you what, it's painful. It's painful. It's not what the market was positioned for. That's for sure in the bond market or foreign exchange. Let's finish on crude. 111 on Brent, 97 on WTI, pushing higher by some 3%. Persistence is the problem. How many times have we said that this morning? And the president's basically just told us, new self-imposed deadline, this will persist. See you on April 6th.
Yeah, living in purgatory at the moment, basically, for the crude market. You have this environment where even Qatar Energy, when it comes to LNG, they're talking about force majeure, people close to the matter telling Bloomberg. And then still, the Strait, what you see right now is just 1 or 2 vessels, 3 or 4 a day getting through. This is so low compared to where we were before the war, where more than 100 vessels went in and out unimpeded whenever they wanted. Until that opens up, you're going to see prices at minimum this level, maybe higher.
Brent, lingering around 111 this morning. Let's get you some morning calls. First up, JP Morgan raising its price target on Halliburton to 40, expecting limited impact from the Iran war in its first quarter. The second call from Wells Fargo boosting its price target on Alphabet to 397, seeing higher compute and the opportunity for new profit sources. That stock's still lower by 1%. What a rough ride it's been for tech recently. And finally, Mizuho raising its price target on Carnival to 39, saying current levels underappreciate long-term earnings power. That name is down by 1.7%. Fuel and travel is a problem right now, Bramo.
Every time I feel like someone's trolling you, though, when you put up the cruise liners.
The cruise stuff?
Yeah, I just feel like, look, they are under pressure. Who's going to be the winner? Well, clearly, it's going to be some of the big guys, which you see potentially consolidating the power of the seas, getting John on the cruise ship.
Mrs. Farrow was trolling me the other day. She brought up the prospect of a Disney cruise.
I think that you should go.
Absolutely not.
I think that in about a couple of years, you'll be seeking somebody to entertain the child.
Fact, I can't think of a single person in the Farrow family who wants to go on a cruise, to be honest with you.
I think that maybe you might change in 2 years.
Yesterday in the press room, I heard The Atlantic, the magazine, is doing a tie-up for a luxury cruise.
Good for them.
And like hang out with some editors and journalists. I'm not really sure that's a vacation.
I cannot think of anything worse than that, to be honest with you. All right. Retailers competing with high gasoline prices. The national average still hovering near $4 per gallon. The team over at Jefferies writing expectations were largely transfixed on consumer tax relief, bolstering the physical economy. However, driven by the conflict in the Middle East, investors have been forced to quickly reframe expectations. Kylie Cohu of Jefferies joins us now for more. Kylie, good morning.
Hey, good morning. Thanks for having me.
How have you reframed expectations since this war started?
Well, what haven't we reframed, right? So coming into the year, one of our biggest fears really in the retail space was disinflation. That has completely been thrown out the window, and now the real input is where are costs going, where are prices going, and how is the consumer responding? Right now, we haven't seen any major changes in volumes as a whole, but to use the buzzword of the last 24 months, this K-shaped economy is real, and this could catch up with us sooner rather than later.
The biggest surprise for me would be, Bram, I'd love your thoughts on this, the opposite happening, which is people got the tax refunds, they've got this confidence, you don't see it in the sentiment numbers, but they keep on spending. And that's essentially what Torsten Slok of Apollo is making an argument for. That would be the shocker. Think about what everyone's calling for right now. No second-order effects because the labour market's not as tight, the consumer's not as strong. That would be the major surprise for the year ahead if actually the consumer stares down these prices and keeps on spending.
Especially if you get policy panic like the one that Michael Hartnett is talking about to juice the economy heading into the midterms. That leads to an inflationary pop, really bad for bonds, but potentially really good for some of these consumer-facing names, which is exactly what Michael Hartnett was pointing out.
So Kylie, a little bit later this morning, we get UMich consumer sentiment. I'm not expecting it to be any good. We know UMich is shaped by energy prices to a greater extent. What are people doing, though? Your channel checks, the visibility on the consumer, the spending right now, the momentum we had into 26, has it held up?
So far, yes. What we are seeing, I was walking a Target last night. Almost all of the Easter decor is gone. So kind of all these seasonal trends that we started to see are still playing out. People are still spending in pockets where it might have been light, say something like a toys. I cover that space as well. Still looks kind of light. The inventory's there. It maybe not be moving as much. So to your point, we haven't seen the big shift yet. What I think people are most concerned about is the prolonged effect of this, right? So, when I'm thinking about peak shipping times for those more discretionary goods, that's where we start to talking about some timing risk.
So near term, you're starting to hear some consumer-facing brands raising prices, the airlines in particular. We were talking with United earlier this week, talking about the potential for a 20% increase in fares in response to the hit that they're experiencing from oil prices. Do you think that there is a counterintuitive shift where suddenly some of these retailers have pricing power because they can say, look, we're dealing with supply shocks. You're experiencing this throughout the universe, but you guys are getting tax refunds. You're still going to keep buying. We can nudge up prices to compensate for increased costs.
Well, that kind of goes back to the point of the biggest fear was disinflation, and now all of a sudden, wait, do we have a little bit of room here, especially for some of these items that are new, innovative, things like that, that the consumer was already drawing towards. What we also see, though, is consumers are becoming more choiceful. So what they might say is, okay, it's the buzz term, right?
Carly, we throw people out of the studio for choiceful.
Saying choiceful.
I was waiting for
Shut it down.
Yeah. Well, I say that though to say that we're going to see maybe more private label mix, things like that. And really, like I said, in terms of units, in terms of overall spend in stores, we haven't seen any major changes yet.
So what are you telling clients when they come to you and they say, okay, so is this a good time or a terrible time for consumer-facing stocks? Do you just look at them, shake your head and say, I have no clue. Why don't you just check the price of oil and get back to me in a week?
Not quite. We do have more of a view, like I said, that the trends that were happening are continuing to play out. The big are getting bigger. Again, we're very bullish on Walmart. And although that stock has seen a little bit of pressure lately, you're still going to end up seeing those structural moves into the players that were gaining share before this.
I was struck a few weeks ago when Ulta Beauty came out, and it was just after the war started, and said that there's geopolitical risks. This is a makeup brand, like a makeup store. Do you think that in this environment you can see like winners and losers, those that are just maybe using this as an excuse because there's underlying issues at their company?
There could be, and that's definitely been topical with some conversations I've been having with investors specifically. I specifically just cut numbers for toys, and they were kind of calling some of this stuff to be tariff related. And some people think that it's read-throughs to just maybe being weaker demand, maybe, more input costs. So yeah, there are kind of some puts and takes of what are we kind of covering up here, what's real, what's structural. And truthfully, right now, everyone's kind of responding in different ways. We're not sure what the long term is. So no, there's definitely pockets where we're positive, but who knows?
Carly, good to see you.
Thank you.
Problems continue. Carly Coho there of Jefferies on some of the retailers right now and the shock to the consumer and the data. Potentially the data, a real shock to the data. What is March and April going to look like? I think we've got a decent idea of what the price pressures will look like, but what about the output numbers? What about unemployment and payrolls over the next week?
Yeah, next week we get JOLTS, we get payrolls, we get the ADP numbers. That's all going to be incredibly important given the fact that so far initial jobless claims have not ticked up. You haven't seen real pressure there. Is there going to be the ability to, as John tells us every single day, go to your boss and tell him, you want a raise?
You should always ask for a raise.
All right, I'm going to blame
Know
you.
your worth, Bramo.
Okay, all right, thank
Always
you.
back yourself.
Is anyone listening to this? Hey, Rachel.
Never allow your employer to think
Totally.
that labor market conditions have deteriorated. You should also always let them know you've got options, that you can always go somewhere else.
Single-handedly creating
and get
a
more
wage
money.
price
Of course you should. Everybody
John.
should do that. Coming up on the program, Michael Gapen of Morgan Stanley. Mike does that. Still expecting 2 interest rate cuts later this year. We'll get his thoughts in just a moment. From New York, you're watching Bloomberg TV.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslinda Amin in Davos, Switzerland, and this is Bloomberg.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The Geo report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg.
The president extending talks and with it extending uncertainty. If I asked you to guess this week, what's crude done on the week? Would you guess that it's lower on the week? Crude is lower on the week. It's up on the session by about 3%, 111 on Brent. But it's these levels that are the problem. And we've talked about it all morning. You don't need crude to go much higher from here. Just holding on to these levels is sufficient enough to cause problems. And you're seeing those problems cross-asset. Turn to the equity market. Yesterday, biggest one-day loss on the S&P 500 so far for the month of March since this war started. We come into Friday at 7-month lows, the lowest since early September. Futures extending losses down another 0.4% on the S&P, on the Nasdaq by 0.6. In the bond market, unlocking higher bond yields, pushing higher again. The 10-year bond yield up 5 basis points, 446 on 10s. Where were we on Monday morning? Lower than where we are right now. So even the diplomatic effort has not turned around the story in fixed income.
I'm laughing because you say that oil prices are lower today than they were when we started the trading session on Monday, and it makes me think of King Ka, which is this roller coaster in Six Flags. If you have kids and have ever brought them there, it's sort of you begin and you end in the same spot, but the ride in between matters, especially if you get sick to your stomach. And it seems like that is adding a risk premium to every single asset class, which is the reason why Russ Kostrich said at this moment nothing seems to be working.
We have a physical problem, not a paper issue. So you can push around paper markets all you like. We saw that on Monday morning. But you haven't addressed the physical problem. And you can't address the physical problem with verbal intervention alone. That's the issue that policymakers and officials have got right now.
Because we do not control the Strait of Hormuz. And this crisis just shows that this threat that Iran has always said, that this leverage they use across the global economy, they're actually using it. And today you see it. The IRGC is turning around ships. You're even seeing Chinese vessels having to take U-turns. They are not getting through. How do you address that? Potentially the military operation, which is why the Wall Street Journal is talking about they're even weighing sending 10,000 more troops on top of the Marines and the 86th Airborne Division they already have deployed.
3 options, 3 doors. Which door are you going to walk through right now? The resolution to a positive outcome, a positive future, door number 1. Door number 2, escalation risk. Things get a whole lot worse from here. You start hitting energy plants. You see retaliation across Gulf nations. They get pulled in. Terrible stuff. Door number 3, far more complicated. The status quo, the new status quo. That these problems just linger. This persists through the next several months.
I picked door number 1, just letting you know.
I hope I'm there with you.
I think that increasingly, though, people are thinking about what door number 3 looks like, and let alone door number 2. And the question of something that Morgan Stanley's talked about, the non-linearities, the idea that once you get past a certain point, suddenly the pain gets much more severe, not in a linear fashion.
We'll talk to Morgan Stanley about that in just a moment. This is how the stage is set going into the opening bell. 1 hour away from the cash open. Futures negative by 0.4%. With an update on some single names, some morning movers, Danny has more. Hey, Danny.
Hey, John. Adding to the not-so-very-good day yesterday and the not-so-very-good morning this morning is a sell-off we're seeing in tech. It started, at least it was attributed to this new announcement from Google about compressing the need for memory. But it feels like it's taking a life of its own because you continue to see SanDisk risk in Western Digital. Down this morning, Micron down less, but still down 0.5%. They're down 15% so far this week. We're also seeing a lot of the software names sell off this morning. CrowdStrike is down, Palo Alto is down, Microsoft is down. There's a lot of speculation that hedge funds had started to short cover in this war when they tried to get low to the ground. Maybe that short covering is over and they're reloading up on those negative bets. Elsewhere, AstraZeneca, that is trading to the upside, releasing a study around a treatment for a deadly lung disease, the results of which are being interpreted as very positive. Bloomberg Intelligence says that this is an addressable market as big as $10 billion, so shares up just about 3.75%. Wrapping things up with Carnival, we should hear from them in about 45 minutes time for their earnings. It's had a very bad month. Since the war has broken out, they are down nearly 20% for their worst month since 2022. The concern, both consumer appetite and higher fuel prices. What will they say on their earnings call? Shares already negative ahead of it, down 1.7%, John.
Danny, thank you. Thanks for the update. Look out for Danny alongside Matt Miller at the top of the hour, about 25 minutes from now, to guide you into the opening bell. Turning to the economy, lots of data coming up over the next hour or so. Consumer sentiment numbers we need to talk about, and Fed officials warnings on inflation following this war and this spike in crude prices. Mike McKee has more. Morning, Mike.
Morning, John. Any of you guys remember Muzak, the people who, in theory, invented the hold music for telephone? Well, Muzak is now Fed speak, because we're seeing everybody at the Fed put the central bank on hold for right now. We had 3 more members last night, all of them on the Board of Governors, saying they're worried about inflation and there's no reason to do anything about interest rates right now. Lisa Cook, I would argue that the inflation risk is greater right now as a result of the Iran war. With respect to the labor market, I see it as being in balance, but precariously so. Joined by Michael Barr. The spike in energy prices and other commodities could have broader implications for both prices and economic activity. And then Philip Jefferson, the Federal Reserve Vice Chair, an extended bout of elevated energy prices could put upward price pressure on a variety of other products. Now, nobody is talking rate increase at the moment, but they are setting the stage for Wall Street to start worrying about it. And what's really interesting, you go back a couple weeks, this is not what the chart of Fed funds futures look like. Right now, all of the futures are basically pricing in out to 2027 rate increases of one level or another. We're not there for a full rate increase yet, but the graph has turned around. Everything, all those bars were going down before. Now they're all going up. Joining them in their concern about inflation, but not as bad as Wall Street economists. The Bloomberg survey of economists out this morning shows that they expect 2026 PCE inflation of 3.1%. That's up from last month's estimate of 2.6%, a big jump. Not a lot of change in unemployment. And they're still forecasting 2 rate cuts, but recession odds have risen a little bit. So the Fed on hold, and right now, nobody really knows what's going to happen, but the economists are a little more optimistic about rate cuts when we get to the end of the year than it looks like Wall Street investors are.
And Mike, you know how much I respect you, but I have to concede I didn't listen to a word of anything you just said because I was searching for Muzak.
Really?
On the internet,
yeah. Music? You didn't know what
I didn't know what the brand Muzak was, no.
Oh, my goodness.
I grew up in the UK.
Yeah, but
so
you probably were exposed to it as well.
I was exposed to it, 100%. Sure, but I didn't know where.
There's music absolutely everywhere. Oh, it's fantastic.
Yeah.
Yeah, I think it's making a comeback.
Appreciate it. Mike McKee there. Did you know what that was?
Nope, and I just was sitting there wondering how long did it take Mike McKee to come out with that?
Oh my God.
You know, that gem of the morning.
Hold on a second. How could you guys possibly not know what Muzak is?
Well, I live somewhere else.
Yes.
And Anne-Marie's on a different side of 40.
Oh,
right. So,
let's move on.
So there you go. Mike Gapen of Morgan Stanley with this to say. In light of higher oil prices, we revise our outlook for 26 in favor of less growth, more inflation, higher unemployment, and later Fed cuts. We now project 25 basis point rate cuts in September and December. Mike joins us now for more. Mike, good morning.
Good morning.
It's good to see you, buddy. Let's talk about your 3 scenarios, because we've been talking about it all morning. We've been obsessed in this market over 2-way risks. The prospect that prices go a lot higher from here, or they go a lot lower from here. There is a middle ground. Can you go through the 3 scenarios for us and what it might mean for Fed policy?
Yeah, I think as you alluded to in the last segment, door number 1 is uncertainty diminishes, risk, walks back, oil comes back down. So we return to where we were kind of pre-February 28th. And as you said, in the other direction, door number 3 is oil goes a lot higher and kind of clearly triggers nonlinearities and it weakens demand, and the labor market and activity clearly suffer. The door number 2 is that kind of in-between scenario where oil stays elevated for a long time. So there's lingering term premium in the oil market. And it's hard to know what to do as a central bank policymaker in these worlds. And because oil up to a certain level is mainly an inflation story. And so you want to lean against that. And the Fed already seeing its policy rate as being restrictive, that's a Fed that's probably on hold for the foreseeable future. But somewhere in there, if oil goes high enough and activity weakens, the Fed may want to cut. So there is a convexity. We think it's around $125 a barrel. That as you move above that, you'll probably start seeing demand for oil and other products be destroyed. So we don't know quite where that level is, but that's the idea. Some oil means some inflation, means at least the Fed on hold for a prolonged period of time. Our forecast is in that world, the unemployment rate drifts a little higher and the Fed turns to rate cuts later this year. But that's, we'll see how that goes.
We're kind of in the middle window right now.
Right. We are in the middle window.
Can we talk about where we are now and the prospect for a broadening out of price pressure? When you're around 110, 111, from the 60s, from the 70s, and you spike up that quickly, what is the prospect of the bleed through to other prices?
Well, the standard analysis here is you don't get bleed through to other prices, right? So the kind of the last 35 or so year history of the U.S. is that oil will be a headline inflation story. It destroys demand on the other side, therefore it doesn't pass through to core. So the history says you probably won't get it. But the story where you might get it is a combination of, well, we're 5 years above the 2% target. This is our third kind of consecutive supply shock. Is it the case that there will be second round effects, either because firms are seeing higher input costs, right? So in one way, there's a price story here, but there's also a quantity story. In the U.S., oil's available at a price. In other parts of the world, it's getting to the point where, as you noted, the difference between paper oil and physical oil. If physical oil starts to become a problem, then you start to get kind of supply chain disruptions like we saw in the pandemic. That could kind of create second round effects on core inflation that you would not expect from a econometric exercise where oil goes up and then oil comes back down. So the longer it stays at 110, the more you start to risk second round effects.
Especially if the economy is as hot as Torsten Slok over at Apollo seems to think that it is. I mean, one of the complications here is the complete disagreement about the state of the labor market and the state of the U.S. economy heading into this period. How important is next week's employment report going to be to give a sense of how much wage inflation there is potentially, how tight the labor market actually is?
Well, as you know, the survey for that would be taken around March 12th, the middle of the month, only about 2 weeks into the uncertainty that we've been seeing. So I don't anticipate that it's, say, a clean reading on what the labor market looks kind of post-Middle East conflict. So we're expecting, I think, a pretty decent report because we'll get some payback from the workers who are on strike and some of the weather. We think 60 to 70,000. So I don't think you're going to see a lot out of it yet. That's probably more the April employment report. And the retail sales data coming, it's delayed. We need timely data. We're not getting it. But the analysis suggests that oil price shocks tend to hit spending on goods more than anything else. So I think that one will be critical. And the other thing I'm watching is the inflation swap data, meaning the inflation market, I think, is a very good indicator for when we might hit that nonlinearity in oil prices. So a year ago after Liberation Day, when tariffs were very high, one year inflation swaps went down. So it was an indication that the market saw those tariffs as embargo level tariffs and activity would fall and inflation would come down. So far that hasn't happened in the current volatility. One year inflation swaps have generally moved up. So that is kind of a trigger point or an indicator I'm watching for maybe when financial markets think oil prices have gone too high.
There's also the issue that financial markets have started to feel some moderate constraint, particularly in the bond space, and you start to see some real pushback around levels across the curve. At what point is that enough to crimp growth in and of itself, to act as sort of a constraint on how high inflation could go?
Well, I think we're there because we made revisions in that direction, taking some of this into account. So I do think financial conditions have tightened anywhere on the equivalent of about 2 federal funds rate hikes. So bond spreads have moved up. Oil, of course, has moved up. The dollar has moved up. Equities have moved down. You combine all of that, and it is probably the market is doing the Fed's work for it now. So I would say we're there, and we've taken some of that into account into our revisions.
You're getting some feedback from Bloomberg subscribers. Most likely there's no data that's super important now. This third supply shock, trade, labor, now energy, has lasted too long to just assume it away. The backward-looking stuff is even more backward-looking.
Which a lot of people would agree with, and we've been getting data, and people point to it, and it makes no difference whatsoever in markets. Is there, though, a difference if you do get a sense that there is a heating up of the labor market, that potentially this could lead to a greater wage price type of reaction to what we're seeing with respect to the oil price shock?
I always think that shocks like this bring the best out of research teams on Wall Street. Really enjoyed the work from the team over at Morgan Stanley. Mike, thank you. Mike Gapin there of Morgan Stanley. Let's give an update on news worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Anthropic considering going public as early as October. Sources telling us here at Bloomberg, the maker of the Claude chatbot is in talks with Goldman Sachs, JP Morgan, and Morgan Stanley about playing a key role in its listing. The information reporting an Anthropic IPO could raise more than $60 billion. Baseball is back. The Mets off to a hot start after beating the Pirates 11-7. Milwaukee dominating the White Sox, scoring 14 runs and striking out 20 batters. And the defending champion, the Dodgers, beating the Arizona Diamondbacks 8-2. And Netflix announcing it's raising prices across the board. The streaming giant's subscription with ads will now be $8.99 a month, with the premium plan increasing $2 to $26.99 a month. This marks Netflix's first price hike in over a year and is effective immediately for new customers. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. Plus, Ajay Radhaksha of Barclays joins us on the widening cracks in the U.S. economy, and we've got to get his view on why they upgraded their outlook for U.S. equities in the last week. Barclays pushing their price target on the S&P higher. That conversation up next.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. Right now, we're still not expecting recession. You have to go well north of $120 a barrel for a recession. So in the meantime, just let the markets go to wherever they're going.
In the meantime, as we've said a few times already this week, it feels like trying to catch a falling chainsaw. That was Bob Michael of JP Morgan Asset Management. Equities this morning, negative once again, inching closer to the cash open. The open about 41 minutes away. On the equity market right now, we're negative by 0.5% on the S&P, down 0.75 on the NASDAQ. In the bond market, yields bleeding higher. At the long end, 10's up by 5. The 10-year this morning, 4.46. And in commodities, Brent WTI looks like this. Are we going to have another weekend when Monday morning starts Sunday evening?
Please not.
When the oil market opens up. Brent crude, 110.86. WTI, just short of 97.
Probably. I mean, based on
Feels
the
that way,
record, right? Ultimately, people are still going to be logged in, regardless of whether there's any news over the weekend, because this is going to set the tone for the rest of at least Monday morning.
Set the scene. You run research at a bank, and your equity strategist knocks the door. You open it. What do you want? I'm busy. And then they say, I want to raise the outlook for our price target on the S&P 500. And you say there's a war. What's wrong with you? Let's have that conversation right now with Ajay Rajadaksha of Barclays. Ajay, good to see you.
Well, I wish I could say the same, but thank you for that.
So that happened in the last week with the team at Barclays. Your chief strategist, your equity strategist, comes to you and says, let's raise the outlook for stocks. Give me an idea of what that conversation sounded like.
So, honestly, those numbers are not built on air. The bottoms-up consensus analyst estimates, you know, there's an analyst at each shop with a bunch of juniors who follows every major name, right? They do channel checks, they do what the guidance looks like, etc. The bottoms-up analyst estimates for S&P 500 show the strongest year-over-year rebound if you exclude the post-COVID rebound. And the numbers are the numbers. I mean, you know, we sometimes tend to be too fixated, tend to extrapolate too much what is happening in the here and now.
Sure.
Take 9/11, which was about as existential as can be, right? I mean, we were completely shell-shocked as a nation, as individuals. 3 months later, the S&P 500 was up 2.5%. 13% higher the day boots went on the ground in Iraq during the Second World War. 60% higher since the Russians invaded Ukraine.
So are we underestimating second-order effects here? If you're saying the outlook for growth is pretty good, I'm wondering what the outlook for inflation is with crude at these levels.
I think Governor Waller said it best. If you remember, 2 or 3 weeks ago, his initial response was that this is a one-time shift in the price level. Base effects are a central banker's best friend. Unless you think that this leads to the Fed losing inflation credibility. And honestly, guys, if the Fed didn't lose inflation credibility when headline ran at 8% for 2 straight years, it's not doing it now. You know, there's no reason to, the Fed hiking is not going to get oil to flow more freely. They are going to sit this out.
Are people overly conditioned by previous crises of confidence where you did see big drawdowns in the market, that there can be a policy response that offsets any of the potential downdraft to growth?
I think that is a fair pushback. I don't think most people believe that now because everyone realizes that a policy response doesn't help get ships faster through the strait. A policy response doesn't help really offset demand destruction. If oil goes to $150 a barrel, right, there is an element of demand destruction, and the policy response doesn't help with that. So I don't think the market is counting on that. I think there's 2 things that the market is counting on. One is the energy intensity of the world economy is significantly lower than it was 10 years ago, 15 years ago, 20 years ago. The second is that $100 oil, a barrel of oil, is not the same thing as $100 in 2022, let alone 2011. And I'll remind you, we were there in 2011. We had a ton of inflation since then. And then finally, the world's largest economy is a gigantic energy superpower. We shouldn't forget that.
Well, this all comes along with the often pushback against the bears that the technology story is strong and that the U.S. is the epicenter of a lot of it, but the tech story hasn't been working. And that raises a real problem for people who are banking on the AI investment structure. I mean, how solid is that, especially in light of tightening financial conditions in the face of this oil shock?
It's incredibly solid. I would argue that the AI capex cycle is a cyclical. I agree with you, Lisa. It's not been working for the last 4 to 6 weeks because we have all been like a deer in headlights, Scott, when it comes to Iran. That's happened before. 2023, SVB goes under. For 6 straight weeks, the only thing you and I were checking was a regional bank ETF. Tiny, but you know, we shouldn't have. The bond market felt like the Fed would cut 100 basis points that year. Remember how many times the Fed cut? 0. We grew at almost 3% Q4 over Q4, just effortlessly shrugged it off. So there tends to be a tendency to extrapolate. What I know are the numbers. I know Satya coming out and saying that the cloud computing backlog in Q4 was $368 billion. I know that Google Cloud is going up 50% year over year, and Pichai is still telling us that their backlog is $240 billion. Those are real numbers. You can't wish them away.
Could you have $150 oil or $200 oil and still have your outlook?
No, then I'm just wrong. I mean, if we are here in 2 months...
But that's what the energy world is saying, because that's where the physical market is.
But you are supposed to look, the forwards are the collective cleanest indicator, unless you believe that there's this gigantic conspiracy, right, where every government sitting around the world is paying futures down hard.
Some people do, but yeah, carry on.
Yeah.
Yeah, but see, Stan Druckenmiller, his first mentor, had this phrase, 60 million Frenchmen cannot be wrong, which is, I'm assuming the guy was French. But the point was that the base case tends to be true 80 to 90% of the time. Markets do a poor job pricing in a tail for obvious reasons.
Yeah.
But in general, it doesn't pay to be a contrarian. And at this point, I think things are nowhere near as bad as people think, which is why the equity market, the S&P, is down only 7 to 8% from its all-time high. That's not a big move.
This was, at risk of offending a lot of people this week, my favorite conversation this week. Thanks for being here, sir. Thank you. Thank you. You tell him. Ajay Rajadaksha there of Barclays. Thank you, sir. Coming up on Monday, it's going to be another long weekend. Monday, of course, starts Sunday evening. Look out for the coverage out of Asia on Sunday evening. Coming up on Monday, Laurie Cavacina of RBC, Vinod Krishna of Barclays on that equity call, Bob McNally of Rapidan Energy, Osen Kwan of Wells Fargo. From New York City this morning, good morning. This was Bloomberg Surveillance.
The women's final is set at the Miami Open. Aryna Sabalenka claimed her second consecutive win over Elena Rybakina to put her just one win away from completing the elusive Sunshine Double. She'll face Coco Gauff for the title after the American reached her first final at her home event with a dominant display over Czechia's Karolina Mukova.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court
aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Headed for a 5th consecutive week of losses. 30 minutes to go until the start of cash equity trading. I'm Danny Berger. Matt Miller is off. Bloomberg Open Interest starts right now. Coming up, strikes continue across the Middle East as President Trump gives Iran another 10 days to make a deal or face more attacks. The Nasdaq may be nearing a correction as a sell-off in memory chip stocks exposes a growing divide in the AI trade, and cyber stocks selling off this morning after an Anthropic report. And amid a wave of redemptions and private credit, Oaktree says it can meet every withdrawal request. Let's get a check on markets. It was a pretty ugly day yesterday. 1.7% was the decline in the S&P, the worst day since the war broke out. We fall again today, so now we're on track for a decline this week. It would be the longest losing streak since 2022. Also underpinning the pain are these two assets here. We've moved up by 0.5 percentage points on 10-year yields since the war started because of what we're seeing in oil. So we are just under 4.5 on your 10-year yield. Brent crude trades at 110. That is lower on the week, but still a painful level of up 2.5% today. Now, I mentioned tech. It's down 5.5% since the war broke out, but if you take it from its peak, it is down 9.7%. So if this market opens up where futures are indicating and it's able to close there, we will be in a correction for tech. It's getting hit from all angles this morning. It's chip makers, it's software, it's cyber, and it's the big cap tech too. Back to our top story, though. President Trump pushing back his deadline for Iran to agree to reopen the Strait of Hormuz or face attacks on its power infrastructure. Bloomberg's Anne-Marie Hordern asked the president about Iran charging ships to pass through Hormuz.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to, but they're doing it a little bit. I don't know. Look, their capability is a lot less than it was 2 weeks ago. And with every week and every day, frankly, it gets less and less. All I can tell you is they're begging to make a deal. So let's see what happens.
Joining us now is Wayne Sanders, Bloomberg Intelligence Senior Defense Analyst and retired Army Colonel. Wayne, the president seemingly taking some of the near term being this weekend risk off the table. The 5-day deadline gets pushed out an additional 10 days. What can actually be done in those 10 days?
Well, I think one of the first things you're going to see, right, is the USS Tripoli and the Marine Expeditionary Unit is going to arrive. So what it does is it opens up options that President Trump has. You know, he likes elements of surprise. A lot of these pieces have been choreographed up until this point, but that extension out to April 6th does provide President Trump with a little bit of, I don't want to call it breathing room, but more in terms of military options, in terms of what he's trying to be able to do. The problem is it's still very limited in terms of these ground troops that are on their way, right? Between the Marine Expeditionary Units as well as the 82nd Airborne Division, you're still talking about probably about 10,000. Even if you put 10,000 more, that's still a fraction compared to Operation Iraqi Freedom or to Desert Storm.
So would that be not in line then with the idea to make one final huge surge to kind of end the war? Would the amount of troops that are coming there not be able to achieve that? And if so, what might even be the thinking of having them there?
Well, I mean, President Trump, from a leverage perspective, anything that requires boots on the ground is going to be something that he can use and say, hey, I am willing to do this. Especially the amount that they have, it could still be surgical and limited to the Straits of Hormuz. It could be the islands around it. It could be Karg Island, specifically being able to take it. It could be a scenario where they're trying to put boots on the ground around the coastline so that they can actually try to eliminate as much as possible and mitigate the asymmetric threats of shoulder-fired missiles from Houthis or others around the Straits as well. So there are other options that are out there in terms of a limited cordon engagement, if you will, specifically inside of Iran. But everything that you do there obviously increases the amount of geopolitical risk to putting boots on the ground in the mainland.
And that risk seeping through markets. Wayne, thank you so much. That's retired Army Colonel Wayne Sanders of Bloomberg Intelligence. And in just a few moments, BCA strategist Marco Papich maps out 4 possible outcomes for Iran and the Strait of Hormuz. We'll catch up with him very shortly. So uncertainty over the war in Iran is continuing to drag down stocks. Something else is also happening in the background. NASDAQ 100 closing on the verge of a correction yesterday, down 9.7% from its high. Let's get more with Bloomberg Tech co-host Ed Ludlow. Ed, it's like those AI fears haven't gone away. For one, you have a jumpy markets to start the week on that Google news about more compressed memory needs. And then you have this report this morning about some sort of Anthropic release that's pressuring cyber stocks. We're still concerned and still a jumpy market at this point.
Yeah, all of the above. I mean, the thing with the NASDAQ 100, or if you just take technology stocks in general, is that there has been a macro-driven drawdown, right? And that much like in the broader market, there's been a rotation out of growth, and that clearly impacts that index, at least at the NASDAQ 100 level. But what people are looking at is not necessarily the direct linear effects of what's happening with the war in Iran. We've assessed the supply chain risk, for example, with helium and sulfur on the chip manufacturing side. But it's simply the consistent themes: free cash flows, capital expenditure spending, and AI spending holding up. And we can get into the nitty-gritty of why memory, which, by the way, now the story's completely changed. It's not memory, it's storage, as a result of turbo quant. But those themes have been completely consistent, and nothing has really changed in terms of catalysts in either direction in the last 10 days or so.
And speaking of Anthropic, maybe they're in this kind of stage of putting all these updates and releases out there, because it seems like they'll be IPOing. I know you and I were talking about a SpaceX IPO. It seems like Anthropic might be trying to join in the fund this year.
Our reporting is that the end of this year is the target, and there is also like a starter gun type situation where either SpaceX is or is not going to file its prospectus confidentially in the coming week. They may go first. June is still our latest reporting on SpaceX. Is Anthropic waiting for SpaceX? It's very hard to know that. There are obviously bankers on the top line common between them, all trying to pull this off, and OpenAI somewhere in the middle. But really, the driver in markets as it relates to Anthropic today is that Fortune report on an unknown model that was accidentally released in a blog. But yeah, that's the latest report.
Well, what did you make of that report, Ed, and the fact that it's sending CrowdStrike, Palo Alto, all of them down so hard?
Yeah. It's not straightforward. Basically, Fortune did a report about a model that's unreleased because there was a blog draft about it in an unsecured location that was found. And then Anthropic confirmed the model's existence via a spokesperson. The reason those cyber stocks are down is that this particular model, this next generation model, which is not yet released, Anthropic, in its own internal detailing, is talking about its competence on the offense. In other words, the capabilities, the cybersecurity capabilities of this model to go out and be offensive is greater than those cyber names that you just mentioned's ability to provide defense. And they are acknowledging an internal concern about that, which is a fascinating state of affairs. You know, that in the future, that is one consideration with AI. It is so good at cyber as a threat that you need to get a hold over it.
And very much so looking forward to today's show. Bloomberg Tech's Ed Ludlow, catch him at 11 a.m., so in just under 2 hours' time. Elsewhere, Oaktree says that it will meet all redemption requests for a $7.7 billion private credit fund aimed at retail investors. The requests total 8.5% of net assets. Usually the gates are put up at 5%. The move makes Oaktree among a handful of firms that's not putting a cap on withdrawals. Bloomberg credit reporter Dana Al-Baltaji joins me for more. Dana, I mean, how to view this? Because I'm always curious when a fund says, we're going to give you everything back that you've asked for, because aren't they the ones arguing that they need to save you from yourself, that gates are important because at the end of the day, these aren't liquid assets?
You've hit the nail on the head, Danny. That's exactly what we're seeing here. We're seeing some firms that are basically saying, if you want your money back, great, we will honor all of the redemption requests. And you've got other firms that basically say, look, this is how the fund works, and we just need to make sure that it works properly. There is absolutely some tension here, and it'd be interesting to see how it plays out.
It does feel like we're in this world where the whole like golden age of private credit, we probably went too far in hyping up how wonderful of an asset class it is. And then maybe we course correct and we go too far in saying the doom and gloom. But Dana, I do wonder when you think of lasting impacts from this moment where you're maybe getting defaults starting to creep up, redemptions are going up. What have you been talking to people about? What have they been saying and kind of the scars it might leave on this industry?
Well, this all seems to be a part of the maturation process of the private credit market, to be honest. I mean, it hasn't really gone through a cycle like this before. And for any industry, it is good to go through a cycle like this just to know what not to do next time. I mean, even Oaktree says that there seems to be some sort of a correction in markets. So, yeah, I mean, it would be interesting to know how things go forward. But, I mean, just to let you know of the changes in tone, I mean, you've got Oaktree with this statement today, but earlier this week, we had Larry Fink basically telling the BBC that the information isn't exactly deep in the prospectus, it's on page 1. So it's really hard to know whether or not retail investors are expected to figure this out for themselves, or if in the future the funds will take more time to really explain what the risks are.
Yeah, I mean, I was talking to the CIO of the Dell family office, and she was basically like, my old retired parents who need liquidity because they are retired, they need to be able to pull that money out quickly, are getting pitched private credit from their wealth advisor, and it makes no sense for them. So it feels like somewhere maybe there is a disconnect. Dana, thank you so much for joining us, Dana Al-Baltaji. And in the next hour, Morgan Stanley's Vishy Tirupatoor will be joining us for more on private credit risk. He and the team said that defaults, their base case is 8% for private credit. Let's get a check on your markets. 20 minutes to go until your trading day. We're down 0.6% for the S&P. NASDAQ underperforms yet again. A really ugly day yesterday for tech. It's like all of the worst things come together. It's a general sell-off because of the concerns about war. AI concerns back in the forefront and fueling stocks selling off. You have oil being a huge pressure too. And then there are tariff concerns as well with China maybe hitting back. You're looking at Brent crude now at $111.40 a barrel. 10-year yields at 447.99. Coming up, de-escalation, regime collapse, or U.S. intervention. Strategist Marco Papich maps out 4 possible outcomes for Iran. You're watching Bloomberg Open Interest.
are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The GM report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Risks from the Iran war are rising, and so are the economic consequences. Economists now warn inflation could climb back above 3%, putting renewed pressure on U.S. growth. At the same time, BCA strategist Marco Papich says that the clock is ticking on the global economy. He lays out 4 possible outcomes for Iran, including what he calls a new kinetic equilibrium, where the conflict continues but oil keeps flowing. Marco joins us now alongside Bloomberg economist Stuart Paul for like the all-star of all-star roundtables on geopolitics and this economy. Marco, let me just start with you. What are the 4 scenarios that you're looking at?
Well, first of all, they don't combine to 100% because some can happen in conjunction, like regime change. I still assign 10% to that. The problem with it is it can go good, it can go bad. You know, you can get a more compliant regime, you can get a far less compliant regime. Then the second, of course, ground incursion, the re-escalation. I think if President Trump chooses the ground incursion option, the market is going to suffer. Then de-escalation, that's an obvious one, some sort of a deal. The one that I think is most interesting, and the one that I assign 50% probability, is a new kinetic equilibrium, where basically the war continues for the next 6 months. No, actually even 6 years, perhaps. However, an equilibrium emerges where energy gets to transit through the Strait of Hormuz despite the hostilities. So you never actually get a moment where there's a ceasefire, where the market breathes a sigh of relief necessarily. There's no like taco day. But eventually we just realize, vessels are transiting Strait of Hormuz. Interesting.
Stuart, let me bring you into the conversation. How are you mapping out the different scenarios and the extremities of the risk to the economy in them?
Well, in the U.S. context, the thing that's going to matter most and where the rubber really hits the road is with gasoline prices and the consumer outlook. Where gasoline prices are now, it ends up equating to about a $12 billion a month drain on consumers' pocketbooks. That ends up going to gasoline retailers. It ends up going upstream to refiners, producers, into the energy infrastructure. But all of that money needs to be taken out of real spending elsewhere, and so we should be marking down our growth forecast by almost a percentage point, definitely our real household spending growth forecast by about a percentage point. In the rest of the world, among oil importers, it really does depend on what scenario we end up seeing. If we do see energy transiting through the Strait of Hormuz,
yeah, like Marco's scenario.
Marco's scenario, where we have this new kinetic equilibrium, we end up having less of a drag in places like India and China. And Marco, that's why I'm really particularly interested in this scenario. I'm interested sort of who holds the cards here. Is it China and India who are going to pressure Iran into negotiating some sort of a deal with the United States so the regime can stay in place, those barrels can keep moving to China and Iran? Or does Iran want this to continue, but they sort of need revenue? Who holds the cards here in this negotiation?
You know, I think everybody holds a little bit of cards, you know, so this isn't one of those like I hold all the cards, but it's a great question, Stu. And what you point out, what you're double clicking on by asking that question is what can China do to change Iran's behavior? And everyone's sort of focusing on the wrong things. I'll tell you one data point that I'm sure you're going to chart later after this conversation, and it's that Iran has a trade deficit with China. How's that possible? They send so many barrels of oil to China. Well, it's because they receive everything that makes them a modern industrial economy. What that means is that those drones flying into vessels, they've got Chinese components. And no, not because China's evil. American drones have Chinese components in them. Let's be real. Iran may be able to assemble a drone. It doesn't have semiconductor fabs. So absolutely China has massive leverage on Iran. Without Chinese trade, Iran cannot function as a modern economy or conduct combat operations. So I do think that at some point you can get Iran to accept certain limits to kinetic action.
But Marco, why not then just have Iran only open up for Chinese vessels? Why have some sort of situation in your kinetic equilibrium where more oil can go through? Why wouldn't Iran just make the decision, okay, we're just going to distinguish, only let China go through. Maybe oil comes down a little bit, but that still seems like it settles at a much higher premium.
Yes, absolutely. I mean, it would have to set at a higher premium, but I also think that there's other ways to pressure Iran. Obviously, U.S. can attack, you know, there's a tacit agreement between U.S., Iran, and possibly Israel on what is appropriate to attack. By the way, there's a historical precedent to this that I think your viewers should really study up on. Iran-Iraq war was a vicious war. And Iraq was actually a proxy of the United States at the time, financed by the GCC, the Saudis, you know, UAE. And yet that war, despite its brutality, over 1 million people dead. I mean, much worse than what's going on today. It settled into this appropriate kinetic path where there were certain things that were appropriate to strike and then others that weren't.
One thing that I've been wondering a little bit about, Marco, is where this conflict fits into any sort of larger multipolar or bipolar geopolitical rivalry, let's say between the U.S. and China. If there's this relationship between Iran and China where China needs Iranian crude and Iran needs imports from China, particularly to create drones or any other sort of infrastructure, why would the U.S. want any sort of de-escalation if it lifts its geopolitical rival China and allows revenue to flow back into Iran?
Well, I think your question reflects this real struggle between a bipolar outlook and a multipolar. In a bipolar world, you're right. It's a zero-sum game between the two rival superpowers. But in a multipolar world, actually, Stu, you have these conflicts where the two rivals find themselves on the same page. And in this particular case, I would argue that the US and China are on the same page. Let's imagine a scenario where there is no de-escalation. There is no kinetic equilibrium. It's that 35% where the market's down another 30%, right? Re-escalation. I can see a world where Chinese vessels are shoulder to shoulder with American in 6 months' time, trying to pry open the Strait of Hormuz.
And you know why that's interesting, Marco, is because this was an administration that has gone back and forth as to whether they really want this, but that at some point wanted NATO vessels to be the one alongside American ships. What difference does it make in the division of this global world to have American allies, which have already been, let's be honest, abused by tariffs, this time around being much more hesitant to help out the United States?
That's a multipolar world, right? It's every pole for itself. It's the famous Palmerston quote, "There are no friends, there are no enemies, there's just interests."
As we look ahead to U.S. discussions with China in the coming weeks, I'm wondering how that, each pole for themselves, this multipolar world, ends up working out. Of course, we're seeing some rhetoric out of China this morning to ramp up any retaliatory tariffs against the U.S. But as there's this larger negotiation about the relationship between the U.S. and China, do you think that this is going to be basically the entire talking point? Reducing, de-escalating on trade so that the two poles or two of the poles in a multipolar world can focus its attention on Iran and opening up the strait?
Well, I think this is where, you could probably criticize the Trump administration a little bit for refocusing America to the Middle East. So how much slack does the U.S. have to now also wage another front war with China on trade? To me, it looked like President Trump was, lining up for some sort of detente with China anyways. And I think that the current situation in the Middle East probably reinforces that necessity. China needs to be a willing partner to pressure Iran now, and they're going to extract something for that service to the United States.
So, Marco, there's a lot of wild cards, a lot of variability in it. And one thing that also sticks out to me, you said the other day, if this doesn't get resolved, we're looking at a pandemic-style shutdown of the global economy. So much is at stake. What are you advising clients to do right now? Are markets appropriately pricing in this risk?
No, they're not. And the lower the markets go, and the futures are flashing on the side of the screen as I'm saying that, the lower the markets go, the better for the de-escalatory scenarios. So if you are sitting there wanting to buy back into risk-on trades, particularly all the rest of the world stuff that was outperforming US, that looked really juicy over the past 12 months, if you want to nibble at that, you want market to go down hard in the near term. It's necessary. It's important. The 10-year yield has to go higher. Stocks have to go lower. That will put pressure on President Trump to avoid re-escalating from this position. So the ground troops. And, Colonel Sanders that came on before me, he really articulated very, objectively and straight the fact that the troops that are being amassed, and I can't even use the word amass because it's not appropriate, the troops that are being assembled are just nowhere near the levels we've had in Gulf War I, Gulf War II. So what's the point? What's the plan here? Why? Take some island in the middle of the Strait of Hormuz that doesn't really give America any strategic advantage, given that it's already got the air bases and the ports in the region. I think that President Trump really needs to think about what is the risk reward for any ground action, given the amount of troops he has already positioned in the region.
So a lot of your outlook for the global conflict comes from what is going on in global markets. My interest is what's going on based on your expectation of a 50% probability for this kinetic equilibrium, and then what that means for markets. If you end up having a prolonged kinetic warfare, but a reopening of the strait, what's your favored trade in that case?
I think in that case, everything that's happened over the last 4 weeks will reverse, and we'll go back to the short dollar, long rest of the world, equilibrium that we had that we had landed on as global investors. Now, what's interesting about that?
I think we might have just lost Marco, which is so unfortunate because I feel like he was just about to make a great point, but great points were already made. Marco Papic, we're going to have to end it there. We're just about out of time. Anyway, we're going to get you back, Marco Papic of BCA. Stuart, I just want to get quickly your take in listening to Marco. These two very different outcomes where there's escalation, but one where maybe oil can flow through. How are you thinking about those assumptions, especially when it comes to what interest rates will look like and that sort of weight on the economy?
I think there's certainly a global interest in reopening the strait. I think that Marco's absolutely right about that. Whether kinetic warfare continues in the background, I think that we know that Iran has the capacity and the taste for doing that. We've seen that they're able to engage in a prolonged conflict in the Iran-Iraq war. What does that end up meaning for crude prices? Of course, fading of Brent, say, back down to 80. We end up having a little bit of an inching back in of headline inflation. We're expecting March headline CPI of nearly 3.5%. That'll start to come back in, and that reopens the door for rate cuts, but probably in the second half of this year.
Yeah, hopefully we don't get that worst case scenario from the OECD of 4.2% for the U.S. Stuart, that was amazing. Please come back again soon. Alongside Marco, that is Stuart Paul. Coming up, Sarah Hunt of Alpine Woods joins the show as stocks head for their longest losing streak since 2022.
tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Welcome to Bloomberg This Weekend. I'm David Durrett.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Just seconds away until the start of your trading day. You are watching Bloomberg Open Interest. I'm Danny Berger. Matt has left me alone until Tuesday. He'll be back. A tough week. We were headed for a weekly gain. That reverses yesterday. Now headed for the 5th weekly loss since 2022. S&P down 0.5%. NASDAQ underperformed. Some drama going on with tech too. And as yields inch towards 4.5%, the Russell 2000 also down 0.6%. At the opening bell, we have a SPAC. SPACs are back. We might not be at highs for markets. It might not be bubbly or frothy, but, you know, maybe it's a sign that we're still getting SPACs. I believe they are just listing now the blank check company, Kensington, Kensington. And then finally, Xanadu, this is a quantum computing company. I swear, I did not realize how many small quantum computing companies are out there. This one happens to be a Canadian one, but I feel like it's like at least once a week we get one of these at the opening bell. So there you have it. I'm going to look at a different part of tech here, though, at the opening bell. Look at what these cybersecurity stocks are doing. CrowdStrike, Palo Alto, Cloudflare, Zscaler, all of them down at least 3%, and as bad as 6.5% in the case of Palo Alto. It's a concern coming from a Fortune report that said Anthropic is testing a new AI model that poses significant cybersecurity risks. We thought cybersecurity was one of the safer parts of software just because of how integrated it needs to be. Maybe it's not with all the AI. Carnival also reporting estimates results that beat expectations. Shares are still down 3%. CEO Josh Weinstein says the company delivered a strong start to the year, driven by healthy fundamentals and solid execution across the business. But maybe the greater concern is what's happening in oil markets. Let's go back over the desk, because joining us now and sitting here patiently waiting is Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods. Sarah, great to see you this morning. Thanks for joining. Just staying on the idea of Carnival earnings, because it's still down and there's been so much sour sentiment towards travel stocks because of fuel, because of consumer appetite. How are you looking at the sector as the war drags on? Is this a place that you can play in this market?
I think that ultimately we've seen when you get shocks like this, the stocks have a bad reaction, and if things resolve themselves, but also in general, they will tend to bounce back. The question is it too early to start that? And I don't know that we know the answer yet. It's certainly a good time to be looking at these and choosing what you would like to be in when you sort of feel like there's some sort of stabilization. But for the most part, you know, you want to look at balance sheets, you want to look at cash flow and understand, can they get through some sort of period of softness? But generally speaking, that's generally been a good opportunity to look at
the thing that I'm kind of struggling with is you want to look for a safe balance sheet and where cash is to protect protect you and safety. And that's brought up with a lot of people saying maybe big tech is the place for safety. But I'm also looking at the NASDAQ this morning, down 0.7%, which means it's now in a correction, down 10% from its October highs. What do you make of this? Is this not currently a nice little safe, cozy place to hide out in the midst of geopolitical strife?
So this is definitely a time frame issue, right? Because we came into this year on valuations that were pretty high, looking for a year where you thought you were going to see expanded CapEx and things were going to move along and the economy was okay and labor markets were okay. And now we have a number of exogenous shocks, including what's going on with Iran. Interest rates have gone higher. There's a number of things going on. Private credit is having some problems. There are a number of things that are going on. So from a longer term perspective, are those good places to be? Yes, they are. Can they have some near-term pain? Absolutely. Because you see that the growth issues are being there's a lot of concern about that, and then interest rates add to that. So I think in the near term, they're a little bit stuck, but longer term, not so much.
By the way, it does feel like whack-a-mole. Private credit, concerns of geopolitics, what AI is doing in general tech. I mean, on the AI point, I mentioned this before, that Fortune had out some story about Anthropic releasing a new model that seemingly is putting pressure on cybersecurity stocks. Are we? I thought we were past this, Sarah, that we were past the world that like one tiny announcement comes out and it crushes stocks. What do you make of the fact that we're still so sensitive to AI disruption for software?
I think that the general level of uncertainty and all of the things that are going on makes everybody especially sensitive. I think absent some of the other things that maybe people would look through that. But with AI, that revolving threat has been going after different segments of software, different segments of other things, and people get really worried about it. And then you already have reasons, I think, you know, to the extent that sometimes when there looks like there's a relief to the situation, the market wants to go higher, tells you people want to buy. The fact that they're so sensitive to things also tells you that people are worried and they're worried about valuations. So it's easy to see sectors get moved around, which is, again, a time frame issue. Because from a longer perspective, I don't think it's much of a problem. On a near-term perspective, it obviously has some sensitivity.
And it's a good point, because we had also been hearing in terms of the time frame issue that people came in before the war broke out, that they were short some of these tech stocks. War breaks out, they get low to the ground, so they unwind a lot of those shorts and they rally. Maybe that's over and they can add back. How much are you looking at general market positioning as driving where we are right now versus fundamentals?
Well, I think this was one of the big issues about coming into this year. We expected some volatility. We didn't expect this much volatility, and I don't think anybody had this on their bingo card of what was going to happen. But I think that you had people positioned for, again, some pretty benign outcomes, and I think right now we're looking at the potential for some outcomes that are less benign than we started the year with. So I think that gives you some problems, and as people work through those, then you start to see some room and some possibility. You know, you also don't want to get to the point where everything is so short, you could end up with a short squeeze. That can happen in a lot of different sectors. So I think, you know, you want to look at positioning because it gives you an idea of where people are starting and how much room there is.
There is also a continued sell-off, and it's actually a curve steepening today. The 10-year yield is up 5 basis points at 446. It's easily up 0.5% since the war broke out. As we creep closer to 4.5%, do certain trades start to become under pressure? Does a 10-year yield at 4.5% break anything?
I think in the same reason that does oil at any X price break anything, the question is, are we staying at these levels or have we run to these levels because of what's going on right now? And I don't know what the answer is. If we stay at these levels, it could be a problem for all of the things we've talked about. Certainly the small cap trade that was having trouble in the beginning of the year as people were starting to worry about what was going to happen. I think that there is always a reason to think that there could be problems. The question really is how long does it stay there? And I don't think we know the answer to that yet. But the longer this goes on, the more it feels sustained.
Do we have an answer to the length at which it becomes a problem? Is this like it needs to last a year? Is it months? Because we've seen that corporate America is incredibly resilient. And Barclays was just on surveillance raising their price target, saying that the fundamentals and the bottom up look really strong. So how well equipped is corporate America to weather through any sort of sustained energy price increases?
I think the combination of higher energy prices and higher interest rates is much harder. But I also think that if you got some sort of a resolution where at least you started to see things transit through the strait, right? Because I don't know what else the resolution is going to be, but you have to see energy start to move for those prices to come down. If that comes down and it takes interest rates with it, then I think that you don't really have that much of a problem. And corporate America is enormously resilient and has managed to, I mean, I go back to when they started raising interest rates to begin with off of zero. And everyone said, well, we're going to crush the economy because we've gone from zero to where we we are. I think that there is a lot of resiliency there. I think there was some dry powder there. I think the question is the longer it goes on, the more tenuous that becomes.
Sarah, just before I let you go, I would love to know how you're thinking about general portfolio construction at this moment. 60/40 is on track for its worst run since 2022. Gold's it's a momentum asset, I guess, now. It's not really providing any sort of hedge. Clearly, bonds aren't either. How are you thinking about the construction and what actually makes for a diversified, well-hedged portfolio in this type of scenario?
So, you know, when you get a couple of years in a row where everything is ridden by tech, and tech is the one that's driving all of the performance, it's much harder to look at the portfolio and say, we really like where we are. But we have been dividend people. We have been capital return people. We have been looking for companies that can grow their cash flow, grow their earnings, and do the kind of things year in and year out under a variety of circumstances. I think that's a time for that sort of construction to shine that is across industries. It's not only certain sectors. You know that certain sectors are going to get hurt by this, but you want to be, again, this is a long-term positioning question. This isn't what do I need for 6 months? Because what you need for 6 months, some of that should have been liquid already. Gold had a huge run, and so it looked like it was going off to the moon. The fact that it's acting the way it's acting right now tells you that there was probably a lot of speculative fervor in there, and so some of that is coming off. But longer term, does it still have a position in the portfolio? You know, we like the miners as opposed to simply gold exposure because they will do well from that, and some of them pay dividends as well. So there's a lot of ways to express an opinion.
It sounds like some good opportunities in that too then.
Absolutely. If you take a look at some of the mining stocks, they've come off quite a bit. I mean, a Newmont has come down from 120s to sub 100. There's a lot of places where if you think that some sort of price above the 2,000 or 3,000 level is going to be positive for these stocks, you've got some room there. I think energy's become reinvestable again because for a while it wasn't investable. Everybody thought that we were getting away from hydrocarbons. I think this is an example of that, how that is not the case. But it means that maybe you have some in there, and again, this is a dividend-paying group, this is a cash flow-generating group. So I think that there's some room for people to look at sectors that have been sort of left by the wayside here, but longer term, you know, we've been doing that anyway, so we think this is a good year for that.
Sarah, thank you so much for joining. Please enjoy the rest of your Friday and your weekend. Sarah Hunt of Alpine Saxon Woods. Let's get a check on your equity market about 10 minutes into your trading day, down 0.6% for the NASDAQ. If we close at these levels, we are going to hit a correction down 10%. I just want to point out Apple at the top of the stack in terms of points added. It's only up 0.4%, but Mark Gurman had this really good story that Apple plans to unleash its Siri with AI, and basically you can choose the LLM. So they're not going to be spending a bunch of money on OpenAI or Anthropic. Maybe Apple is going to win the AI race by not spending any money. Maybe that was the genius move all along. Elsewhere, we are seeing a rebound in some of these chip stocks that have gotten hit. The memory stocks like SanDisk, Lam Research on that report that we saw earlier in the week about Google's release, Exxon doing well, energy stocks doing well. That's not a surprise. In the down ledger, look at these big cap tech having a really tough day. Microsoft, Amazon, Alphabet, all of them down at least 1.5%. Tesla, it is the Mag 7. A who's who, minus Apple, of selling off and selling off hard. Just want to point out, you can see Palo Alto at the bottom there. That was an issue that we've been talking about with a Fortune report about a new release from Anthropic. Looking at the sectors, staples are having a really good day. Michael Hartnett from Bank of America recommended staples as a place to hide out when we get more government stimulus to try to avoid a recession. Energy and utilities do well. Energy up with the price of oil, and consumer discretionary with Carnival falling at the bottom of the pile. Coming up, we're going to talk about that. Carnival issuing weaker full-year guidance as fuel costs rise. We're going to take a deep dive next. This is Bloomberg Open Interest.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1
is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The losses stack up for this week. We are now down for a 5th consecutive week, the longest losing streak since 2022, as Brent crude inches higher by 2.5%, and 10-year yields sit at just under 445. Now time for some top calls. Let's look at the analyst action this morning. First up, JP Morgan. They upgrade the power plant builder Argan after reporting a strong 4th quarter. The firm sees several potential catalysts on the horizon, up a whopping 22.5%. Next up, Evercore. They raise its rating on the trucking company Knight-Swift Transportation, citing its valuation and saying it will benefit from an upturn in the trucking business, but shares fall 0.5%. Finally, Bank of America. They upgrade TripAdvisor to a buy, saying pressure from the activist investor Starboard is increasing and could unlock more value, up 3.2%. By the way, I spoke with Jeff Smith of Starboard about his plans for TripAdvisor on the Bloomberg Deal Show. You can find that conversation on the Bloomberg Terminal or on Bloomberg.com. Let's get a check-in on Carnival shares because they are down only 0.8%. They were worse before. They're bouncing around. They reported 1st quarter results. Its full-year adjusted EPS missed estimates. Bloomberg consumer reporter Red Brown joins me now for more on the results. Red, you've been looking through these. What do you make of what we had to hear from Carnival?
Yeah, well, I think the thing that's kind of jumping off the page is across the board they missed with their outlook. They're still saying that there's demand is going to be really strong. They're saying kind of record levels of demand. This is something we've been hearing from cruise companies for a few years now. But I think we're starting to see maybe some of these costs kind of creep in, especially the fuel costs. One thing to keep in mind with Carnival, in comparison to its rivals, Royal and Norwegian, is Carnival actually doesn't hedge its fuel prices. So we are going to see like a little bit of that impact from the recent change in fuel prices impact them a little bit. They said in the 2nd quarter they're expecting to see fuel costs around $610 million. Analysts were expecting $540 million, excuse me. So yeah, we're definitely seeing that impact kind of hitting the bottom line right away for Carnival.
Yeah, because I was just looking at what's in their assumptions for their guidance for the price of oil. So $90 for the remainder of April and May, $85 average for the 3rd quarter, $80 for the 4th quarter. Presumably that is an assumption to make. If the Strait of Hormuz remains closed, maybe we stay more towards the 90 region. What does it mean for a company like Carnival? Do they have the capacity to raise ticket prices if all of a sudden they're going to see higher fuel costs?
Yeah, no, that's a great point. And they can, because the demand is so strong. I think, if I'm remembering correctly, they said they have 85% of their trips already booked for 2026. So once it's in that final 15%, they can still raise prices because the supply is so limited. Like they said, the demand is at record levels. So there is still that lever that they can pull on, but it kind of remains to be seen. You know, maybe demand does change as we move through the year. If the economy does start to wobble a little bit more with the elevated prices as well. So there's still a lot of things that could, it's very dynamic, I think, still for them.
Yeah, I mean, the market is maybe concerned. I think they're down like 20% since the war broke out. So that's not necessarily great. What are you seeing from other consumer-facing companies and their ability to raise prices? Because you're starting to see it creep in. I mean, a government company, USPS, for example, is talking about a surcharge. According to a Wall Street Journal report, Delta, 20% increase too. Where are you seeing those price increases come in, and whether the consumer is able to handle them? Is it just like traveling, for example?
It's really tough right now. So if we think of just like the CPG companies, they've been so reluctant to raise prices now because they have done for so long. They're really focused on increasing volumes, right? But now with the costs coming up, you know, you're in a difficult position. The packaging costs are going to be rising, fuel costs are going to be rising, transportation costs are rising. So what do you do in that situation when you're so focused on improving your market share, improving your volume? So I think it will probably take us another earnings season before we start to get a really good sense of how companies are going to navigate this. Whether or not, you know, we can use Carnival as an example. They say that they're going to find $150 million of efficiencies, of operational efficiencies this year. So maybe they don't have to pass those prices on. But I don't know, you know, those can sometimes be a bit of a guess, right? It's an estimate for them. So it depends whether or not they're actually going to be able to achieve that goal and not pass the prices on.
Yeah, because we haven't had a complete rethink like we had in COVID or in tariffs of completely altering supply chains. Will be interesting to see if we get to a point where there is a reaction like that. Red, thank you so much for joining us. That's Bloomberg's Red Brown, as Carnival shares are slightly lower after a miss across the board. Coming up, a historic shift. Investors are pulling record amounts out of commodity ETFs to find their safe haven role. That's next up on ETF Fridays. This is Bloomberg Open Interest.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to Bloomberg Open Interest. Let's get a check on your markets this morning. About 20 minutes into your trading day, still a negative session, still on track for a 5th consecutive weekly loss, being led by tech. It's a tough day. It's like all the fears come together. You have war, you have AI concerns weighing on the cybersecurity stocks, and still private credit, a concern too, with Oaktree meeting all of their redemptions in one of their BDCs. So S&P falls 0.7, NASDAQ down almost 1%, now in a correction. Russell not doing well either because of what we're seeing in yields. Yields continue to creep higher, but this time, it's not necessarily the front end, it's the long end that's leading it. In fact, we're rallying on the front end. We're down by 1.5 basis points, but we are pricing in now maybe longer term uncertainty, maybe longer term inflation as this conflict drags out, as President Trump says, not 5 days of a pause now it's 10 days to allow more room for negotiations. What does that do to the long-term uncertainty? 10-year yields at 4.45. What happens if we get to 4.5%? What breaks? NYMEX crude, that's up 3.2%. Brent crude not gaining as much. That's an interesting thing too. Brent crude only up 0.7%. And great news, everybody. Gold is rallying. I mean, it's fallen quite a bit since this war broke out, but it's up 1.2%. The Gold Trust ETF also up 1.5%. There have been so many questions as to whether this is still a hedge, but we did see commodity energy moves higher.
Yeah, I mean, part of it is people were trying to, bet on it going up and they're taking profits. I think a lot of it has to do with the fact that you kind of saw this in major crisis, right? Like if you go back to 2008, the funds that bet on the housing crash, like they actually saw redemptions because people were going what has done well and taking their cash out. I mean, we've seen that all these things are not great hedges. As you just talked about, gold is down pretty hard right now. It's rallying slightly today, but over the last month, it hasn't been great. If you look at gold ETFs from the start of 2025 through the end of February, they had record inflows, 65 billion. But as you pointed out as well, 15 billion has come out so far in March. So I think a lot of it is, one, the hedges aren't working that great, whether it's bonds in general or gold. The only hedges that are really working are cash, and we see that with record money market assets, record money going into ultra-short bond funds like T-bills. But again, people are taking money, they're seeing gold go down a little bit, and they were like, it's already up, so why would I sell something that's down pretty hard when I can sell something that's up? And that's what I think contributed to what happened in March.
Yeah, we've seen some of that in the fund manager surveys from Bank of America, that cash has been really attractive to rotate into, the biggest rotation into cash, I think, since 2022. James, another area that people like to talk about is kind of a safe place to hide out when there's geopolitical uncertainty is tech. That hasn't really been working out. I was just talking about the NASDAQ entering into a correction. What do tech ETF flows look like?
Yeah, so it's funny. To absolutely nobody's surprise, tech usually is the #1 sector for ETF flows. That is going to be upended for the first time since like early 2023, where energy has taken in the most money, or energy, specifically equity. Industrials is doing well, materials is doing well. Thematic ETFs that invest in things like infrastructure and natural resources, basically anything in the real economy, that's where most of the money is going. People are betting on, these supply chain disruptions and people actually having to build real things. But it's not like tech is seeing outflows. They're still seeing inflows. It's just that that's not where the money is necessarily going.
Right. I mean, maybe it's a good buy the dip. NASDAQ down 1.1% this morning. James, more broadly, there have been some reports about how retail investors haven't really been buying the dip this week for the first time. They sold NVIDIA for the first time since July on a net basis. Are you seeing any of that hesitation to dip buy starting to come through to the broader ETF universe as well?
Maybe a little, but there's nothing that's like jumping off the page. I mean, people are still trading these 2X products. They're still jumping into, yes, there's been recent outflows, some broad commodity stuff, but specifically broad commodity-based ETFs, there's people still allocating to them, diversifying. People are still betting on oil going up in many ways. It's just that you're never going to see these traders step away, but we're not seeing like massive, people trying to bet on what's happening from retail in the way that we were when this first started, a month ago.
All right, James, thank you very much. That's James Seifert from the Bloomberg Intelligence team. As stocks continue to fall, now falling on a report of a U.S. strike on a steel plant in Iran. We're looking at stocks down 0.9%. The NASDAQ falls 1.1%. We'll keep you up to date with any headlines as they come. You're watching Open Interest.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open a restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing because I never watched the movies. You know, I was traveling the business. But of course, after people, hey, Nobu, so you must know him, and then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He support me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He say, hey Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
News on the Hour, sponsored by JTV.com.
I'm Deborah Rodriguez. Lawmakers on Capitol Hill have made a move to end the crisis at airports. Correspondent Nicole Killian.
Just after 2 a.m. here on the East Coast, the Senate voted to unanimously fund most of the Department of Homeland Security. That includes TSA and other parts of DHS like FEMA and the Coast Guard, but funding for ICE and CBP or Customs and Border Protection is not included.
The House could vote as early as today before lawmakers break for the Easter Passover holidays. More airline passengers are donating to help TSA workers who've been on the job without getting paid. Ellen Dean dropped a gift card in a box at Birmingham Shuttlesworth Airport in Alabama.
I don't think it's fair at all. I think these people should be paid. They're the ones for our security, and to not be paid, I give the ones credit that are showing up.
So far, no comment from Iran after President Trump announced he was giving Tehran 10 more days to reopen the Strait of Hormuz in a new bid to bring the war to a close. Correspondent Chris Livesay reports from Dubai.
Publicly, the Iranians certainly are denying that they are, quote, begging to make a deal, as President Trump has characterized it. Instead, they're doubling down on their previous demands. They want the United States, of course, to cease hostilities. They also want to basically own the Strait of Hormuz.
Brent oil tops $110 again after 2 ships from China, an Iranian ally, were turned away from the strait today. Things will heat up across the South today. Meteorologist Craig Allen.
Dozens and dozens of record-high temperatures are expected at least one more time in the east. So Augusta, Georgia, South Carolina, it would be Charleston, North Carolina, may see a city like Charlotte getting into the mid to upper 80s to near 90 degrees.
There is a cold front moving east, and that's expected to have temperatures plunging tonight into tomorrow. A baseball star is suing his parents. CBS's Michael Wallace.
It is gone! Opposite field home run, Alec Bohm!
The Philadelphia Phillies third baseman led his team to an opening day win Thursday, a day after he sued his parents for $3 million. Bohm claims they misappropriated his funds while managing limited liability companies on his behalf and misrepresented their stake in those LLCs. An attorney for the parents says they have always acted in their son's best interests and are saddened by the false narrative he is painting.
Savannah Guthrie is set to return to the Today Show. NBC says she'll be back a week from Monday, following a 2-month absence after her mother's kidnapping. The Dow is down 495. This is CBS News. As March Madness revs up, a court rules on that pervasive 2-word term, and others like it.
A federal judge has denied the NCAA's motion for a temporary restraining order to stop DraftKings from using registered trademarks associated with the men's and women's basketball tournaments. The NCAA requested DraftKings stop using March Madness, Final Four, Elite 8, and Sweet 16, and variations of those terms to promote its business. The judge indicated it was not demonstrated how the online sports wagering platform's use of those terms would cause irreparable harm. Steve Kathan, CBS News.
Love was in the air at the iHeartRadio Awards when Taylor Swift picked up one of her 7 prizes.
This album probably also feels very happy and confident and free because that's the way that I get to feel every single day of my life because of my fiance, who's here.
Deborah Rodriguez.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube. We are streaming live on Bloomberg.com as well. Coming up, we're going to check in with Joanne Shu. University of Michigan surveys. The UMich survey came out today. The headline a little bit weaker than expected. We'll break that down coming up with Joanne. Nancy Daoud, a private wealth advisor at Ameriprise Financial, will join us, give us her thoughts on these markets going forward. And then Brendan Murray, Bloomberg News global trade editor, talk to us about U.S.-China global trade. We got a summit coming up, and how's the trade situation look? Wendy Schiller will give us the latest on what's happening in Iran, U.S.-Israel. She's at the Brown University as well. Randall Williams, Bloomberg Business and Sports reporter, is going to talk to us about the NBA. It looks like the NBA wants to expand here, talking about maybe Vegas, maybe Seattle. It's going to cost you some big money if you want to get into this league. So we got a lot coming up over the next couple hours. It's Scarlett Fu and it's Paul Sweeney, and this is the Bloomberg Intelligence Program. Let's kick it all off with Charlie Keller.
Hi, thank you very much. And here's what's going on. This Bloomberg Business Flash is brought to you by IBKR. Will the price of gold exceed $51.50 on March 31st, 2026? Turn your view into a trade at ibkr.com/forecast. Last trading day March 31st. As Paul mentioned, just getting word that consumer sentiment slipping to a 3-month low in March, and year-ahead inflation expectations jumping as the war in the Middle East drives up gasoline prices. A whole lot more on the University of Michigan's final March sentiment index coming up in just a moment with Joanne Shu. The Dow, the S&P, NASDAQ all lower. NASDAQ 100 index moves into a correction. S&P right now down 61, 64.15 where we stand, drop there of 0.9%. The Dow down 454, drop of 1%. NASDAQ Composite Index down now by 275, down 1.4%. NASDAQ 100 Index down 1.2%. The VIX with a 30 handle right now. The 10-year 4.44%. The 2-year 3.94%. Gold up $79 the ounce, up 1.8%. West Texas Intermediate crude, the big story, 97 a barrel, up 3%. Brent pushing higher as well, 110.27, a gain there of 2.1%. Bitcoin down now by 3.8%, 66,331. Again, recapping, stocks lower, S&P down 0.9%, the VIX at 30. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here with you in the Bloomberg Interactive Broker Studio, streaming live on YouTube and streaming live on Bloomberg.com. As Charlie's just reporting, we've got a broad sell-off in the marketplace here today. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Christina Aquino. Christina, what are you looking at today?
All right, let's start with Halliburton, Paul. Ticker HAL. That share is doing well today, up 2.7%, and that is because J.P. Morgan raised its price target on the company, saying that it expects limited first-quarter earnings impact from the Iran war compared with its other peers. So J.P. Morgan rating the stock overweight, so maintaining that rating, but they did raise the price target to $40 from $35. Current stock price around $39. And so analysts from J.P. Morgan citing that the fact that Halliburton maintained its guidance for Saudi Arabia and North America compared with lower guidance by some of its peers helps keep up its rating there and the outlook as well. Although second quarter earnings could see some impact from the war, but not majorly so at the moment.
All right, and let's move on to your second stock in the tech space.
Absolutely, Scarlett. Let's take a look at Meta. So ticker META. Those shares are down today, extending some of those opening declines, now down 2.7%. And of course, we all know that Meta and Google were found liable in the first social media addiction trial. So companies, of course, have responded to the verdict. They disagree, and Meta says that it is evaluating its legal options. We do have Bloomberg Intelligence analysts weighing in on the verdict and its impact for the company, saying that ultimately it's unlikely to have a material business impact, given that the case, while it was strong, it wasn't a unanimous decision, and so that could potentially poke some holes in the arguments depending on how the appeal process goes.
Carnival Cruise Lines.
Carnival Cruise Lines. We just got the report earlier today, and that is not boding well for the share. So ticker CCL, those shares are down now more than 3% at the moment, and that is because we did get some disappointing outlooks for the company for both the second quarter period and the full year period. So first quarter adjusted EPS actually beat estimates. That came in at 20 cents versus 18 cents, but it's the outlook that investors are worried about clearly. So for the full year, EPS outlook is about $2.21. The estimate was $2.35. I also note that their fuel costs bigger than expected, as one would expect. So now they're seeing their fuel costs for the second quarter, $610 million versus $539 for the estimate.
Good stuff. Thank you so much. Christina Aquino is Bloomberg Managing Editor for Markets Live. She just got back from Asia, too. How'd that go?
I did. I loved it. 2 weeks in Asia. Fantastic. 90-degree weather, 100% humidity all the time. But at the end of it, I was like, you know what? I miss sleeping in my own bed, and I miss my cat.
Yeah. Makes sense. All right. Welcome back, Christina. And for, of course, more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. We got some data today, Paul Sweeney.
Yes.
And consumers are, as you might expect, worried about rising oil prices and what that means for inflation.
Yeah, U.S. consumer sentiment slid to a 3-month low in March, and year-ahead inflation expectations jumped as the war in the Middle East drives up gasoline prices. So there you go.
There you go. All right, let's bring in Joanne Shu. She is University of Michigan Surveys of Consumers Director to walk us through what we've seen in this data. And by the way, this is the final read for the month of March. Just kind of sum up for us, Joanne, what this report tells us.
Essentially, after the start of the Iran war, we have consumers being quite worried about the trajectory of the economy. Primarily, this is coming through worries about both gas prices and inflation overall. We have a pretty large surge in short-run inflation expectations, and we had a deterioration in one-year expectations on multiple dimensions of the economy. But interestingly, consumers don't necessarily think that this is necessarily going to pass through to long-term deterioration in the economy. They think it's primarily focused on the short run.
So talk to us about, Joanne, just kind of how the labor market plays into this, because the labor market's still pretty robust. We got some jobless claims yesterday that were pretty much in line. So how's the labor play into it?
So consumers perceive that labor markets are much weaker now than they were a few years ago. And a majority of consumers are still expecting unemployment to rise in the year ahead. So consumers don't think that labor markets are going to be super strong over the next 12 months, but there hasn't been too much of a deterioration from February. The primary deterioration we saw from last month was with inflation, as well as personal finances and business conditions.
When you look at the inflation outlook, is it surprising that most of the concern is focused on the short term and not on the long term? At what point would you start to maybe see some of that spill over into long-term expectations?
There are a couple of reasons why consumers might not think that the current conflict may pass through to long-run inflation. And one is that they might think that the conflict is not going to take that long. So if the conflict ends quickly, that would be consistent with limiting the long-term implications of this current conflict. And there are also a subset of consumers who believe that the conflict itself might lower energy prices relative to where they were before, or lower inflation. So there is kind of a mix of views. If the conflict continues to drag on, consumer views could very well change quite quickly.
Is this data skewed in any way by political affiliation?
You know, as always, people across the political distribution don't always agree or see eye to eye on how things are going. It's always the case that if your party's in power in the White House, you tend to see the economy more favorably, and right now is no different. That being said, this broad-based deterioration in business conditions, personal finances, inflation expectations from February, we saw that among both Democrats and Republicans alike.
Have you started to see any kind of convergence between Democrats, Republicans, or independents? I mean, they've kind of all gone in their own direction, depending on whether Biden is a president or whether Trump is president. But after a while, do you start to see any kind of convergence?
So both in the previous Trump administration, the Biden administration, and now, even though there are level differences between consumers of different parties, they tend to move in parallel, and that continues to be the case now. Consumers across the political spectrum see the short-term economic outlook as worse than it was prior to the start of the Iran conflict, even if they may differ on their beliefs about what that might do to the long term in terms of lowering gas prices in the long term.
Joanne, thanks so much. Appreciate it. Joanne Shu, Surveys of Consumers Director at the University of Michigan. A stock-specific story that got my attention, Scarlett. Microsoft set for its worst quarter since 2008 as AI takes 2 bites. And the story goes on to say, you know, first of all, people are concerned about all this software CapEx on AI. That's number one, and Microsoft's all in on that. And then second, investors are selling software stocks over fears that AI startups like Anthropic and OpenAI are creating agents that can replace products made by companies like Microsoft. So, I mean, Microsoft is a story. If you talk to any tech investor, like a Dan Ives, for example,
right.
You ask him, hey, top pick, and he says, a lot of them are just reflexively over the years have said Microsoft because they have such a deep moat around their products.
And for a long time, it was a proxy to OpenAI as well because of their relationship with that startup. You know, I was just looking at the price action for Microsoft, and in the past 3 weeks, that stock has risen only 1 time each week. So you have 15 trading days, and the stock has gained in 3 of those instances.
Yep, stock's down 2% today, down about 25% year to date. So you don't typically see that for this stock. Again, kind of a bellwether here, but it goes to that issue that we were talking about before the Iran war news, and one of the key topics was AI, and the market now seems to be in a position where the market is trying to figure out who are the winners and losers potentially from greater adoption of artificial intelligence. And the software stocks broadly defined, we're feeling some of the wrath there.
And Microsoft, again, was one of the better performers when the AI story really began, right? It was seen as, I don't want to say as resilient, but just certainly holding up better because it was able to take advantage of its position with OpenAI. Of course, that kind of changed in 2025 when Alphabet became kind of the poster child of companies that were really pressing their advantage with AI.
Yeah, and I think the consensus coming off of Wall Street as it relates to these software stocks is if you've got a software stock that's got a big moat around it, where it's really entrenched in enterprises, probably okay long term. And I think that's where you would put Microsoft, clearly put that at the top of the list.
A utility software maker.
Yes, if you're kind of a one-off, standoff, one-trick pony, two-trick pony, or you're not really entrenched, maybe that's the ones that are at risk. But again,
I'm pretty sure we're going to be talking about Microsoft in 5 years' time or 10 years' time.
I think so. Again, the sell-off continues here with the S&P off 0.75%. The Nasdaq off about 1.1%. That's in part because oil's up about 2.5% here on WTI crude oil. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. The NASDAQ 100 index in correction territory. This after a 10% decline from its peak. Right now, the NASDAQ 100 index down another 1%. Dow, S&P, NASDAQ all in the red with the S&P down 48. Drop there of 0.7%. Dow Industrials down 362. A decline of 0.8. NASDAQ down 1.1%. Again, correction now for the NASDAQ 100 index down 1%. The VIX right around 30, the 10-year 4.44% with the 2-year currently yielding 3.95%. Spot gold up $83 the ounce today, 44.60 where we stand, up 1.9%. West Texas Intermediate crude. Keep it locked into Bloomberg. We will continually update you throughout the day on what's happening with crude prices. WTI right now 97.58 a barrel, up 3.3%. Brent, the global benchmark, above 110 now, up by 2.2%. So again, the Dow, the S&P, NASDAQ, all trading lower. We're keeping an eye on Netflix shares. Netflix gaining again today, up another 0.3% after announcing price increases yesterday of its standard streaming subscription with ads going up by $1 to $8.99 a month. Recapping, S&P down 0.9%. The VIX right around 30 on a 10-year 4.44%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. And when Charlie Pellet tells you that the NASDAQ's into correction territory, that gets your attention. That means something's going on there. And I guess it's that old higher for longer as we think about energy prices. That's what the experts told us a month ago. Hey, if it's higher for longer, there could be some problems. Well, here we are. Nancy Daoud, she's a private wealth advisor at Ameriprise Financial. She joins us via Zoom from Miami, Florida. And I guess if you're into sunny and 80 degrees, I guess Miami's okay. Those of us, yeah, exactly. Hey, Nancy, what are the conversations you're having with your clients over, the last several weeks? Because this is starting to get old here.
Yes, headlines are clearly overwhelming, and the market is grappling with conflicting narratives around the war and what's going to happen. And of course, oil prices are in the driver's seat, and that's what's causing the ups and downs in the markets. The advice really is to, yes, it's been 4 weeks, yes, it's overwhelming, but stay level-headed and don't let the headlines scare you. Staying the course is the best course of action if you're fully invested, and if you're not fully invested, what an incredible opportunity. Because, by the way, this too shall pass eventually. I mean, it's not going to last forever. The key, though, is how long will it last? If it gets wrapped up within the next few weeks, then the prospects are very positive. If it does linger on to a much longer time frame, that could certainly cause some problems.
Certainly, there are a lot of areas where there's opportunity, but is there any area, sector, for instance, where it's still not time to get in because things still look pretty lofty?
Well, they will always look lofty. There's no way to time, this is the best day to get in. So my advice would be to do some dollar cost averaging, because as you could see, the volatility is pretty heavy. I mean, it's big swings every day. So if you're looking to be opportunistic and to get in, I would do it periodically, not all in one day. That would make much more sense.
Nancy, we had a little bit of a rotation starting towards the end of last year out of some of the larger, high cap, maybe higher growth technology names into some more cyclical, maybe into some small and mid cap stocks as well. How do you think about that rotation play versus sticking with what's kind of really worked for investors over many, many years, which is those big cap growth names?
Yeah, I think it's actually exciting, and we always like a broadening of the market. We don't like it when just a handful of stocks or one sector dominates the market. I do like the broadening and the diversification. And the reason that that's happened, of course, is because AI is touching every sector and every single kind of company. It's not just technology. if you're a corporation that's not engaging in AI in some way, shape, or form, you're going to become a dinosaur. So it's pretty much spreading across the board. And that's good news for stocks, because then you could be well diversified and not feel those big swings up and down like we did with just tech.
Of course, it's a midterm election year, and we're going to start to see elected officials start talking up, including President Trump, talking up certain sectors, perhaps promising better prospects for certain industries than others. How are you thinking about positioning ahead of the midterm election, or is it too early for something like that?
Well, it's never too early, because election seasons seem to take forever and they're exhausting. But right now, the headlines are really around the conflict in Iran and what's going to happen. We just don't know. There's a great deal of uncertainty and a great deal of unknowns. And it really depends on who you're listening to. There are very, very wide opinions about this. Some people will say, oh, yeah, we're about to finish this up and we've won and everything is going to be great. And then you hear the other side and it's like, well, it's not quite as good. So it really is depending on who we're talking to. And the reality, and people forget this, is that we're not supposed to know exactly what's going to happen, because if we did, then that would actually be adverse for us. We have to rely on the fact that these people have information that the general public does not have, and that's what they're acting upon. But that's lost in the translation. And of course, the midterm elections will really hone in on that. The oil prices, the inflation, the fear-mongering of the whole affordability conversation is going to be exhausting in the next few months.
Right.
So we'll see. It's no different than any other election.
Yep, just with a war in the backdrop, I guess. Nancy Daoud, private wealth advisor, Ameriprise Financial down in there in Miami. She's a UConn grad, so she's all dialed in for both the women's and men's NCAA basketball, that's for sure. Let's get back to trade here. It's going to be President Trump going over, scheduled to go to China in the next several weeks. And trade will certainly be front and center. And China, they've started a pair of investigations into U.S. trade practices. So they're not going quietly. They're
taking a page out of President Trump's book, his playbook.
Yep. So we'll see how that plays out. Brendan Murray, global trade editor for Bloomberg News. He joins us from London. Brendan, talk to us about kind of current trade between the U.S. and China, and maybe what both sides would like to achieve in this upcoming meeting that is scheduled between President Xi and President Trump.
Right, so things are pretty stable right now between the U.S. and China when it comes to trade. They announced a truce in their tariff wars last year, and that has pretty much held intact. And we're going to see if it continues to hold heading into this summit in mid-May between Presidents Trump and Xi. What we saw from China today was basically the mirror image of what the U.S. did to China 2 weeks ago, and that is launch an investigation into what they consider to be unfair trade practices. And those investigations can lead to tariffs of as high as they want to go. And so what we're seeing is basically the typical kind of jockeying for leverage ahead of the summit, and the both sides saying, this is how I can hit you if you don't give me what I want in these discussions leading up to the meeting between the leaders. What we're really going to be interested in finding out next is, what are they going to ask for? What is China going to want in return? And what is President Trump going to want from China in return? Both sides will try to hammer those details out over the next several weeks.
And of course, you also have the war in Iran as a backdrop here. It's delayed this summit between Xi and Trump until May. It was originally scheduled to take place earlier. How else has the war on Iran affected and influenced what will be these critical trade talks? Because obviously China does business with Iran, and China gets oil from Iran.
Yeah, exactly. It really has highlighted the fact that China and much of the rest of Asia is very dependent on oil from the Mideast, and so the Chinese will be looking for some sort of off ramp if we aren't there, if the war is still going on in several weeks from now, because the price of oil is really hurting not just China but other countries across Asia, and so there's leverage there that you could say that President Trump could apply, and China as well could say, look, you could do us a favor and try to stabilize the situation sooner, as soon as possible.
Brendan, some folks are speculating that by setting a date here, President Trump is signaling that the war won't go up to that date, that he wouldn't necessarily visit China, engage in those talks while a hot war was going on. What do your sources say about that?
Yeah, I mean, we've heard President Trump throw out dates and deadlines all the time and then shift them as he needs to. So I wouldn't put too much stock in the fact that the mid-May date is something that signals when the war would be over. President Trump figured out that he couldn't meet with the Chinese leader while there was a war going on, and so they had to sort of save face and push that meeting out. China has not confirmed that that's actually the date of the meeting, and that's not unusual for China, but still, there's some flexibility in there. You can imagine if the tensions and the conflict in the Middle East are still going on.
Brendan, do you expect Taiwan to show up in any way in these trade talks?
Yeah, absolutely. I mean, this is what China wants. It wants some, it wants the U.S. side to give it some of what it's asking for in regards to Taiwan, and so that the geopolitics and trade are all kind of interwoven into these, and you can bet that's what will be front and center for China with these trade talks.
Who has the leverage in a trade talk right now? I have no idea, the U.S. or China. How do you read it?
Yeah, I mean, it's difficult to game this out because, last year we saw China with a lot of leverage, and they used it in the critical minerals monopoly that they had in the global marketplace. And so you could argue that, President Trump has midterm elections coming up, and, raising tariffs really isn't going to be in the interest of the U.S. economy in the short run. And so you could argue that China is feeling pretty confident that Trump doesn't have the big tariff card to play this time around, at least in the short run, until the midterm elections are over with. But then again, President Trump has shown that he's undertaking these investigations. From those, the tariffs that he could impose could be very high, and so there is some leverage on the U.S. side as well.
All right, good stuff. Brendan Murray, thank you so much, global trade editor for Bloomberg News. And of course, I'm sure he is getting ready for the weekend where anything could happen. The president could announce something related to trade. He could announce something related to the war in Iran.
Yep.
He has a habit of what our reporters are calling kind of dropping a seismic Saturday news development for everyone to respond to and maybe get ready for the following trading week.
Yeah, it's a 24-hour news cycle with this president. We learned that in the first term, and if you're covering him, you better have a big team of people covering this administration, because it can make news. This president can make news at any time. The sell-off continues here. The S&P off 0.9%, the NASDAQ off 1.2%. This is
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. The NASDAQ 100 index moves into a correction. Right now, down 1.3%. The Dow, the S&P, NASDAQ, they're all in the red. S&P keeping it all in context, down 1%. The Dow also down by 1%. S&P, by the way, dropping 63 points now to 64.14. NASDAQ down 1.4%. Again, the NASDAQ 100 index in a correction, down 1.3%. The VIX at 30. Even 10-year, 4.44%. The 2-year, 3.95%. Gold is up $83 the ounce, up 1.9%, $44.60 now. West Texas Intermediate crude just above 98 a barrel, up 3.8%. Barrel of Brent holding above 110, up now by 2.5%. The University of Michigan is out with its Consumer Sentiment Index, and it slipped to a 3-month low in March. And year-ahead inflation expectations jumped as the war in the Middle East drives up gasoline prices. Joanne Shu is Director of Surveys at the University of Michigan. She was a guest right here on Bloomberg Intelligence.
Essentially, after the start of the Iran war, we have consumers being quite worried about the trajectory of the economy. Primarily, this is coming through worries about both gas prices and inflation overall. We have a pretty large surge in short-run inflation expectations, and we had a deterioration in one-year expectations on multiple dimensions of the economy.
Joanne Shu of the University of Michigan, interviewed right here on Bloomberg Intelligence. Pernod Ricard and Brown-Forman, the owner of Jack Daniels, are discussing a merger as the alcoholic drink companies look at ways to consolidate amid an industry downturn. A combination would bring together Pernod's brands like Martell Cognac and Absolut Vodka, along with Brown-Forman's whiskeys and other brands. ADRs of Pernod are up now by 6.4%. Brown-Forman, the Class A shares are up by 3.8%. Recapping, stocks move lower. We've got the NASDAQ 100 index in correction territory, down 1.3%. The S&P down by 1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and on Bloomberg.com. Finishing up kind of week 4 here of this war in Iran. The Pentagon has reported that they have inflicted serious damage on Iran and have achieved most of the military goals. But if you're in the Republican Party, a leadership position in the Republican Party, you got to wonder at what political cost to the president and what political cost potentially to the Republican Party. Our next guest can help us frame that out. Wendy Schiller, professor for Brown University. Wendy, again, if I put myself in a leadership position in the Republican National Committee, this war is not a good thing on any level. What are you hearing from the RNC and leaders in the party?
Well, the RNC, Paul, has done very well with fundraising. So, last week we saw sort of celebration. They have far more resources than the Democratic Party does at the national level, the DNC. So when you look ahead to 2028, I think they're thinking we're still really raking in the dollars, and where do we get positioned to keep the White House in 2028? How long can this war go before there's sort of reverb on 26, but also reverb on 28? So I think that's where they are. But you can see the members of Congress on the Republican side understanding that they're basically going to end the shutdown. The Republicans made a big concession, keeping the ICE funding off the table and just letting everything else get funded. That's a concession to the Democrats' objections about ICE tactics. But they recognize that they're in negative territory with the president, who's in negative territory. And as you mentioned in the run-up, on the economy. And I think the war in Iran is not as troubling to Americans yet because we don't have massive ground troops. But certainly the prospect of increased fuel costs, in particular gas costs already, that is really starting to hurt Republicans who are running at a more local level, which is to say Congress.
But the idea is if this war can be wrapped up, by the summer, in a couple of months, by November, everything should go back to normal in terms of the war has ended and oil prices will be on their way back down, if not back to prices that we had seen before the war began.
Carla, I think that all depends on how you calculate the beginning of summer. Memorial Day weekend is typically what AAA always talks about in terms of driving. You know, if consumers are paying a lot more money for gasoline in May and June, and even through July 4th, our 250th anniversary, that will not go away. That kind of pinch will still, voters will remember that. Oh, my summer vacation cost me a couple of $100 more. So I think it's got to end before Memorial Day in terms of the reverb on the economy.
What is the support level, I guess, within Congress for the president and this war? We know that his approval ratings are low, but boy, the military's had some tremendous successes so far.
Well, certainly, I think that President Trump can make an argument that he has done more damage to the political infrastructure and even the nuclear capacity of Iran than his predecessors Biden or Obama did. I think he can walk away with a victory on that now. But, you know, decapitating that leadership, really regime change is not going to happen without ground troops and hundreds of thousands of ground troops. That's not something they've finally realized now. I think shortly after they started this thing, you can't do it without ground troops. And I think that's an area Trump does not want to go. So I think that the members of Congress have said they support the president. Iran's an enemy. Iran's the largest sponsor of world terrorism that we know of. But they have said they have strong concerns about any plan for massive ground troops. And I think they're sticking with that. And they're hearing from their Republican voters in their districts, do not do this. We do not support this. Even MAGA is split nationally. You know, some very loud voices in MAGA are saying, we didn't sign up for this. It's not what you promised us. We don't want any part of it. And also looking like he's pressured from Israel is also a liability in MAGA. In ways, the Democratic has its own liability, the Democratic Party with Israel, but the Republicans have a liability with Israel and the Iran war as well. So I think we're getting a lot more loud discontent that could absolutely reverb on the Republicans with people staying home in 2026.
It's kind of hard to understand what victory looks like because the public didn't really get a full explanation of what the war was meant to achieve. So is it a victory for the president, for Republicans? Is it mission accomplished if there is no regime change in Iran, if there is no seizure of Iranian uranium?
Well, that's absolutely the point about the messaging around this war. Unfortunately for the Trump administration, their messaging was mixed. You know, you can't have that and then claim a clean victory. The messaging was we were supporting our ally Israel, or the messaging was Iran poses a direct threat to the United States. And those people who are old enough to remember the Iraq War under George W. Bush, when that same messaging came out, and we later learned after 15 years of war that they weren't really a direct threat to us, that is the big fear, I think, amongst a lot of members of Congress, Republicans who remember that as well. So is it a threat or not? We can certainly say that the terrorism that's been funded by Iran has threatened not only Israelis, but people all over the world, in France, all sorts of terrorist attacks, Africa, America, that there is a threat and that it's a continuous threat. And that has to be visibly stopped. And then in terms of nuclear progression, that's going to depend on access. Can we get in to verify how far we have set them back? And that will be a condition of any cessation of hostilities that I think the Trump administration would insist on.
30 seconds left. Wendy, what do you think the strategy for the Democrats should be leading up to the midterms?
Democrats also face the problem with simplifying their message. It has to still be affordability, it has to be gas prices, it has to be housing, and it has to be health care, because that's when they win elections. Those messages win them elections. When they get into international relations, as we saw in 2024, it gets very divisive and very difficult for them. So they have to critique this, but they have to really always come back to how it's affecting the daily lives of Americans.
All right, Wendy, thank you so much. Appreciate that. As always, Wendy Schiller, professor at Brown University, joining us via Zoom from Providence. Markets continue to sell off here, Scarlett.
Yeah, I like what she said about how the Democrats have to critique this, but I feel like they also have to offer a solution. You can critique and win elections, and then if you don't do anything about it, once you are in office, then you're part of the problem again.
Yep, absolutely. So we'll see how that messaging goes, and we'll see what happens over the next coming days. This is probably a war that lasting longer than most people thought, at least initially, or certainly wanted, but we'll have to see kind of what breaks over the weekend, because news tends to break over the weekend for this president, particularly when it goes down to Mar-a-Lago. Looking at the markets, S&P is off 55 points. That's 0.9%. The NASDAQ down even more, down 270 points. That's 1.25%. The big culprit here, we've got oil pushing higher yet again. WTI crude oil up 3.9%. We're at $98 per barrel. WTI crude, Brent, close to $111, close to the high of the day.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Good Friday morning, everyone. We are, of course, Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. And because it is Friday, let's just take a step away from the market action, at least for a few minutes, the war in Iran, and talk a little bit about the business of sports, because the owners of NBA teams have voted to consider expanding their league and adding franchises in a couple of other cities. Let's bring in Randall Williams, our Bloomberg Business of Sports reporter, on this story. And Randall, we're now looking at possibly a Las Vegas franchise, a Seattle franchise?
Yep, and it was always going to be those two cities. The league was open to listening to more offers from other cities. You think Nashville, you think Kansas City, you think maybe Vancouver or Mexico City. But Seattle and Vegas are proven sports towns. Seattle used to have the Supersonics, and Las Vegas has a bunch of different sports teams. I would consider it the sports capital of the world right now. So they'll be listening to bidders over the course of many months, and if they find the right price and if the bidders get the right number, then we'll go from 30 to 32 NBA teams.
All right, if I want an NBA team, what's it going to cost me to get in the door?
I would guesstimate it is going to cost you at least $8 billion. They're saying 7 to 10 is the range. I think Seattle will go for probably between 7 and 8.5, and I think that Vegas team could easily reach 9 to 10.
And who are the obvious bidders here? Who are the people who are right away going to be putting together packages?
Sure. So Samantha Holloway, who is David Bonderman's daughter, is the owner of the Seattle Kraken. She just formed this holding company called One Roof Sports and Entertainment. She owns the arena, or has partial ownership of the arena, which is Climate Pledge Arena in Seattle. She's the heavy favorite in Seattle. In Vegas, you have Bill Foley, who is the Vegas Golden Knights owner. He controls alongside MGM and AEG. T-Mobile Arena. And so I think if you have arena ownership and you don't have to spend another $1.5 billion to $2 billion, then that's going to enable you to get a bit ahead. Yeah. Now, who knows? Maybe someone does come in and say, look, I'll build a stadium in Las Vegas or in Seattle. I think it would be difficult, but those two would be my leading favorites right now.
All right, so we're just had opening day for Major League Baseball. Let me take it down to the dark side.
Uh-oh.
Are we going to get a work stoppage next year in Major League Baseball?
Absolutely.
You think so?
I think
Absolutely.
so. I think so. I mean, look, you think about the collective bargaining sessions that we just finished with the WNBA. I think we talked about it last week. Everyone that I've talked to around sports has said that that is the prelude to what is coming with baseball, which is really a war of, do they want to have the owners have a salary cap, or do the players who are probably going to be negotiating for a minimum floor spending, because you have teams that are just content with not spending any money and being loser franchises. And then you have those same owners complaining about how you have franchises like the Yankees, the Dodgers, the Blue Jays, who spend so much on players that there's nothing left. So it's really going to be an argument for the heart of baseball.
Feast or famine in the MLB, essentially. Right. Is there parity in the MLB? I mean, are there changes they can make to create more parity?
I'm in favor of having a minimum floor spending, and the reason for that is because, like, you think about the NFL, and the NFL turns over playoff teams literally every single year. That doesn't mean that that team is able to win the Super Bowl, but we see a lot of turnover. Different teams make it, and in baseball, it does feel like the same teams are winning. Now, I'm definitely rooting for the Dodgers in terms of the dynasty effect. I think having a franchise to chase, having a franchise to beat, then gives the hero and the villain side of things. The city of Los Angeles thinks they're the heroes and everybody else thinks they're the villains. At the same time, there are other franchises out there. You think about the Pittsburgh Pirates, you think about the the Miami Marlins. Like, these are franchises that no one really talks about, and it's because of the fact that we might not see the investment from their owners in terms of how, you compare that to the Yankees, the Dodgers, and maybe they don't have the deep pockets, but you want to be competitive, I would think, and that's not happening right now.
But this will, if there is a work stoppage, it will be because the owners, are bringing it, because the owners, by and large, is it fair to say the owners want a floor here, or do the owners going to take this work stoppage because they want a cap?
They want a cap, I think. The players the MLB Players Association scored probably the biggest win of any Players Association ever with not having a salary cap, because that's how you get a $700 million deal or a $500 million deal. Like, it's not out of the ordinary if someone were to one day get $1 billion contract. Shohei is going to top that right now in terms of, we're not paying anyone more than Shohei, but for owners, like, you think about the Dodgers, they just retool every single year because they can. They don't have a spending limit. And if you have an owner who's willing to pay tremendously more than another owner who might not have that, then there's going to be complaints and be like, listen, we need to get control of this spending, because at the end of the day, this is going to become a game in which if you spend the most money, then you're going to win.
Let me just bring this full circle. We're talking about NBA expansion to 32 teams from the current 30. The NFL already has 32 teams, as does the NHL. Baseball has 30 teams. I mean, are we going to potentially see expansion of MLB franchises?
I think that baseball will consider expansion after collective bargaining, when that ever ends. All of these things seem very dire at the beginning because they are clashing. You think about the conversations we were having about the WNBA a year ago. It seemed like they were never going to come to a deal. But the reality is they will at some point.
They need to.
Right, exactly. They both have a vested interest in playing. And I think baseball will probably expand to Nashville. I think Nashville could be a good baseball town, and they'll find another city/location, and they'll go from there.
But it took Major League Baseball half a decade to get back the goodwill, and it took juiced baseball players to do it.
Yeah.
This would be bad for Major League Baseball. I mean, like, fundamentally, generationally bad, potentially. Randall Williams, U.S. sports business reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. We appreciate that. There's always stuff to talk about, the business of sports, that's for sure. Big, big dollars. For our listeners in the U.S., a reminder, You can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just moments with a sell-off continuing in the marketplace here. Stocks near their intraday lows. The S&P is off 0.8%. NASDAQ off 1.2%. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Friday morning. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu, as well as Charlie Pellet. We are in the Bloomberg Interactive Broker Studio here in Midtown Manhattan, and it looks like nobody wants to be long before the weekend and the prospect of some Saturday surprises from the White House. You see equities selling off right now. We also see bonds, at least at the short end, selling off. We'll get into all of that in just a moment, but we have a big show today in the second hour of Bloomberg Intelligence. Nathan Dean will be joining us. We're going to get the latest on the Homeland Security deal. The Senate has passed a deal, and now we're waiting for the House to do the same. George Ferguson, our senior aerospace, defense, and airlines analyst, will be joining us on the latest airline news to follow up on that theme. There is some talk, perhaps, that JetBlue is interested in making a deal with someone. Elizabeth Rember is our Muni reporter. She's going to give us the latest in the Muni bond market, and we're going to check in with Ryan Egger, our senior gaming and lodging analyst, on earnings out of Carnival. In addition, Dana Dioria, co-CIO and group president at Investnet Solutions, will be joining us for her take on the markets. And then we're going to wrap things up with Matthew Schettenhelm, our media litigation analyst on Meta and Alphabet, of course, losing that trial over social media addiction and what happens next. First, though, let's bring in Charlie Pellet for our Bloomberg Business Flash.
Hi, thank you very much, Scarlett Fu. Here's what's going on. Do want to begin with a developing story headline on the Bloomberg Professional Service. FBI Director Kash Patel's personal email said to be breached by hackers linked to Iran. That, according to sources, again, the report from CBS News and Reuters. The Dow, the S&P, NASDAQ, all in the red. S&P down 50, drop there of 0.8%, 64.27 where we stand on the S&P. NASDAQ down 1.2%. The Dow down 0.7%. The NASDAQ 100 index, it is official, now in correction territory, with the NASDAQ 100 index now down by 1.1%. The VIX at 29 now, with a 10-year 4.42%, the 2-year 3.93%. Familiar market themes. We do have traders driving global stocks and bonds lower ahead of the weekend on concern that a protracted war in Iran will keep oil prices elevated. Gold up 3% now, up 133 the ounce to 45.08. West Texas Intermediate crude 98.04 a barrel. WTI up 3.8%. Barrel of Brent 110 a barrel right now, up by about 2.6%. Well, as for the U.S. stock market, yes, a down Friday here. Michael Darda, the chief economist and macro strategist at Roth Capital Partners, told us on Surveillance this morning you cannot ignore this market's resilience.
If we listen to what individual committee members are saying, they're just very uncertain. They're not sure how this oil shock is going to play out, how long it'll last, what the overall impact is. I mean, let's not forget the U.S. since 2018 has been a net exporter of oil and energy products. And so, I don't want to say we're completely isolated, insulated, but it's certainly going to hurt other economies in Asia and Europe far more than it hurts the U.S.
Michael Darda of Roth Capital Partners discussing oil and the Fed this morning on Surveillance. Again, WTI up 3.8%, 98.07 a barrel. Brent 110.77 now, up 2.6%. The NASDAQ 100 index in correction territory, down 1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Looking at the market here, the sell-off is continuing, as Charlie was just reporting. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Avalon Purnell. Avalon, what are you looking at today?
We can go ahead and start off with CrowdStrike. That's ticker CRWD. It's falling about 5.6% right now. That's after Fortune reported earlier today that Anthropic is testing a new AI model that could pose significant cybersecurity risk. As we already kind of know, this year has kind of been a question of how will AI impact security and also software names. And they are definitely falling with the rest of their peers. Piper Sandler saying that while CrowdStrike hasn't been spared from that sell-off, they still feel incrementally positive about their strategic positioning. So we'll keep an eye out.
It just continues to roll through the entire software sector. All right, let's move on to something not involved in software, Carnival.
Yes, Carnival, ticker CCL, sliding also about 4.2% and continues to be down more than 20% this year.
Ouch.
That's after Carnival's full-year outlook disappointed investors as the Iran conflict continues to drive up fuel costs. The firm forecast adjusted earnings per share and adjusted EBITDA for the year that fell well short of expectations. As we already know, it's been a very tough year for cruise operators and just other travel stocks across the space as they face higher fuel costs and potential hits to routes because of the war.
And we're going to have Brian Egger from Bloomberg Intelligence joining us later here this hour. He covers Carnival, so we'll get the latest analysis there. Entergy, ETR.
Yes, finally found a green spot within a ton of red, gaining 7.2% to hit a record high. That's after Meta agreed to fund 7 gas plants to provide electricity to a data center it's developing in rural Louisiana. The deal continues to build on a previous partnership that they had with the company. Entergy says that the deal is structured to ensure Meta pays its full cost of service and expects the partnership to deliver more than $2 billion in customer savings. That's fairly important considering earlier this month, President Trump did demand that companies pledge to pay for their own electricity to help make sure that power bills don't rise too much. We'll continue to keep an eye out for that as well, but the AI infrastructure boom continues.
All right, good stuff. Thank you so much. Avalon Purnell is our Bloomberg Equities reporter. And for more conversations like this, be sure to subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Paul, you and I both have children who are going to be flying this weekend.
Yep. Mine's en route as we speak.
En route. So she got on with no problem? How long did she wait?
Yeah, but she got in there at 3:30 a.m. to LaGuardia. TSA opened at 4:15, so she was right at the front of the line. She said it was fully staffed, so she felt like it was fully staffed.
Oh,
so
okay.
We'll see how that goes.
All right, that's encouraging.
Yeah.
I have a child who's going on a plane on Sunday.
Okay.
It'll be 4 p.m. JetBlue out of JFK. I know. So let's bring in Nathan Dean. He is our senior policy analyst on the top political stories. And I think the one that gets everyone's attention right now, Nathan, is the eternal lines for TSA at the airports across the nation, particularly places like JFK, Houston as well, LaGuardia to a lesser extent. What is the latest here? Because we know that the Senate has passed a deal to fund Homeland Security, to fund TSA, and the House has not yet done so, right?
Yeah, that's right. So just this morning, the Senate passed a bill that would actually fund the bulk of DHS minus ICE, which, as a reminder, gets its funding through the One Big Beautiful Bill through fiscal year 2029, and now goes to the House. The problem is that there's some logistical House issues, namely that under the rules of the 119th Congress, you can't consider a rule this quickly on Thursdays, Fridays, Saturdays, or Sundays, and you need unanimous consent to just get past that. The problem is that the House Freedom Caucus, certain members aren't happy with this bill because it doesn't include the Save America Act. This is the bill that President Trump's been pushing about voter ID rights. So they have to go through this decision of, okay, does President Trump need to get involved here and tell the House Republicans you need to pass this en masse, or do Democrats get involved here to try and bypass that Rules Committee? Long story short is that it's either going to pass later tonight through some very messy logistical issues, or it may have to wait until Monday when they can actually come back and consider it under suspension of the rules.
You can't make this stuff up.
Wait, which days can they not do that? Thursday, Friday, Saturday, Sunday?
Thursday, Friday, Saturdays, and Sundays under the Rules Committee. And this is partly because, you know, the House Freedom Caucus in particular has a couple members in the House Rules Committee, and this is where they get their leverage. So they can actually get leverage on a bill before it gets to the floor. And they, in the past, have been very upset about the fact that, you know, in order to pass something quickly, it bypasses them, goes straight to the floor. So they put it into the rules when they began, you know, this congressional session. But you can always change the rules, but it takes a 2/3 majority to do so. And that's where the struggle is, because you would need Democrats, and the Democrats right now haven't opined on where they're thinking at the moment.
You would think, Paul, that they want to get this passed so that they can go home themselves for their recess.
Yes, that's a good point. So how do you think this is going to play out, Nathan? You're good at putting probabilities on things.
Yeah, so, you know, for, you know, Scarlett, for your child on Sunday, you know, I think, look, it's going to get funded early next week. By early next week, this will get funded. There's really not going to be any more drama over this. And, you know, for all the talk that President Trump has said in terms of the Save America Act and, you know, the filibuster, that is going to transform from this debate into a reconciliation debate. So think of the One Big Beautiful Bill, Part 2. Now, this is where the Iranian supplemental defense package of reportedly $200 billion is going to go. And so you're going to see Republicans over the next week or so, when they get back from recess, so in 2 weeks, you're going to see Republicans really try and hammer out what this idea of a reconciliation bill looks like, because if it's small and narrow, tied to that $200 billion, I think the Senate can ultimately pass that. Senator Majority Thune has even said that he thinks he can get there. But, you know, these bills start small and then they balloon big. And if you get a $1.5 or a $1.2 trillion reconciliation bill with a margin of only one vote in the House, the Republicans are going to really struggle to get that past the finish line.
I'm at a loss.
Yeah, I just
feel... I depend upon Nathan just to tell me what I need to focus on.
Well, I mean, the takeaway here is that it's kind of a big mess.
Yes. So, all right, talk to us about this $200 billion Iran defense ask here. Is this something that can get done, or as you suggest, it'll get passed, but it'll have a lot of other stuff on it, too?
So I think it will get passed, but let's talk about the process and the amount. So right now it's been reported the Pentagon is looking for $200 billion. The bulk of that is for anti-missile and counter-drone technology. So look at Lockheed, RTX, and Northrop Grumman. Those are the programs in particular that would be applicable to this. Now, the Pentagon is going to ask the White House. The White House then has to ask the Congress, and the Congress has to try and pass it. Now, at each stage in that process, this number can go from $200 billion to $300 billion. We've even heard House Republicans say that they want to attach $15 billion worth of farm aid to this. So if they pass it via reconciliation, I would expect for this price tag to increase. But once it gets past like the $300 to $500 billion number, then Republicans are going to start getting a little bit concerned here, because if you go through reconciliation, which allows you to bypass the filibuster, every dollar you spend has to be offset somewhere else in terms of like economic growth or tax, you know, increases or anything like that, or budget cuts. And that's just very difficult, because at the end of the day, if anything that they were considering a reconciliation was easy, they would have done it in the One Big Beautiful Bill last year.
Yeah. Now it's all the complicated stuff. Nathan, fantastic summary of everything. Nathan Dean is our Bloomberg Intelligence Senior Policy Analyst on the top political stories. So it looks like there will be some kind of deal to fund the TSA part of DHS, but probably not till early next week.
You know, Nathan puts out a note, I think it's Friday afternoon or something, just kind of like, hey, this is what happened this past week. This is what's going to happen this week. I just read that over the weekend. I figured that's enough. I mean, that's all I can take coming out of Washington.
At least for those who are going away for spring break next week, things should be better.
But the Congress still gets their spring break.
I know, this is so unfair.
Their recess, their recess. Like
it's a spring break.
If they're going out.
It's their spring break. All right, let's bring in George Ferguson. He is our Senior Aerospace Defense and Airlines Analyst. And George, there was a headline earlier this week that got my attention, which is JetBlue looking to team up with someone, looking for a partner in some capacity. It was reported from Semaphore, and JetBlue has tried this before. It tried to merge with Spirit Airlines, or tried to buy Spirit Airlines, and it failed in that quest. What do we know about JetBlue's M&A ambitions?
Yeah, so we haven't heard anything out of JetBlue, right? But when you look at JetBlue, you know, I think that one, sort of their financial performance hasn't been great since the pandemic, partly due to this failed merger with Spirit Airlines. And so you could see, as they're, you know, looking out at the U.S. market right now, fuel prices have doubled. They're probably thinking demand's going to come down pretty hard. You know, it's going to be hard to sort of turn around financial improvement in that environment. And so I'm not sure, you know, who Semaphore talked to inside, but I don't think it's hard to see how JetBlue would be starting to think about what might be different permutations of how they could get the carrier through what I think is going to be a difficult summer for the business.
George, typically, can airlines pass along fuel increases like we're seeing here, these huge jumps in fuel prices? Can they pass that along to consumers, or that goes into their bottom line?
So I think the opportunity to pass it along is pretty good this time. And typically they do. Typically they pass it along at a lag. And so the airlines usually will go through a bumpy ride, in their profits for a little period of time, for, I don't know, a quarter or something like that, as they're getting ticket prices up. If you look at the U.S. airline business right now though, nobody hedges inside the business anymore. It used to be there was a smattering of airlines that hedged. Southwest was one of the bigger ones that hedged, and you might have some Alaska, some JetBlue hedging. Nobody really hedges anymore, and that means everybody has to increase ticket prices so that it can remain profitable. And I think that means the move to higher ticket prices goes faster this time.
So when they increase ticket prices, is that something that's kind of static? Once it goes up, it doesn't come back down? Or would any of them consider adding kind of a fuel surcharge the way a UPS or FedEx does?
Yeah, I mean, look, I always think of a fuel surcharge as a way of reminding your customer that the reason you're increasing the cost of the product that you're delivering to them is because of fuel. And I think fuel
not your fault,
surcharges
in other words.
Yeah, exactly. So FedEx goes, hey, look, sorry about it. The world economic environment is such that I'm going to have to charge you more because fuel prices are higher. Look, I think at airlines are a very competitive business. And so airlines see a lot of movement up and down in ticket prices. And so I think because of that competitiveness, yes, you could see where they would rise here. And then, as soon as you start to get decreases in the price of fuel, we typically see some of the airlines that want to take market share, they'll lower fares, they'll add to the airplane, add people to the airplane, and then the game starts over again, right? We start moving the wrong direction in fares if you're a shareholder.
George, what are the airlines doing in terms of capacity? Are they adding capacity to the system? Are they taking it down? What are they doing?
Yeah, so we're not seeing much yet. My colleague Francois Duflo put out a report this week. It's on our AIRLN dashboard. We haven't seen much movement. And my guess is that the airlines are probably waiting to see if this war could end quickly. If it ends quickly, maybe they don't have to take any capacity out for summer season. Summer's their peak season. They've probably sold a lot of it already. But I think if these higher fuel prices persist, I think you'll see as you get through summer, they'll have to start to cut capacity to keep fares higher. And that becomes part of the risk as well for the companies like JetBlue, Spirit, Frontier that cater to the lower tier of the traveling public. The challenge is their customers are probably going to be their budgets will be stretched a little bit more. And I think if you're United and you're American, especially United and Delta, and you've got a fair amount of premium travelers flying on your airplanes, they're not going to really be bothered, right, by a 20 or 30% increase in their fare price. They're going to keep flying, and those airlines are going to continue to subsidize the back of the airplane, that discount traveler, and it's going to make it harder to fill airplanes, I think, at the low-cost carriers here for a bit. So we'll see how it all
I don't
develops.
think they'll like the 20% increase in fares. They'll keep flying, though, because, they have places to go. George, thank you so much. George Ferguson is our senior aerospace defense and airlines analyst on the latest in the world of aviation. This is Bloomberg Intelligence. We're looking at declines in equities on this Friday, with the S&P lower by almost 1%, the NASDAQ off by 1.4%, and yields at the short end moving down. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks in the red. We've got the NASDAQ 100 index in correction territory. This Bloomberg Business Flash brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. Get a free gold and silver info guide. Learn how to add metals to your IRA or 401k tax and penalty free. Go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. S&P 500 index down 59 now, drop there of 0.9%. The Dow down 404. Right now, down 0.9%. S&P on track for another losing week. We are looking for a fifth weekly decline on the S&P. NASDAQ is down 1.3% now. The NASDAQ 100 index, as I mentioned, in correction territory, down 1.2%. The VIX just above 29 now with a 10-year 4.42%. The 2-year 3.92%. Gold up 3.8%, 45.43 the ounce. Brent right now at 110.80. That's a gain of 2.6%. West Texas Intermediate crude right around 98 a barrel, up 3.7%. Meta Platforms is paying for the construction of 7 new natural gas-fired plants to fuel its most power-hungry data centers, increasing its reliance on fossil fuels amid a fast-moving artificial intelligence race. Company has reached a new agreement with Entergy. Meta Platform shares today, right now we do have Meta trading down by 3.6%. Energy is surging 7.1%. Recapping, stocks lower, correction territory for the NASDAQ 100 index, S&P down 0.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. This is the time of the week. It's Friday. We talk municipal bonds. Today we do that with Elizabeth Rembert, municipal finance reporter for Bloomberg News, joining us here in studio. Elizabeth, I noted that you are a University of Nebraska graduate, right?
Yes.
Okay. Tough night last night for you guys, right?
Devastating. And all Nebraskan fans know we would have rather lost to any other team.
Than Iowa. So talk to us about that rivalry, because we don't really get that here in the East.
Mm-hmm.
Big rivalry, Nebraska-Iowa.
It really is. We're both in the Big Ten. We are neighbors.
Yep.
We play each other in football on every Friday after Thanksgiving. It's pretty intense. There's a rivalry over who has better corn, and the answer is Nebraska, of course.
Nebraska corn. That's awesome, fighting over quality of corn. All right, in the world of municipal finance here, I see some U.S. municipal borrowers are opting for shorter dated debt to cater to investors that prefer those maturities. What's going on there?
Yeah. So that's been something that we're watching in the market. A big theme last year was that there was just a lot of supply in the long end of the curve, and issuers were having to pay to incentivize buyers to buy out on that long end of the curve. And now it seems like the supply has been moving inward to take advantage of a bespoke type of muni account called separately managed accounts, which tends to focus on shorter maturities. So it seems like instead of wanting to lock in those rates for 30 years, have more time to pay back their debt, issuers are wanting to minimize the cost of capital and coming down to cater toward that investor preference.
Doesn't that create more risk for the borrowers?
Yeah, it does. But it seems like for now they're willing to take that on instead of paying for more to borrow money.
Because usually for this municipal borrowings, there's to build a highway or a bridge or something, long dated assets. So you want to get long maturities to kind of match there. But they're just saying, hey, they're doing the cost-benefit analysis. Maybe it's a little bit better to go on the shorter end.
Exactly. Yeah, I've talked with some folks who have been in conversations with underwriters who are helping issuers sell this debt and with issuers themselves. And yeah, the calculus is just shifting more into let's minimize the cost of borrowing and come in shorter instead of trying to lock in that stability, minimize that risk. Instead, they're minimizing the cost of capital.
How short are we talking about? I mean, you've gone from what, 30 years to how many years?
Well, we ran some numbers on our using our Bloomberg data, and we saw a big jump in the issuance in bonds underneath 15 years. So inside of 15 years of maturity, we've seen a big jump compared to last year's numbers looking at sales this year.
All right, I see what you're doing here, you guys on the Muni team. You're getting into the March Madness here. I see. The best college basketball teams in the nation all have one thing in common. They're housed at universities with powerful financial resources. Yeah, so talk to us about that.
Yes, like Scarlett just said, big endowments. So we ran some numbers, and 24 of the 28 schools that made the Sweet 16, both on the women's and the men's side, have more than $1 billion in their endowments. And there's some huge endowments at the University of Michigan and the University of Notre Dame, and we know them as very powerful recruiting powerhouses. And let's compare that to what endowments typically look like across the higher education space. A survey that polled 650 schools on their endowments found that the median fund was just over $250 million, and more than a quarter of those participants had endowments of less than $100 million. So thinking about 24 of the 28 schools having endowments that are over $1 billion, these are very powerful schools with huge, deep pockets.
I didn't know that Michigan's endowment was that big, $18.9 billion for Michigan.
Yeah, it's pretty mammoth. They have a very loyal alumni base. Of course, speaking of loyal alumni, talk about Duke, because Paul is going to go there anyway, so I'll just beat him to the punch.
Yes. Duke is a powerhouse, and they certainly have a lot of resources as well at their disposal. They've got a prime credit rating. They've had great enrollment, and they're getting a lot of payments from their students for tuition and housing, and that helps pay student athletes for their salaries. That helps get coaches. It just helps have a really successful program.
Yeah, tuition and housing for 2024, Paul?
$90,700. I mean, unbelievable. Now they've got a $12 billion endowment, but here's the big but for higher education. The threat to funding from the U.S. government, the federal government, particularly as it relates to healthcare. So for the universities that have big healthcare components to them, like the Duke Medical Center is massive, and that's it gets a lot of money from the federal government, from the Department of Health, and that's the flow that's been at risk, and that's been a
Duke has not been targeted, really. I don't recall it kind of being in the headlines, right?
No, they haven't. But again, the NIH funding has been threatened, has been delayed, and that's had a monstrous impact at Duke. And so they've cut costs and done all that kind of stuff because they're kind of preparing for the worst. So anyway, so we'll keep an eye on that. But good stuff. Elizabeth Rembert, she covers all the Muni stuff for Bloomberg News, and she's a proud graduate of the University of Nebraska. Tough night last night for the Huskers, but they had a great. I'm 62 years old. I've been following college hoops since I can remember. By far the best year Nebraska's ever had. So
absolutely,
maybe they're on something. Elizabeth, thanks so much.
Thank you.
Let's turn our gaze to the cruising business. I know nothing about the cruising business. That will change in October when I take my first cruise.
I know, he's finally taking the plunge.
But with the guy we have here now, our next guest is an expert on all this stuff. Brian Egger, he covers all the fun stuff, gaming, casinos, hotels, and cruises for Bloomberg Intelligence. Carnival, what's going on in Carnival here?
So they came out with what otherwise would have been a very good quarter in terms of bookings demand, 85% of the year sold, actually raised revenue yield guidance, but they had to cut EBITDA guidance because the cost hit from fuel due to the war in Iran. And so the underlying demand part of the business is quite good. You know, the concern would be if that war persists, they are modeling in a level of fuel cost assumption for the second half that might not be conservative enough.
The thing that people like about these cruise lines and cruise line operators is that they have a lot of visibility into their bookings because people book years in advance or months in advance, as in the case of Paul Sweeney and his upcoming cruise. But that also locks in the revenue that they brought in. Do cruise lines add a fuel surcharge later on because, you know, oil prices have gone up so much, or is it something they just have to eat?
Well, I think the revenue yield management part of it is always the science behind it, because 85% of bookings sold, if you oversell too much and demand goes up, you're left with inventory that could have been sold at a higher price, or you're missing inventory. You're not saying so much in terms of a fuel cost surcharge, but I mean, the reality is even with $150 million in offsetting cost savings from efficiencies, their estimate is that the full year impact on their adjusted net income from the fuel price increases we've seen since December could be about $500 million. And our concern is that assumes 80 to 90 Brent in the second half. And what if that's much higher? That's the concern.
What are these cruise lines saying about their underlying demand at some point? Some of these inflation pressures, if they do remain here a little bit longer than maybe we initially thought, fuel in particular, but other areas as well, when does that typically impact the top line for those guys?
So I think, generally speaking, cost inflation can have an impact. The assertion of the industry would be that they are relatively affordable as per day compared to other forms of vacationing and travel. And so that's been a big underpinning behind their assumption they continue to get more consumer penetration.
And, you know, people might have pre-booked their cruises, but the amount that they spend is also another big revenue increase for these cruise line operators. I mean, that's where they make up a lot of ground. How do you expect that to play out if oil prices stay high? I mean, people are still going to go on their cruises, but they're not going to spend for the all-you-can-drink package.
Yeah, I mean, that may be a concern. Right now, the yield outlook is quite favorable. It's still solid, low single digits. Over time, an increasing portion of the overall revenue has come from either onboard ticket spending or pre-cruise purchases of excursions and other amenities. And all of that could be subject to vulnerability if there's a major change in discretionary spending.
On fuel for these big cruises, they don't use a lot of the alternative fuels, do they? They're just burning that big bunker fuel kind of stuff.
The mixes over time increased more towards LNG and other forms of, I guess, more efficient fuel and cleaner fuel. I think one of the cruise lines just announced its first hydrogen-powered ship. So they are looking at alternative uses, and a big offset to these cost increases has been fuel cost efficiencies. You know, the amount of metric tons of fuel consumed per passenger capacity day has over time gone down. So they've tried to get some offset and have gotten some offset from increased efficiencies, both from just the general way they operate, but as well as more efficient ships.
All I know is I'm sitting on the beach in Aruba, and I can see the smokestack from the little port there of Aruba, and as the shops are docked, and it's just billowing out the black.
And you're thinking, well, I'm going to join those people one day.
Exactly. But boy, I could just, that's just brutal. And they don't hedge, do they? Or do they hedge?
Carnival has not hedged historically. They've had in past years, have had some collars. Norwegian and Royal Caribbean do hedge. Okay. And so, you know, there's a cost-benefit analysis to whether or not you put hedges in place.
Yeah, because George Ferguson was just telling us that the airlines don't hedge.
Well, they got messed up during the pandemic, right? Yeah. And they all came out worse for it, so.
Yep. All right, Brian, thanks so much. Brian Egger, appreciate that. Senior Gaming and Lodging Analyst, Bloomberg Intelligence, joining us live here in our Bloomberg Interactive.
Wait, I have a quick question. How many cruises do you go on a year?
A year? Oh, that's over time. I have gone on a number of cruises.
Double digit?
Well, it may be. Of course, I've been covering this sector for longer than as long as Paul's been doing this too. So yes, long time.
Long time. Yeah. So I've been out on the Disney cruise a couple times when they have a new ship. We'd fly out to LA, hop in the thing, they take us out overnight.
Oh yeah, but that's as an analyst.
Exactly, as an analyst. So yeah, I mean,
I've taken a vacation cruise separate from my role.
Yeah, there you go. All right, Brian Egger, thanks so much. Appreciate it. S&P down 35 points. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow, the S&P, NASDAQ all in the red. NASDAQ 100 index in correction territory. All of this as the escalating war in Iran boosts oil prices. Treasury yields are climbing. Right now we got the 10-year 4.41%. Equities lower. S&P down 42 at 64.34. A drop now of just about 0.7%. Wall Street on track for a fifth week of declines. Dow Industrials down 304, drop there of 0.7. NASDAQ Composite Index down 1.1%. The NASDAQ 100 Index down now by 1%. The VIX holding at 29 with the 10-year, as I mentioned, 4.41%. The 2-year, 3.91%. Spot gold up 3.6%, 45.32 the ounce, while West Texas Intermediate crude 97.48 a barrel, up 3.2%. Brent 110.34, up now by about 2.2%. So oil continues to advance. That means questions about how consumers will adjust to higher gasoline prices and ultimately what that will mean for economic growth. Stuart Paul is U.S. and Canada economist for Bloomberg Economics.
In the U.S. context, the thing that's going to matter most and where the rubber really hits the road is with gasoline prices and the consumer outlook. Where gasoline prices are now, it ends up equating to about a $12 billion a month drain on consumers' pocketbooks. That ends up going to gasoline retailers. It ends up going upstream to refiners, producers, into the energy infrastructure. But all of that money needs to be taken out of real spending elsewhere, and so we should be marking down our growth forecast by almost a percentage point.
Stuart Paul of Bloomberg Economics. In the meantime, Carnival Corp marking down its outlook of surging crude prices, driving up fuel costs. Carnival down 3.7%. Rival Royal Caribbean down 3.5%. Norwegian Cruise Line Holdings down now by 4.5%. Microsoft stock on track for its worst quarterly performance since the global financial crisis. Microsoft shares today down 1.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. All right, let's talk about the markets right now because it is a Friday, and what we've noticed is the president likes to come out with announcements over the weekend that kind of shake up the board completely. He has a pattern of this. The June 2025 bombing of Iran, the capture of Nicolas Maduro in Venezuela was also over the weekend, and of course the start of the Iran war took place over the weekend as well. So I guess it's no surprise that you're seeing a decline in risk assets. Equities are red heading into the weekend. So let's bring in Dana Dioria. She is co-CIO at Investnet Solutions, and she joins us now from Hartford, Connecticut. I guess it makes sense, Dana, that people do not want to be long before the weekend because anything could happen. But you're of the mind that perhaps the worst of the oil spike, the price spike, may be behind us. Walk us through how you're seeing things right now.
Yeah, well, so I mean, it's not to say that oil is, going down or even might not continue to leg up, but we've probably seen, in terms of the big, price spike, we've probably seen what we're going to see. Unless this conflict widens, unless you really start to see direct targeting of energy infrastructure, which, you really can't rule out, right? I mean, the hostilities are obviously at this point past, at least from my perspective, obviously past what the administration thought they were going to get into when this started. And, the problem part of it, I think, is that Iran and Israel, to a certain extent, both appear more than willing to continue, right? Whereas I think the Trump administration, because of the impacts on the market and the economy, would like to see, some out here and is certainly looking for an off-ramp. I don't think the same can be said of the other two combatants here. So I caveat it with, obviously, if you start having energy infrastructure targeted, that's a different scenario.
So what's the message to your clients these days? I guess it's we're trying to adjust here on the fly, or we're looking past this to the other side. Don't make any changes. What are your conversations like?
Yeah, it's funny. I was just at a event with a bunch of advisors, and obviously this was sort of top of mind for everybody. I think, we're often accustomed to conflict like this sort of being looked through. You know, there's an initial assumption that the powers that be have understood what the risks are, planned for it. There's an exit strategy. We're going to go, you know, and something like what happened this summer, right? Where what happened in Venezuela, right? It's an in and out and an expectation, you know, that markets aren't going to be too discombobulated. There, you know, you can kind of look past it. I think what the market is starting to price in, and maybe hasn't entirely priced in, is the notion that we actually could be mired for a period of time, that there isn't a plan here really for an off-ramp. And if that's the case, and I think, you know, there's plenty out there now concern about the Strait of Hormuz, the fact that it's not just oil, it's fertilizer, it's potentially food impacts, you know, there's other products, et cetera, that means inflationary concerns. And so I think, you know, in terms of how you talk to clients about it, it obviously, one, volatility, right? The volatility is probably going nowhere. Two, you could start to see past the initial direct impact of energy, you could start to see this permeating more and more into different sectors, particularly the longer that it goes on. We all know it's going to take months, you know, if not years, to repair the damage that's already done there. But if we knew that there was an off-ramp, if we knew the timeline, I think you could put some arms around it. The market could do its job. It could price the impact. I think the problem now is the uncertainty. And so for clients, that means making sure you're not overly invested in markets where you can't handle that volatility, because we could be in for a bumpy ride.
We could be in for a bumpy ride. It also complicates the picture for macro policy from the Federal Reserve. And in fact, traders are now starting to price in 50% odds for a rate hike later on this year. How are you thinking about this push from the administration for lower interest rates and the prospect that the Fed can't do anything about it?
Yeah, what a way we've come, right? In a month. We started this year with an assumption of 2 rate cuts. We've certainly, markets then pivoted to don't expect rate cuts, and now you're actually starting to see talk of rate hikes, of course, and, you know, even suggestions around some of the great strength that we've had in terms of growth. You know, are we even looking at a recession? So I think at this point, you certainly can't count on rate cuts. Obviously, you know, I've said in the past, this Fed's fail would be to let inflation take root again. This Fed has overseen, you know, a huge spike in inflation. They don't want that to happen again. So notwithstanding, unfortunately, we do have cracks that we're seeing in the jobs market. I think they're going to focus more on inflation. And so again, if there's a clear timeline to this, I think the Fed historically has looked past an oil price shock, and you wouldn't have to worry about rate hikes if you could see, okay, this is going to end. We can get past this. But if there's not a clear off-ramp, I think the Fed, just, you know, in the same vein as the markets, is going to stay its hand and potentially even consider a move that it feels it needs to take to prevent inflation from ramping again. I know the president obviously has made clear his preference for rate cuts, but it will be very hard to make a case for rate cuts if we're still in conflict and energy prices are still ticking up.
Is this a time to go to your clients and say, hey, here's some names we like. They've traded off with the market here. We think this is a good entry point. Are we at that point?
So I do think that, you know, diversified, careful sort of, hey, we're down. And, you know, there's obviously an argument here, right? It's sort of binomial outcome. If we do see an end to the hostilities, or a timeline that we can actually trust and believe in for an end to the hostilities, then yeah, you could see markets kind of go back up and really refocus on, you know, where are corporate earnings, which have been strong and are strong, right? So I do think that there's absolutely a branch of this decision tree that says that markets could be fine and this is a buying opportunity, but you know that's the chance you take, right? Is that might not happen now. You know, like market timing, like any other time, it's not an easy thing to accomplish. In terms of particular names, I'm typically not a proponent in general of trying to take a bet on particular names. I'm even less a proponent of it during a market like this, because what you see is that it's not just the time series volatility of the market that increases, but you see cross-sectional dispersion increase. And so if you're wrong and you're taking a concentrated bet, you're more likely to really suffer the outcome. So we're working with retail investors who these are their retirement assets, right? I'm not a proponent of picking names. If anything, I'm a proponent of spreading it more.
All right, Danny, thank you so much. Appreciate it. As always, Dana Dioria, Co-Chief Investment Officer of InvestNet Solutions. joining us via Zoom from Hartford, Connecticut. Looking at the market, we're off 42 points on the S&P. That's 0.6%. The Nasdaq's off 225 points. That's 1%. A little bit off the lows, but still pressured. Oil higher by about 3% here for WTI.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube. We're streaming live on Bloomberg.com as well. Well, if you're anything like me, you probably feel like you spend too much time on your phone, particularly with scrolling through the social media sites. New Year's resolutions every year usually include, let's spend some less time on the personal device, but that doesn't always work. It's tough to do. There's actually been the subject of a lot of litigation against some of these social media platforms, Meta, Alphabet, those types of folks, and there's been some cases coming down against these companies as well. So let's see what it means for a lot of these social media companies and tech companies in general. Matthew Sheltonhelm joins us here. He's media litigation analyst with Bloomberg Intelligence. Hey, Matt, it seems like we've had a couple of court rulings come down against some of these social media companies. Summarize what's going on out there, and does it pose a risk to these companies?
Yeah, so this is litigation that has been developing for the past 3 to 4 years, and it's finally, in the first couple cases in line, reached the stage of juries making decisions. So Meta had a loss in New Mexico state court when a jury announced a verdict of $375 million. We also, as you said, had this California jury come down with a personal injury suit on behalf of a woman who claimed that she was harmed by the social media's features. There, the jury came down with an initial $3 million award against Meta and Google's YouTube, and then added $3 million of punitive damages on top of that. These are just the very tip of the iceberg. There are a number of other cases lined up to go to juries this year. And the whole goal here is to try to shape a settlement, potentially. These are bellwether cases to try to give information about, okay, do these cases have legs or not, and how should everyone think about trying to quantify them to settle them?
So I think pretty much every parent out there would say, boy, my kids are spending way, way too much time on their devices here. What do these companies say? I mean, because otherwise they're just going to be in litigation forever.
Absolutely. I mean, I think you're looking at a lot of tough headlines here, because you have a lot of parents on these juries, and maybe these social media isn't the most popular thing right now. So it's going to be sort of an assault of headlines for the companies here. Now, the companies say, look, there are lots of problems in the world. We're not responsible for it. In fact, we add a lot of value to the world as well. And there are real legal problems that the companies say with these cases. One is that the companies say, look, we have a First Amendment right to speak and to develop our product. We have a liability shield under federal law, Section 230. All of that sort of looms behind these jury decisions, and you can guarantee that the companies are going to appeal these initial decisions to higher courts on those tough legal questions.
So, the amounts being awarded here are immaterial to these companies. $6 million here, $300 million there, $375 million there. I mean, they're just not material to the finances of these companies. Is there a scenario where we could get really, really multi-billion-dollar type things that might get the attention of these companies?
So these personal injury lawsuits, probably not. This California case was brought by a single person, and there's no vehicle really to bring it as a class action, because damages are so individualized. The thing to watch here are the state attorneys general lawsuits, and also slightly behind that, lawsuits brought by school districts, because they both offer opportunities to pool a number of supposed victims and to bring claims on their behalf. So I think Meta's been sued by 30 to 40 different state attorneys general, and a number of those cases are consolidated in federal court in California. That's a bigger ticket item, and so that's the one to watch. I think these individual personal injury suits are lower down the line because of their individualized nature. Meta made $60 billion in profit last year, and a $6 million loss isn't a huge deal.
Has it been a deal for the stocks at all? Is this an overhang at all for these stocks, thinking that, or could it be like the tobacco industry where investors are like, it's just cost of doing business kind of thing?
Well, it's been a tough couple days for Meta's stock, and there's just been a barrage of headlines on this. And as I said, this is just the beginning. But there are a lot of people that don't feel that great about social media right now and use these decisions as an opportunity to jump on top of it. And so in that sense, I think it's going to be a lingering and ongoing risk. That helps drive a global settlement here to make this litigation go away. And I think that's the decision the company's going to have to make is do we have to make this go away sooner rather than later, or do we test these legal theories, which might be pretty strong, to make this stuff go away, but it's going to take a long time for those appeals to play out.
All right, Matt, we'll pay attention to that. And certainly the investors on some of these social media companies and stocks will pay attention as well. Again, and Meta seems to be in the crosshairs for a lot of them. Matt Schettenhelm, he's a media litigation analyst for Bloomberg Intelligence. Again, he joins us from Washington, D.C., and it goes to the topic of, you got a lot of people out there, as Matt was saying, are not too fond of social media. A lot of folks would like to reduce their time on their devices, but the question is, what is the litigation risk for these companies? For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment, and the sell-off continues here. The S&P is off 50 points. That's about 0.8%. The Nasdaq is off a little bit more, 230 points. That's 1.1%. And you guessed it, oil, it's higher. WTI crude oil up 3.7%. That's $3.50, right around $98 per barrel. More Bloomberg Radio coming up.
This is CBS News on the Hour, your home for original reporting.
I'm Steve Kathan. Today, the House takes up the Senate bill designed to break the partial government shutdown that's held up TSA pay. CBS's Nicole Killian says the key stumbling block for Democrats has been ICE funding.
They did extract some concessions, but ultimately, because these talks collapsed, that didn't make it into this final package. There are just some very modest reforms like additional money for body cameras, but that was already part of the original DHS funding bill. So even though Democrats didn't get the reforms they were seeking, Minority Leader Schumer still believes that this is a win.
CBS's Jason Allen at the Bush Airport in Houston, where TSA security lines have been among the longest.
All this is happening even though they have surged ICE here to help out. They have sent more TSA officers here to help out, about 30 of them. But you're still looking at 2.5 to 3 hours wait time. We've seen this in Atlanta. We've seen this in New York. The question is, how long will it be until officers are going to get their paycheck? And how many of them will maybe be enticed to come back to work?
Overseas, Israel promises more attacks on Iran. Tehran insists it's not involved in talks with the U.S. CBS's Chris Livesay.
There are reports that the United States is preparing to deliver a kind of final blow to Iran that would bring about an end to this war. So Iran behaving as if it simply does not trust the Trump administration. In fact, it says that it doesn't, citing that they were already in the midst of negotiations when the United States and Israel decided to launch attacks on Iran at the end of February, sparking this conflict to begin with.
On the weather map here at home, the heat wave that hit the southwest is now affecting people in the southeast. Meteorologist Craig Allen.
Dozens and dozens of record high temperatures are expected at least one more time in the east. North Carolina may see a city like Charlotte getting into the mid to upper 80s to near 90 degrees.
Authorities say a Secret Service agent assigned to protect former First Lady Jill Biden accidentally shot himself in the leg at Philadelphia's airport. The Secret Service says Biden was not in the area at the time. The 4-member crew of the Artemis mission to send astronauts to the moon is arriving today at the Florida launch location. Liftoff is set for next week. Retired astronaut Mike Fink.
This is a great crew. They've trained to go fly on a test flight of the Orion spacecraft. They're going to be launching on a really huge rocket called the SLS, and they're going to go farther and faster than we've ever gone before.
The plan is to reach the moon, not land on it or orbit it. Wall Street, right now the Dow is down 415 points. The S&P is down 50. This is CBS News. power couple turned up at an awards show.
Love was in the air at the iHeartRadio Awards in L.A. when Taylor Swift picked up her prize for Best Pop Album.
This album probably also feels very happy and confident and free because that's the way that I get to feel every single day of my life because of my fiance, who's here tonight.
Travis Kelce in the audience mouthed, "I love you." Swift took home a total of 7 awards, including Artist of the Year. The lovebirds, Swift and Kelce, danced to singer Ray's viral hit, "Where the H Is My Husband." Her husband-to-be, Kelce, was right there. Deborah Rodriguez, CBS News.
Phillies third baseman Alec Boehm, who hit a home run on opening day, is suing his parents, alleging they mismanaged his money for their own use. He seeks control of his accounts and $3 million in damages. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The Senate passes a funding bill, but will the House follow? Welcome to the Friday edition as the upper chamber clears legislation to, yes, reopen the Department of Homeland Security. But, of course, anything could happen next door in the House of Representatives, and we're going to bring you there in just a moment to talk with Bloomberg's Caitlin Riley following a 2:30 a.m. vote on DHS. Maybe they'll get it done today, maybe not. President Trump gives Iran another 10 days here. But the markets are not impressed by the new ultimatum. Oil's up, stocks are down, NASDAQ sliding into correction territory. And Bloomberg's Edward Harrison from the Everything Risk newsletter is going to walk us through all of this. Our political panel back together today. Rick Davis and Jeannie Shanzano with us for the hour. And things have become so wild on Wall Street. We pulled Charlie Pellet back from his vacation. He's with us now with his update on the markets from world headquarters in New York. Charlie, what is going on?
Right now we are looking at oil moving higher, and as you said, stocks moving lower. And you also pointed out that we've got the NASDAQ 100 index moving into correction. The Dow, the S&P, NASDAQ, all in the red right now. Traders driving global stocks and bonds lower ahead of the weekend on concern that a protracted war in Iran will keep oil prices elevated. Let's begin with what's happening in crude. WTI, West Texas Intermediate crude, just above 98 a barrel, up by 3.8%. Brent crossing 111 now, 111.41, up by 3.1%. All of this as stocks decline. S&P down 54, drop now of 0.8%. Dow Industrials down 456 on the Dow, decline there of just about 1%. NASDAQ down 1.2%. The NASDAQ 100 index down now by 1%. The VIX at 29 was around 30 earlier today. The 10-year 4.42%, the 2-year 3.93%. Gold up 3.5%, 45.27 the ounce on spot gold. Michael Gapin is chief U.S. economist at Morgan Stanley, and on surveillance this morning, he told us Wall Street is looking ahead to next week's data on jobs and retail sales.
You know, we're expecting, I think, a pretty decent report because we'll get some payback from the workers who are on strike and some of the weather. We think 60 to 70,000. So I don't think you're going to see a lot out of it yet. That's probably more the April employment report. And the retail sales data coming, it's delayed. We need timely data. We're not getting it.
Michael Gapin of Morgan Stanley. Again, oil advancing. West Texas Intermediate crude up 3.9% right now, 98.14. Oil majors also gaining. ExxonMobil up 3.2%. Chevron up 2.2%. ConocoPhillips up by just about 0.3%. A headline from the Bloomberg Professional Service: Citigroup is eyeing a regional bank deal as its CEO gears up for the next chapter. Shares of Citigroup today, they are trading lower now by 4.6%. Recapping, the Dow, the S&P, NASDAQ, all in the red. S&P down 0.9%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
All right, Charlie Pellet, great to see you back, sir. Happy Friday. And yes, welcome to the thresholds of the weekend. It's not worth celebrating yet in the House of Representatives because they may have a lot of wood to chop here, but we'll call it Friday here on Balance of Power. Thanks for joining us on Bloomberg Radio, streaming live on YouTube right now, of course, Bloomberg Originals, and on your satellite radio channel 121. You want the good news first or the bad news? I don't have a lot of good news, so I'll get it out of the way. Peak bloom. It actually happened yesterday here in Washington. The cherry blossoms, the day when 70% of the Yoshino cherry trees circling the tidal basin are at last open. Yes, spring is upon us. Things are beautiful in Washington. Tourists are here spending money. Although, did you see the forecast, James? It's going to be like 32 degrees tonight. Those blossoms might be shivering. There's a big question about whether the Department of Homeland Security might blossom again, based on what's happening today in the House. And it brings us back to about 2:30 a.m. Imagine Eric Wasson and Stephen Dennis walking around the House of Representatives, I guess in this case the Senate, spending time in the rotunda looking up, wondering when the night might end. They had to bring in the pizza and the wine. They never got to the cots last night. It was a voice vote, 2:30 in the morning. Almost no one was there. And the bill passed. Pretty remarkable. Actually, I was pretty darn surprised when I woke up this morning. We did the late edition of Balance of Power up on Capitol Hill last evening when there was a crowd in John Thune's office and nobody knew what was going to happen. Well, they passed a bill to fund DHS, all the parts except ICE. As you know, it already has the money from the big, beautiful bill. This would actually get the TSA paid, FEMA, the Coast Guard, and reopen the department after more than 40 days of closure. But of course, it's got to pass the House, and that's where things get complicated. I will say Chuck Schumer is feeling pretty good about things, even though they did not move the dial on masking, on warrants, when he spoke from the floor in the middle of the night. Here he is.
This could have been accomplished weeks ago if Republicans hadn't stood in the way. Democrats held firm in our opposition that Donald Trump's rogue and deadly militia should not get more funding without serious reforms, and we will continue to fight for those reforms.
Okay, so they held firm, but there are questions again about what did they get? Rosa DeLauro wrote a bill that would do exactly this, 2 months ago now, and the body cameras were already in use. Kristi Noem may have seen herself out without a government closure. So we go to the House now, and you know that Republicans in the House don't like this idea of passing a bill without funding ICE. And they're going to need to get on board if this happens, because the Speaker is expected to move through unanimous consent, or suspension of the rules is what I should say. That means you need a 2/3 majority. So you got to have the caucus together. And this is where we start our conversation with Caitlin Riley, who was up there before the sun came up, took the volley from the late shift, and she's with us now on Capitol Hill, what I suppose could be another late day. Bloomberg Capital Influence reporter. Caitlin, we need you on that wall, and we're glad you're there. Give us a sense of what's happening right now, because Republicans want to put ICE funding back in the bill.
Yeah, Republicans, particularly the conservative branch of the party, but also we've heard this criticism from the whip, Tom Emmer, are upset with the bill that's come out of the Senate. They don't like that it doesn't have funding for Border Patrol. They don't like that it doesn't have funding for ICE. Some would also like to add in the voter restriction law they've been pushing for the last several weeks. And so we haven't heard yet on what leadership wants to do or plans to move forward. The procedural rules in the House does give conservatives some leverage to slow this down. Democrats have come out in support of it. Minority Leader Hakeem Jeffries has endorsed it and said Dems will do what they have to get this over the finish line. But right now the question is how Republican leadership wants to move forward and how they will quell the dissent within their party.
Interesting. This is recess day, right? It's supposed to be flyout day. Actually, last night, I suppose, was flyout, and senators were getting itchy. Maybe that's why they passed it. Is there a thought, Caitlin, that everyone stays here beyond today if need be? Are we working the weekend, or does this need to be hashed out now?
Unclear at this point. If they don't pass it today, they may very well be here through the weekend. Conservatives have been pushing to change the bill, send it back to the Senate. The Senate is out next week. House conservatives want them to push to accept whatever the House sends them through unanimous consent during a procedural session next week, which seems very unlikely. But right now, things are very up in the air. We've gotten several mentions from members about having vacations planned, and they've acknowledged that as a pressure point. But we will see what happens.
Well, maybe this bit of news means that everyone's going to go home. This, while you were getting wired up in the gallery there for us, Caitlin, this just broke from Axios. Mike Johnson has agreed in a meeting with the Freedom Caucus, the very conservative Republicans you're referring to here, to put a 60-day CR on the floor that funds all of DHS, including ICE and CBP, in lieu of the Senate-passed bill. So what this means, we've got no deal, everybody goes home, DHS remains shut?
Well, the problem they would still have there is if they put that on the floor, it still needs to go to the Senate. The House in the past has pulled a fast one where they passed the bill that they back and leave town. We'll have to see.
You think Senate comes back to approve a House bill if they get this done? They just left.
I would be very skeptical of that.
Wow. All right, so Caitlin, bring me to the other end of Pennsylvania Avenue, and I know you're not our White House reporter, but the president was going to take executive action to pay TSA agents. Is that real as far as lawmakers are concerned? Does that give them breathing room on passing a bill?
They seem to be treating it as if it's real. We know that there are still questions about where that money is coming from and the legal case to be made for it. But Republicans on the Hill seem to be treating that as if it's legitimate and it will happen. Crucially, we've not heard much from the White House backing the bill passed in the Senate, at least not publicly, and that's also a problem typically for wrangling the conservative wing of the Republican Party in the House.
Of the matter here, absolutely, Caitlin. The president didn't endorse it, so we're just all spinning around, bumping into each other here on Capitol Hill. I do wonder what this means for reconciliation, though. If conservative Republicans in the House demand that ICE be funded the old-fashioned way through legislation, will there still be a drive to craft a reconciliation bill that was designed to carry ICE funding and maybe, I guess, the Save America Act? Or does this change the whole dynamic now?
I think this robs a second reconciliation attempt of a lot of immediate momentum. There's still, the chance that funding for the war in Iran prods Republicans to act, and they go that route. But the big impetus for taking another stab at a second reconciliation bill, at least in the recent week or so, has been to fund ICE and Border Patrol outside of the regular funding process.
Yeah, right. We'll see if we get that far. This is important. This is an important development here. If Mike Johnson's not going to follow the Senate will not jam the House. DHS will remain partially closed unless senators get on airplanes here. Do we know if this goes to a vote this afternoon, Caitlin? Is everybody out of town just in our remaining moment?
Yeah, that's my understanding.
Okay. Leaving on a jet plane. Caitlin, it's great to have you. Appreciate it very much. There you have it, straight from the House of Representatives in Caitlin Riley with our Capitol Influence team. Bloomberg is fanned out across the Capitol right now. We're straddling this entire debate here. We'll have the very latest for you. Assuming this does come to a vote, we'll probably watch this unfold. And the president, by the way, of the United States is going to be speaking a little bit later on this hour. He's got farmers at the White House. That's before he goes to Miami this afternoon to speak again. We've barely mentioned Iran. We're going to get into this coming up with Edward Harrison because the most recent attempt by the president to cool things, to lower the temperature, is not working on Wall Street. Has the taco trade become the boy who cried wolf? We'll talk to Edward about that, the man behind the Everything Risk newsletter, straight ahead on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks very much in the red. We do have the NASDAQ 100 index now in correction territory. U.S. stocks close to session lows. Here's the update as of midday. S&P 500 index down 58 right now, drop there of 0.9%. Dow Industrials down 1%. Tech stocks being hit hard. The NASDAQ 100 index down 1.1%. The NASDAQ Composite Index down 1.3%. And again, to underscore, NASDAQ 100 index now in correction territory. We've got the VIX at 29, the 10-year 4.41%, the 2-year 3.92%. Gold is up $155 the ounce, up 3.6%, now at $45.31. West Texas Intermediate crude oil surging 4%, $98.31 a barrel. And Brent crude just below $112 a barrel. So Brent on the move now, up by 3.6%. Bitcoin down 4.3%, 65,980 now on Bitcoin. Oil prices are higher as traders brace for the Iran war to stretch into April, and attacks are continuing across the Middle East. Higher energy prices also affecting corporate earnings, specifically Carnival Corp. It is cutting its full-year profit outlook as surging crude prices drive up fuel costs. Carnival Corp shares today, along with other cruise lines, moving lower. Carnival down 3.8%, Royal Caribbean down 3.5%, Norwegian Cruise Line Holdings down by 4.9%. Again, recapping, S&P 500 index down 0.9%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcast. And that, Joe Matthew, is a Bloomberg Business Flash.
Charlie Pellet live from New York. He sure talks nice, but this is an ugly market, and one that we need to spend some time on. More specifically, not just an ugly market, but it's being provoked by everything that's coming out of Washington right now in the Middle East by way of Washington. You heard Charlie Pellet. He set the table for you here, and we wanted to take a dive into some of the other corners of the markets on this Friday edition. Thanks for joining us on Bloomberg Radio, streaming live on YouTube with Iran, of course, in the market's focus. And the president's decision last evening to add 10 days to the clock did not help. That's been the sort of pattern here, right? The S&P 500 starts to crater, breaks through the 200-day, maybe interest rates start moving a little bit higher, and something magical happens on Truth Social or maybe in front of a microphone to soothe the markets. Some call it a taco, but until now, that taco tastes pretty good. Today, it's not making any difference. The president was talking about the Strait of Hormuz. This is before he added 10 days to it. In a pretty interesting way here, knowing that he had said he's not desperate. Iran is begging to make a deal. And Bloomberg's Anne-Marie Hordern was in the room for the cabinet meeting yesterday in which she asked about this whole idea of Iran charging money to let boats through the strait. This is what's got the oil market in a tizzy again, with WTI West Texas Intermediate at $98, Brent at $112. Here's how it went in the cabinet room.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to, but they're doing it a little bit. I don't look. Their capability is a lot less than it was 2 weeks ago, and with every week and every day, frankly, it gets less and less. All I can tell you is they're begging to make a deal. So let's see what happens.
Of course, they're doing it more than a little bit. The president talked about the 10 oil boats, as he called them, that Iran left through as a present or a gift. Iran and Israel still exchanging missile fire. The U.S. as well, to the point where the Washington Post is writing about the Tomahawk burn rate. We've fired more than 850 Tomahawk cruise missiles in 4 weeks. And we have to buy a lot more of them. They cost $3.6 million apiece. Also news that the United States is laying mines in southern Iran. The first time this has happened in more than 2 decades. These are not anti-personnel mines, but set up for tanks that might be moving missile launchers. As the Wall Street Journal then throws the final log on the fire, reporting that the president is considering calling up 10,000 troops. This is a big one. The Pentagon looking at sending 10,000 additional ground troops to give the president more military options as he weighs peace with Iran. This is the kind of talk that upsets Wall Street. And here we are on a Friday with, once again, nobody wanting to go along into the weekend. which Edward Harrison can explain to us. He is Bloomberg's senior strategist and the man behind the Everything Risk newsletter. It's great to see you back, Edward. We never pull you in when we have good things to happen. How come that is, James? Can we call Edward when we have a rally? Because, boy, we'd like to see one right now. I mean, just take a look at this. Bitcoin is down $3,000. We've got a VIX of almost 30 here. The S&P 500 down 65. The NASDAQ in correction territory. The 10-year at 442. I can keep going. What do you call this market?
It's definitely a risk-off market, Joe. It's interesting, too, because actually, when you were saying before that the market wasn't soothed by the taco, it really wasn't, because it's not only that it was risk-off, it was that on top of that you had equity or bond yields going up. But recently, short-term bond yields have started to go down. And so that seems like we have a classic risk-off mode. Gold is up, short-term bonds are down in the yield, and equities are selling off. We've got Bitcoin selling off. All of the risk assets, the riskier assets, are selling off, but the less risky assets, the stores of value, are getting people to come to them.
Interesting. Why didn't the taco taste good this time?
I think part of it was that we've seen this many times in the past, but also the 10 days was a long time for the extension.
So he essentially promised that the war would take longer than some were factoring.
Correct.
Okay.
I mean, not only are we talking through this weekend, but we're talking through next weekend.
Yes, sir.
So oil prices will be problematic through next weekend. And while that's happening, you have the United States and Israel striking Iran, striking targets that are potentially going to create retaliation, and we have Iran actually striking other targets in the Gulf. So for another 10 days at a minimum, it looks like we're going to be in this situation, and that's not something that markets want to see.
Is that how you get $150 a barrel oil?
It is. And
does that feel extreme to you right now?
I think that all scenarios are potentially there because, in certain ways, it's already a quagmire in the sense that what's the next option for the president? Iran has already shown that they're not going to back down. The United States is not going to go and send ground troops to take over the entire country. They might strike specific targets, but Iran likely has the ability to weather that storm. The interesting thing I saw today was that Iran was pumping 1.1 million barrels before the war. Now they're pumping 1.5. They were doing it at a price of $60 a barrel. Now they're doing it at a price that's double that. So they actually, and then on top of that, they're getting money from these ships in Hormuz. So the war has actually increased the revenue of Iran, allowing them to actually have more capability to weather the storm. Really? So that suggests that this is going to be a long-term problem, and that they're going to have to be concessions on both sides if it's going to come to a resolution.
From a technical standpoint, tell us what's happening here. When you see the NASDAQ in correction territory, when you see the S&P 500 below the 200-day, like we saw last Friday, which was supposedly what helped to motivate the president at that point to back off the initial or extend the initial ultimatum. Does this simply bring about more selling, or are we going to start bumping into opportunities?
I think what's happening is people are starting to price in the potential of a recession. The potential for recession is higher now. Basically, what we're seeing is people getting out of the riskier assets, getting into less risky assets, and then also reversing some of these these rate hikes that they had priced in. If you look at swaps markets, they're showing all of those are being coming off because it's not just about the oil price being high. It's being high for a long enough period of time that potentially we actually have a recession.
Wow. So I got to start asking everybody about a recession now when they come on the show? This is real.
I think that Goldman Sachs...
It was stagflation a week ago. Now we're doing a full-on recession.
A day or two ago went from 25 to 30%.
Yeah.
When you start getting to the 30, 40%, that's not a tail risk scenario. It's starting to become, the secondary case, not the base case, but the second case.
And if oil keeps chugging along, we do have stagflation in that world.
Exactly.
So fantastic. Would you buy anything in this market right now? I asked you, I think on Monday, when all hell was breaking loose. Isn't this when you buy in the teeth of the sell-off, Edward?
I certainly would buy cash.
Oh my God, that's okay.
But interestingly, my question is
buy cash.
Is gold? Is this a sign that it's made a change? Because
it's got a bid.
Basically,
what does that tell you?
Yeah, we had a washout. Now suddenly people are buying gold when all the other risk assets were down. Gold and the Nasdaq 100 were actually correlated before. Now suddenly the Nasdaq's in a correction and gold is doing well.
So is gold catching a bid because of what's happening with interest rates, or because it's a hedge against risk in the Middle East, or it's both?
It's unclear. This is just a one-day move, so we don't really know. But it is acting in the way that people had anticipated it should act from the beginning. So the question is, has something changed in terms of market psychology?
Why is tech taking the hardest beating in this world, knowing that these companies, the Mag 7, they have the biggest piles of cash in corporate America? Wouldn't they be the most prepared to deal with a downturn?
There are lots of potential narratives as to why people are doing that. Up until this point, my thinking had been that people were selling the winners. They were selling gold because that was a winner. They were selling silver because that was a winner. I think that now the sell of the winners has gone into the Mag 7. People are taking profits there. And, that's a precursor to a more generalized sort of selling.
Okay.
That's potentially one narrative. But, obviously it's just one day, so we can't
absolutely.
really say.
It's a totally unfair question. 10 days from now, the Strait's open. What would happen to the market?
I think we would get a
couple
huge
thousand
rally.
points. Yeah.
If the Strait opens, then
you see the first American ship sail through. It's rally time.
Suddenly,
Are you surprised they're not trying to? With retail's not trying to catch the bottom, knowing that could happen?
Well, retail is fatigued. They are the most fatigued. We've seen reports that net sales from retail investors are what we're seeing recently, and so they're the ones who are potentially bailing out of the technology stocks.
Understood.
And so they're scared. And running for cover. So the question then is, what happens when we have a turn? Suddenly, all the most draconian negative scenarios are off the table, and therefore we have the potential for a rally. The recession risk goes away almost entirely as a result of that.
Incredible. So we'll call you that day. You can take a victory lap. We'll share a big rally together. Edward Harrison's the man you want to talk to on a day like this. This is a remarkable market and a remarkable moment that we're in here. If you're not already subscribed to the Everything Risk newsletter, this is the man behind it, and you do want to do so. Our senior strategist at Bloomberg. Great to see you, and thank you as always, Edward. This is a market clearly not interested in going long into the weekend, and we'll keep tabs on what's happening here, from stocks to bonds to crypto. And if any developments come from the president's speech here, he's about to speak to farmers at the White House. Good thing it stopped raining. A view of the South Lawn for us. If you're with us on YouTube, dial us up, search Bloomberg Business News Live. Our panel's next, only on Bloomberg.
12:40 on Wall Street. We do check markets all day long here at Bloomberg. Lows of the session right now for the S&P 500 index holding just above 6,400, 6,407 to be precise. A loss now of 1.1%. Stocks are falling. NASDAQ 100 index in correction as the escalating war in Iran boosts oil prices. The Dow now down 533 points, a drop now of 1.2%. S&P again down 1.1%, on track for a fifth week of declines. NASDAQ is down 1.5%, and the NASDAQ 100 index down 1.4%. The VIX just below 30 now, with the 10-year at 4.41%, the 2-year 3.9%. Right now, spot gold is at $45.07 the ounce. Spot gold up by 3%. West Texas Intermediate crude heading into the weekend, $98.60 a barrel, up 4.4%. Brent 111.77. Brent crude up by 3.4%. Economic news this morning. Consumer sentiment as measured by the University of Michigan now at a 3-month low, and year-ahead inflation expectations are jumping as the war in the Middle East drives up gasoline prices. Joanne Chu is Director of Surveys at the University of Michigan. She was a guest on Bloomberg Intelligence.
Essentially, after the start of the Iran war, we have consumers being quite worried about the trajectory of the economy. Primarily, this is coming through worries about both gas prices and inflation overall. We have a pretty large surge in short-run inflation expectations, and we had a deterioration in one-year expectations on multiple dimensions of the economy.
Joanne Chu of the University of Michigan. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Live from New York, Charlie Pellet watching Wall Street, and he'll be back at the top of the hour. 1 p.m. Eastern Time, as we welcome our global television audience to the Friday edition. Thanks for being with us here on Bloomberg Radio, satellite radio channel 121, and streaming live right now on YouTube. If you want to see the president on the balcony, dial us up, Bloomberg Business News Live on YouTube. Let's do that right now. The President of the United States just hit the balcony. He's speaking to farmers on the South Lawn, complete with a golden tractor that has been parked in the driveway. This is live on Bloomberg.
And rain or shine, and you don't mind rain, shine. The one thing about farmers, they don't care about that weather. They get out there, it makes no difference. But rain or shine, no one has more grit or greater spirit than the American farmer. We love the American farmer. I just gave you $12 billion. I don't know if you know that or not. You make enough money, it doesn't matter to you, right? But we just provided $12 billion, right, Brett, for the American farmer. You think Biden would have done that? No, he wouldn't have done that. We're delighted to be joined by Secretary of Agriculture, who's doing a fantastic job, Brooke Rollins. Brooke, thank you very much. Secretary of Health and Human Services, Robert F. Kennedy Jr. Robert, Bobby. EPA Administrator is doing such an incredible job. He's getting those costs down for you, and he's always protecting the environment, but he does it quickly. A real superstar, Lee Zeldin. Thank you, Lee. Great job. And someone everyone loves, and they love in particular the job she's doing, Small Business Administrator Kelly Loeffler. Kelly, thank you very much. Thanks as well to John Hoven, Joni Ertz, Pete Ricketts, along with the chairman of the House Agricultural Committee, G.T. Thompson. And I tell you, they're fantastic people. They are warriors. And representatives, Jim Baird, Randy Feenstra, Monica De La Cruz, Brad Finstadt, Michelle Fishback, Mark Messmer, Victoria Spartz, Frank Lucas, Tracy Mann, Zach Nunn, Adrian Smith, and Derek Van Orden. They're all out here. They want your votes desperately, desperately. They're only here for your vote, you know that. But they're here because actually they did a great job. Those were people that were the most, I would say, the most aggressive for the farmer, which is what we want. Other than me, they were right in there. I was more aggressive than any of them. But also with us is the CEO of Tractor Supply, Hal Lawton, who will soon open the company's 2,500th store in honor of America's 250th. Hal, thank you very much. It was great great to meet you at the Oval Office 2 minutes ago. I also want to thank the president of the American Farm Bureau Federation, Zippy Duval. I've known Zippy for a long time. Zippy's been with me right from the beginning, right, Zippy? From day one, he liked Trump. He said, well, I don't know, but I just had a good meeting with him. I'm gonna go with Trump, right? That was in 2015. And very special thanks to the proud young parents of two beloved American institutions, Future Farmers of America and 4-H. Two great ones. For 4 disastrous years before I took office, sleepy Joe Biden and the Democrats in Congress crushed America's farmers with the worst inflation in the history of our country. Prices were going through the roof. So bad, it was so bad what they had done to our country, and by the way, in so many other ways too, borders and everything else. But they crippled
President Trump speaking to farmers live at the White House. We thought we would just put an ear on this conversation for a moment to see if he would address some of the news that has broken in the past couple of hours. And if he does, we'll return to a misty South Lawn here. It's an interesting moment since we've taken air, some really important headlines having to do with the Department of Homeland Security. And I was listening closely to hear if the president might mention this, because he has yet to endorse, and I guess will not be endorsing, a Republican-led effort in the Senate to get DHS reopened. In fact, the bill passed by voice vote at 2:30 in the morning. When you saw us talking to senators up there on the late edition of Balance of Power yesterday, it was unclear what was going to happen. Leader John Thune had his office full, as it turns out, of Republicans and Democrats, and actually got it done. They got the deal done to fund DHS with the exception of ICE, and that would give Republicans the opportunity to go back around and do that in reconciliation. But it would get DHS reopened. It would pay TSA agents and start to get the system moving again here. But of course, this just ran into a wall in the House. Anybody who thought this was going to be easy should keep on reading here. It does appear now, Bloomberg is matching earlier reports that I mentioned. The House Republican majority plans to vote on a 8-week stopgap on DHS funding, and it will fulfill ICE. So if DHS is going to, they're feeling about things. Bloomberg Politics contributor Rick Davis, Republican strategist and partner at Stone Court Capital, and Bloomberg Politics contributor Jeannie Shanzano, Democrat analyst and Democratic visiting fellow at Harvard Kennedy School's Ash Center. My brain has fallen out of my ears, guys. It's been one of those weeks where everybody's fried, and it looks like it's not over. Rick, what is Mike Johnson doing? We were so close.
Well, you had me excited there. I thought Jeannie was switching over to the Republican side. God, what a celebration. Yeah, look, I mean, it's hard to say what this is all about. It's you know, the complaints from the complaints from Freedom Caucus were totally predictable. Chip Roy said it yesterday. We're not going to go for this. But we also see Chip Roy cave on every single time he says we're never going to go for this. So that alone probably wasn't convincing enough. But you know, when you have the chairman of the Freedom Caucus come out and say, hey, we don't have voter ID, we don't have funding for child sex trafficking. I mean, like, there's a litany of conservative causes that he believes has to be in there.
It had to be. John Thune marched back. They come up with this really hard to negotiate unanimous deal last night. They send it to the House, and guess what? The conservatives, like the president, say, not so fast. We want the SAVE Act. We want voter ID. Now, it's going to come down to pressure from Donald Trump to get this through. And of course, Donald Trump, what is he going to do? Call his supporters in Congress and say he doesn't want something that hours ago he said he does and really wants? It's a mess out there. And John Thune is going to take the pushback here because I think you're right when you say the House isn't going to be jammed. I know Rick is optimistic that this gets done. I think if it does, it's going to be at the hands of Democrats, and Hakeem Jeffries has said they will support getting TSA funded, but I will have to see how many Democrats come over with that.
So, Rick, this is interesting. the scenario that you just outlined, if the Senate bill were to get to the House floor somehow, would it require Donald Trump's endorsement? Does he need to pick up the phone, or has he already done that today, do we think?
No, I think, as Jeannie said, it's a capitulation, right? The leadership bill fails. They got to take up the Senate bill. The Senate's out, right? I mean, jet fumes are in their nostrils. These guys aren't coming back for 2 weeks. There's nothing the House is going to do to get them to come back and vote on a stopgap. And so that'll fail. And then the speaker's going to be stuck with having to take Democratic votes. And he's done it before. The days of you pass a bill in the House outside your caucus and you're going to get thrown out of the speaker's job, everyone's figured out that speaker's job is the most horrible job in Washington and nobody wants it. So no one's going to throw him out again. And so, yeah, I think this is a perfectly reasonable exit plan for both the House and the Senate Republicans, is that, Thune pulled the hat trick and got a, 2 a.m. vote that nobody was expecting yesterday, although I might add I kept holding on to the idea that something good was going to happen. And I think that this is just the closing of an ugly mess, and it'll be ugly for another day, but by tonight you'll have a passed bill that'll mirror the Senate bill enough that it can go to the president's desk.
Yeah, your long view has been accurate on this, Rick. It's duly noted. Jeannie, this is really, the golden tractor is pretty snazzy. I don't know if we can show this. Not just the golden tractor. There's a red, white, and blue painted tractor out there. I guess these came from Tractor Supply. Pretty snazzy stuff. The president's on the balcony right now talking to farmers. I see a lot of cowboy hats in the crowd here, Jeannie. And he said earlier, hey, I gave you $12 billion. Who else would have done that? He said, sleepy Joe Biden never would have done that. Is he right? Did Joe Biden help the farmers?
Yeah, Joe Biden helped the farmers enormously, because guess what? Joe Biden got us out of a costly war. Joe Biden didn't go in, even when under provocation from Israel and elsewhere, and bomb Iran, closing the Strait of Hormuz, causing fertilizer prices and oil prices to jack up and the stock market to have its worst day in a long time. So yeah, Joe Biden did help. For Donald Trump, he is in such dire straits in terms of the economy, including in Fox News' latest poll. Just thinking back about the issue of the TSA agents and how sort of mind-boggling this all is. All of a sudden last night, Donald Trump tells us that he can pull out his famous Sharpie and he can sign an EO and pay these people. Well, if that's the case, why didn't you do that weeks ago? Why are you making Americans, TSA agents, TSA workers, American travelers experience all this pain? Likewise, farmers can ask the same question. Why are you raising tariffs on every country in the world? This is what Donald Trump has done, as much as he wants to wiggle his way out of it by blaming Joe Biden.
Well, I thought that might give lawmakers some breathing room when I saw that TSA EO. We'll get into the situation in Iran coming up with our great panel. Rick Davis and Jeannie Shanzano are with us on a Friday, only here on Bloomberg.
Washington, D.C. This is Balance of Power with Joe Matthew.
A deal to reopen the Department of Homeland Security may have just gone up in smoke. Welcome to the Friday edition as the Republican-led House rejects a bill just passed by the Senate to fund DHS except for ICE. And we'll get the very latest from Capitol Hill later this hour when we talk to Bloomberg's Eric Wasson with insights ahead from Republican Congressman Troy Downing of Montana. But first, President Trump gives Iran an additional 10 days, and it is not helping markets. We'll get the latest from Bloomberg White House correspondent Courtney Subramanian, and we'll talk with former U.S. Ambassador to NATO, Ivo Dalder. Analysis from our political panel. Rick Davis and Jeannie Shanzano are with us, and we start, as always, on Wall Street. Not been a fun ride today. Let's get to the Friday trade with Charlie Pellet at World Headquarters in New York. What do you have, Charlie?
Right now, Joe Matthew stocks lower across the board. Bottom line, who wants exposure along over the weekend? We have got the Dow, the S&P, NASDAQ all falling. NASDAQ 100 index right now has moved into correction territory, and as I speak, we do have U.S. equities holding very close to session lows. Right to the numbers with the S&P 500 index down 1%. Dow Industrials also down 1%. The Dow down 485. S&P just above 6,400 right now. NASDAQ down 305, down 1.4%. And the NASDAQ 100 index down 300 points now, down by about 1.3%. We do have the 10-year at 4.41% with the 2-year 3.92%. Gold is surging 3%, 45.11 the ounce. Crude continues to be the big story. 98.90 right now for a barrel of West Texas Intermediate crude, up 4.5%. Brent, the global benchmark, at 111.72. Barrel of Brent up now by 3.4%. The U.S. and Israel have bombed several nuclear targets and steel facilities in Iran today, targeting a heavy water research reactor and a yellow cake production plant, as well as two of the country's biggest steel makers. According to the U.S. Nuclear Regulatory Commission's website, yellow cake is the solid form of mixed uranium oxide. Again, recapping here, stocks lower, S&P down 1% right now, NASDAQ 100 index looking at a correction right now, and the 10-year 4.41%. Oil, of course, the big story, 98.75 on WTI, up now by 4.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie, thank you so much. Charlie Pellet will have more on the markets coming up in about 20 minutes' time here on Balance of Power. It's the Friday edition. Thank you for joining us here on Bloomberg TV and radio. To think that there are still yellow cake manufacturing facilities in Iran to hit is quite remarkable, as both sides continue lobbing missiles here, even though the president has extended the ultimatum. It was big news last evening as we came to air on the late edition of Balance of Power. An additional 10 days. This came about on Truth Social, the president saying that things are going very well, talks going very well with Tehran, and therefore the extension. In fact, he put his own voice to this in an interview on Fox News last evening, the decision to go for 10, even though Iran didn't even ask for that much of a timeline, according to the president. Here's what he said.
I gave them a 10-day period. They asked for 7. You're going to say, oh, Trump's a terrible negotiator. They asked for 7, and I said, I'm going to give you 10 because they gave me ships. We talked about the 8 ships, the president that I talked about the other day. But they asked for 7, and I gave them 10. You got 10 days, and they were very thankful about that.
They have been thankful, but the market not so much, as we just heard from Charlie. Each attempt the president has made here to soothe markets, to lower the temperature, to extend the ultimatum, as we've already seen a couple of times now, have gone over pretty well. Markets are not responding that way this time, as we know this will be underway for at least another 10 days. And when you look at the price of oil here, it's not reassuring. In New York, WTI selling for $98.70 now. We're up almost 4.5%. Getting closer to $100 a barrel for West Texas. Brent crude, $111 right now, up 3%. The VIX approaching 30, and of course, the risk-off mood for stocks with a 10-year now yielding 441, 30-year at 495, and a market that's not in a good mood. NASDAQ in correction territory, as Charlie Pellet told us, and the S&P 500 is back below the 200-day, right where we were last Friday, when the president, again, attempted to soothe the markets, and it worked that time. It's feeling different right now as Donald Trump speaks to farmers on the South Lawn. We bring you to the North Lawn for a conversation with Bloomberg White House correspondent Courtney Subramanian, who's following all of these storylines. And Courtney, we welcome you back to Balance of Power. It's great to have you here on a Friday. The president is going to be speaking again a bit later. He's got an appointment in Miami to be speaking before an investment conference. But is this it? Investors are looking for more tangible information as we go into another weekend of uncertainty. What are we hearing from the administration?
Yeah, the president continues to strike this very positive tone about the talks, right? He keeps saying the talks are going very well, which is why he has agreed to extend the deadline and push it by 10 days. This, of course, the big question is this him actually, allowing time for the talks to continue, or is he just buying time to amass more troops in the region before a potential ground invasion, or should he decide to take over Karg Island, which of course is important to Iran's oil exports? So there is a lot of uncertainty, and as you and I both know, the president likes to make these decisions, these big military decisions, on the weekend. He is headed to Miami, as you said, so we should hear from him later and hopefully get a bit more about what he's thinking about doing this weekend.
Well, certainly we're going to be all ears, and I suspect he could talk to reporters, including yourself, when he leaves a little bit later on to go to Miami. Courtney, it's been interesting watching this. Of course, we remember what happened after Liberation Day, but even just in the last week, it was a week ago today when he dropped the 48-hour ultimatum, right? He was going to obliterate the company's power plants. Then, of course, markets freaked out, and the president on Monday issued a new 5-day timeline. That pulled everybody back from the ledge. We felt better about things. Now we got the 10-day extension. Since that does not seem to be soothing markets, do you suspect we might hear from the president again with more calming words when he leaves the White House later on, or in a Truth Social post? You know how concerned he's been about these markets lately, with a lot of worry on Wall Street.
I think that's right. I think we should hear from him either before he leaves the White House today, or before, he may speak on the plane on the way to Miami this evening. I'm sure he'll address the war later tonight in his remarks in Miami as well. But as you and I both know, he is watching very closely, and they are projecting just the most optimistic attitude about these talks, even though both sides remain pretty far apart. We know that Iran rejected the 15-point proposal that the U.S. put forth through intermediaries in Pakistan. And they put forth their own demands, 5 conditions that, of course, we don't think the U.S. would agree to, which includes sovereignty over the Strait of Hormuz. So, again, it's unclear exactly how these two can meet when they remain so far apart, but I'm sure we'll hear from the president later today about, his efforts to, again, try and soothe those markets as we head into the weekend.
Just lastly, Courtney, we just ran a headline, the U.S. signaling to allies no immediate plans for an Iran invasion. And we saw a report today in the Wall Street Journal that the Pentagon is looking at considering sending up to 10,000 additional ground troops to the Middle East. Is the White House acknowledging or denying that?
They continue to say publicly that this is a decision that rests with the president alone. But we do know, I know from speaking to, some of the president's administration officials, that he wants options. He wants to, be able to have the ability to move on a ground invasion if that's something he decides to do. And so they are weighing all their options, and that includes deploying thousands of troops to the region. And I think we'll continue to see that.
Courtney Subramanian live at the White House. It's always a pleasure to have you, Courtney. We appreciate it very much, reporting for Bloomberg at 1600 Pennsylvania Avenue. I want to add the voice of Ivo Dalder. I was delighted to hear that the former ambassador to NATO was joining us today. This brings us back to the Obama administration, now senior fellow at the Harvard Belfer Center. Mr. Ambassador, welcome back to Bloomberg TV and radio. I'm deeply curious to hear your thoughts today as the president drops this additional 10 days on the ultimatum. Do you think this is an opportunity to let talks breathe, or to actually prompt them to begin?
Yes, and yes, also on putting more escalation options into the hopper. The problem here seems to be that the president is kind of losing the thread about what it is that we're trying to achieve here. Why did we go to war in the first place? All the focus is now on opening up the Strait of Hormuz. Of course, the Strait of Hormuz was open on February 28th when the bombing started. It was a consequence of the bombing. It was a foreseeable consequence of the bombing, but somehow the president and his advisors didn't do the planning and didn't take into account the need to ensure that the strait was going to be open. So we're in a new ballgame, and we're trying to figure out a way. The president is trying to figure out a way to get out of it, and it is through some negotiated solution, because other than occupying Iran and taking over the government and having a government that is more conducive to American persuasion, it's got to be a deal. Some deal has to be struck in which Iran agrees to no longer threaten shipping through the strait. And right now, the tables seem to be turned to some extent, where Iran holds, to use the president's favorite phrase, the cards. Iran is the one that is keeping the strait closed. It is opening it up for those who are willing to pay it sufficient amount of money or its friends, but it's keeping the strait closed to those it doesn't like. And the president is running out of options to figure out how to do this militarily, threatening, in my view, in order to see if we can get a deal that at least achieves some of the objectives that were set when we started the bombing campaign back 4 weeks ago now.
Yeah, but this isn't a surprise, though, right, Ambassador? Isn't this in every model that the Pentagon has ever had about a potential conflict with Iran? The first thing they would do is close the strait. Everyone in the energy market knew this, right?
Yeah, it's not a surprise, but apparently was a surprise for the President of the United States, who decided to engage in a second bombing campaign. Remember, he already did so in June of 2025 when he said he obliterated the nuclear program. He did so without paying attention. He was warned about this. I think it's reporting in the New York Times by the chairman of the Joint Chiefs of Staff, Dan Kane, who said that this is a possibility. He said, oh, I'm not worried about that. Our military, your military, we're so good, we can take care of it. What we see here is a president, and this happens to other presidents. It happened to George W. Bush after Afghanistan. It's happened before. They become enamored with the military tool. Our military is extraordinary. It's the best military in the world. It can do things that no other military can do, but it can't do everything through military force. And we know that from Afghanistan. We know that from Vietnam. We know it from Iraq. But somehow, because Venezuela, the bombing campaign against Iran in June went so well, the president assumed that we could just change the regime with a bit of bombing and things would be fine. Well, turned out that, as military strategists like to say, the enemy has a vote. And in this case, the vote was to close the Strait of Hormuz, and they didn't prepare for it.
The enemy has a vote, and Iran is not Venezuela. Ambassador, I want to ask you about NATO, its potential involvement or lack thereof. This is something the president's certainly been talking about a lot, as recently as yesterday in the cabinet meeting. Listen to what Donald Trump said.
One thing, we're very disappointed, I'll say it publicly, we're very disappointed with NATO, because NATO has done absolutely nothing. And I've always said, 25 years ago, I mean, I was somebody that wasn't a politician, but I was always involved in politics and I understood politics. I said 25 years ago that NATO's a paper tiger, but more importantly, that we'll come to their rescue, but they will never come to ours.
The president has called NATO a paper tiger. There he has called NATO cowards for not joining him in the strait. NATO is talking as well, though. We just heard from the Chancellor of Germany. Again, Chancellor Merz saying the U.S. and Israel have no strategy in the war on Iran, and says German contribution in resolving the crisis is an option, interestingly here, as Marco Rubio urges maximum partner contributions from G7 nations over Iran. Distill this for us, Ambassador, to the point where the Chancellor is compelled to speak like this publicly. What is the conversation between the White House and our NATO allies right now?
Well, I'm not sure there's much of a conversation other than perhaps Marco Rubio talking to his G7 counterparts in Paris. I mean, let me make 2 points. Number one, 25 years ago, the United States was attacked by al-Qaeda, and for the first and only time, NATO, at the behest of not of the United States, but of its allies, invoked Article 5, which is the collective defense provision of the North Atlantic Treaty, saying that an armed attack against one shall be regarded as an armed attack against all. Not only did they invoke Article 5, they deployed massive amounts, tens of thousands of troops to Afghanistan. Our allies lost well over 1,000 troops in a war. So for the President of the United States to say today that NATO doesn't do anything for the United States, that NATO is never there for us, when in fact the 25 years he invokes was the time frame in which NATO did that, is frankly obscene. And it is regarded by Europeans as obscene because they lost troops to defend the United States and the United States security interests. Not because they thought it was important for their security, but they thought it was important for America's security, and that's what allies do. Number two, NATO is a defensive alliance. It responds to an armed attack on it. There is no armed attack on NATO. The only attack that occurred was an Israeli-U.S. attack on Iran, which many, in fact, I would say most Europeans regard as illegal under international law, unnecessary, given that the diplomacy was still a possibility, and reckless in ignoring the outcome that could have happened. And I think Chancellor Merz is expressing that. So under those circumstances, to say that this was, quote, a test for NATO, or second, that NATO is a paper tiger, is never willing to do anything, is frankly beside the point. It's not going to work. And it's not going to lead NATO countries to deploy the forces. Now, if hostilities have ended, there probably is going to be a European contribution to helping to keep the strait open, or even to open it. After all, NATO European countries have capabilities the United States no longer has, like minesweepers. And finally, just to point out, NATO bases in Germany, in other countries, are being used every single day to facilitate the ability of the United States to conduct this war. Without NATO, without Europe, the United States couldn't be doing what it's doing today.
Well, what would happen if every NATO nation with a ship showed up when the president initially asked them to in advance of the strikes? Would that have made the difference? The president says you need volume, you need scale to reopen the strait. If we showed up with all of our NATO allies, would the strait be open, Ambassador?
Well, if we hadn't bombed, the strait would be open, and I think that's the fundamental point. The strait was open. It was closed because of the bombing. I think if there had been consultations with the European nations, as indeed there was prior to the Iraq War, deep consultations, although Europe was divided, NATO was divided, that we might have come up with a strategy to say, how do we put maximum pressure on Iran to achieve what we want to achieve, which is an Iran that does not have nuclear weapons, which, by the way, it doesn't, and it hasn't had nuclear weapons, in part because of negotiations, in part because of sanctions, in part because of pressure, but certainly because of diplomacy, that it reduces its ballistic missile inventory and that it cuts its support for proxies. We could have had a joint strategy. That's not what the President of the United States did. He worked it out with the Israeli government. He ignored pleas from the Gulf allies who said, do not do this because it is going to affect our security, as indeed it has. And he failed to even talk to our major allies, both in Asia and in Europe. So as a result, the Europeans and the Asian allies said, we're suffering the consequences for a decision we had no input in, and now you're asking us to solve it.
With a diplomat's perspective, Ivo Daalder, the former U.S. ambassador to NATO in the Obama administration, senior fellow, Harvard Belfer Center. Mr. Ambassador, it's always great to compare notes, and we appreciate your insights. We'll assemble our political panel next. Rick and Jeannie are on the way here, only on Bloomberg.
7:21 on Wall Street. We do check markets all day long here at Bloomberg. Fresh lows for the U.S. stock market right now. We've got the Dow, the S&P, NASDAQ, all in the red. Most importantly, NASDAQ 100 index has moved into correction territory. We begin there. The index, the NASDAQ 100 index, down 1.5% right now. Keeping it all in context, S&P 500 index, lows of the day down 1.2%, 63.99 right now on the S&P. The Dow is down 1.2%. The VIX right around 30, the 10-year 4.42%. Spot gold up at 4,500 even, the ounce up 2.8%. Crude, the big story. West Texas Intermediate up 4.5%, 98.77 a barrel. Brent 111.65 right now, up 3.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet will have more on the markets coming up in about 20 minutes' time here on Balance of Power. Thank you for joining us on the Friday edition here on Bloomberg TV and radio with our eyes on Iran and a market that's having more fits today, not unlike the same situation we were in a week ago today, remembering that is when the president dropped the ultimatum. It was Friday, the 48-hour ultimatum, and he climbed back knowing that the markets were in a bit of a tizzy going into that weekend, saying we're getting very close to meeting our objectives as we consider winding down. Remember, winding down our great military efforts in the Middle East with respect to the terrorist regime of Iran. We had the 48-hour ultimatum, became a 5-day ultimatum, now a 10-day ultimatum on top of that. And each attempt to climb down corresponded with an uptick in the market. Investors were reassured. Call it the Trump put, the taco, whatever you want to say. It's been different this time, however, with a market that seems to be very reluctant to go long into the weekend, despite any rhetoric that is coming from the White House. In fact, we were in the throes of a deep sell-off when we spoke to David Weston right at this time last week. Investors looking for a reprieve may not be getting the same treatment today, as David joins us, of course, the host of Bloomberg Wall Street Week, who's been through a couple of these before. And David, it's great to see you again. I think I gave you the same awful doom and gloom setup when we spoke last week. With now a NASDAQ in correction, an S&P 500 below the 200-day, we've got a VIX approaching 30. Risk off, 442 on the 10-year, 496 on the 30. Wall Street's not buying this most recent attempt to step down, and I'm wondering what you think about this reaction.
Well, the immediate reaction is just exactly what you said, which is there's just so many times you can say we're going to back off before they don't believe it. But I think we have to also, as I'm sure many on Wall Street are thinking, it could be real. I mean, it could be that they really are negotiating and may actually work out. I mean, they're just too wide a range of possibilities here, and we always want to figure out what's going to happen immediately, and I certainly don't know. Right now, I don't see a lot of reason for hope of anything getting resolved very quickly, but I could be wrong. I've been wrong in the past. I hope I'm wrong this time.
Well, boy, that's for sure. The scenario is becoming pretty easy to see, though. As soon as oil goes up, stocks go down, and the energy market really seems to be keying off everything that's happening in the Strait of Hormuz here, David. It's almost like a slow-motion movie. We were talking about this very same issue last week. Any attempts that we've made to reopen the Strait diplomatically have not helped, and even doing strafing runs and bombing that area has not helped. NATO is obviously not joining us in this endeavor, and now Iran wants to start charging for passage. So the gates remain closed, effectively.
And you really, Joe, taken us beautifully to what we're doing in part on Wall Street Week tonight. We're going to talk to Nick Burns, the former U.S. Ambassador to China, about that. Remember that summit that was supposed to happen right about now that got postponed until May, about where China is in all this. But also, we went beyond the oil and gas markets. You mentioned they certainly have been roiled by what's happened in Iran. But it's not just them. There's something else being roiled, and that is fertilizer at a critical moment. April is the critical moment in the Northern Hemisphere for planting. And we found a couple of people who really know fertilizer well. One whose title is Vice President of Fertilizer, believe it or not, for StoneX. Out in the Middle West, his name is Josh Linville, who really knows it backwards and forward. And also our new contributor, special contributor, Christian Freeland, who it turns out knows a lot about fertilizer. This is part of what they had to tell us.
Everybody's talking about the oil and the gas and everything else that flows through there. Few people know urea, being the most commonly traded nitrogen product of the world, about a third of the world's product flows through that Strait of Hormuz. When you look at the top 10 list of global urea exporters, 3 of them sit behind the Strait of Hormuz. That's Iran, that's Qatar, and that's Saudi Arabia. Those 3 nations represent 3 of the 10 largest anhydrous exporting nations.
Farmers are very affected by the price of fertilizer. Fertilizer accounts for, about 25% of the costs for a farmer. And this is happening just at seeding time as they're getting ready to plant their crops. And it's happening at a time when farmers have been really beaten up. The trade wars have been really hard for farmers, for American farmers, I should say. COVID was really, really hard for farmers. And Russia's invasion of Ukraine and the economic impact was really hard for farmers. So they've been having a hard time. And then on top of that, you see the price of fuel, the price of fertilizer skyrocket at a time when you're just, going into your shop, looking at your seed drill, checking that everything works, getting ready to get out in the fields.
So, Joe, that was Chrystia Freeland there you heard, and we know her as the former Deputy Prime Minister of Canada, the former Finance Minister of Canada. But what I didn't necessarily know is she says herself, she's a farmer's daughter. She comes from Alberta. Her father is back on the family farm out there, so she knows fertilizer and knows farming backwards and forwards. And she said one of the first thoughts she had when she heard about this attack on Iran was, oh my goodness, what's going to happen to the farmers? So she's got that very as you know, as we're seeing President Trump with it looked like a golden tractor, right, at the White House today, reaching out to farmers saying,
I don't know how many farmers are using golden tractors, but yeah, David, your timing is impeccable. The South Lawn is full of farmers wearing cowboy hats right now. There's indeed a golden tractor and a red, white, and blue one, and the president was talking to them about how much he has done for farmers. He said, I gave you $12 billion, and I'm wondering if there's going to be another subsidy coming here. We're talking about Farm Bill again, and obviously an industry that is maybe more impacted than any by what's happening in the Strait.
Well, and you remember, Joe, he did this the first time around, too, in the first administration. Yes, he had a big subsidy for farmers because of what happened with China. And we went out, as you recall, to Iowa and talked to the farmers out there and said, well, that's okay, but we'd rather actually earn it ourselves. We don't love these subsidies. The one thing in the markets I will say is I think I want to go long on spray gold Rust-Oleum. I think you could make a lot of money on that right now because we're going to have to spray everything gold, I think, from now on.
If you want to get it in the White House, you got to see what he's doing to the treaty room, David. I know you know the White House pretty well. That is another report we haven't even touched yet. The NASDAQ 100 extending its decline to 1.6%. We're now at session lows here. S&P 500 down 85, a little more than 1%. Not a great situation, and you wonder, David, how resilient, how elastic this market might be when good news arrives. You just said, look, this could be real. If the president shows up in 10 or fewer days here and says, we've got a deal in Iran, what would this market look like?
Most people on the street say that it would rebound really quickly, including oil would come down quite quickly as well. Having said that, you know so well, Joe, business is based on prediction. And having some certainty about what's going on. I think there is a cost being paid for all the ups and downs, even if it comes out all right in the end. And at this point, we don't see that, but it could. Even if it does, there's a price to be paid. And one of the questions we're going to be taking a look at is, what does it do, for example, to the U.S. dollar as a reserve currency if we really push this to the edge? And we can do longer-term damage that it may be difficult to come back out of.
Fascinating stuff. That's why you want to stick around after the late edition of Balance of Power. It's Wall Street Week with David Weston, 6 p.m. Wall Street time here on Bloomberg TV and radio. Great to compare notes with you always. David, thank you so much and enjoy the weekend. Let's assemble the panel and get their take on all of this because the economic impact of this war is severe, even though it could be immediately reversed, as we just established again with David. Bloomberg Politics contributors, Jeannie Shanzano, a Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center, and Rick Davis, Republican strategist and partner at Stone Court Capital, with us right now. Jeannie, you saw those farmers out there listening to the president. When they go back home, it's a grim reality, as we just established. Not only are they preparing for planting season here, they can barely afford to fill the tank, and now fertilizer is going to be prohibitively expensive. And guess what? All this comes through at the grocery store in the end, doesn't it?
That's right. You know, I heard somebody who is an expert on these things say that there's 8 months out of the year that if you're going to close the strait, that you would do that. And the United States chose the exact wrong time to do that because, of course, it is planting season. So you've got the fertilizer, you've got the oil problems. And this is why, of course, Donald Trump is in big trouble politically. He's under 40% in 3 of the latest polls, making him not just unpopular, but the most unpopular president in the modern era at this point in his time in office. And to make matters worse, I'm sure for Donald Trump, because he always likes to compare himself to Joe Biden, Joe Biden's numbers on the economy, his approval for the economy, were better than Donald Trump. And that's a real problem for Donald Trump, because there's one thing people have always trusted about him is he's a businessman. He knows how to manage the economy. He knows what he is doing. And from farmers to people across the country, they are feeling now like their economic situation under this president is worse. That is setting up some very bad political realities for Donald Trump and the GOP. And of course, I will let my dear friend Rick Davis talk about consumer sentiment, because I wouldn't dare step on it. But that is very bad numbers for them as well.
Well, yeah, lower than expected today. That final number is ugly, and I know that's your favorite political poll, Rick, when you look at UMich. The president today just told farmers, by the way, he's going to be asking Congress to pass a new farm bill with more extensive farm relief. Will there be any appetite for that in this environment?
You know, think about the environment that they're going into to talk about that. You know, with a reconciliation bill now almost a certainty if you want to actually fund ICE, and a $200 billion supplemental that may get tacked onto that for the military. And now you're talking about, you know, $12 billion for farmers and I mean, you're talking now about like almost a $300 billion reconciliation or supplemental bill. I mean, like at a time when we're running the highest national debt in history, that our deficits every year continue to climb, and it is impacting our capacity to function as a country. When you start spending this much on debt service, you have to spend less on national security. It's just a certainty. And so I think it's going to be a very difficult discussion, especially into an election year where, you know, Congress typically saves up some capital to spend so that they can have a good attitude going into election. But I think the barrel's going to be dry. I think it's going to be very difficult to get these big spending bills through the Congress this year.
With that $200 billion supplemental request still looming, and we don't know that that will be the number. That's the report, Jeannie. The Washington Post today, in our remaining moments, says the military has fired more than 850 Tomahawk cruise missiles in 4 weeks of war, and they need to buy a lot more. We know this story. They cost $3.5 million each, at least the more recent versions. Is that supplemental going to run into headwinds?
Oh, it's going to run into big headwinds. And Rick just went through some of the numbers here as, again, our debt reaches the highest in American history. And of course, what is the president saying politically at that very strange cabinet meeting yesterday? He's saying, I thought things were going to be worse. This isn't so bad. It's not as severe as I thought. Politically, he is more out of touch than Joe Biden sounded. And that's saying a lot, because Joe Biden sounded out of touch even more than George Bush with his grocery not understanding how we price groceries. So
the grocery scanner and the price of a gallon of milk. Great panel. Rick Davis and Jeannie Shanzano. Let's meet back here on the late edition of Balance of Power right here on Bloomberg.
check markets all day long here at Bloomberg. We have got stocks trading lower with the Dow, the S&P, NASDAQ all in the red. NASDAQ 100 index in correction territory. Traders driving stocks down ahead of the weekend on concern that a protracted war in Iran will keep oil prices elevated. Right now, the S&P is at 63.92. The S&P down 1.3%. Dow Industrials down 587, drop there of 1.3%. NASDAQ down 1.8%. The NASDAQ 100 index down 1.6%. All of this with the VIX above 30, the 10-year at 4.41%, the 2-year 3.91%, and gold is up $100 the ounce, up 2.5%. Spot gold now at $44.86, while West Texas Intermediate crude up 4.4%, $98.64 a barrel. Brent crude right now up 3.4%, $111.68. Carnival Corp has cut its full-year profit outlook as surging crude prices are driving up fuel costs. Carnival shares, they're down 3.9%. Rivals Royal Caribbean down 3.9%. Norwegian Cruise Line Holdings down 6.2%. Recapping, stocks move lower. The NASDAQ 100 index in correction territory. S&P down 1.3%. And West Texas Intermediate crude 98.63. Right now up by 4.4%. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, I appreciate that. Charlie Pellet will have more coming up top of the hour, 2 p.m. Eastern, with his view on the Friday trade, which is not getting better as the day goes on. Much of that has to do with the situation in Iran, and we'll have the latest for you again on the late edition of Balance of Power. The president might be speaking again in a short time. He's leaving the White House, having spoken to farmers on the South Lawn. He's now headed out of town to Miami, where he's going to be speaking at an investment conference a bit later on today. He's scheduled to start talking after the close, but we could get some driveway remarks from the president. And of course, we'll be listening, as always, to Jeff, who checked in, watching us today on Bloomberg TV, with the big question that we get from a lot of listeners and viewers, those of you who see us on Balance of Power on television or on YouTube. I can tell you it's real. The question, is Rick Davis's dog that sits on the leather chair behind him real, or is it fake? It's not AI, and no, that's real. Bindy's a celebrity. With our eyes on Capitol Hill today, it looks like a deal to fund DHS that everyone woke up feeling very optimistic about may have just been dashed in the House. The Senate was up almost all night, 2:30 in the morning. Eric Wasson was there as they passed the bill on a voice vote to fund DHS in its entirety except for ICE. The plan was Republicans would come back and do that through reconciliation later on in the year, even though ICE has plenty of money. But it would get DHS open again, get TSA agents paid. Passed the Senate, as I said, in the middle of the night. It took a lot of cajoling. Day-long, well into the wee hour meetings in John Thune's office. And the whole thing just crashed on the rocks in the House, with Republican leaders saying no, and mainly the Freedom Caucus, no, not going to pass a vote, in this case, a bill that does not fund ICE. And so we have a stopgap here. And the fact of the matter is, any bill that would have been different from the Senate would have been a problem, because senators have already left town. So it looks like this is going to drag on for some time. Eric Wasson is with us now, Bloomberg congressional correspondent, with the very latest on this. Eric, I hope you got some sleep here, because it looks like we're far from done. Is there a chance this could be rescued today, or is it all up in smoke?
There is a chance. It's a very fluid situation. Speaker Mike Johnson's on a call with his members. Certainly the Freedom Caucus wants this 8-week stopgap bill that would fund all of DHS. It's dead on arrival in the Senate. Chuck Schumer just issued a statement saying that House Democrats wouldn't go for it. But it's not really clear that the House could even pass an 8-week CR. Moderates in Johnson's party are pushing back on the call. So this is going to be potentially an embarrassing attempt on his part. He had scheduled a press conference at 1 p.m. to announce this plan. That was put off, and we were all told to come back later. So it's a very fluid situation. Certainly, if they stick with this plan, the shutdown would continue. I will note for air travelers, the president did issue, or is about to issue, an executive order paying TSA agents. So I think, no matter what happens with the House and the Senate this weekend, the airline situation should abate as TSA agents are starting to get paid. It's not a fund. It's a fund about $10 billion. It probably won't pay the full year, but it could last for several months to pay those agents.
I'm really glad you mentioned that, Eric. We're going to talk to Congressman Troy Downing in just a moment, but to clarify, the president did late yesterday drop this executive order to pay TSA agents. So even if the agency stays closed, if senators don't come running back to town, or if there isn't a different vote in the House today, agents know that checks are coming. And would that be retroactive?
I believe it would be retroactive. It should stop the staffing shortages, the sick outs, and other problems that have caused these massive 3 or 4 hour lines. But there are other elements of DHS, whether you're in the Secretary of Homeland Security's office, whether you're working on other projects related to Border Patrol, that are not actually patrolling the border but supporting them. Those guys are not being paid, and it's unclear if there's a legal authority to pay them through an executive order. So I think there's certainly some motivation for moderate Republicans, and certainly there's a motivation for Senate Republicans just to, in the middle of the night, agree to fund most of these agencies. And again, the thing that passed the Senate funds everything except ICE and Border Patrol, and those could be backfilled through a special budget process later.
Boy, Eric, you've been great. I guess we'll sleep when we die. Eric Wasson reporting for Bloomberg throughout the night on Capitol Hill. I mentioned the gentleman from Montana. It's one thing if you're a congressman from Virginia or Maryland or even New York. If you're a congressman from Montana, you don't have any choice but to get on an airplane. And Troy Downing will tell you all about it. He's the Republican representing Montana's 2nd District, a U.S. Air Force veteran who was deployed twice in Afghanistan. Congressman, it's great to see you back on Bloomberg, and we appreciate the time today. I don't know how you're feeling about heading to the airport at this point, but what do you think about everything that has transpired in the House today? Would you have voted to approve that Senate bill if it got to the House?
Well, let's just go back to the beginning of this. I mean, what's happened is politics has taken the place of policy. And obviously, when we started out, we had the great work that were done in appropriations on both the House and Senate side. We had a bipartisan, bicameral bill to actually get our 12th appropriation bill through. And then the Democrats completely blew this up in the Senate. And we've been, 42 days now that DHS has been unfunded. And it's clear that they put politics above public safety. And not just public safety, but just the welfare. Think of all those TSA agents that are now, continue to go unpaid. Think of, all the issues with the Coast Guard, with FEMA, with everything that falls under DHS. And I'll tell you, what we've done in the House is we have continued to pass a bill to fund DHS in its entirety as we got out of committee, bipartisan and bicameral. So, of course, there's some heartburn about passing this.
Okay, so can I get back to that question, though? I mean, we're steeped in this wonky stuff every day, Congressman, and we understand the stakes here and the rhetoric that's coming from both sides. Is there a way out of this today, or is everybody going home for another couple weeks?
Well, what I understand is going to happen now, because we've had conversations about, trying to get a vote on suspension on whether we could get, the votes to get that through or not, whether we had to go through the rule process. But what I understand now is there is a CR that's on the table that will be an 8-week continuing resolution so that we can continue, so that we can fund everything that we need to fund and give us 8 weeks of time to actually negotiate and try to get some good policy through and hopefully cut through the politics. And what we're expecting now, I believe, if they haven't started, that at some point today, the Rules Committee is going to meet to try to get this through for this CR. And I've heard it's possible that we'll vote on that as early as tonight. It may be tomorrow, but this is Congress. Who knows what else might be thrown in there, but that's the current expectation.
All right, we're going to the source here. This is really fascinating, Congressman. Is the Republican conference largely or entirely on board? And if this passes, do we think the Senate comes back to vote on it?
Well, I mean, the Senate that's a big who knows. But what I'm hoping is that we can get everybody on board, because this is critical. As I mentioned, it's become very political and not about the policy. We need to get this agency refunded for all the reasons I've already articulated. But if the Senate continues on this path that they're willing to put the politics ahead of the people and not actually pass this bicameral, bipartisan bill that they've already agreed to, I'm not sure where we get to at this point. But we continue to pass this bill in the House as everybody's agreed to. We're going to continue trying to do this and hopefully calmer heads can prevail if we get this CR passed and have that 8 weeks to negotiate a final version of this.
Really interesting. It's a long ride to Montana, Congressman. I know you got to wait in some lines here. And I'll remind our listeners and viewers, you deployed twice in Afghanistan as an airman. And I'm wondering your thoughts right now. That first batch of Marines. Go ahead if you want.
I was in a combat search and rescue squadron. Sorry, I stepped on you there.
Yes, sir. No, not at all. I just say airman as a member of the Air Force. We've got troops on the way right now. That first, as I understand it, first Marine Corps Expeditionary Unit could arrive as early as today, and others are on the way. There's a Wall Street Journal report out today, whether it ends up being true, that the Pentagon's considering calling up another 10,000 troops. As probably the only person I'll speak with today who's been deployed in harm's way, I'm just wondering where your head is on all of this. If you're worried about these men and women, or if they are exactly what's needed to apply pressure at the negotiating table.
Well, you never take the decision to put boots on the ground lightly. And there's always concerns about that. And what I come back to in this is you've got to weigh the risks, not just to our allies, not just to the region, but to the United States of America and to this planet in having a terrorist Islamist regime that has access to nuclear weapons. And we needed to make sure that we completely foreclosed on their opportunity to do that, and to make sure that they continue to comply and not be developing that. We needed to make sure that we were taking out their ballistic and their naval capabilities. So now move to where we're at right now. Obviously, there's been a lot that's happened since this started. And we need to find a way of opening up the Port of Hormuz. And I think that we're starting to move on that line. Nobody takes sending troops into harm's way lightly. But the other part, the alternative, is having a terrorist Islamist regime that has access to nuclear weapons. And whether they can send those ballistically or send them in containers or some other way, it still puts this planet at risk. And I think that we need to make sure that we completely foreclose on that opportunity for them.
Well, most analysts have told us it will require actual people. It will require troops to get our hands on that enriched uranium that has gone missing. And apparently that is, in fact, one of the objectives that the White House has here. Was it a smart move for the president to give this another 10 days?
Well, as it should be, because the concern is now, I've heard different numbers of 60% enriched uranium. And the ability to get that to weapons grade it's pretty close already. So we need to make sure we're pulling that out so that it's not used. Like I said, even if you've completely disabled their ability to send anything ballistically, that doesn't mean something's going to be, sent and harm us in a much bigger way, in a shipping container or some other means. So we need to make sure that that's all accounted for and or destroyed, but obviously if we can get in there and pull it out so we know that they don't have access to any material, I think that's the best outcome we can get to. And as the president said, and as we've said from the beginning, the goals here is to make sure that they never have the capability of nuclear weapons, they don't have ballistic capability, and they don't have naval capability, and that's that last part of the stated goals.
Are you glad the president gave this another 10 days, or should he be less forgiving?
Well, I'm not going to, speculate on what intel the president had access to make that decision. But I will tell you that I have faith in this administration in doing the right thing and making sure that we prevail in our stated goals in this operation. And you don't ever want to be overzealous and put anybody in harm's way that you shouldn't, but you need to make sure that we are getting to that stated goal. And as everybody said from the beginning of this, this is not intended to be, and we don't expect it to be, a prolonged operation, but we do need to get those stated goals, and I'm still confident that we can do it without this turning into a long, drawn-out deal.
He is a member of the House Financial Services Committee, Small Business, Natural Resources, and an Air Force veteran. Congressman, it's good to have you back as part of our conversation. I appreciate the insights. It's Congressman Troy Downing, the Republican from Montana. Facing a long airplane ride home whenever this resolves, and it looks like it could go into tomorrow based on what the congressman just told us. Fascinating, again, to get it from the source. With Republicans in motion today in the House, it appears they will not be accepting the bill that was passed in the Senate to fund DHS with the exception of ICE. And again, fluid. As Eric Wasson told us, anything could change by the end of the day. And as Rick Davis predicted this hour, the House will pass that Senate bill before they leave. We don't know if that's going to happen. But right now we've got an 8-week CR for DHS. It does fund ICE. That apparently will get to the floor, according to what the congressman told us. Whether or not senators come back to address it is another thing. That executive order the president put forth to pay TSA agents might be the only way they get a paycheck anytime in the near term. We'll address all of this and have the latest for you in the late edition of Balance of Power at 5 p.m. on Blue.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Good afternoon, everybody. Live on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We're streaming on YouTube as well. I'm Tim Stenivek, along with with, wait a second, that's not Carol Masser. Bloomberg News cross-asset reporter Isabel Lee is in for Carol Masser on this Friday. And Isabel, you chose quite a day to come in with equities under pressure. We're seeing sort of the worst streak of weekly losses for the S&P 500 since 2022. Cross-asset, it's not looking pretty.
It's not looking pretty, and you forgot to mention the NASDAQ, which has officially entered the correction territory. Brent crude up by around 111 per barrel, and the VIX hovering at around 29. It's an exciting day, Tim.
It is, and you know, all of it emanating from the Middle East. Strikes from both sides continue after President Trump's deadline extension, and that is the backdrop for our program this afternoon. We're going to have the latest on the Iran war from Washington and the signals that the president is sending to the Middle East. On that, an expert in Iranian drones and nuclear facilities, Spencer Faragasso, joining us to discuss the prospect and practicality of a denuclearized Iran. Also, the conflict sending borrowing costs higher. Kathy Jones is stopping by from Charles Schwab on the outlook for bonds and the bond market. All that and more coming up over the next hour right here on Bloomberg Business Week Daily. First up, though, on that trade and the pressure that stocks are seeing, Charlie Pellet is in the Bloomberg Business Week studio. Hey, Charlie.
All right. I thank you very much, Tim and Isabel. Lows of the day right now on the S&P 500 index, a familiar phrase that I've been using for several updates today. Right now, we've got the S&P down 90 at 63.86. So the S&P now falling below 6,400. Right now, looking at a drop of 1.4%. The Dow also down 1.4%, tumbling 667 points. S&P, by the way, on track for its fifth week of losses. NASDAQ down 417. The NASDAQ Composite Index down now by 2%. And as you mentioned, correction for the NASDAQ 100 Index down now by 1.7%. That defined as a drop of 10% from a recent high. 10-year, 4.42%. The VIX above 30. The 2-year yield, 3.90%. Gold is up $119 the ounce, up 2.7%. $44.95 for an ounce of gold. West Texas Intermediate crude, $98.50 for a barrel, up 4.3%. Brent now above $112 a barrel. Brent up by 3.9%. Oil majors also gaining as crude moves higher. ExxonMobil up 3.1%. Chevron up 1.9%. ConocoPhillips up by 0.7%. So again, recapping the Dow, the S&P, NASDAQ all very much in the red. S&P down 1.4%. West Texas Intermediate crude 98.71 a barrel. That, Isabel and Tim, is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Now to the latest out of the Middle East, and to our live blog we go, where it's reporting that strikes from both sides continue after President Trump's deadline extension. The U.S. and Israel hit nuclear and steel facilities in Iran. Tehran threatened retaliation against steel plants, and stocks are lower as Brent crude is higher, hovering around to $112 a barrel. The Strait of Hormuz remained largely closed to shipping. I want to bring in Ian Marlowe, Bloomberg News national security editor. He joins us from our Washington, D.C. bureau. Ian, I want to go back to what we heard yesterday after the market closed from President Trump, pausing the period of energy plant destruction by 10 days to Monday, April 6, 2026, 8 p.m. Eastern time. The markets, we saw oil fall on that. We saw futures move higher on that news. And then fast forward to today, and it seems like things are not cooling down at all in the Middle East. What's with the mixed messages, the mixed signals?
Yeah, you know, I think they seem to be pretty closely related in the sense that anytime stocks fall too much, oil prices rise too much, you hear signals from the Trump administration that talks are going well, negotiations are happening, the war is not going to last very long, and then you see market reactions. At the same time, we know that the market is anxious about unclear U.S. strategic goals in this conflict. There's not a lot of things the U.S. can accomplish short of opening the Strait of Hormuz now that would have a significant long-term impact. And so at the moment, there's no clear rationale or endpoint for the war short of Iran just acceding to U.S. demands. And the 15-point plan that we've seen put forward by the U.S. seems to have a lot of the demands in it that Iran rejected in the talks leading up to the U.S. and Israeli strikes that opened this war. So it's, we've seen a sort of very obvious interplay between, Trump's comments, administration comments, and oil and stock moves in the sense of just Trump trying to calm markets, essentially. And we've got a lot of mixed messages from different officials in the administration and from Trump himself, sometimes in the same day. So there's a lot of confusion and not a very clear end state in terms of where we get to, with this conflict right now.
So is the U.S. actually signaling flexibility here when it comes to enrichment and sanctions? And from Iran's perspective, why the hesitation to come back to the table?
Yeah, I think in the 15-point plan the U.S. put forward, there's all sorts of things that basically go against what Iran has been doing for the last 40 or 50 years. Not supporting militant groups across the Middle East. Curtailing its nuclear program, curtailing its ballistic missile programs. All of these things are things that they have slowly built up over time, to give themselves a security posture that they feel comfortable with. Obviously, the U.S. and the West don't want Iran to be doing any of these things, but as we've seen from previous U.S. administrations, this is a tough thing to get Iran to agree to. We've seen things from former U.S. officials saying Iran is a problem to be managed, not necessarily a problem to be solved. And the issue here was the U.S. going into those talks ahead of the war, with these extremely maximalist positions, asking Iran to basically give up everything to get nothing, essentially. And, Trump was the one who pulled out of the Iran deal that the U.S. struck with Iran before, and has bombed Iran twice now in the middle of talks. So you can see from Tehran's perspective that, they don't necessarily see the U.S. as a trustworthy negotiating partner, and vice versa, given all of the Iranian attacks on U.S. troops and personnel over the last few decades. So there's a lot of ill will, and right now, one of the key aims of the war seems to be to open the Strait of Hormuz, which was something that did not exist. It was a problem that didn't exist before the war began. So we're in very strange strategic territory right now, where the U.S. is asking for stuff it had wanted in talks that it themselves abandoned in order to start a war, which then created more problems, which the U.S. is now trying to address with talks. So it's a bit of a confusing situation for a lot of us following this on a day-to-day basis, and you can see the markets just sort of gyrating back and forth here with every utterance from the White House, which may indicate either it's escalating or talks are going well.
Well, Ian, on the view from Tehran, I want to bring up a post on X from Abbas Araghchi, Iran's foreign minister, who writes, just in the last few minutes, Israel has hit two of Iran's largest steel factories, a power plant, and civilian nuclear sites, among other infrastructure. Israel claims it acted in coordination with the U.S. The attack contradicts the president's extended deadline for diplomacy. Iran will exact heavy price for Israeli crimes. Does this contradict that extended deadline for diplomacy that we heard from the president yesterday, these attacks on infrastructure?
Yeah, it's not clear. I mean, obviously, essentially any attack on any civilian infrastructure in wartime is essentially a war crime. And the deadline that Trump mentioned was specifically related to power plants, presumably that the U.S. themselves wanted to hit. This is not necessarily the first time we've seen U.S. and Israeli war aims diverge. That's been an issue from the very beginning of this conflict. But you're right in the sense that, the U.S. and Israel are in this together. Iran sees them as linked. They are only engaging at the moment with the U.S. side, seemingly on talks. The commentary out of Israel from Benjamin Netanyahu and others is that this war is very much continuing. They have their own goals in Iran that are different from the U.S. And so this is not the first time this has come up as a problem. And if Iran is seeing it that way, it could be an issue for this deadline and this sort of the talks. Although again, this deadline is a bit amorphous in the sense that it keeps getting extended. as Trump kind of seeks off ramps here to a conflict that is just totally rocking markets. Israel has come out and said that they did hit some of these nuclear facilities, but their justification for that was that these were plutonium sort of enrichment related facilities, not civilian nuclear facilities. They were designed for weapons grade material.
Very quickly here, we're hearing the 15 points versus 5 asks. Is there actually any real overlap to work with?
I think there are things on both of those lists that we know are red lines for both sides. I cannot imagine, for instance, U.S. taxpayers or Israeli taxpayers supporting war reparations for Iran to help rebuild some of Iran's facilities, for instance. That's one of the Iranian asks, as is sovereignty over the Strait of Hormuz, which it didn't have before the war. So, there's no way the U.S. is going to agree to those. And so that's why, to some degree, you're seeing this this escalation, this intensifying of the conflict, even as we see, Trump repeatedly saying he wants a ceasefire. I think the reality here is that we're not in traditional peace talks. We are in talks between two extremely hostile, long-term geopolitical enemies, and even as part of the ceasefire deal that Trump is trying to push, there are massive asks in there for Tehran, and so there is basically no way Iran will agree to this unless military, like in the U.S. mind, unless pressure is brought militarily. Okay. So that's the kind of issue we're dealing with right now.
Ian Marlowe, really appreciate you joining us. Ian is national security editor for Bloomberg News, joining us from our Washington, D.C. bureau. I want to drill down on some of those nuclear headlines that we saw. The Kondab heavy water research reactor targeted twice by U.S.-Israeli airstrikes. That's according to the semi-official Fars news agency. And Iran said its yellow cake production plant in Ardakan Yazd province was targeted by U.S.-Israeli strikes on Friday afternoon. That's according to state-run Now News, who cited the Atomic Energy Organization of Iran. For more on this, we're bringing in Spencer Ferragasso, senior fellow at the Institute for Science and International Security. He specializes in Russian-Iranian advanced conventional drone systems and nuclear facilities in Iran and North Korea. Spencer joining us from Washington, D.C. Spencer, I want to start with those two headlines. And you specialize in looking at satellite imagery, understanding the extent of damage from attacks and what's actually happening at these facilities. I know it's still early days, early hours at this point, but what can you tell us about the yellow cake production plant in Yazd province and the Kondab heavy water research reactor that was targeted twice, at least according to semi-official news agencies?
Yeah, well, first off, thank you for having me on the show. Really appreciate it. So the Kondab research reactor is also known as the Iraq IR-40 reactor. It was a reactor that was built many years ago, possibly for the intention of producing plutonium. And plutonium is one of the key resources that are used in producing different types of nuclear weapons. For example, during the June 2025 war, it was targeted. The dome of the building was penetrated, and likely the reactor was destroyed. It wasn't operating at the time, so there's no release of radiation, et cetera. Israel at the time also attacked the heavy water plant. They damaged one of the last stages in the heavy water production. Heavy water is a very important chemical compound that is necessary to operate heavy water reactors. It's also a source of neutrons in a nuclear weapon. So destroying this facility is incredibly important to creating bottlenecks in Iran's future ability to create nuclear weapons. What we saw at Ardakan is also similar. Ardakan was used to convert natural uranium into yellow cake. And yellow cake is what's converted into uranium hexafluoride, which is ultimately enriched to higher and higher levels and possibly weapon grade levels. So we're seeing Israel eliminate certain stages and steps and that are vital for Iran to be able to continue its enrichment program and wider nuclear program.
Are there any key red lines the international community is watching when it comes to this?
Necessarily, it would be the enrichment up to 90%. That has been stated to be a massive red line that if Iran touches that, in the past, obviously, many past presidents have stated that that would trigger strikes. But the key here is that Iran hasn't reached that yet. But what Iran has been doing, they've been accumulating very large quantities of 60% highly enriched uranium over the last several years. They're the only country in the world that does that doesn't have a nuclear weapon. There's no civilian application for that type of enrichment. So there's no justification whatsoever.
Spencer, can the U.S. and Israel destroy Iran's nuclear facilities without endangering bystanders through the release of radioactive material?
Yeah, certainly. You wouldn't want to target something like a Bushehr-style nuclear reactor. That would have very large consequences. You wouldn't want to hit the actual reactor itself. But the other facilities, such as Fordow, Natanz, Esfahan, et cetera, those are relatively isolated facilities. They're a good distance away from populations. And the actual risk of dispersion on a wide level is relatively low. It would be very isolated to the facilities themselves.
Do the attacks in recent days on these facilities, do they call into question the official U.S. assessment or of the damage assessment of the June 2025 strikes? Because I think a lot of folks thought, okay, well, based on the rhetoric and what we heard from the president at the time, the nuclear program in Iran was set back quite a bit.
Yeah. So, we had some issues with that initial assessment. I think you're referring to the assessment that said it was only set back a few months. We had some issues with that. Our analysis stated that the program was severely set back. The June 2025 war effectively destroyed Iranians' enrichment program, and enrichment is a bottleneck in the ability to produce a nuclear weapon. If you cannot get to 90% weapon-grade material, it's very hard to build any sort of usable nuclear weapon. 60% highly enriched uranium, technically, theoretically, can be used to build a nuclear weapon, but it's not practical. It's very hard to deliver. It'd be a very large device. But what Iran had plans to do during its Ahmad plan, and that was ended in 2003 explicitly and continued in a more covert form, was to build missile deliverable miniaturized warheads that would fit on a Shahab-3 ballistic missile. And so that's a very different thing. Our assessment was that their program was severely set back, and it would take years for Iran to recover what they actually lost. But that doesn't mean that Iran doesn't have options. So after the war, there's a few outstanding elements that were left over. For example, obviously, everyone's talking about the highly enriched uranium. Half of it, the 220 kilograms of the 60%, is likely in the tunnel complex at Esfahan. There's a lot of talk and chatter about that right now. Iran also produced a number of advanced centrifuges that they built but likely never deployed. So there's questions about where is that, and then the wider state of what's the actual accounting of all this. The IAEA has not been allowed to conduct inspections on the ground. So there's significant questions here, and it leaves Iran options for the future.
Spencer, gonna have to leave it there. Have a great weekend. We got to get you back on the program soon. Spencer Faragasso, Senior Fellow at the Institute for Science and International Security. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ 100 index, all in the red. NASDAQ 100 right now in correction territory. And U.S. stocks trading very close to session lows. On the S&P, we're below 6,400, 63.85 right now, down 1.4%. For the S&P 500 index, a drop of 91 points. The Dow down 687, a decline there of 1.5%. The NASDAQ Composite Index down 406 now, down 1.9%. The NASDAQ 100 Index down 1.7%. The 10-year at 4.42%, with the 2-year 3.90%. Gold up $130 the ounce. Spot gold 45.06 the ounce, up 3%. West Texas Intermediate crude closing in on $100 a barrel again, 99.81 right now. WTI surging 5.6%. Barrel of Brent above 112. Brent crude right now up by 4.3%. Citigroup shares down 4%. Citi's top executives are weighing buying another bank, a move long considered inconceivable as the firm wraps up years of work to address regulators' criticisms. Again, recapping, stocks move higher. We've got the NASDAQ 100 index in correction territory. Oil is surging. West Texas Intermediate crude 99.75 a barrel now, up by 5.7%. I'm Charlie Pellet. Tim and Isabel, that is a Bloomberg Business Flash.
Hey, Charlie, thanks for that update. Some of those superlatives worth repeating. The S&P 500 on track for its longest streak of weekly losses going back to 2022. The NASDAQ 100 falling into correction territory. The yield on the 10-year climbing toward its highest since July. The war in the Middle East driving up gasoline prices. Data showed today that U.S. consumer sentiment slid to a 3-month low in March, and year-ahead inflation expectations jumped. I want to bring in Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research. She joins us from New York. Kathy, welcome. I want to start with the war. You write that it is inflationary. I think we're all seeing that happen right now, at least when it comes to oil prices and the way that oil flows through to the rest of the economy. What's the bond market telling us about how inflationary it will be ultimately?
Yeah, what we've seen is the way we look at it, Tim, is through the TIPS break-even rates. Now, that isn't necessarily the best measure, but it is one way the bond market tells us what it's expecting. And those break-even rates have moved up, particularly for shorter-term TIPS. They're, pushing 5% or so for 1 year. So it's implying that the market is expecting an inflation rate, at least on a short-term basis, to move all the way up to as high as 5%. The longer-term break-evens are still pretty well behaved, maybe around 2.5%, but they have come up. So what we've seen is the expectations about inflation move higher across all tenors, but particularly across the short-term tenors. And you can look at other measurements in terms of expectations. I think the bond market, though, is really speaking loudly right now that the big fear is inflation hitting us due to the war.
And in private markets, spreads are widening. How much of that is growth versus just really the stress in the private credit space?
Yeah, there's a combination of things going on here. So kind of coming into this, we've seen spreads were really compressed, really tight. So anything that didn't work out perfectly was probably bound to cause them to widen. I think now between the woes in the private credit area and the expectation that we're going to see some weakness in earnings amongst various companies that might be caught in this, in the after effects of the war or the downside of what the war may do, starting to widen those credit spreads. It's also probably just a general risk aversion taking place as investors just pull back. Credit spreads tend to be correlated somewhat with equities. We're seeing equities come down. I think it's just a risk aversion taking place.
Why, Kathy, do you think that treasuries are not being viewed as a safe haven asset right now?
Yeah, it's got to be somewhat disappointing, I think, to a lot of analysts who thought perhaps we'd see a run into treasuries. But I think the primary mechanism that we're dealing with here is the inflation pressure that was already building up coming into the war from, the fiscal stimulus from the One Big Beautiful Bill and the fact that inflation's been above target, the Fed's target for 5 years now. I think that there's not, the market's not as comfortable with treasuries as a risk off right now because of those factors. And the Fed is not indicating an aggressive rate cutting cycle because it's not yet a financial market risk. But, I wouldn't rule it out down the road if financial conditions tighten enough, if there's enough worries about economic growth down the road that we could see treasuries rally. I do think we're getting to valuations that discount a lot of negative news, but in terms of flight to safety, the dollar's gone up, but we haven't seen a whole lot else in terms of the treasury market.
So talk a little bit, if you could, Kathy, about what it would take for you to see investors flock to treasuries as a safe haven. Like, what financial conditions would need to tighten? What would need to change?
Well, I think it could go one of a couple ways. So on the one hand, if we had a severe enough sell-off in the stock market or in risk assets, where we started to see the potential for the Federal Reserve to come in and provide some sort of support, then I think you'd start to see treasuries rally. And again, we may not be too far from that, because if conditions tighten enough, then the economy is going to take a hit, and that would pull the Fed in. A second way that it could occur, though, is that, we do start to see the war and, these tightening conditions really, really depress expectations for economic growth. And then we'd start to see people move out on the yield curve, looking for something that would benefit from slower growth. But again, we're just not there yet.
We're seeing a bear flattening in the yield curve. What should investors take away from that signal?
Yeah, again, this is kind of a not great signal for Treasury investors right now, the bear flattening. We've been in a steepening, which was, I think, generally, we had been talking about the steepening for about a year or so, as the expectations were for the Fed to cut rates, but inflation to remain sticky, and that was keeping the curve steepening. You add in the rising debt levels, deficits, financing, that's happened. Now we get a little bit of a bear flattening now. I think that's more driven by all the focus on the short end and seeing those yields move up to compensate for inflation expectations.
So the Fed and where the Fed goes from here, there are a lot of questions about what the actual next move at the Federal Reserve will be, higher or lower. What do you think it'll be?
Well, I think they'll try to stay on hold as long as possible. So I think they're trying to navigate this by doing very little and saying, well, we're positioned okay for now. This thing could go one way or another. We don't want to make a mistake. And again, if the war continues and we continue to see upward pressure on prices, oil prices in particular, then barring a big decline in the economy or rise in unemployment, the Fed may actually have to pivot towards hiking rates. I don't think that's the most likely outcome, but it is now on the agenda, I would say, because of the inflation pressure and the rise in inflation expectations. So a lot's going to depend on the labor market, but I would say no change in policy for the rest of this year, barring a big surprise. And maybe we're building in the potential for a rate hike somewhere, late in the year if things continue. But it's such a highly volatile environment, both from a policy perspective and a market perspective. I think for the Fed to try to make a call now, let alone, us spectators, is really difficult.
It does seem like the Fed is relatively calm about long-term inflation. Do you think that the market, though, is underestimating that risk?
Yeah, I think the Fed, Fed Chair Powell has frequently pointed to those break-evens in the TIPS market as an indication that inflation expectations are well anchored. And I take a little bit of issue with that because particularly you go out in the tips market, the liquidity isn't great, and it's easy to latch on to an indicator that maybe provides some confirmation bias for you. There has been a divergence if we look at survey-based, say University of Michigan survey inflation expectations. Seen short run, inflation expectations rise very sharply, and then the longer run rise, but not as sharply. That may be a better reflection right now of where inflation expectations are than the break-even rates. Again, the Fed is taking comfort in those break-evens. I would say I would look to the survey-based right now, because the longer inflation stays up and goes higher, the more those expectations get built in, and the longer it's going to take to unwind them. So I think the Fed may be latching onto something that may not be as strong an indicator as they would like.
Hey, Kathy, before we let you go, I just want to take a moment to recognize the incredible career that you've had. You're stepping down, or retiring, I should say, from Charles Schwab and from the industry at the end of this month. And we're gonna talk a little bit about that. But before we do, this moment in the context of your career, it's a really complicated one. And you're sort of, I think it's fair to say, at least when it comes to the news cycle, you're going out on top. But how do you view this moment in the context of your career?
It's one of the most complicated situations I've experienced, and I've been around a while, so I've experienced a lot. All the way from the commodity markets of the late '70s, early '80s, and that was crazy. The flash crashes, the big crashes in markets, the Asian currency crisis. I mean, you name it. Certainly the great financial crisis. I've seen a lot. This is not as severe as some of them, because I think the economy was in decent shape coming into this. But I think from a policy-driven perspective, it's one of the most complicated, because it really wasn't signaled very much in advance that we were doing this. We were at a kind of pivot point in terms of trying to get inflation down. The global economy is feeling a lot of inflation pressure and was coming into this. So we've had a combination of policy issues that are hard to unwind, along with market issues that are hard to unwind. And I would say this is one of the trickier that I've seen in my career.
Well, Kathy, we are so grateful for all the time that you took with us to join us here on Bloomberg Business Week. You've had an incredible career, not just at Charles Schwab, but at Morgan Stanley, at Citigroup, at Prudential Securities, and more. And we're grateful for you spending so much time with us. Carol wishes she was here. I promised we would say goodbye to you for her, and she sends her best. So don't be a stranger. Enjoy retirement. Enjoy hanging out with those grandchildren. And we will see you, hopefully, sometime soon. Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research. Kathy, thank you so much. All right, well, let's take a look at what's going on with markets right now. We talked a lot about fixed income just now, but don't forget the equity market under pressure, down 1.5% on the S&P 500. This is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ very much in the red. NASDAQ 100 index now in correction territory, and the S&P 500 index is on track for its fifth week of declines. The S&P down 95 right now at 63.81, falling below 6,400 this Friday. The S&P is down 1.5%. Dow Industrials down 717. The Dow is down 1.6%, and a 2% drop now for NASDAQ. The NASDAQ Composite Index is down 418 points. NASDAQ 100 in correction territory with a VIX now closing in on 31. The 10-year 4.43%, the 2-year 3.91%. Oil surging. West Texas Intermediate crude up 5.1%, up 4.79 a barrel, 99.31 right now on WTI. A barrel of Brent over 112.23, up right now by 3.9%. And gold up 3%, 45.18 the ounce on the precious metal. Microsoft stock on track for its worst quarterly performance since the global financial crisis due to concerns about investments in AI infrastructure and potential disruption from AI startups. Today, we're looking at shares of Microsoft, and they are down now by 2%. Recapping, West Texas Intermediate crude, 99.25 a barrel, up 5.1%. The NASDAQ 100 index in correction territory. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. The S&P 500 down by about 1.5%, bouncing off its worst levels of the day, but hovering close to those lows. The Dow down 1.5%, the NASDAQ Composite down 1.9%. Charlie talking about the NASDAQ 100 being in correction territory, down 10% from recent highs, down right now by 1.7%. We do also have a redhead crossing the Bloomberg terminal. President Trump signs a memo directing use of funds to pay TSA staff. We'll bring you additional information about that, and also reporting around whether or not that helps with those delays in those TSA lines at airports in the coming future. I want to continue our coverage of the latest out of the Middle East and the war in Iran. It's affecting markets with stocks lower, oil higher, a drop in treasuries stalled. Suffice it to say, there's a lot for global business leaders to digest right now. That's where Angel Sass comes in. He's professor and director of ESADE Geo. It's the Center for Global Economy and Geopolitics at ESADE, the business school in Spain. Also with us, Dimitra Castaneda. She's Bloomberg Businessweek senior editor. She leads Businessweek's coverage of business schools. Angel, good to have you on the program. You are a business school professor, but you're also an expert in geopolitics, international business. The macroeconomic backdrop today, higher oil prices, barriers to free trade, increasingly countries looking inward. You teach a global community of business leaders who then become leaders, go out in this world. How are you looking at the backdrop today in the context of your research?
Great, thanks. Thanks for having me. It's a pleasure to be here. So I think there are two ways we're looking at it. So one is to understand where we're coming from and where we are. And I think one of the difficulties of today for business leaders is that we are stuck with global value chains that are hereditary from from those decades of open markets. And we're now in an environment which is not that open any longer. So you have many more vulnerabilities and risks around you. The second one is more short term. So what do you do? And I think there you can play with different scenarios. And I think what we were talking about in classrooms and with executives around in ESADE is to see how they can think about how long we're going to have this crisis, what are the different options, and basically I think it comes down to whether Hormuz is open or not, and how much long it can be closed, and then try to make sure what are the transmissions that can affect the transmission channels that can affect business strategy. And of course, there's oil prices, as you were saying, there's inflation, there might be effects on upstream in your value chain with critical inputs. It can be downstream with your exposure to markets. I think many business schools, for example, were open and doing business in the Middle East, and now we are on standby. And so and then finally, I think what we're seeing is this new economic security paradigm in its full strength, which is what we're seeing is governments intervening markets to guarantee their energy security. Unfortunately, not in a global in a global collective way, but at national level. So all these different companies are seeing how governments are interfering.
Well, let's just hit on that for a second, because oil prices, it's visceral. It's something that a lot of Americans see when they drive to work. It's not something Americans are used to. Other parts of the world, high gas prices are just that's the cost of doing business. The government intervention, it can only be successful to a certain extent. People, countries have strategic petroleum reserves or variations of that. You could subsidize, like we've seen in Japan, a little bit. What works?
So, well, I think what we have seen in the past is that what usually works is when we have a collective solution to a global problem. And in fact, that's why the International Energy Agency was set up back in the first oil shock, because countries had to coordinate, in particular oil-consuming countries, to coordinate collectively to make sure that you don't start a war, an economic war among countries by all of them starting to impose export controls and controls on exporting gas and their derivatives. So I think what we know is we need a collective action. Otherwise, we're going to go into a bigger thy neighbor sort of policies, and this can be a sliding slope.
And you mentioned the government intervention. It's been increasing, even in democratic countries, even in countries where you won't expect. I'm not going to name some. How do you think, is there a threshold there? And I know it can be hard to quantify, but if you use the case study of what's happening today to teach your students, what do you tell them?
Well, I tell them that the world globalized because countries decided that they wanted to globalize and open markets, and they wanted to respect markets. And that's where we were coming from. That's over. Today we have countries that are not that interested in keeping borders open. And secondly, they have given up on the principle of the sanctity of markets, for good or for bad. And so what is happening, and even before this very severe crisis, we already had many countries coming up with two types of policies. One is economic security policies, where you start to see how they are affecting markets, companies to check their value chains, make sure they don't get kid up with certain suppliers, which means they're really going down into the detail of how corporations operate. And the second one has been the way they go after industrial policy. So industrial policy is back in vogue.
Yeah, it is. Demetra, come on in here. I see you nodding.
Yeah, I was just going to say, I think that's a super interesting part of your research and the work you've done is what we've seen with the way that companies are going after this industrial policy and taking on, for example, lobbying more directly on their own rather than through associations or the way that we've traditionally thought about lobbying. And that's also another piece of this and something that Angel has spent a lot of time on.
Angel, is that specific to the United States or specific countries? Because when I hear that, I think, okay, lit bouton of Intel going to the White House, and then that Intel, over the summer, and then the big Intel stake that the U.S. took, and critical mining, critical minerals, the ties that the Trump administration has with the business community. Is this happening outside the U.S. too?
Oh, yeah. I think it's happening across the world. I think it's always happened. For example, in China, when China came up with Made in China 2025 back in 2015, we were all scandalized. Today, we're all doing our own industrial policy. So I think that's not only the U.S. The U.S. is, of course, very visible, had been a leader of the free market, had been a leader of the West in that sense. So when you see this in the U.S., it's really, really surprising to see certain policies. No, and then the other thing is that the more industrial policy we are seeing, the more companies need to then get involved to design those industrial policies, because industrial policy essentially means government going in and trying to affect and design markets in detail.
It's fascinating stuff, Demetra. I want to end with you because you oversee coverage of Business Week of business schools for Bloomberg Business Week, and business schools are, in recent years, have become so international. Recent decades, I should say. What is it like now as countries increasingly turn inward?
I mean, we're seeing that sort of trend towards the top U.S. programs are still the ones that are the most in demand and the most desired globally. But I think that anecdotally and even in terms of the data that we're seeing coming out of certain bodies, there's a lot more happening and movement towards international programs. Not just because of what's playing out geopolitically and maybe the type of programs and institutes you'll find in places like ESADE, but because of the sort of the perception that we are not really the most welcoming place for some of those students and what they're interested in pursuing right now.
Demetra Castanedis, Bloomberg Business Week senior editor. Angel Saz, Professor and Director at Asadi Geo, Center for Global Economy and Geopolitics.
You're listening to Bloomberg Business Week Daily with Carol Masser and Tim Stennebeck on Bloomberg Radio and Television.
It is Bloomberg Business Week Daily. I'm taking a look at the World Equity Index's function on the Bloomberg terminal, down 1.52% on the S&P 500, hovering around those lows of the session. The Dow down 1.6%. The NASDAQ Composite down more than 2%. The NASDAQ 100, which, yes, is in correction territory, down 10% from recent highs, down 1.9%. Taking a look at what's happening with oil, with the GLCO Go function on the Bloomberg terminal. WTI getting close to $100 a barrel, 99.48. That's up 5.3% today. Brent crude up close to $113 a barrel, 112.69, up 4.3%. That's the backdrop of the trade today. Yield on the 10-year hitting its highest going back to July of last year. I want to bring in Bloomberg's managing editor for Markets Live blog, Christine Aquino, to take a look at some stocks on the move today. We are joined by Christine Aquino here in our Bloomberg studio. Do you have anything, Christine, that's not lower today?
I do, actually. Okay. How about we start with...
Okay, we're going to have to wait for it.
Yeah. How about we start with a little bit of a Merger Friday
okay,
story,
that sounds good.
Right? Yeah, I want to talk about Brown-Forman. That is, of course, the maker of Jack Daniels. So those shares, the ticker BF/A for the Class A stock, up 4.9% today. So very much in the green, one of the few shares in the green. And that is because we did get news that Brown-Forman is in merger talks with Pernod Ricard, who is, of course, the maker of Absolut Vodka. And so potentially putting all of those brands together in one big company. And, you know, these are family-run businesses still. So the Pernod Ricard, the Ricard family very much still major shareholders in Pernod, and then the descendants of Brown-Forman founder George Garvin Brown apparently still largely control the group. And so, you know, we'll have to have the family's blessing. Any sort of merger, they're probably going to roll their shares into a new company if that comes to pass.
If it comes to pass.
Exactly.
A big family in Louisville, Kentucky, very well known, and I wonder if they will approve of this.
Yeah.
I mean, it comes at a time, and a really interesting time for the spirits industry. Do you go out like?
No, and you and I don't drink.
We don't drink, and that's we're the problem.
This is a sober table.
So
we're not the target.
We are a lot of fun on this Friday afternoon. This is the backdrop that, you know, these large liquor companies are facing right now.
Yeah, more and more, especially Gen Z, but I think we're millennials. Are you a millennial?
A geriatric millennial. That's what they call
Still
it.
counts.
Yeah, still
Yeah,
counts.
sure. We all don't drink.
All right, what else you got for us?
All right. Sadly, this is a stock that is down today. That is Palo Alto. So ticker PANW, down more than 6% at the moment. It's not actually because of news related to Palo Alto specifically, but actually news related to Anthropic. So we did get a Fortune report raising concerns that Anthropic's artificial intelligence model called Claude Capybara might be used by hackers to skirt cyber defenses. And so a lot of cyber stocks, including Palo Alto, falling as a result of that. We do have, you know, analysts on Wall Street saying that maybe the markets are misinterpreting what we're seeing in the report, but, you know, it tends to be the trend, especially for AI-related stocks, right? Like if there's any sort of whiff of bad news, especially in this environment, I think the instinct for a lot of traders is to sell first and then ask questions later.
Yeah.
And Palo Alto getting sideswiped today in that.
Is it bad that when I first read that news article, I thought, capybara? That's
Kind of
what caught my attention. Exactly.
Yeah.
And I thought, why did they name their...
I started singing a song from
Capybara?
TikTok.
Do you want to demonstrate?
I'll show you the TikTok later. It's the whole thing.
All right, so we've
have a last
TikToked a
one.
little bit. We've talked a little bit about the maker of Jack Daniels. Let's go on a cruise.
Yes, let's go on a cruise,
Nice segue.
specifically with Carnival, right? So ticker CCL. We did get results from that company today. So the silver lining is that first quarter results actually mostly beat estimates. EPS, sales, all looking good. The problem is that its outlook was disappointing for a lot of investors.
Was it due to higher fuel costs? Was it due to concerns emanating from the Middle East?
Yeah, definitely part of that is the higher fuel cost because, you know, our Bloomberg Intelligence analysts took a look and basically, you know, the guidance assumes, for March anyway, the guidance assumes that there's going to be a full year $500 million hit from higher fuel costs. And that's based on the assumption that Brent is going to be around $80 to $85 per barrel. But just before I came over here, it hit, well, it was over $100 already. And so, you know, the estimate is that it could be around 110, 150. So that's an upside to the fuel hit that the Carnival company is going to have to contend with.
There's this story by Bloomberg reporter Red Brown.
I love this story.
I know. I'm sorry if you talked about it yesterday,
didn't.
but it's wild. Cruise influencers make $350,000 a year, and they lure Gen Z folks. Maybe geriatric millennials. They'll also lure you. So
Yeah, we sometimes look at
they'll pay you
so.
$350,000. That's nothing.
No.
I mean, I would take that if
For
they
going,
invite me. Yeah.
taking some videos and going on cruises, not bad,
Yes,
right?
and we can have it approved by Bloomberg.
$350K. I mean, yeah, I would say yes to that gig.
Christina Kino, managing editor for Bloomberg Markets Live blog. For more conversations like this, check out our new Stock Movers podcast. Subscribe to 5-minute episodes on the biggest winners and losers in the stock market. You can check out Stock Movers on Apple, Spotify, or anywhere you get your podcasts. If you are long this market, you are not so happy on a day like today. We're pretty much at session lows, down 1.53% on the S&P 500. The Dow down 1.6%. The NASDAQ 100 in correction territory, down by 1.8%. This is Bloomberg.
is CBS News on the Hour, your home for original reporting.
I'm Jennifer Kuiper. House Speaker Mike Johnson calls a Senate-passed bill to fund most but not all of Homeland Security a joke and plans a vote on an alternative.
We're going to put a clean, simple, continuing resolution that will go until May 22nd to allow for all those who sacrificially serve the country and protect other Americans. All these agencies will continue at their current funding levels.
The TSA says yesterday was the highest call-out rate of the shutdown at almost 12%. At the Baltimore-Washington airport,
everything is fine. We're going to make it. I'm really, sad for the TSA agents who are having to go through this, and we're going to support them.
But according to CBS's Jason Allen at Houston's Bush Intercontinental Airport,
we have seen people filling this area downstairs, and now it's empty, just kind of one line of people going through there. However, still a line upstairs, and still out on the curb where people normally get dropped off, there are still huge lines out there.
President Trump is awaiting a response from Iran to a U.S. peace proposal. He has already claimed Iran has agreed it will never have a nuclear weapon, but Iran said that in 2015 and stated it again last year. CBS's Aaron Navarro at the White House.
CBS News has learned from multiple sources that Iran's response to the 15 points of agreement that the U.S. had sent earlier this week is expected to arrive later today. That'll be conveyed by an intermediary country, with Pakistan being the main one in the region leading in terms of connecting the U.S. and Iran in these indirect talks.
The president portrays himself as a great friend of America's farmers and ranchers. CBS's Linda Kenyon.
Speaking from a covered White House balcony on this cloudy, rainy day in Washington to farmers and ranchers seated outside on the South Lawn.
Rain, shine. The one thing about farmers, they don't care about that weather.
President Trump claimed he eliminated the estate tax for family farms and gave farmers billions from tariff income.
We love the American farmer. I just gave you $12 billion. I don't know if you know that or not.
Many farmers have been adversely affected by the president's tariffs, especially those who sell soybeans overseas, while the war against Iran has disrupted the supply of fertilizer. Linda Kenyon, CBS News, the White House.
The Artemis II mission, part of NASA's goal to establish human presence on the moon, is scheduled for launch on Wednesday, April 1st. Astronaut Christina Koch.
I am so grateful to those that paved the way for me to be here and for all of us to be here. And it's an honor to potentially inspire the explorers of the future.
It will be a 10-day mission. Stocks are down on Wall Street. The Dow has fallen 744 points. The Nasdaq is down 441, and oil is up 5%. This is CBS News.
I want to...
Hearts melted at a music award show last night. CBS's Deborah Rodriguez explains.
Love was in the air at the iHeartRadio Awards in L.A. when Taylor Swift picked up her prize for Best Pop Album.
This album probably also feels very happy and confident and free because that's the way that I get to feel every single day of my life because of my fiance, who's here tonight.
Travis Kelce in the audience mouthed, "I love you." Swift took home a total of 7 awards, including Artist of the Year. The Lovebirds, Swift and Kelce, danced to singer Ray's viral hit, "Where the H Is My Husband." Her husband-to-be, Kelce, was right there. Deborah Rodriguez, CBS News.
Farmers around the world are facing fertilizer shortages and rising costs after the war with Iran has disrupted shipments through the Strait of Hormuz, which handles a third of global fertilizer trade. Jennifer Kuiper, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
It is Bloomberg Business Week Daily, and we are at session lows on the S&P 500, down 1.62%. I'm Tim Stenivek, along with Isabel Lee from the Bloomberg News cross-asset team. She's in for Carol Masser this afternoon, and we're seeing risk-off across assets.
Risk-off across assets, you're looking at a market that we have stocks lower, bond yields are also dropping, NASDAQ is in a correction territory, and the yen, we haven't mentioned this ever, but we have the yen weakening to 160 for the first time since 2024. It's actually really a wild week, and Friday is even wilder. So we have with us joining is Eric Weiner. He heads a team, or is a senior editor in the equities team, but he can talk cross-asset. I just found out that he was in the cross-asset team where I am
was.
from.
We're going to get to Eric Weiner in just a few minutes. In the meantime, I do want to talk a little bit more about what's coming up on the program. A little later, we're going to be hearing from Joe Lovinger. He's Texas reporter for Bloomberg News, because CPAC is going on right now. And we're talking a lot, Isabel, about the conflict in the context of what the market reaction is, but there's some serious political implications too, at least when it comes to the Republican Party, because President Trump campaigned on no new wars, and to a lot of his supporters, this looks indeed like a new war.
I know, it's actually really interesting to see. I mean, a lot of investors and some traders we talk to feel betrayed. I feel like that's a strong word, but that's just one that pops into my head. But that's what they feel, because exactly to your point, he campaigned on it, and now look at what's happening.
Also, we don't drink.
We don't drink.
But it doesn't mean...
Should we ask Eric if he drinks?
Yeah, Eric, you might have to stay for 2 hours, because we got a wine guest coming on a little later on the program. We're looking forward to that as well. We got a great program over the next 2 hours coming up on Bloomberg Business Week Daily, but we are squarely focused on those markets. Charlie Pellet is standing by in the Bloomberg Interactive Broker Studios with an update. Hey, Charlie.
Well, hello there. We are at the lows of the day right now. Tim and Isabel with the Dow, the S&P, NASDAQ very much in the red. 53 minutes to go until we wrap things up. On track for another losing week. On track for the 5th losing week in a row for the S&P 500 index. The NASDAQ 100 index moves into correction territory. Oil rallies, stocks sell off. That sums it up. But the S&P right now down 1.6%. Dow Industrials down 1.7%, down 783 points on the Dow. The S&P at 63.72 right now. NASDAQ down 2.1%. Again, session lows. NASDAQ 100 index down 1.9%. The VIX now above 31 with a 10-year 4.44%. The 2-year ahead of the weekend 3.91%. Spot gold up 3%, 45.08 the ounce, and West Texas Intermediate crude above $99 a barrel, up 5.2%. Barrel of Brent close to 113 right now, up by 4.4%. Seema Shah is chief global strategist at Principal Global Investors, and on surveillance this morning, she spoke about how markets have been responding to the war with Iran.
I think what we've been seeing in the last couple of weeks is that the bond market has been very, very concerned about the conflict, the potential impact, inflationary pressures, how central banks are going to be responding. Whereas with the equity market, there's certainly been more of a reaction this week, but there has been, I think, a little bit of complacency. So there's something in between. The bond market is saying this is really severe. The equity market has been a little bit more muted.
Again, the 10-year 4.44%. NASDAQ 100 index in correction territory. Oil higher. Oil majors also advancing. ExxonMobil up now by 3%. Chevron up 1.6%. ConocoPhillips up by 0.8%. I'm Charlie Pellet, and Tim and Isabel. That is a Bloomberg Business Flash.
Thank you so much for that, Charlie. Again, we're looking at a market that's kind of morphing into this one big full-blown rout. We're looking at a NASDAQ that's falling around 1.7%, that's sinking into correction territory. The S&P 500 capping its longest losing streak since 2022. Bonds are down, pushing the benchmark 30-year yield towards 5%. And Bitcoin, Tim, you have a Bitcoin show, so we have to talk about Bitcoin.
I haven't even talked about Bitcoin yet. What's it doing?
It has dropped to about half its pre-war peak. So Bitcoin is really struggling right now. This is why it's facing an existential crisis. It's now 65,000.
Okay.
Because what is it really? A risk asset, a haven? I mean, I don't want to get hate out there, but To join us to help make sense out of all of this is Eric Weiner. He is senior editor at the equities team in Bloomberg News. So, Eric, in all your years of doing this, how do you make sense of the market today? What is the big driver?
Oh, this feels like an inflation trade. This is, well, I mean, because everything you guys were just talking about, people feeling abandoned by the president. And yes, it's the war. But really, when he talked about what he was going to do, he was going to get prices down on day one. And inflation is still here. Yeah. And it's not just oil. Obviously, WTI approaching 100, that's serious, but it's everything. So it's hitting technology, it's hitting consumer products. Everything that has a supply chain gets wailed on in this situation.
But Eric, is this the type of thing that is like a redux of 2022, or is this more short-lived? Because and not just redux of 2022, but a redux of post-COVID inflation, where that was really sticky, and for a lot of us, including me, it was sort of the first time as an adult experiencing inflation in the way that it just ruins purchasing power. Is this different? Because if the Strait of Hormuz opens up, doesn't that mean oil prices go down?
It should. Well, absolutely.
When the Strait of Hormuz opens up,
it should. The question is how open. The variability of attacks in the Gulf of Hormuz, in the Strait of Hormuz, was not on the radar until a month ago. So this wasn't something that we were factoring in as a risk. Now it's a risk. Now, it's interesting you point back to 2022, because if you look at the S&P, it's heading for its worst month since September 2022. And that's really the last month of declines before the bear market takes off. That is the end of that whole inflation freakout, which was real. I mean, it came out of COVID, and then it was going to have to be controlled. You went through the Powell, is it transient, is it not? And then it's not, so we're going to have to raise rates incredibly high, and they fought it off, brought it back down. But that is a whole process. They're not looking at that right now. You're not talking about, you don't have, the Fed is talking about, we may have to raise rates, or we may hold steady for a while. Nobody is saying, okay, we're going to be on a series of 75 basis point increases over the next, series of meetings. So the risk is definitely muted. However, when you have these kinds of pressures, you don't know when they're going to abate, and you don't know how they're going to flow through the whole system. That's really the systemic concern, which is that it's going to pop up over here, it's going to show up over there, and a bunch of different things will be taken out, possibly inadvertently, but a bunch of things will be hit.
So where do we go from here? Because everywhere you look, it's looking very grim. We have central bankers who are thinking of cutting, now thinking of hiking. And then oil, I mean, who knows? It's like triple digits now. And then even OECD, they ramped up their inflation expectations for this year and next year. I mean, what are you hearing?
Well, so what people are doing is a few things. They're definitely chasing utilities, which have dividends. So you start looking for where the money is. So we were talking about gold a couple of different times, and gold has caught a bid today, oddly enough. It's having actually a really good day, first good day in a couple of weeks. So, that is a bit of a store of value, but really what you look at is bonds. You look at different equity plays where you can get safety, so things that people need, consumer products that are staples, that kind of thing. What you flee is any sort of risk, and risk is at the top end of the market. So you're talking about the big tech stocks, you're talking about the big consumer stocks. Anything that requires a lot of capital to be poured in is in question right now.
Go ahead, Isabel.
We have Goldman Sachs trading desk warning investors not to turn bearish on stocks. But I have a lot of portfolio managers telling me that they've decreased exposure to U.S. equities because, things aren't looking that amazing.
So it's interesting. We were having this conversation just earlier on the desk.
I was eavesdropping.
Yeah, well, so the positioning idea that you should get into stocks right now carefully, but get into stocks right now, is pretty widespread among the different trading desks offering. JP Morgan had a similar, Andrew Tyler had a similar take along those lines. I don't know that I would have the guts to do that. So, and what they're talking about is valuation. So, like, if the market is down, 10% in a month or so, well, that's going to create value. We were talking about Facebook or Meta earlier. The thing's off 20%, this month. At what point do you buy?
More than 30% from its August highs.
It's amazing. It's absolutely amazing.
What is happening?
Well, with that specific stock.
Well, but Microsoft set for its worst quarter since 2008.
Yep.
Like the Mag 7 under some serious pressure.
So Microsoft is getting wailed on because of both of them are mixed messages. So you have Microsoft spending a ton and software being at risk from AI. So they're building out AI, but at the same time, the fear is that their products could be replaced by AI agents. You look at Meta, and it's like, they're spending a ton on building out AI, yet they're walking away from the metaverse.
That was a mistake.
Yes.
Like they let go of people over the past few years. They kind of shut the door on it. It seems like at least this week with laying some people off.
They're cutting off the headsets. And the thing is that what that does is then that questions management's ability to assess spending, because they went after the metaverse, and at the time people were laughing, and now nobody's laughing. They're just more crying. But if you look at like where they are, the question is, and then there's also those lawsuits. So the question is, should they be down 20%? And if you don't think so, you buy. That's where like these individual places where where traders are advising you, you may want to step in. That's where, if you have conviction, you step in.
I will just point out, Isabel, real quick, the Meta out this week rewarded top executives, the New York Times, saying that the executives can buy additional Meta stock if the company hits certain growth targets. So some, Boz could get as much as $920 million worth of stock as a result of this new program.
What about, do we have time for one more question?
Very quickly.
What about hyperscalers? I was talking to a PM again yesterday, and he was saying he's still bullish on hyperscalers because even with oil and inflation, people are still going to invest in hyperscalers.
So the hyperscaler thing is a long-term trend. That, like, you have to believe that these guys are going to make the right call over a year. So that's, if you buy that, you buy those stocks because they're cheap right now.
That's a fair point.
Eric Weiner, we always love it when you join us. We always want to keep you forever. He oversees the equities team for U.S. equities here at Bloomberg News. Coming up next on Bloomberg Business Week Daily, we're going to Texas. That's next on Bloomberg.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks in the red, the Dow, the S&P, NASDAQ, all lower right now. We are on track for our 5th week of declines on the S&P. Right now, we got the index down 101, drop there of 1.6%. A slight bounce off the bottom, but still a drop of 102 points on the S&P. The Dow Jones Industrial Average down 753 points, with the Dow right now down 1.6%. NASDAQ is down 2%, while the NASDAQ 100 index is now in correction territory with a decline of 1.8%. The 10-year 4.43%, the 2-year 3.91%, and a VIX Wall Street Sphere gauge above 31. Gold up $145 the ounce, up 3.3%, 45.22 now on the precious metal. West Texas Intermediate crude above $99 a barrel, up 5.1%. Brent 112.60 on Brent. That is a gain of just about 4.3%. Nancy Daoud is private wealth advisor at Ameriprise Financial Services, and on Bloomberg Open Interest this morning, she discussed the Iran war and the market volatility.
The headlines are clearly overwhelming, and the market is grappling with conflicting narratives around the war and what's going to happen. And of course, oil prices are in the driver's seat, and that's what's causing the ups and downs in the markets.
Nancy Daoud of Ameriprise Financial Services. Again, the Dow, the S&P, NASDAQ, all in the red. Cruise lines sailing lower right now after earnings this morning from Carnival Corp. Carnival down 5.8%. Among rivals, Royal Caribbean is down 4.1%. Norwegian Cruise Line Holdings down by 7%. Recapping, S&P down 1.5%. NASDAQ 100 index in a correction. West Texas Intermediate crude 99.23 a barrel. I'm Charlie Pellet. Tim and Isabel, that is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. Do appreciate it. We've been talking a lot about the war in Iran and the effect on markets. You just heard there the sell-off that we're seeing from Charlie. But what is it doing inside the Republican Party? Because President Trump campaigned on not starting any new wars. Well, for a view on that, let's bring in Joe Lovinger. He's a Bloomberg Texas reporter. He joins us from Dallas. Joe, you were at the biggest annual political conference for American conservatives, CPAC. President wasn't there. You and our colleague Jeff spoke to some folks who were there. What was the takeaway about how this is emanating through the Republican Party?
Thanks for having me. Normally CPAC is a time of unity in the Republican Party. In recent years, President Trump has made sure to come by and tout his agenda, talk about his successes. And this year, don't get me wrong, there was still a lot of love for President Trump, but we were starting to see some cracks in the MAGA coalition, specifically around the Iran war. Now, some of the people that I spoke to were still in favor of the president. They think that he's handling this well and that the Iranian regime needs to go. But some folks I spoke with are concerned. They feel that this war was unprovoked and that, it's a veering away from Trump's campaign promises to focus on America first. One woman I spoke with said that, she feels that if we had been attacked by Iran, that would be one thing, but that, short of that, we really should be focusing on tackling domestic issues, things like homelessness, veterans affairs. So some people are starting to show some signs of frustration with this. And along with that goes frustration over the cost of living. This event was held at a big convention center outside of Dallas, sort of a 40-minute drive away. Everyone had to drive there. Everyone had to fill up at the gas pump before. And gas prices are averaging around $4 a gallon. That's something that really did frustrate some voters. So don't get me wrong. Again, this is something that largely the coalition is still in favor of President Trump. They're still behind him. But we're starting to see some concerns over this war.
I mean, no administration and no president is certainly perfect, but how would you rate the frustration in this? Because it sounds like there were a lot. I mean, relative to the others that you've been to or our colleagues have been to, is it really directed just towards the war or other issues also, like, I don't know, inflation or increasing prices in groceries and oil?
I think it's all wrapped into the criticism of this war. I think that the people I spoke with are concerned that this administration is kind of taking its eye off the ball by focusing on this war. There were some that I spoke with that said that, we need to be focused on lowering the cost of living. And instead, they feel that by starting this war, they might also be putting control of Congress up in the air. There's one gentleman I spoke with who said that he's concerned that, by going into this war with Iran, President Trump might specifically turn off young male voters who helped push him over the top in 2024, partially by promising not to start any foreign conflicts. This man said that he's concerned that now those voters, they might not vote for Democrats, but they also might just stay home rather than come out and support other Republican candidates on the ballot in November.
And from here, what were your big takeaways moving forward? Is there anything that struck you when you talked to these folks? Because you had a ton of great anecdotes and a ton of photos actually in this story, and I urge our listeners and viewers to read it.
Thank you. Yeah, I think that, my takeaway from this is that if this war continues to drag on, we'll only see these fractures expand. There was a straw poll at one of the booths where people could kind of put a bean in a jar if they support the war and a bean in a different jar if they're against the war. And it was about 2-1 in favor of the war. But there were a lot of people who I saw hovering over both jars. They weren't quite sure how they felt. And if we continue to see gas prices increase, we continue to see inflation in other areas of the economy that are affected by oil prices. We could see a world in which the people who influence opinion in the conservative world, Tucker Carlson, Megyn Kelly, they've already come out and said that they feel that this war was something that the U.S. was dragged into by Israel. We've seen, other folks say that, the administration shouldn't be focused on it. And I think that if the war drags on and we see the costs continue to mount, there will be more people like those that I spoke with yesterday who just think that this is not the right use of time and energy for the country.
Hey, Joe, you brought up Megyn Kelly, Tucker Carlson, and there's also something happening here with Israel, and it's also it's really sensitive. So I want to be sensitive about the way I bring this up. Yeah. But there's this element of anti-Semitism or accusations of anti-Semitism within the party. I want to separate that from support of Israel because I think those are certainly two different things. I think a lot of people would agree with me about that. What was the sense that you got there about how those two issues or two things are part of the party right now?
Yeah, it's a difficult issue. I think that, we've heard, candidates from both sides of the aisle criticize the Israeli government over its policy in this war, over the war in Gaza. And none of the people I spoke with, to be clear, said anything, along the lines of, what I would call anti-Semitic. I do think that there are, we've seen some other sort of far-right influencers, people like Nick Fuentes, who is, openly anti-Semitic, who are trying to, I think, maybe seize on this as an opportunity to make their case. But the people I spoke with, again, they were, frustrated with what they view as, the Israeli government being able to kind of drag the U.S. into this war. And again, I can't speak on, what the motivations are to that, but, it's certainly a factor in this debate.
Beyond this event, in your coverage as a Texas reporter, what is the sense you're getting from the region? We know that majority voted for President Trump, and we have Pew Research Center polling shows some 69% of Republicans and people who lean Republican approve of his handling of the war. So that's kind of a disconnect from the anecdotal evidence we are seeing.
Yeah, and I would say again, I think the spirit at CPAC this year was still overwhelmingly in favor of President Trump. There were people walking around in sparkly gold blazers saying Texas Trump team.
That was a great photo, yeah.
Yeah, and the president is definitely still popular here, but I do think that especially as we look towards the midterms, there are going to be some storylines that we're keeping an eye on in Texas. One is, will Latino voters, particularly in majority Hispanic districts along the Texas-Mexico border, vote for President Trump? We saw them flip to support the Republicans in 2024, and the new congressional maps that were drawn last year, they rely on continued Latino support for the Republican Party for the GOP to pick up as many as 5 new seats, which is what they were designed to do. We've seen some signs since those maps were passed that indicate that Latino voters in Texas have started to shift back towards the Democratic Party. So we'll be keeping an eye on those border districts. We'll be keeping an eye on the Senate race where the Republicans are, in sort of a traditional Bush-style Republican versus a newer kind of conservative. They have a primary going on. The Democrats have a candidate who they feel can raise a lot of money and who might be able to appeal across the aisle. So the Senate race will be very interesting here. There's a lot to watch in Texas politics this year.
Joe, how quickly do things or could things change? Nishan Zano, Bloomberg contributor on Balance of Power earlier, was sharing some recent polling that showed the president's in a pretty precarious place. Of course, he's not up for re-election, but his party certainly is come November. If the war gets figured out, if prices come down, I don't want to say prices come down, if the inflation moderates, could that mean big success at the polls in November for Republicans?
I think this battle is still the Republicans to lose in Texas. I think, Republicans control the governor's mansion. They control both houses of our legislature. This is Texas, after all. It would be a real surprise if a Democrat can win a statewide election in Texas. But if you look back to the last Trump presidency midterm in 2018, that was when Beto O'Rourke came within 3 points of unseating Ted Cruz for the Senate. We're seeing a lot of the same signals that we could have seen in 2018 leading up to the midterms that suggested that voters were frustrated with the Republican Party. They were frustrated with what they saw as chaos from the administration. You could very easily make the case that this war is an example of the same. And I think that, coming into November, who's to say what would happen if inflation slows, like you said, but the Democrats in the state that I've spoken with are very enthusiastic about their chances because of all of these factors that resemble what they saw in 2018 when they did make a lot of strides down the ballot, even though, of course, Beto O'Rourke didn't end up winning the Senate seat. He definitely helped a lot of the down ballot candidates on the Democratic Party.
Joe's a great story, and we appreciate you joining us on all things CPAC, Texas politics, and more. Joe Lovinger, Texas reporter for Bloomberg News. He, along with Jeff Mason, wrote a must-read on the Bloomberg terminal. The MAGA divide over Iran spills into CPAC, where some blame Israel. Isabel, you are watching markets and the sell-off that we're in the midst of. What are you seeing on the terminal right now?
I think what we're seeing is really, I can't get my eyes off of the NASDAQ 100. It entered correction territory. S&P is on track for its longest stretch of losses in 4 years. 4 years ago, we were just recovering from the pandemic. That was 2022, if my math is correct. And of course, Dow Jones. Who talks about Dow Jones? I don't really talk about the Dow Jones, but it's on track to close in correction territory as well. It's down by 1.7. Do you like the Dow?
Listen, it's not my job to like an index or not like it. Okay, I'm going to report on it.
Fair, sure.
I think the criticism that it gets, that it's a price-weighted index, makes a lot of sense. So, that's why people refer to the S&P more. The S&P, not at session lows, just off of session lows, down 1.5%. So far this year, though, down 6.8%. The NASDAQ Composite, you mentioned the NASDAQ 100. The NASDAQ Composite down just around 2% right now. The Dow down 1.6%. I want to bring in Bailey Lipschultz, Bloomberg News senior equities reporter. Bailey, sell-off like we're seeing right now, not quite at session lows, but hovering around them, at least on the S&P 500, a superlative that Isabel and I keep going back to, the NASDAQ 100 in correction territory. Eric Weiner talked a lot about how this was inflation-driven. What is your view of the sell-off?
I think it is inflation-driven. I think when I talk to sources, it's uncertainty around the ultimate knock-on effects is every week that we have this Strait of Hormuz closed, not only are you not having oil flow, but the knock-on effects of jet prices, fertilizers being stuck. When I talk to people in the supply chain industry, the cost to ship and move goods and also the uncertainty around if those goods are going to show up on time has been top of mind. Ultimately, that will work its way through costs. We've seen really kind of a complete flip, if you will, when we look at what swaps are showing in terms of the Fed, not really marching towards hiking, but certainly cuts at least being completely priced out with the kind of dipping the toe in the water potentially on a hike at some point this year. Again, I haven't talked to many investors at all who say that that's realistic. And also, Tim, I just want to go ahead and point out things that we know to be true and are kind of the main points that investors make. One, markets do not like uncertainty. It's hard to say that anything is certain right now. And two, markets and investors don't really like being long over the weekend when no one knows what's going to happen over a 72-hour stretch.
And Bailey, you're our preeminent IPO reporter. You've broken a lot of news.
Oh, that news last night? The Anthropic
I was in the
news?
office after 8 o'clock. I'm loving life.
I try not to use my phone at night, and then Bailey does stories like this Anthropic IPO story that gets a push alert. And I got to read it. I see his byline right there. Congrats on that big scoop, Bailey. That was huge. Sorry,
Yes,
Isabel, I
exactly.
interrupt.
No, not at all. I mean, that was exactly my point. Like, what are you hearing from your sources? It's definitely not an ideal environment for the market for them to go public.
No, I mean, the main thing to keep in mind is, so what we reported is that Anthropic could go public as soon as October. They're in preliminary conversations with bankers. They're, as far as we know, kind of racing against OpenAI, looking along that similar time frame. The two things to keep in mind is, one, we've reported that SpaceX is expected and trying to go public as soon as June. So that's a much more near-term event that could raise magnitudes more in a single deal. And the second thing, just to keep in mind, is that these are processes that can take quite some time and can be delayed easily without actually blaming the market. So as much concern and uncertainty as there has been top of mind in March, June a completely different picture for SpaceX. Obviously, come October, we'll be heading into midterms. The market dynamic and the geopolitical backdrop could look quite different. But according to the bankers we talked to, it's relatively full steam ahead for all three of those companies trying to tap the market, again, amid the uncertainty, amid the volatility that we've been seeing, partly because they view these as unique companies, unique assets, and then also just given the fact that we are in a very different situation now than we were at the end of the year. And when you look 3 months from now, or 6 months from now, 7 months from now, it's anyone's guess what the market will look like.
Yeah, on that, Bailey, the idea of IPOs and being first out of the gate, OpenAI versus Anthropic, does that matter?
If you talk to bankers, it does matter. And if you talk to investors, they both have their own kind of puts and takes. Obviously, Anthropic has been going back and forth with the U.S. government. There's a lot of questions around kind of the funding model and the cash burn as it relates to OpenAI in particular and their valuation. A lot of bankers will compare it to Uber versus Lyft, and that was an interesting race to watch who went out first. And obviously, Uber has been markedly better as an investment from the IPO relative to Lyft, and that's the closest parallel people can point to.
And Uber was first.
Yeah.
Okay, sorry. But go ahead.
Sorry.
Yeah, I was just going to say they're very different businesses, though, and like and same. You could say the same thing about OpenAI and Anthropic. They have different businesses too, but yeah, it's just the idea of a race. I mean, I guess it makes sense that bankers want it because they want the money, but like the sooner they can get it, the better. But from an investment perspective, like I was there for the Uber IPO, and I'm like, do I even remember which one went first? I don't know.
Well, I think the thing, Tim, you got to keep in mind is, as we've reported, the only company we've reported firm potential numbers on in terms of the IPO size is SpaceX, and that they could be looking to raise $70 to $75 billion. Again, that's more than each of the last 4 years in totality that was raised in the U.S. And so when you take that as an exogenous event in June, and then you pair Anthropic and OpenAI, who are expected to raise, or presumably you could use like napkin math and say tens of billions of dollars each, then all of a sudden you're asking the question of how much capacity does the market have? How many checks can investors reasonably write that are, $1, $2, $3, $5 billion to an individual company to get in, maybe that they've been invested in through their private funds. So I think the big thing when you look at timing and trying to be the first out the gate, yes, these are companies that are not completely identical, but also there is a limit to the capital in this world, as much as we like to talk about money moving from the sidelines. So if investors are forced to sell publicly listed companies to buy SpaceX and then turn around and do it all over again for the next company, at some point that math gets a little bit harder, or at least more difficult to justify.
Bailey, don't go far, because we might call you back in just a few minutes with the sell-off that we're seeing right now. Bailey Lipschultz, he is senior equities reporter for Bloomberg News. Just take a look at what markets are doing, and we're going to get a bigger update from Charlie Pellet in just a minute. We are at our lows of the session. The S&P 500 down about 1.7%, seeing some selling into the close. Let's head things on over to Charlie Pellet for a more detailed look. He's standing by in the Bloomberg Interactive Brokers studios. Hey, Charlie.
Well, hello there, Tim. More than 800 points to the downside on the Dow. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Stocks selling off, 19 minutes to go. Let's head right over to the first word breaking news desk for today's afternoon call. Here is Bill Maloney.
And good afternoon, Charlie. It's another ugly day for U.S. stocks, with the Dow currently down 829 points. The S&Ps are down 1.7%, and the NASDAQ, that's sinking by 2.2%. The U.S. 10-year yield is at 4.44. Gold and oil are surging, but Bitcoin, that's sinking by 4.5%. Among the main 11 S&P sectors, leaders were energy and consumer staples. Consumer discretionary and the financials were under pressure. And leaders to the upside in the Dow, Chevron and Coca-Cola, while UNH fell 3.7% and led to the downside. In deal news, Citigroup is said to consider buying a U.S. regional bank. And in the tech space, Google nears a deal to help finance Anthropic's data center. Wrapping things up, Rubio tells allies the war will continue for 2 to 4 more weeks. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much. Have a great weekend, Bill Maloney. And to hear live breaking news over your Bloomberg, type squawk SQUA on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Daddy, can I drive?
Yeah, sure, why not?
Do I look like I drive a minivan?
Shut up and drive.
Don't drive angry. Don't drive angry.
I'll drive. Shotgun.
This is the drive to the close.
If you had access to a car like this, would you take it back right away?
On Bloomberg Radio.
Markets remain at the mercy of one headline after the other. It's really been a crazy Friday, a crazy week, actually. We have the NASDAQ entering correction territory, and the Dow is on track for that. We have the S&P down by roughly 1%, down at session lows. It's really a lot of things to digest. We have oil surging triple digits. Even VIX is up some 30 handle, Tim, which we haven't seen in a while. And to help us make sense of all of that, we bring in Mark Lucchini, Chief Investment Strategist, President, and Chief Investment Officer of Janney Capital Management. Thank you so much for joining us, Mark. In a climate like this, how are you advising your clients to position themselves? Have you shifted any asset allocation since the onset of the war?
Isabella, we really haven't made any measured shifts in our asset allocation decisions. I think it's really difficult at the moment to have a high conviction in doing anything other than staying the course, which is an old saw, doesn't lend itself to any exciting movements one way or another directionally. But right now it seems as though equity prices are trying to probe for a bottom, which remains elusive. And at the same time, the safety that you would normally find in bond prices isn't working, obviously, because of the inflationary pressures that are being parted on yields. And so as a consequence, until we have some visibility with regard to either a potential diplomatic outcome with regard to the conflict in Iran, or perhaps some movement of vessels through the Strait of Hormuz, we're really looking to, see opportunities that may emerge as a consequence of the sell-off. As you said, certain broader indices are already in correction territory. Certainly certain sectors of the S&P 500 are already in correction territory, giving us some very appetizing looks at stocks we haven't seen at these valuations in some time, but at the same point, not believing that perhaps we've seen a durable bottom.
Mark, Facebook, Meta Platforms, down more than 30% from its August highs. Are there bargains out there right now?
Well, I think we're certainly coming close to seeing that, Tim. I mean, obviously, in the case of Meta, it's a somewhat idiosyncratic event related to obviously the social media settlement that we have seen in the headlines and in the press. And so, as a consequence, I think that circumstance is yet to completely resolve, and its fluidity is going to continue to keep some volatility in the share price of that stock. But look at others that are being sold off indiscriminately in the space, whether you're talking about Alphabet or even the technology sector or tech adjacent companies in areas like consumer discretionary. And so I think we're getting to the point where valuations are coming in. I mean, if you look at the aggregate S&P 500, well, hardly one could declare cheap at this juncture. It's now trading at about 20 times what's expected to be earnings for 2026. And I know, obviously, those are being jeopardized by how oil prices are going to evolve here over the coming weeks and or months. But at the same time, if you do put some faith in their likelihood of being realized, it would imply a forward PE of, again, 20 times, maybe even looking into 2027, something less than that. And obviously, even subcomponents of the market looking even cheaper than that. So on balance, I do think one needs to be preparing their shopping list for opportunities to begin to leg into, perhaps if we can find a point at which, like I said, we can see some visibility that would allow for the market to put in a more durable bottom, which I think we've yet to find yet, even at levels now down some 7% on headline S&P 500 or more from the peak from late January of 7,002 on an intraday basis.
We're seeing parts of the markets in correction territory. The NASDAQ is one of them. Do you think this is just a healthy reset, or is it the start of something more serious? And are you still constructive with regards to your equities view?
Isabel, we're still constructive. Right now, at least, the fundamentals remain pretty well intact. We still see sturdy economic conditions. The New York Federal Reserve's Nowcast just posted its update for Q1 GDP activity, and it's coming in at 2.1%. And the Atlanta Fed's kind of affirming the same number in the terms of their GDP Now tracker. And some of the other data we've gotten from the S&P Global Manufacturing and Services surveys are still in expansionary territory, and jobs claims remain near historic lows. So there's, I think, myriad reasons to believe that the fundamentals haven't deteriorated to the point that we need to sacrifice our conviction that the fundamentals ought to continue to support an environment where equity prices can resume their advance once some of this uncertainty recedes. So as a consequence, I think of this pullback in equity prices as something investors should treat for the moment as normal and customary, given the fact that so many times on occasion over the last 30 or 40 years, we've experienced drawdowns on an inter-year basis of about 14%, only to see that the annualized rate of return for the market over the last 45 years has been 10%.
Yeah,
so
I'm glad you're saying that, Mark. I mean, that's always where my head goes, because if you look at, the pullbacks, they seem dramatic in the moment, especially when you're used to a bull market. But look, the historical context is a few of these per year even are normal, right?
Well, absolutely. I mean, again, I think we can be victimized by the cognitive biases, known as recency, in looking at the returns that have been generated from the S&P 500 over the last couple of years. We had 2 consecutive years of better than 20% returns. You'd have to go back to the mid-1990s to remember a period like that, followed on last year with a 16% price-only return. Yeah. So, investors have become sort of conditioned to believe that stock prices only go up almost in a linear fashion, and that's hardly been the case historically speaking. So again,
Mark,
things being
gonna have to
right
leave it there. Mark Lucchini at Janney Capital Management.
This is Bloomberg Business Week Daily with Carol Masser, Bloomberg Radio.
It is Bloomberg Business Week Daily. That's Isabel Lee from our Bloomberg News cross-asset team. Carol Masser is out, and we are lucky Isabel Lee is here on a day where assets across markets are getting crushed. Isabel, what are you seeing on the screen?